A much weaker performance in North America, this from the French tyre maker, so we'll watch that one in Paris. And really fascinated to see what we see happen to basic resources this morning. Iron ore prices down by 2.5%, steel down by nearly 1%, this all through the Asia session. And we've got weakness now for a change in silver prices, Guy, and given some of the silver miners went up by nearly 10% yesterday, we watch that sector.
Yeah, is Fresnillo going to be on my 52-week high list today? That's what we're all waiting for, a hard pass, isn't it? I know. OK, here we go. Here's the market open. This is what we are seeing. We're anticipating a quite negative story. You've got the IBEX down by 0.4%. The FTSE 100, in some ways, is going to be interesting today, in as much as you do have that mining narrative that I think is worth paying attention to, and I think that may protect it a little bit. It's going to be interesting to see how the oil trade works its way through, though, once we get BP and some of the other oil traders open as well. But yeah, now falling in line with, I think, probably more what we would have anticipated. But the 600 is down by 0.6%. That's pretty much in line. 6, 7, 0.8%, I think, is what futures were basically pointing to us to this morning. It's going to be interesting to see what happens stateside a little bit later on. Remember, you've got Powell coming up, as he points out, at 5:20. Is he going to ride to the rescue, signalling rate cuts and everything's going to be fine? We'll wait and see what that narrative looks like later. But here we go. European stocks are down. Yesterday, the bounce that we got didn't feel convincing, and I think we have probably confirmation of that this morning. Lizzie, sectors, single stocks, what are we watching?
3/4 of sectors in negative territory this morning. As you suggest, you've got basic resources at the bottom of the basket. They're down 1.3%. Energy, somewhere in the middle there, down 0.2%. BP itself down 1.5%. And Fresnillo, not going to be on that list today at 8:30, Guy. It's down 1.9% off the back of these gold moves as well. Just some of those individual stock stories that I was flagging. Publicis had those great results, actually, because they raised their growth outlook, because of the strong ads and the AI demand. But actually, those shares on the CAC down 0.6%. So really, this risk-off mood penetrating many of the sectors this morning.
Yeah, we seem uncertain about a lot of things, don't we, this morning? So basic resources on the back foot, partly because all the sort of frothy precious metal trades have rolled over a little bit. We're flat on the gold price. The silver price is down by over 1%. We're taking a pause for breath there, maybe. But then there's the more fundamental side with iron ore and copper and what's happening there on the back of the China-US trade tensions. They're weakening, and so all of that adds up to a sort of negative mess for basic resources, and that sector down by 2.3%. And where do we find solace, Guy? Well, it seems in consumer goods. That's where we find solace this morning. Unilever, Tesco, low-value consumer goods.
Safety.
Yes, I was going to say ice cream, and then I couldn't remember whether that still included ice cream. But anyway.
It's in the process of melting or being spun out. I'm not sure there's an ice cream joke there. Bellway is up this morning in the house building sector, which I think is interesting. It's out with a statement this morning. In terms of what else you are getting, Givaudan is rising on the back of what it has to say in terms of the fragrances and flavours business that it works in, which maybe takes us back towards that safety trade. Nokia's up as well. I'm trying to see where Ericsson is, but Nokia is tracking a little bit higher. Kind of feels like a bit of a reversal of some of the other stories that we've been watching over the last few days. Some of the car stocks are coming back a little bit. They've been badly beaten up. So as you point out, Anna, I think it feels like a market that is rotating towards safety.
Well, let's get some analysis now. Joining us around the desk, I'm pleased to say, is Kate Moore, Chief Investment Officer for Citi Wealth. Good to have you in London.
Yeah, it's wonderful to be here.
I want to take the temperature. So today, we all came in optimistic, and yet we have European equities all in the red and US futures also pointing lower. NASDAQ futures down more than 1% at the moment. Yeah. It's looking like what we saw earlier in the week wasn't just a blip. I'm wondering, is it Liberation Day in slow-mo? How do you characterize the tariff threat's impact on these markets?
Yeah, so I think there are a few things to keep in mind here. Of course, we're kicking off U.S. earnings, the large cap earnings in earnest today with a bunch of the banks, and that's going to be really important for sentiment. So I think from an investor's perspective, everyone is very, very focused on the guidance and the commentary from U.S. management teams, especially since we've continued to reach new all-time highs, what felt like on a daily basis over the course of 2025. So I think that's important in weighing on sentiment, and people are in a wait-and-see mode, perhaps take a little profits. But the tariff side is really important. And I've been saying for the duration of 2025, or at least since the April 2nd tariff announcements, that we are past perhaps tariff shock, but not past tariff pain. And I think that the President of the United States will continue to use tariffs as a negotiating tactic with all of our trade partners. We saw this, of course, with China on Friday. It is not going to be off the table for the duration of this administration.
Yeah, and I mean, there's so much focus on those earnings in the absence of government data because of the US government shutdown. But I wonder, on the tariff point, is it too soon for clarity on the impact of tariffs on companies' bottom line, given that, as you say, the US-China tariff spat is ongoing?
Yeah, so this is what I will say. This is where taking alternative data into your process is even more important than ever, because some of the official data doesn't tell the true story. And one piece of data I've been anchoring to has come from a Harvard Business School study. There's been kind of a scraping they do of the internet and like looking at all these major US retailers and kind of saying what's happening to prices. And for many of the imported goods, the prices have risen sharply over the course of the beginning of October, even as we haven't had official economic data. So I'm watching these third-party data, which is indicating basically that inflation is percolating once again. And I think that'll make the decision for the Fed that much harder as we go through the fall.
You talk about tariffs, and it seems timely to linger on that conversation a little bit, Kate, given we've had this news flow overnight, which once again catches our eye around China, the United States. So you draw a distinction between the shock and the pain.
Yes.
Is the pain less when there's no shock? I'm trying to work out whether we have a sort of reduced reaction function to tariff headlines.
This is what I will say. We actually had this conversation last week on the team with some of our counterparts on the street, et cetera. People were just not talking about tariffs at all. I was trying to get a pulse of, all the traders and everyone's in the markets business, and they were saying no client really wants to even talk about tariffs. They're thinking it is, in the past. And of course, this comes up on Friday, reminding everyone it's not just in the past, it's in the present and potentially in the future. So I think there was complacency around the impact that tariffs could have on overall activity and on price levels.
Yeah.
And I think we're likely to see some impact, especially at the low-end consumer in the U.S., of higher prices into the back end of this year.
Yeah, and so when you talk to wealth clients then, when you get the temperature of what they're thinking, do they feel the need to protect themselves right now from either tariffs or, maybe AI bubbles bursting? And if they do, where do they go? We had a great conversation with Evie Hambro from BlackRock earlier. Yes. His view is the rally in metals is all about fiat currencies being on the wane. I mean, is that the conversation amongst wealth clients?
So I would say throughout the course of this year, there have been lots of concerns our clients have expressed. In general, they've seen markets at new all-time highs consistently, especially since the April lows. They've looked at, inflation percolating not just in the U.S., but everywhere else. Geopolitical tensions on the rise, notwithstanding what happened over the weekend in the Middle East. And I think it's made people a little bit anxious. The dollar weakening and emerging market equities all happening at the same time is kind of tearing people in two different directions. So our clients have wanted to do a number of different things. Number one, they wanted to really kind of rethink their dollar exposures. I think that makes a huge amount of sense in this environment. Number two, they want to stay geared to the AI trade, but they want to do it in a kind of more cautious way because they're afraid of being all in and having a very concentrated exposure and then perhaps getting some news flow that suggests the AI spending and infrastructure build out is slowing and then, taking that on the chin. And then they're having a lot of conversations with us about what they want to do in fixed income because long duration bonds anywhere in the world don't look very attractive. And we've been shorter duration like everyone else on the street, but people are getting uncomfortable with that concentrated position.
Okay. I'm trying to put it all together.
That was a lot.
There was a lot. So I'm just like, let's kind of Powell speaking at 5:20 today.
Yes.
Is he going to tell? If he's listening to Kate Moore this morning, it sounds like he's going to be going, yeah, I'm not quite sure I want to be cutting rates right now because inflation's coming back.
I don't think it's a slam dunk, to be honest with you. I mean, I think the Fed is going to have to continue to show that it is data dependent, assuming that we get government data in advance of them making decisions, and that they will have to continue to be disciplined about assessing the current environment and adjusting their forecasts. At this point, I don't think an October rate cut is a slam dunk.
What are the implications for equity markets if that's the case?
I think there are parts of the equity market that are banking on consistent, every single meeting, a rate cut. So we could see some indigestion, let's call that.
That's a very polite word.
Yeah. Thank you. Thank you. I've had enough tea this morning to remember to use my polite words.
Took you a while to work that one out, but it was.
Yeah.
What does indigestion look like?
I think indigestion looks like some of the rate-sensitive stocks are those that have benefited the most from expectations of a consistent rate-cutting cycle may cool a little bit. And like the U.S. labor market has been frozen, but it's not deteriorating rapidly. And the inflation story percolating makes it hard for the Fed.
Which is the bigger threat to my portfolio right now, inflation or growth?
I think inflation.
Okay, that's interesting.
Yeah, I think
because people aren't talking about that. People are definitely focused on growth.
Yes.
There's, like,
we don't see a significant deceleration in economic growth at this point. A cooling in economic growth next year, but not a deceleration that's scarier. Nothing close to a recession. Not in the U.S., not in Europe, not in the UK. That's not our base case. That said, of course, there are things that could shock the system, and we'll be watching the data very closely. But I'm more worried about inflation having an impact. When we get the data, I'm more worried about inflation having a greater impact, particularly on lower-end consumers. The high-end consumer can't continue to hold up the market forever and ever in all consumption. So,
well, speaking of the data and the lack of it, and the root cause, the government shutdown, I'm looking at Polymarket odds of it going beyond 30 days, 65%.
Yeah.
I do wonder how long it has to go on for that to really knock the stock rally.
Well, what I'm interested to see is what kind of pressure is put on representatives in Congress the longer this goes on. And, you know, the public right now is not screaming. They're not saying anything is wrong with the government shutdown. Most of them don't feel it in their everyday life. But if they get to the airport and their bags don't get screened, or if basic services are not rendered, or if we have government workers calling in sick because they're just tired of not getting paid. Those are things that could really change the pattern and put pressure on representatives. We're not seeing that yet. And so, unfortunately, I understand why the Polymarket odds are extending to a longer and longer shutdown.
But you have got people being laid off instead of furloughed. Is there not a risk that that leaves scarring and actually wobbles your growth outlook?
I think for certain segments that will definitely could potentially have an impact. But what I will say again is the high-end consumer is holding up well. I don't know if they can forever and ever, but at this point, with asset prices higher and people feeling wealthier.
You saw the Delta numbers last week were just like Ed Bastian saying we're good to go here.
And I watched the airlines and these kinds of discretionary spend areas really closely. When there was that whole period where all of the airlines were saying all of the spend or all of the growth was coming from business travel alone, that made me anxious. But now we're getting, you know, more discretionary spend. And frankly, we're getting a little bit more travel from the average consumer. So we'll watch this. Look, here's what I will say. There's a lot for us to focus on going into the end of the year. And there's a lot of reasons for us to stay on our toes, given the fact that markets continue to reach new all-time highs in the U.S. But this earnings season, as I started my commentary with, is going to be really, really important for sentiment. And we'll be watching not just what companies say about what happened in the third quarter, but their expectations not just for fourth quarter, but for next year. And that this is the time for them really to reset.
That sets up my final question, Kate, so nicely. It is about earnings. I was looking at, I think it's a Citi chart, in fact, of earnings and earnings revisions. And it was suggesting the beginning of the year, a lot of earnings revisions to the downside because of around April, the tariff threat. And then since then, we've been ramping up expectations, but now it's sort of flattened. But maybe we're just done and waiting for the detail and the disclosure. So how are we set up going into this? How high are expectations?
Yeah, so I pay very close attention to earnings revision ratios, and I look at not just the 3-month, which is what a lot of people look at, but also the 1 month relative to the 3-month. I think this is critical because we've seen actually 1 month relative to 3 month in every single region weakening going into earnings season. And these revision ratios, remember, are 12-month forward, not just for third quarter reporting or fourth quarter. And, you know, after revising up, after that very negative sentiment at the beginning of the year, people are realizing that growth is going to be okay, but not phenomenal. I would expect that kind of full year 2026 numbers are a little bit too high. Analysts always start off a little too high, and that's why this earnings season kind of resetting from companies is going to be incredibly important. So not catastrophic. We're talking about positive earnings growth, but maybe not as lofty as current estimates stand.
Kate, great to see you.
Yeah, thanks for having me here.
Glad the new gig's going well.
Yeah.
Enjoying it?
Loving it.
Excellent.
Yeah.
That's what we like to hear. Kate Moore, City Wealth CIO. Thank you very much indeed. Let's take a look at the core six this morning, figure out what is happening. This is the picture that we find ourselves with here in Europe. As you can see, there's a fair amount of red on the screen. Remember that LVMH is going to post numbers just after the market closed today. Keep an eye on what is happening there for sentiment in the luxury sector. But you've got a broad-based sell-off happening here. Defensives doing better. Look at Nestle, up by 0.7%. What else do we need to be watching this morning? Some quite big moves. Ericsson is certainly one of them. Chloe, Melly, over to you.
Good morning, guys. So, yeah, a really positive move in Ericsson this morning, up more than 10% on the back of its earnings this morning, and reported a third quarter profit that was that beat estimates, and that was also a massive jump. And that is a lot of that has to do with the sale of its business iConnective. It also struck quite generally optimistic tone and said that it made progress in improving its margins. So this is quite a welcome relief for Ericsson after the weak dollar and then also weak demand for 5G equipment, for telecom equipment, really weighed on the shares over the last few quarters. So a really positive movement for Ericsson this morning. Moving on to a more negative story, and we have got Michelin down at 9% and also dragging down Continental this morning, down 3.5%. Michelin cut its outlook due to really weak sales in North America, and this is something that analysts have said maybe it indicates a broader weakness for that tire market, especially in that region. And so we are seeing a very big downward moves here for that sector. Continental is also refocusing on being a tire-only business, but it seems maybe that was quite a difficult time to be doing that. Moving on to Bellway, the house builder, the UK house builder, it flagged quite weak consumer sentiment, but it launched a £150 million buyback program, and that is being reacted to very positively by the market. It is up 4% this morning for Bellway. And finally, Klépierre, which is a French property management company, was double upgraded this morning by JP Morgan from an underweight rating all the way up to an overweight rating because of prospects brightening for that company. And we are up 1.6% on the back of that upgrade.
Chloe, thank you. Chloe Melly from our equities team with a look at some of those stocks on the move. Coming up, another stock in focus this morning, EasyJet shares on the move this morning on reports. This from Corriere della Sera over in Italy, that a particular suitor might be mulling a bid, even though the report says that they've denied it. But the stock is on the move, up by 6.4%. So we'll get some analysis of that and other things moving the aviation sector. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Tuesday morning, good morning. 20 past, approaching 20 past. Equities are down, and down quite hard, actually, reflecting really what we saw in futures as we've seen effectively the trade war story being repriced back into markets. You see in US futures are down pretty hard. European equity markets are opening down pretty hard as well. Despite this, there's some actually quite big single stock moves today, which are really worth paying attention to. Take a look at what's happening with Ericsson. Shares in EasyJet are also very much on the move this morning, fading an earlier pop, but still up by nearly 7%. There are reports coming out of the Italian daily Corriere della Sera, the Mediterranean Shipping Company, which is domiciled in Ireland, but I think is Greek, is in partnership with an investment firm and potentially taking a look at a bid for EasyJet. Now, this is not something I've heard about being talked about before. EasyJet's being talked about as a takeover target, but not down this route. Benny Camel leads our aviation space coverage and joins us now. What do we make of this?
So far we've not heard from EasyJet, so that would lead us to think that maybe it's not imminent. Normally under takeover panel rules they would have to respond with a statement, so the fact that we've not heard anything so far might suggest that it's not imminent. However, EasyJet is one of those companies, one of those airlines that has sort of been in play for a couple of years. There was a takeover approach in 2021. Bloomberg later wrote that Wizz was in fact the suitor. So this is a company that has sort of been out there. If you listen to people like Michael O'Leary from Ryanair, he keeps saying there will be consolidation in this space. He obviously thinks that his rivals, i.e. Wizz and EasyJet, are the obvious target. So it's not an impossible thing to imagine. The whole sort of take private fantasy is also out there. A lot of companies with cash out there. And then finally, you know, you might be scratching your head a bit. Why would a shipping company want to buy an airline? But MSC have been poking around that space previously. They were part of the original bidding consortium, I should say, with Lufthansa when they bought ITA, the Italian airline. They ultimately dropped out. But again, you can get a sense that this is a company that's sniffing around for potential targets, that's looking at potential companies, and Corriere, I'll have to say, are usually fairly well informed, so who knows, this might actually turn into something.
We'll see. And certainly, and the EasyJet founder, Guy and I were just remembering, has something of a shipping background as well. So that certainly got our attention. Benny, elsewhere in aviation news, we have a story that Airbus is opening a factory in Alabama. What's the impact of that?
The impact really is that Airbus has a problem that a lot of other companies would love to have, which is a huge backlog of aircraft, and they're trying to work through that. This is literally thousands of planes that they have yet to build, and they're expanding their manufacturing footprint. So they're adding another so-called final assembly line in Alabama, in Mobile. They're adding one in Tianjin in China. That gives them 10 production lines in total across the world. The biggest ones are in Toulouse, where the company is based, in southern France. There's a big one in Hamburg, but this really gives them this global footprint, and it helps them churn out the A320 family at a faster clip. That's the plane that really is the most popular one. We're seeing it take off there in the background. And the A321 is the larger version of that, and that's really the plane that everyone is buying right now. That's also a plane that takes a little longer to build. It's a complicated aircraft. So having more production facilities, that's really what Airbus is trying to do here. They want to get to 75 A320 families by 2027. They're some ways off from that right now, but opening up these additional FALs, as they're called, final assembly lines, that's going to help them.
All right, Benny, good to see you. Benedict Camel, thank you very much for that. And staying in the corporate space, but turning to fashion, analysts expect organic sales at LVMH's key fashion leather goods unit to come in lower for the third quarter due to a continued downturn in demand. The owner of Louis Vuitton and Christian Dior reports today after the close of European trading. And for more, we're joined by our Bloomberg opinion columnist, Andrea Felstead. Andrea, good morning. We're looking ahead to these results. Of course, you've got lots of new creative directors at some of the big names, including Christian Dior. I wonder how much that means that they're individual, idiosyncratic stories for the different luxury houses, or whether LVMH is actually going to set the tone for the rest of the sector.
I think there's two things. The good thing about the creative directors is people are talking about fashion and luxury again, and they're not just talking about the price increases. That's been the narrative for the last couple of years. All the prices have gone up, it's too expensive, it's priced people out. Now we've got a fresh discussion about luxury. We don't know what the pricing will be on some of these things, but the fact that it's generating excitement and interest in luxury and fashion once more has got to be a positive.
Yeah, picking up on Lizzie's question, Andrea, is it going to be that we have one, do we look for one narrative to dominate this time around, or do we think there will be, all these different stories popping up from the sector?
I think the one narrative we'll be looking for is have things turn the corner. I was in the States last week. The wealth effect is real. There's a lot of interest in luxury. New stores, the Demna collection for Gucci was in their store in Soho. It does seem to be back, a lot of interest in luxury. What is missing is the China recovery. So I think the narrative will be, are we seeing a recovery? The US is there. Is China coming back? What's the story on China? Within that, you will get issues with you will get discussions of the brands. Really, for LVMH, it's how's Louis Vuitton doing and is Dior recovering?
Just to come back to the US, though, Kate Moore was sitting in that chair just a few minutes ago from Citi, and she's saying we're questioning how long the high-end consumer story can continue in the States. It's related to the stock market, it's related to crypto. Crypto's just had a massive wobble. You talk about it being real. Is it real built on solid foundations or real built on stock market paper wealth, crypto paper wealth?
It's luxury demand in the States tends to be correlated with stock markets. So I think as long as the market stays, then that story will continue.
Crypto wobble? That was a big crypto wobble.
I definitely think that will be an issue, maybe particularly for watches.
Yeah.
But I think it's more the mainstream stock market and that wealth effect. People are looking at their, savings accounts or investment accounts and really seeing that they are very wealthy. And luxury does well when we feel happy and we feel confident.
I've been told I should thank you, Andrea. Thank you very much. I've been told I should thank Anna as well. For some reason, I have no idea.
I'm off to a new energy finance conference.
Oh, right.
I'll be back tomorrow.
Back tomorrow. I'm still going to be here. Lizzie's still going to be here. We've still got half an hour to go. This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
This is the opening trade. We're 30 minutes into today's session. And do you remember that market reaction to President Trump's tariff threat, an extra 100% tariff on China? Do you remember when we thought maybe that was a blip? It's not looking like it this morning. Red across the screen for European equities at the open. And it's pretty much the same story when you look at US futures as well this morning. This is usually the point in the programme when I would hand over to Guy and we would see that Fresnillo, the gold equity, is up again. But it's not looking like it's a gate, Guy.
No. Which is disappointing in some ways, because it's been such a feature of the landscape over the last few weeks and months. But today it isn't. We've got other 52-week highs and 52-week lows. Let's start off with the internal metrics. 183 up, 406 down. Volume's a little higher as well. We've got volume up on a down day, which I think is worth paying attention to. Let's talk about what we are seeing in the 52-week highs and lows. Fresenius Medical is my 52-week high of the day. It is not Fresnillo, but it does start with an F. There you go. That's the one-year chart. As you can see, nice left to right move. We're up by 44%, which is great, but it's much less than Fresnillo, which the mining sector has delivered some stunning returns. At the other end of the spectrum, let's talk tyres. US tyres in particular, and this is the story with Michelin this morning. Out with a warning. The stock is down by 24%, and it's a big move lower this morning. We're kind of taking out the April lows quite convincingly. And here's the interesting story around this. So this is weakness in the heavy truck sector in the United States. There's a lot going on in that space right now, but that's an economic bellwether to what is happening in the US economy. Heavy trucks worth paying attention to. The other thing is agricultural machinery as well is where they're seeing weakness too, which again speaks to this tariff story. We know what's happening with the soybeans and what's going on more broadly with the agricultural space right now. Pay attention to that as well, because that's where you are seeing weakness as well. Is that something you want to extrapolate into names like John Deere as we work our way through the US earnings season, which again is a sort of key stock for that reporting season? Anyway, Michelin at a 52-week low, down hard this morning. Lizzie, what else do we need to know?
Well, here are some of our other top stories this morning. China has threatened further retaliatory measures against US curbs on its shipping sector after sanctioning American entities of a South Korean shipping giant. The Ministry of Commerce said that it was placing limits on 5 US units of Hanwha Ocean, one of South Korea's biggest shipbuilders. The company's shares dropped as much as 8% in Seoul, their biggest decline in about 2 months. Elsewhere here in Europe, Sébastien Lecornu will address the French Parliament today for the first time since being reappointed Prime Minister. as his fledgling government tries to pass a budget. President Macron has called on the fractured parliament to deliver stability for the country rather than precipitate another government collapse. And silver, as we say, is trading lower after touching an all-time high above $53 an ounce as a historic short squeeze in London added to momentum fueled by surging demand for safe haven assets. Gold also paired gains after climbing to another record high, building on 8 straight weeks of gains. Guy.
Okay, let's take a look at what we are seeing in terms of the crypto trade this morning. It has been a brutal few days, to be honest. And in some ways, Bitcoin has been an area of calm because it's been some of the altcoins that we've really seen being battered. But you saw huge numbers of liquidations Friday into the weekend. You've only got to see what is happening with your Twitter feed right now, your X feed right now, absolutely blowing up with all of the commentary around what is going on here. So let's figure out what is going on here. Elsie Susie Watts, Executive Director, Global Digital Finance, joining us from Washington. So thanks for the timing. Elsie, let's talk a little bit about that. Well, let's talk a little bit about what happened over the weekend. People are talking about this as being a kind of key moment, that actually this is going to be something that is with us for a while, that actually it's not going to be a short-term blip, and that the market isn't going to recover kind of quickly. What's your sense this Tuesday morning of where we are after a brutal few days?
So I think as you were talking about, the traditional markets a little bit earlier as well, you can still see that crypto is a little bit down this morning. And I think, though, actually what's interesting here is that this is actually not a crypto-specific event. This is, as you were talking about the tariffs, a policy-induced liquidation cascade. And again, I think the timing is really telling here. The market was already quite nervous about, rates, deficits, liquidity. And then when we saw Trump's Truth Social post, as well as other tariff-related news last Friday evening, that's when we really started to see that big tumble in crypto markets. But what I would actually argue is really interesting here is compared to previous incidents of volatility, this time the crypto market actually had a much quicker bounce back, noting that I think that there is that structural support there, which wasn't there previously, such as ETFs, corporate treasuries, or institutional trading desks, which are now involved in crypto. And so it's a bit more resilient than it has been for volatility incidents in the past.
So, Elise, you don't see, I read a lot about lasting damage, late cycle. These are kind of the phrases that are being thrown around at the moment. Lots of liquidations, a lot of people being pulled out of the market, a lot of people struggling to recover, therefore. So you still see this as short term, whereas what I'm reading elsewhere is suggesting that this is a much longer lasting effect that will be felt for weeks, if not months.
I think that it's fair to say that it's a lasting effect, but I think you also need to separate out some of these various parts of the market and certainly separate out what we're seeing from the altcoins versus from what we're seeing from Bitcoin, for example. So I think that you can still argue that Bitcoin, despite its volatility over the weekend, it has recovered and it is still a risk-off expression in some ways. Not the same as gold, and obviously that gold comparison is, drawn on quite a bit. But I would argue that probably Bitcoin is not necessarily the same as a safe harbor as gold, but it is certainly very different to the altcoin market. And that's especially because of its proof of work mechanism. That makes it structurally closer to gold. It's energy-based, supply capped, costly to produce. And so the investment thesis there, as I'm sure you know, is scarcity. That's not the same for the altcoin. And of course, that then depends on value to usage, developer activity. And bear in mind, there was also a lot of leverage in the altcoin market as well, which is, I think, why you're seeing those large effects. So I think you do need to draw a distinction there as well between proof of work and proof of stake and what we would see from Bitcoin versus what we might see in other parts of the market.
Elise, part of what Guy is alluding to is, of course, the plumbing and the fact that this happened over a weekend and, you just saw how thin liquidity gets over the weekend. I wonder how much the structural issues mean that it's a long way before crypto trades like a mature asset class, and actually if there's more that can be done to help it on that journey.
So, I think that that's a fair criticism, and there were definitely some aspects of the market where we saw some failures, but what we also saw was more responsiveness and more transparency than when this has happened in the past. And I mentioned it earlier as well. I think that those, more structural elements that are closer to institutional infrastructure, the ETFs, the corporate treasuries, and the market makers that weren't panic selling, I think that that still reflects that we can see the market maturing. Is it fully to a mature scale yet? Probably not. And again, I mentioned the leverage. I think that a lot, of the market was probably vastly over leveraged as well, which is why you saw some of these, really devastating losses. But equally, I think that, coming back to what I was saying about Bitcoin, I think capital market desks are still viewing Bitcoin as a bit of an asymmetrical trade there against sovereign and corporate debt. And so I think that, we are still seeing, and with the advent of tokenized gold as well, and soon tokenized treasuries, these can be bridge assets to blending that safety with the programmability that we see of crypto markets. So in short, you're right. I think the markets aren't fully as mature yet, but I think we definitely have seen a lot more maturity than when we've seen historic losses in the crypto market and volatility like this in the past.
Well, here in the UK, the Reform UK leader Nigel Farage is calling on the government to regulate the crypto industry. And I just wonder, as you survey global crypto markets, where in the world is getting the right balance between innovation and investor protection?
So that's a really interesting question, and one that I work on probably every day. I think that, as I'm sitting in Washington, D.C. this week for D.C. FinTech Week, we certainly have seen a lot of progress in the U.S. And I think that the Genius Act, which regulates stablecoins in the U.S., is a really great example of balancing innovation with, making sure those market protections are in place. Of course, we're still seeing Treasury doing rulemaking on that. And so those final rules are not yet in place. I would argue that the UK, despite Farage's comments, has actually done a good job making progress on its own framework. And we've seen the FCA progress their roadmap and a number of consultations on issues anywhere from market abuse through to, of course, stablecoins in custody. I would argue I'd call out another great jurisdiction would definitely be the UAE. We've seen a lot of progress from both Dubai and Abu Dhabi. They have a regulator specifically for crypto in Dubai, in VARA, and Abu Dhabi has done a lot of great work on both stablecoins, which they refer to as fiat reference tokens. So I think that's certainly another contender and challenger for the balance of innovation and regulation.
If we see continuing volatility, like we saw over this weekend, how much is that going to undermine the case for crypto in the near term? There's a lot of deregulation happening at the moment, but if you want to make this a longer-term prospect, don't you need to get rid of some of this volatility, which we thought for a while had disappeared, but now feels like it's back with a bang?
I would come back to what I said before. I think if the volatility continues in the crypto markets as well as in the traditional markets, then I think it's clear that this is actually a macro correlation. This isn't just some idiosyncrasy of volatility that's within the crypto markets. And I think that, perhaps what we might see in future is that institutional investors are actually using crypto as an expression of macro sentiment when they react to policy shocks, similar to, FX desks. And so I don't think that that kind of volatility in relation to policy is necessarily a bad thing. However, I will say that I think to bring more trust and confidence into these markets, then we absolutely do need regulation. We need to think about what cross-border regulation means and how to enable, deference mechanisms and reciprocity, because these really are cross-border and global assets as well. And so I think that's really the next piece of this picture in, thinking about the overall stabilization of the industry.
Okay. Elise Susie-Watts, Executive Director at Global Digital Finance, up early for us out of Washington. We thank you so much for joining us. And Guy, it's interesting, this point about crypto regulation. I was on stage at our Women, Money and Power event here at Bloomberg with the CEO of the London Stock Exchange, Julia Hoggett, and she's defending why there aren't IPOs happening in London. And she's so frustrated when you're trying to get the retail investors to buy equities, and yet all these young people just flooding to crypto because of the lack of regulation there compared to all of the regulation she feels is faced on the UK stock market.
Yeah, the barriers to entry are just lower. Like it's easy, but also in some ways the kind of the volatility is a feature, not a bug, for maybe some of those investors too. You get big price swings, and as a result of which, it's a different investing prospect to maybe investing in equities, which is a longer-term narrative. I don't know.
Might be the first time some of them felt it over the weekend.
Certainly, it was a painful weekend. I got a lot of. You saw all of the kind of social media. The narrative was just really extreme. A lot of people getting really battered by this.
Well, speaking of a stock getting battered, ASML, not quite battered, but down 1.9% this morning. The chip maker expected to report solid third quarter results, though, as various AI partnerships keep orders flowing. And this is ahead of Wednesday's earning release. Joining us for more and a preview is Mark Bergen from our tech team. Good to see you, Mark. What can we expect from these results?
You know, I think it's really, ASML is a fascinating company that is now inextricably tied with politics and geopolitics. And we're seeing both the rare earth restrictions out of China and then Trump's continued tariffs. And we also saw in the U.S. Congress calling out companies like ASML for continuing to do business with China. That almost feels more significant than their quarterly revenue in some ways.
Hence the move today.
But before I ask the next question, how do I value, therefore, a stock like ASML when it is effectively being pulled and pushed by so many of these kind of massive macro themes?
Yeah, I think, there's the argument that kind of the tariffs have been priced in certain ways. ASML is, they are the monopoly of monopolies in this industry, right? There's no competition. They are the one that is the primary equipment maker for these chips that NVIDIA and AMD and everyone
relies on. Yeah.
Right. And so in some ways, even despite the political wins, like that, their core business is remaining pretty strong.
ASML is the kind of the critical part of this whole story from a European perspective, but Europe struggles elsewhere in terms of defining a narrative for itself when it comes to the AI story. There is a sense within Europe that it doesn't want to be left behind, that it needs to develop its own infrastructure, its own ecosystems. How possible is that?
ASML is a really interesting story there because they've actually kind of stayed on the sidelines, and we don't really think about them as European, although arguably they're the most important tech company in Europe. They recently invested, became the largest shareholder in Mistral AI, which is the French startup kind of competing with OpenAI in some ways. That was a really fascinating move. They described it as sort of a business strategy using their AI across their products. I think of it is a geopolitical strategy. It is we're putting our bet behind one of Europe's few champions in this place. There's a lot more conversation in Brussels, in Paris, in capitals about sovereign AI, about actually how much can Europe be independent from the U.S. and China. Right now, very little. I think there's an argument for the Euro stack. In our story today, we talked about that there are politicians and there are leading figures saying Europe should actually be buying as much as possible. And you see certain countries that are now cutting out, trying to remove contracts from Microsoft, trying to remove OpenAI for a lot of these fears and the concerns that we need to have in Europe tech independence.
When you look at the sort of investment, ASML, SAP committing billions to European AI startups, just really quickly, how big money are we talking here? Is it not chicken feed in the scheme of AI investment?
Well, that's a intense word, but it's not huge amounts, right? I think that these are SAP is the biggest software company in Europe. They've talked about spending on their sovereign AI cloud 20 billion euros over, I think, coming maybe decade or so. Which is, look compared to what the Microsofts and Google and Amazon are spending is chump change, right? Compared to what something OpenAI will do in one day. They're a different business, and SAP's their CEO has actually come out and said, we shouldn't be trying to compete with the U.S. here. He wrote this op-ed in The Economist and said the hardware train has left the station. Europe's not going to compete on chips. It's probably not going to compete on that level at cloud, but it's going to have these winners in the apps and a lot of these applications in AI, and those kind of companies actually can compete on a global scale.
Thanks for stopping by. Thanks for updating us. It's a great story. Definitely worth a read this morning. You'll find it on the Bloomberg terminal and, of course, on the website, etc., etc. Mark Bergen talking to us about what's happening with the chip story, the tech story. The China story gets folded into this very, very quickly, doesn't it? And we've got comments coming out currently from the Chinese officials. The Ministry of the Ministry of Finance team is out talking about the fact that the U.S. needs to correct the mistakes it's made, U.S. measures. I think it's talking about shipping here, talking about those of measures affecting the global supply chains. It wants those fixed. It's retaliating to them. And it wants these issues resolved through dialogue. But all of this needs to be set against the fact that we have a big stage coming up with President Trump and Xi Jinping potentially on that stage. But whether or not that happens or not, we don't know. The moment the market is reacting quite negatively to all of this, you're seeing equity markets under pressure. You're seeing, obviously, some of the currencies being affected as well. Val was pointing out the fact that the Aussie's on the move. It's a big risk barometer around this kind of trade. Lots of things happening around what is happening. What did I say? Ministry of Finance, Ministry of Commerce is out with these statements. Apparently, I'm being told. MOFCOM.
But look, Nasdaq futures not that much further lower than they were before these headlines out of China. We'll continue to monitor it.
We will. What have we got coming up? We're going to be talking about the banking sector. We need to set you up for that as well. That is going to be a story that we're going to be watching towards the back end of this week. The earnings season's about to get going. What are we going to learn from Wall Street? We'll talk about that next. This is Bloomberg.
For Trump to have been, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good educations, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging?
Yes, exactly.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We're 51 minutes into today's session, and as you can see, it is red across the screen. The risk-off mood spreading across these markets as traders start to worry again about the US-China trade spat. But we've also got a lot of earnings on the docket this week. In the lack of the economic data, more of a spotlight on these this week as well. So major US banks kicking off today with JP Morgan, Goldman Sachs and Citigroup all expected to post strong results in investment banking and trading. And we've got Charlie Wells here for a preview. Charlie, just give us the overarching narrative going into earnings season.
So look, big picture, it's positive, right? We've had $1 trillion in deal volume in the third quarter. That bodes really well for the investment banking sides of these businesses. They're expected to clip a lot of fees there. So looking like it's going to be a really good quarter. But there's a little bit of skittishness here that I think we need to pay attention to, because that KBW Bank Index, it's been outperforming the broader market over the course of the year, but it's down from September highs. And so there's a little bit of concern on the edges. Maybe expectations are too high AI, maybe some of this uncertainty is eating into that sector.
Winners and losers? Talk to me about winners and losers, because you're kind of hinting at winners and losers.
Yes, I am. So look, on the volatility picture, we have seen a lot of these trading desks. We're expecting to see a lot of strength coming there. Think about equities trading, Goldman likely to come out on top. FIC trading, it's likely to be JP Morgan. But I've got a cautionary tale for you, and that's Jefferies. And we've been talking about that over the past couple days. And look, they had a great report card, right? Their third quarter revenue was the best they ever had. Look at their share price now, right? It is down significantly because of the concerns about exposure to the auto sector.
And I just mentioned about, the importance as an economic barometer of the US. What sort of window could we get into the state of the economy?
Great story by Bloomberg out about how some of the banking data could be something of a proxy for this economic data that we are not getting because of the government shutdown in the U.S. But there's a flip to that, right? We get a great picture, but also that adds more scrutiny to these earnings. I think it's going to be really important to listen to these analyst calls today as they ask executives about the outlook going forward, because I think that in this quarter in particular is going to matter a lot more than solid numbers coming forward. We're getting this great quote from Mike Mayo in a recent note about how it's all about that outlook, all about looking forward.
Charlie, great to see you again. Haven't seen you for a while. Charlie Wells on what we're going to expect from the banks. David, looks like this. ZEW will be out shortly. Earnings are going to be starting. We've just touched on that one. LVMH is out after the bell here in Europe. The main event, Lizzie tells me it's 5:20. It says 5:30 on the screen here. I've got 5:20 though on the.
It says 5:20. You need your glasses, guys.
It says 5:30 up there. Look, 5:30 p.m. on the screen. It's 5:20. I know on the Bloomberg. There you go. Fed Chair Jerome Powell delivers keynote address at the NABER annual meeting. Q&A, yes, with moderator, 5:20. Is the market's having a struggle this morning, Valerie Teitel. Yeah. Is Powell going to ride to the rescue?
Well, look, it's all going to be about his assessment of the labor market. We've been in this blackout period when it comes to data because of the U.S. government shutdown. And I think the market is really going to be hinging on any comments of just what data he is looking at to have a clear picture on the U.S. labor market. So watch out for that. I think that would be very interesting in his speech. He does make this speech every year to this conference. So it's something, perhaps it wasn't, I guess, timed on the calendar on purpose. But this comes after we heard from Fed Governor Waller. We know he's the more dovish of the camp. He spoke to CNBC on Friday saying, we don't need any new government data to verify the labor market is weak. In his mind, we have negative payroll growth, and to him, that is not maximum employment, and the Fed still needs to keep
So do you think, though, with the market down, as it is at the moment, and the market is jittery, that Powell is... does he change the narrative?
Surely he needs to. If the expectation is 3.1% inflation when we actually get it on October the 24th, and all the indicators that Kate Moore was talking about earlier, surely he needs to sound more dovish. More hawkish.
But if he sounds more hawkish, heaven knows what's going to happen with equity markets later on today.
Can the AI trade handle that today? Yeah, no, that's a good question. But it comes after we also heard from a new Fed president, the Philly Fed president, speaking to the media for the first time yesterday. This is Anna Paulson.
She doesn't vote until next year.
She doesn't vote until next year, until 2026, but mark her down as a dovish voter. She was mentioning that the AI infrastructure trade is masking broad weakness in the U.S. economy. She's in favor of 2 more rate cuts this year, and then went on to say that she thinks the U.S. economy right now is too weak to generate sustained inflation off of tariffs.
It's not what we heard from Kate Moore earlier.
Nope.
She was certainly hinting at the fact that we are still going to see inflation coming through, and she's worried about it, and she thinks I've heard it twice today, coin toss on what is happening in terms of the Fed rate cuts that we're going to get the back end of this year.
Well, there is Q&A today, so Powell might be asked about these recent flare-ups of U.S.-China trade tensions and what he thinks about that. Will he answer with something inflationary, or will he answer with something about negative growth? Because we have seen a pretty decent Treasury market rally on the back of these U.S.-China tensions. It's taking place today, so Treasuries are a safe haven. It's back.
You heard it here first. Valerie, U.S. futures are really negative, though. You've now got the NASDAQ down by 1.1%. That's what we're going into in terms of the session. That's what Powell's going into in terms of the session that he's looking at here. That wraps things up. Hope you enjoyed the show today. We had some great guests and great commentary. We'll do it all again tomorrow. The opening trade is done. The pulse is next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Trade tensions reignite between Washington and Beijing as China sanctions the American units of a South Korean shipping giant and threatens further measures. A pivotal day in Paris with newly reappointed Prime Minister Sébastien Lecornu facing Parliament in a high-stakes address that could define his political future. Plus, President Trump calls it dawn of a new Middle East, but questions, of course, remain over what happens next following U.S.-led efforts to end the fighting in Gaza. Now, we also have some really great guests. This hour, we speak to Canadian mining billionaire and founder of iPulse, Robert Friedland, and the chairman of Chilean mining giant Codelco. We also discuss the macro outlook with economist Mbisa Moyo, and finally we look at how the M&A market is actually heating up with Dietrich Becker from boutique investment bank Perella Weinberg. Now, first thing is first, let's have a look at the stock market. Now, global equities are actually falling. Overall, you can see S&P futures down some 0.8%. This is on the back of China also upping the ante in this trade dispute with the U.S., and this is actually stirring fresh concerns about tensions between Beijing and Washington, again, at a time when stocks may look overstretched. So we look at the European map, but Brent crude, always good to look at Brent crude, 62.41. We also have the IEA raising its estimate for record oil oversupply in 2026 for the moment, still holding range bound to Euro-dollar 115.47. But again, there is also an unofficial opening to the earnings season because we have a lot of the banks reporting in the U.S. Look, if you look at European indices, a lot of the tension that's playing out between the U.S. and China is also crystallizing in Europe with the CAC 40 and the DAX between 0.9 and 0.7% lower. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, fintech, or the French, not fintech. We'll talk about fintech in a second, but the French Prime Minister, Sébastien Lecornu, is proposing his new budget in a cabinet meeting this hour, ahead of a crucial address to Parliament this afternoon, his first since being reappointed. Now, in just a moment, we'll be hearing from Bloomberg's Caroline Conan in Paris, but first, a new front in the trade war between China and the U.S. as Beijing announces a new round of retaliatory measures in the shipping sector. So let's get straight to Ross Matheson, our chief Asia correspondent. Ross, what do we know about the fight that China wants to have or not have?
Well, as you were saying, what we've got today is news on the shipping front, which is that China is sanctioning the US entities of a South Korean shipbuilder, Hanwha. There's been a series of tit-for-tat actions, in fact, between the US and China over shipping, because the US wants to bring shipbuilding manufacturing back to the US. China is keen, obviously, not to lose market share. This is a key industry, obviously, for the global trading industry. It's interesting to see this bubbling up now, though, because a lot of the focus has been on critical minerals, rare earths, the high-tech sector, chips. This just shows that the tensions in this relationship on the trade front, they run deep and across multiple sectors. And also, we're seeing this come up potentially as positioning again, all this negotiating before a potential meeting between the presidents of the US and China. You've got China threatening things, the US threatening things. They're all getting in their corners, in their strongest position to potentially have this conversation. For now, the US Treasury Secretary Scott Bessent says he does believe this meeting will go ahead between Xi Jinping and Donald Trump at the end of the month in Asia. Of course, for each leader, there's got to be that calculation up to the last minute. Does this meeting make sense? Am I going to get from this meeting what I want? Are we going to get tangibles from it on the trade front? So until they actually walk into the room, we don't know what's going to happen. But it does seem a lot of this is this kind of positioning, getting into strong positions before the two of them potentially sit down later this month in Asia.
Rose, thank you so much. I mean, the other big story is France. Sébastien Lecornu will address Parliament for the first time as Prime Minister this afternoon. I mean, for the first time, the second time round. The address will be a make-or-break moment for his fledgling government in its efforts to pass a budget and bring some political stability. Let's get more with our very own Caroline Counant in Paris. So, Caroline, if Lecornu does not deliver his message, what happens?
Yes, Francine, I do feel like it's Groundhog Day as well, living the same day over and over again. And again, today it is the moment of truth for Sébastien Lecornu, who was supposed to deliver his general policy speech a week ago, but then he resigned after the rebellion from the Republicans before being reappointed on Friday. So today he's going to deliver his general policy speech, 2 p.m. UK time, and what the socialists are calling for is a suspension of the pension reform. This 2023 reform that brought the retirement age in France from 62 to 64 years old after months of strikes and protests in the street. This is really the flagship reform of President Macron in his second term. But if President Macron has signaled some openness on Friday after meeting with all the political parties to delay this reform, the socialists want more. They want a pure suspension. They want to go back to 62 years old for the retirement in France. So Sébastien Lecornu will have to say something about this in his general policy speech if he wants to avoid another vote of no confidence, because he needs the support of at least 2/3 of the 69 socialist MPs in Parliament if he doesn't want to see his government fall again tomorrow, because the far right of Marine Le Pen and the far left have both proposed 2 motions of no confidence against this Lecornu government.
Caroline, thank you so much. Caroline Counant there in Paris. So uncertainty in France and the return of trade war fears between the world's 2 largest economies is gripping the markets. And I have to say, it's not great news for them. Let's bring in Craig Cameron, head of European equities at Franklin Templeton. Craig, thank you for joining us. I have to say, I've been speaking to Italian officials that aren't delighted about what's happening in France, but at least it makes them look good. So I don't know whether there's a tactical play or whether actually this fight between China and the U.S. will take everyone down.
Yeah, I think, look, the French situation is obviously something that needs to be resolved. So whether we see, changes in tax rates or we're going to get some spending cuts, ultimately I think something will be agreed and we can all then move forward. I think what we try to remember here is that the French companies in particular are global and international. There's many great businesses there. And they're actually largely immune from sort of the domestic challenges that we're seeing in France. So, while it's never easy to see these sort of situations occur, and as you say, it's an interesting comparison relative to the countries like Italy in the past. ultimately, these things tend to get resolved.
Craig, I mean, overall, look, valuations are not cheap, or certainly a lot of the stocks in Europe and elsewhere could be priced to perfection. So where do you find value? Do you worry that there could be some kind of correction coming that just takes everything down?
I think you've always got to be aware that if something does happen, Europe is not immune. It's not immune from the US-China challenges. It's not immune from a reset in valuations. I think where we see opportunity is in the fact that Europe itself remains at a meaningful discount to global markets, particularly countries like France today. I would also mention the UK really are trading in line with their long-term averages, despite being I would say in a sort of higher valuation market. So those are the areas that we find particularly interesting.
What do you do with defense? I know there's actually a Bloomberg, there's a BNEF Green Summit later today, and I know some parts of European Union are at pains in trying to maybe spend some of the defense and matching green. I mean, do you see opportunities in defense more than anywhere else in Europe?
I think from a valuation standpoint, the market has really priced in a lot of that already. So, I'd be reluctant to say that defense is a great opportunity here. I think actually the converse is true. You mentioned the green spending. It's really an area that continues to develop. It continues to grow, but we haven't really seen that enthusiasm that maybe we did in 2021 or 22 around that kind of theme. So, I think both of these are absolutely necessary, and you speak to a broader point, which is that Europe is investing in fiscal stimulus for really at a level that we've not seen in a long time. And I do think that supports the European equity markets relative to global.
Craig, when you look at, some of the, what's happening with China, so I think there was a big accusation also from the Treasury Secretary. China's probably trying to destabilize. My words, not his, but that was the gist of what he was trying to say. How problematic is that for European valuations and European markets?
So I think all of this is interconnected. I mean, Europe is more impacted by China than the US is, but I think from a geopolitical standpoint, Europe sitting in the middle of that sort of fight and staying out of it is clearly helpful. If you look at Chinese companies looking to invest overseas, I was reading this morning about BYD looking at another factory in Europe. Clearly, Europe is more preferential than the United States for those kind of businesses today, and as that comes through in the numbers, I do think that's a positive for Europe.
What does that mean there's a lot of Fed expectations. If the Fed suddenly turns more hawkish, does that change your view or impact your view on European equities?
So I think that the sort of attractive thing about European equities is we are in this falling inflation, falling interest rate environment that the US is not in. That has supported equities, but it also would argue for that valuation discount to close. So certainly for companies globally, a declining interest rate at the US Fed is helpful. But I think what's most important for Europe is the ECB rates and the environment that we operate in here in Europe. So less meaningful for Europe than the global economy overall.
Okay, Craig, thanks so much. Craig Cameron, there, head of European equities at Franklin Templeton. We're seeing a little bit of a correction. The Hang Seng Tech Index falling some 11% from its October high, which means it's entering a correction. Coming up, it's a venture that uses electricity to shatter rocks and make mining more efficient. We speak to Robert Friedland, Canadian mining billionaire and iPulse founder, with Maximo Pacheco, the chairman of Codelco. It's going to be a good conversation, so stick around. This is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins.
We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back, everyone. Now, Codelco has acquired a stake in a Robert Friedland venture that uses electricity to shatter rocks as the Chilean copper giant seeks to make its mines more efficient. Well, the state-owned Codelco joined other miners such as Rio Tinto, Newmont, and Teck Resources as investors in the U.S.-based firm. Well, I'm delighted now to be joined by Robert Friedland, Canadian mining billionaire and founder of iPulse, and Maximo Pacheco, chairman of Codelco. Thank you both for joining us. This is an exciting partnership. Give me a flavor of actually what the nature of the partnership is, Maximo. I mean, it's quite rare that Codelco enters in these kind of partnerships. So what did you see?
Well, we are partners nowadays with BHP, Rio Tinto. We are partners with Teck, with Anglo American, with Freeport in Chile. So now we are partners with iPulse and Robert Friedland because Chile owns the largest copper reserves of the world. And we know that the world needs a lot of copper, but we need to be competitive. We need to produce it with less energy. We need to cut our costs and be sure that we can supply this market at the right cost. So that's why this will only be done with innovation and new technologies. So that's why we are partners now with iPulse, because we believe that they are leaders in something that will change the shape of the mining world.
So, Robert, how would you explain pulse powered? I remember actually meeting you in Qatar, in the corridors of the Qatar Economic Forum, and you showing me how this worked. This is something that you've always believed in, but what are the applications in the mining world?
Well, Francine, it's great to be back here with you on a show called The Pulse, because our company is called iPulse. So
who came first? No one.
In the entire known universe, this is the best place to explain pulse power on a show called The Pulse. So we're compressing electrical energy, and among other uses, we're using it to burst rock or tear it apart from the inside. For all of the history of humanity, we've crushed rock from the outside, squeezing rock into little pieces. Now we're pulling it apart with electromagnetic pulses. So it's a much more efficient way to get the metal out of the rock. The act of crushing and grinding rock is using roughly 4% of all the electrical energy in the world. Mm-hmm. So it's a green technology, and it results in higher metallurgical recovery. And we've been developing that technology for some 19 years with assistance from the French government, even though we're an American private unicorn.
What, Maximo, at what valuation did you buy into the iPulse, and how much do you own?
Well, this is an equity stake that we've taken, and we will be commenting on this hopefully in the coming weeks. But it's a significant investment for Codelco. Yeah. We're committed to innovate, and I think this is the best way to do it, with partners.
How much do you want to grow this company, Robert? How big do you think? I mean, I'm going to, try and ask about valuation, but how big, what's next for iPulse?
So there's three fundamental ways to use electrical energy. There's direct current, which Thomas Alva Edison was a big fan of. Alternating current, which was Nikola Tesla and George Westinghouse. And there's pulse electrical power, which has been confined mainly to national strategic weaponry and weapons. But we're dumbing down technology. In the military, pulse power is used at terawatts. And we're just playing with gigawatts. The power output of a nuclear power plant, approximately. And the applicability is very broad, not only in mining, but in manufacturing and a host of other industries, even in agriculture.
So what are some of the other tangible benefits of this technology? I mean, Robert was explaining a little bit of the convenience, but how much does it cost, for example, to produce a ton of copper compared to traditional methods?
Well, I mean, it has a huge impact in our energy efficiency, and we are very obviously intensive in energy. Also, this has a great impact on sustainability. This is environmentally more friendly, the way we can use this technology, not only in developing our mines, but also in exploration. I think Chile, as the largest reserves in the world, is a country that's underexplored, and we need to increase exploration, because that's how our business starts. We start our business with exploration. So a technology like the one that Robert has been describing is very, very strategic for exploration, and therefore for finding new mines. This business is not only about buying other assets or buying other companies. It's primarily about finding new resources and new reserves.
And I imagine that's much cheaper than the current methods that you had.
Absolutely. It's not only much cheaper, it's more efficient. You can go deeper, because in the past we could find copper very close to the surface of the earth. Yeah. But copper now has lower ore grades, and it's deeper in the earth. Yeah. So we need to explore, and we need to drill deeper today. And that's how this technology will help us to find new resources.
And Robert, how much does it cost to deploy this kind of technology, and will it get cheaper?
First thing we want to tell you, this magnificent studio runs on copper, and all this big data, AI, the world runs on copper, and the price has to be low enough that humanity can really achieve uplifting 7, 8, 9 billion people on this planet. So. The mining industry has been very slow to innovate. With 19 years of innovation, we're changing the fundamental way that we get metal out of rock, not only for copper, but all other metals. You've been seeing news about critical raw materials on the news every day. So we're tearing the rock apart. We put huge shock waves. We put the rock in a bath of water. We put enormous shock waves through that water. The rock just pulls apart and liberates the metallic particles. That can be scaled to produce more metal for the world at much lower cost. Otherwise, the industry is going to have real problems finding the copper needs. We're going into deficit in future years. The world is not producing as much copper as it needs. Codelco has enormous lower grade resources that become ore, that become profitable, but you have to reduce the energy consumption in the act of mining. And it's that very copper that we're mining that you need to produce energy.
I mean, the numbers are mind-blowing. I think about, 5% more or less of the world's electrical energy is used for crushing rock.
Isn't that incredible? To give you an idea, the amount of energy that we use as human beings to crush rock exceeds the amount of energy for all the world's aircraft flying around. And we're worried about efficiency in aircraft as well.
Let me comment probably that we had the numbers for the first semester of this year, where the main source of power generation in the world now is our renewable energies. It's 35% of all of the power generation in the world comes from renewable energy, and 34% is from coal. So if we want to continue having renewable energy, that uses a lot of copper as well. And renewable energy needs copper. So if we want to speed up the energy transition, we will need also more copper.
Maximo, what's your outlook for the copper industry?
Well, it's obviously a very challenging moment, because probably last year, the main issue for the copper industry was geopolitics. This year, we are now in the London Metal Exchange Week, this year, the main issue for the copper industry is operational continuity, because it's becoming more and more challenging, more and more difficult to find copper and to develop copper mines. So we are at this stage facing a very challenging moment where we need to bring more innovation so as to make sure that we can have more copper.
And Robert, I mean, you think this is a revolutionary because also it decreases energy consumption by 80%. Are there any other new technologies that you see innovating the mining industry?
Nothing to compare to this. We're in a desperate position for mining metals in the world. We've mined 700 million metric tons of copper in human history. We could get it back if we tore down this studio and all the buildings in England and Europe and the United States and China. We get the copper back. But at the rate that we're consuming copper, our industry has to mine as much copper in the next 18 years as we mined in the last 10,000, just to maintain 3% GDP growth. We won't get there with the old way we've been mining. The industry has to innovate, and we need a real step change in energy savings and a greener, more sustainable way to mine. And that's what we've been working on in this company for about 19 years.
Do you think this significantly changes the future of the mining industry, and how much faster can you find and mine?
Well, I mean, on one side, we can see a very healthy and robust demand for copper. You just mentioned renewable energy. It's about electromobility. It's about AI. But on the other side, the supply of copper can grow at rates of 2-3% per year. That's what we have seen. It's very difficult to develop a mine. It takes more than 10 years. So it's long planning. It's a lot of perseverance, patience, and therefore we require to be very, very disciplined in this if we want to increase copper production. I remember last year when we visited the LME week, people were commenting that there was going to be a small surplus of copper in 2025. 2025 is almost over, and there is no such surplus in copper. It's short. We are short. You have seen a shortage in copper supply precisely because of the operational continuity issues.
Yeah, I remember having the former head of commodities at Goldman Sachs saying, we're running out of everything. Robert, what comes next for iPulse? Are you going to sell this technology to others, or is this, for the moment, are you focusing on Codelco?
No, BHP is a shareholder. They're the largest miner in the world, as is Rio Tinto. We saw them yesterday during London Metals Week. Teck Corporation, who's talking about merging with Anglo as a shareholder. Newmont, the largest gold producer. But Chile has the biggest copper endowment in the world. All the easy copper has already been mined. We have to go deeper. We have to mine lower grades. The Democratic Republic of Congo is now the second largest producer of copper. These two countries have the best endowment. Peru also has some challenges in growing production. And we just want to tell you that you want to keep the lights on this planet. You need copper metal, and somebody has to get out there and find a better way to do it. iPulse will be at the very forefront of disrupting technology to find the metal by injecting electrical energy into the earth and lighting it up at depth so we can see it non-invasively, then crushing the rock, grinding the rock, and then we're going to go into driving tunnels underground, and then geothermal power, all from the same core technology.
There you go. All our viewers are now mining engineers. Thank you both for joining us. Robert Friedland, founder of iPulse, and Maximo Pacheco, chairman of Codelco. Coming up, trade tensions flare once again between the U.S. and China. Dambisa Moyo from Versaca Investments joins us next to discuss the macro outlook. Global equities actually falling as China's upping the ante on its trade dispute with the U.S. This is Bloomberg.
Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Trade tensions reignite between Washington and Beijing as China sanctions the American units of a South Korean shipping giant and threatens further measures. A pivotal day in Paris with newly reappointed Prime Minister Sébastien Lecornu facing Parliament in a high-stakes address that could define his political future. Plus, President Trump calls it the dawn of a new Middle East, but questions remain over what happens next following U.S.-led efforts to end the fighting in Gaza. Now, major U.S. banks kick off earnings season today with J.P. Morgan, Goldman Sachs, and Citigroup all expected to post strong earnings in investment banking and trading. Well, Charlie Wells is here to discuss. Charlie also has a new book out, which we'll talk about in a second. But the overarching narrative going into earnings season for banks is what, Charlie? Good morning.
Good morning, Francine. That's a great question. Now, look, there are high expectations going into this season. We can see that reflected in the share prices here. You've got that KBW Bank Index of major U.S. lenders outperforming the broader market over the past year. I want to bring up a number that helps animate why this is happening. It's $1 trillion. That is the value of deals in the third quarter, and the investment banking units at these banks have been able to clip fees off of that deal volume, which has been really helping them on that front. But I want to present a little bit of a canary in a coal mine, too, because we can't get over-optimistic here. If you look at Jefferies, they reported their best third-quarter earnings as far as revenue a few weeks ago. A little bit of a foreshadowing here because there are concerns, despite that great number, of the exposure that they've had to bankruptcies in the auto sector. So some red flags out there for analysts as we start hearing from these banks.
Yeah, and Charlie, people are obsessed with the state of the global economy. So what can, if you glimpse into earnings calls with like Jamie Dimon and the like, what can we expect to hear from them on the economy?
So look, we've got Mike Mayo, the veteran analyst at Wells Fargo, talking about how that forward trajectory is going to be incredibly important, particularly at this point when the U.S. government is in shutdown. So we are not getting those data points that we otherwise would. In this context, some of the numbers that we may get from these big investment banks could help fill in some of the gaps there. But really, despite the fact that some of these prints may come in incredibly strong, Mayo talking about how it's that forward trajectory, the guidance that they give, what it looks like as far as tariffs, as far as the shutdown, as far as that larger economic picture, that is really going to count today.
Charlie, massive congratulations from all of the Pulse team. You're just back actually from your book tour. The title, What Happened to Millennials in Defense of a Generation. I loved it because it's a little bit of a love letter, to millennials who sometimes get a hard time.
Francine, thank you so much it's so great to be back. Thank you for having me. And look, this is a book that in some ways is an extension of the sort of reporting that we do at Bloomberg, where we look at how some of the big data points, how some of the big numbers, how some of the big trends are flowing into the lives of everyday people. So I spent 4 years, hundreds of hours interviewing 5 millennials from across the United States, asking them about how some of these big trends have factored into their lives to get a sense of how America's largest living generation has fared over the past 25 years.
If only I was a millennial. I'm so much younger, so Charlie, that's why I never got into your book. Thank you, as always, Charlie, and welcome back. Charlie Wells there, newly minted author. Now, renewed China-U.S. trade uncertainty continues to linger, unnerving markets. Today, new U.S. tariffs come into effect on imported timber, kitchen cabinets, but also upholstered furniture, much of which comes from China. Dambisa Moyo, principal at Versaka Investments, joins us now. Dambisa, always great to speak to you. You're also an author. I feel like I'm surrounded by greatness. When you look at U.S.-China, it's actually unclear what China and the U.S. are playing at.
Yeah, so I guess I'm fundamentally optimistic that directionally the U.S. and China will continue to engage, will continue to forge ties. I think obviously it's very bumpy right now. The tariff story is ongoing. The issues around critical minerals, as you've highlighted, and there will be some tit for tat. But if you think about this year, there've been a number of meetings with high-level meetings on trade, on more integration, on semiconductors, and so I'm fundamentally bullish in terms of the long-term and progression in terms of that type of relationship. There's far too much integration in terms of debt, in terms of trade, in terms of consumers. And so I feel fundamentally it's the right direction, but it might be a bit bumpy.
Dambisa, I feel like sometimes, having these conversations day in, day out, almost on an hourly basis, we miss the overarching trajectory, which is, has the Trump administration actually achieved what they set out to do? They want a weaker dollar. I mean, maybe they're getting it. Are they getting back what they want in terms of tariffs?
Look, I think there's economists need a bit of humility because many economists like myself who've been traditionally very globalist, we've been wrong in terms of tariffs and the border closures. We were certain that was going to be net inflationary, and it just hasn't happened. I mean, the country is growing at 3.8% in the last revisions from Q3. The numbers in terms of sort of economic progression, in terms of sentiment, continue to just be reaching new highs in stock markets, continues to be net positive for the country. Now, I personally don't think we're out of the woods. It just seems that the policies seem to be defying canonical models of economics, and so there is a narrative that says next year we'll have loose monetary policy, loose fiscal policy, plus higher wage pressures because of the border closures, plus tariffs. All of that could be net inflationary, and then maybe we see a turn in terms of the mood music on rates.
But why is that, Dambisa? Because first of all, it's very rare to be able at this point to say, look, maybe we got it wrong.
Yeah.
But is it because the supply chains had already moved?
Yeah, so I think there's a number of things, and I think the word the U.S. economy being resilient is perhaps overused, but I think that's very telling. The balance sheets of the households have held up. I think a lot of the absorption, as you said, with respect to supply chains that already happened, companies that already pivoted post the pandemic, and so I do think that a lot of the expectations as a shock to the system just haven't been felt. And the other thing, obviously, is that many corporations have been able to absorb the threat of tariffs. Of course, we don't want to see tariffs above 20% or 30%, but the 10% tariff in terms of margin, I think many companies feel like that's something they can absorb.
Yeah, is there a danger that maybe actually we think that we're fine, but it gets, it's the pressure cooker, that there's going to be one thing where it's just going to be too much for companies?
Yeah, look, I think that the fact that there's a lot of risk in the system is something that I've been writing about recently. There's risk in the shadow banking system. There's a lot of risk with the new 401k announcement from the government and what that means for the ability for pension funds and for retailers to be able to take on more risk. I think all of those are risks in the system that could be very impacted if the rate environment changes. And as I said, there are a number of factors that suggest that we could see more inflation tick up in the year next year.
What does fragmentation look like? Again, we talk a lot about these big words, the New World Order. It's reimagining allied countries. On an economics term, what are the consequences of it?
Yeah, look, I think that it's clear that there's a lot of fracturing going on. I mean, my worry is that a lot of the fracturing is not just happening between the sort of developed and developing countries or the U.S. and China, but also within the developed nations. If you look at the U.S. versus Europe, the European story is pretty much heavy regulations, very slow growth, continued high energy prices. That is not the U.S. story right now, and I'm worried that if not, dealt with very aggressively, many European countries could miss the new super cycle of AI, and that's my great concern right now.
Do you also worry about valuations? Again, AI, it's unclear who the big winners are, how exactly it changes, at what pace it changes the work we do, but also they really do seem priced to perfection.
Yeah, look, I mean, how can you not be sort of paying attention to the valuations? If you think on a historical basis, multiples traded around 16 times. We're now at 25 times. You look at the extremes like an NVIDIA or even a Tesla, we're at 200 times on forward PE. I mean, that's obviously eye-watering, but you start to think about what is that really telling us? That's telling us that there's a lot of expectation around productivity gains. I think we haven't yet seen a lot of that productivity gains flow into corporations, but there is upside. I'm not yet worried. I still think we're in the early innings, maybe 97, 96, 97. If you looked at the e-commerce or the .com bubble as an analogy, I don't think we're near the sort of the 2000, 2001 concern about a bubble about to burst, and that's a lot to do with the fact that institutions are still net neutral and haven't really jumped into the euphoria that we're seeing today.
Dambisa, how much do you think about, we're putting so much money in AI, and it depends on how much you get the return on investment and how quickly you get that. So once you start to see a return on investment, then maybe if we're not out of the woods, it just makes much more sense for companies to keep on piling on.
Yeah, look, I think there's a study by MIT NANDA that came out about 6 weeks ago saying that, a lot of the pilots, 95% of the pilot programs that have been run by corporations is generating 0% in terms of return. And I think my sense is that to the extent that there will be gains, I'm optimistic that there will be gains, but I think they're much further out into the future than we might be expecting and perhaps what is priced into the market right now. I do think that there's a long way to go, and it's still going to be much more interesting to see how it actually permeates, how it's distributed, how you think about applications, and that's not something that's in the mind's eye as yet.
Does it make a difference on our economies if it's the U.S., if we're in the so-called technology war between the U.S. and China? Does it make a difference, who wins?
Yeah, well, look, I think I hope we both win, and there's some sense of sort of cooperation in this space. I do think that just in terms of transparency, in terms of the rule of law, in terms of sort of democratic values, and you want the U.S. to remain very aggressive and very competitive. And they obviously are leading with estimates of $300 to $500 billion in terms of capital investment from the AI, sort of led by the hyperscalers. So I am optimistic that the U.S. can continue to compete, but of course China is not far behind, and in some instances is actually leading too. So we have to remain very, very sort of animated and energetic about that competition.
Dambisa, thank you so much. I love always speaking to you. Dambisa Moyo, their principal at Versaka Investments. Now, Broadcom has become the latest chip maker to forge a blockbuster data center deal with OpenAI. In the most recent wave of AI infrastructure deals, OpenAI has agreed to buy custom chips and networking components from the chip maker. News of the pact sent shares of Broadcom soaring, adding more than $150 billion to its market value. Volodymyr Zelensky plans to meet Donald Trump in Washington on Friday. Now, the meeting between the Ukrainian and U.S. presidents follows 2 phone calls over the past week. Zelensky is pushing to secure more air defense systems to protect energy assets after a series of Russian strikes triggered power outages across Ukraine. Well, President Donald Trump has laid out his vision for broader Middle East peace following the success of U.S.-led mediation efforts to end the conflict in Gaza. Trump signed the Gaza agreement alongside world leaders in Egypt.
This is the day that people across the region and around the world have been working, striving, hoping, and praying for. They have done things over the last month that I think were really unthinkable.
Our Jumana Bersachi is in Dubai. Jumana, momentous day. What was achieved?
It really was. President Trump basking in the glory of what happened yesterday. The Gaza peace signing ceremony was how the day ended, and of course he had traveled earlier in the day to Israel, received a hero's welcome there, addressed the Knesset. Everyone from all sides of the political spectrum are very thankful for the effort and momentum that the Trump administration had put into getting this deal across the line. And then he managed to gather some of the biggest leaders from around the world in Sharm el-Sheikh in Egypt for that Gaza signing ceremony. There you're looking at images of him quite literally having these leaders line up one for one for photo opportunities with him. So a huge diplomatic breakthrough, but of course let that not take away from the substance of what was achieved, which was a major human day as well, with the return of the hostages reunited with their loved ones, with the return of Palestinian detainees alongside prisoners, with the cessation of hostilities and the resumption of humanitarian aid into Gaza. The big question from here, Francine, is how you can keep up this momentum, the focus from the international community, and take this ceasefire, this truce, and turn it into something more long-lasting.
Yeah, Jumana, how fragile is the ceasefire, given many details are still left to be worked out?
I think there's hope at this point that the ceasefire may lead to something more permanent. And the key is that word momentum and the fact that President Trump is appealing to the international community, to world leaders, to keep the focus on, i.e. this, from yesterday's perspective, is no longer just an Israel-Gaza or Israel-Palestinian issue. It has become a focus for the international community. And so of immediate concern is going to be the demilitarization of Hamas and what that actually means in effect, the monitoring of the ceasefire, establishing an international security force and the participation of some of the Arab countries with the establishment of that force, the reform of the Palestinian Authority so that a credible, technocratic Palestinian government can be set up in the coming months, and then ultimately the eventual withdrawal of the IDF from the Gaza Strip. One thing I would say, though, is when President Trump was asked about the possibility of a future Palestinian state, he was non-committal. He has not committed to a two-state solution, and that stance remains even after his 24-hour or less than a 24-hour whirlwind trip around the region. So he's not yet committing to a long-term prospect of a vision for a Palestinian state. Nevertheless, a massive, massive day in the region and undeniably a huge diplomatic breakthrough for President Trump.
Jumana, thank you so much. Jumana Bersachi there in Dubai with the very latest, of course, on the Middle East. Now, coming up, a global deal values topped $1 trillion in the third quarter, for only the second time on record. We discuss the M&A outlook with Dietrich Becker, the president of Perella Weinberg. That's next, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Now, the M&A market heating up, with some even claiming that the animal spirits are returning to the sector. Now, according to data compiled by Bloomberg, global deal values have topped $1 trillion in the third quarter for only the second time on record. Now, we'll discuss all of this, the outlook, with Dietrich Becker, the president of Perella Weinberg, a boutique investment bank that advises major clients, including BlackRock and Thoma Bravo. Thank you so much, Dietrich, for joining us. So first of all, I mean, the volumes are pretty impressive. What do you think is driving them?
Well, first of all, thank you for having me, Francine. So, yes, we've seen a very active quarter. It has to be said that, we sort of immediately after Liberation Day, we had a wobble, and there was a period where not that much was being announced, and then since then we've seen a lot of growth. The world is sort of uncertain and it's shifting right now, and we are seeing companies redefining strategy. We are seeing, people focusing on investment in certain regions, in certain technologies. We're seeing companies and sectors transforming themselves. We're seeing private equity and private credit driving a lot of that activity. So there are a lot of drivers. The financing markets are open, so deals can get done and can get financed. And so the general sort of spirit is good. But having said that, it's not good in every sector. Some sectors are benefiting from this environment a lot more than others.
Yeah. But I mean, if you put it into context, so overall transactions are flat, but deal volumes are up. So what does that show?
It just shows that in highly valued sectors where a lot is going on, the big deals are happening. But you're right, overall deal volumes have not grown in the same way, and we're far away from the heydays of 2021.
Will the U.S. activity actually shift to Europe?
So, excellent question. There are plenty of reasons why things need to get done in Europe, and obviously, that's something we work on all the time. We have seen Europe being more active, actually, and we see a lot of interesting things in the pipeline these days. So the answer is I'm hopeful. Germany, France, Europe in general have found a degree of self-confidence, I would say, in 2025 as they are looking to sort of redefine Europe's role in the world. And there are many companies that are critical to that. And so, yes, we are optimistic that there will continue to be some attractive volumes in Europe as well.
I mean, Europe is attractive, right, in terms of valuations compared to the U.S. How does that factor into M&A?
So it's an excellent point. At the beginning of the year, all of the capital was accumulating in the United States, and Europe was pretty down. We then saw a resurgence, and we saw a lot of capital moving to Europe. We've seen a lot of capital looking to be invested in some of the big themes in Europe around defense, around infrastructure, around technology. And a lot of international capital is moving, and some of it sort of is shifting, I would say, from the U.S. to Europe. And so that in itself, I think, is going to drive some attractive volumes over the next 18 months or so.
Dietrich, I have the great privilege of being on air every day trying to figure out what's going on, and there's a lot of uncertainty. It's tariffs. Today we have U.S., China. How are clients dealing with this uncertainty?
Well, they're getting advice because it's complicated. But the answer is it's difficult, and it's very, very tough to be a decision maker of a global company these days. The sands are shifting every day, and the question of where you allocate capital, how you allocate capital, where you get capital from, all these things have shifted over the last, in recent years, and the market is continuing to innovate by providing different kinds of capital that then sort of helps drive some of the development of these companies forward. But the answer is strategies are changing very quickly, and as a result of that, strategy and M&A also changes.
So what can you tell us about, we look at, for example, Electronic Arts or some of these cases that have been studied. I mean, do you worry about bubbles, or do you worry actually about, a boom because you see this biggest leveraged buyout ever?
Yeah, well, look, we've seen very high valuations in a number of sectors, and there's a lot of talk these days about potential bubbles in certain sectors. The world is, in fact, bifurcated. You know, there are sort of the very hot sectors, which are really, really attracting a lot of capital these days. AI, defense, infrastructure, energy, energy technology. But then there are also, electronic arts is an interesting space. Media, there's a lot of transformation there. And so, you're seeing a lot of high valuations and a lot of activity in those spaces. In certain industrial, consumer, and other areas, it's a lot more quiet. And so those companies need to figure out how to reinvent themselves and to attract capital for their strategies.
I mean, defense is I would say quirky because it's it's technology. It's very much kind of depending on what the government also wants to do. Could you ever see M&A in that space?
Well, there's a need for M&A in that space because we have a very fragmented industry, particularly in Europe. And so now, as Europe is trying to redefine its defense strategy, it needs to also create the companies that are able to actually provide what Europe needs. There is a degree of appetite for sovereignty in Europe that requires innovation and technology. What defines innovation in defense is currently being, completely redefined as a result of the experiences of the war in Eastern Europe. And I would expect a lot of these European companies to innovate, but also to see consolidation. I think the answer is yes, there will be some deals in defense.
So could you see big European champions in defense or even AI or even data centers? Like, what can Europe be really, really good at?
Look, I think Europe can be really good in application of AI. I think that's an area where already a lot of really interesting companies are emerging. There's the whole question of who provides the AI, and then the whole question of what you do with it. And I think that there's a lot of really interesting opportunity for application of AI and for technology in Europe. And great companies are currently coming up. And by the way, some of them are very much in the defense area. I think that, the spending commitments that have been made, for example, by the German government are attracting a lot of other capital from around the world that is going to be deployed in areas like defense and infrastructure. And so in those areas, I suspect we will see a lot of activity.
Do you worry about valuations? Do you worry actually about a bubble in AI?
Look, it's a great question, and people far smarter than I am are debating that these days. I think that we are still in the early stages of what AI will do to everything that we do, and so there will be unbelievable success stories, but I suspect that some of the capital that's being deployed in AI today is probably not going to be generating the kind of returns people are hoping.
I think we only have time for one question. I'm debating whether to ask you what keeps you up at night or how you deal with jet lag. So maybe a little bit of both. How do you deal with jet lag? Because you travel all over the world all the time.
I do indeed, and it was a lot easier 20 years ago than it is today, but I'm very thoughtful about which flights I take. I'm thoughtful about how I eat. I drink a lot of water. I make sure that sometimes I get drips. To sort of re-energize me, but there's real method to the madness.
I love that. So, given you're not actually awake because of jet lag, what do you worry about?
Look, it's a very uncertain world, and I wake up every morning, I think like most people, wondering what's going to happen today that's going to shift the sands that we're all walking on, and that in itself is sort of what's keeping me up at night. I think we've come used to a world in which uncertainty is normal. It's actually pretty good for us. We're advisors that help companies work through difficult situations. And so complexity is good for the business model, but generally speaking, there are a lot of things I worry about because I have kids.
Perfectly said. Dietrich, thank you so much for joining us. Dietrich Becker there, president at Perella Weinberg, with some life advice and, of course, a good overview on what could go right or what could go not so right. Bloomberg NEF Summit taking place in London over the next 2 days, with the whole event being streamed live. Among the conversations, our very own Anna Edwards speaking with the European Commission Executive Vice President Teresa Ribera. You can follow that by hitting live on the Bloomberg terminal. And one of the conversations I know that Brussels is having is actually there's been so much focus on green. Could you now combine green and defense, because so much of the money is going into the defense industry? Up next, Bloomberg Brief, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, and the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Good morning, it's 5 a.m. in New York City. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Mounting trade tensions, China placing limits on 5 entities tied to a South Korean shipbuilder, threatening further retaliatory measures. And big banks kick off earnings with JP Morgan, Wells Fargo, Goldman Sachs, and Citi all on deck this morning. Thus, stocks dip following Monday's gains as investors await Fed Chair Powell's remarks. And of course, we're going into a blackout period, so these will be the last remarks we get. We're also, of course, in that data vacuum, so we'll definitely be parsing what he says today. But as you can see, risk cracking once again today. Futures pointed lower even after multiple percentage point gains for the indices yesterday. This on the idea that China trade tensions may be mounting further. It depends on where you look, though. If you look at the Ministry of Commerce this morning, it came out urging the U.S. to de-escalate. And there's some suggestion from Treasury Secretary Scott Bessent in the Financial Times that perhaps China's Ministry of Finance and Ministry of Commerce are not on the same page. So it's all fascinating. But right now, markets are taking it as risk off. If we look at bonds, they're also bid. We have yields down another couple of basis points today. And you can see the 30-year yield at 460, the 2-year yield at 470, and that 10-year yield hugging 4%. The VIX is above 21. We also have a much weaker euro. It's at underneath 116 today. We'll be chatting later on about all of these asset classes. But first, let's get across to London for some individual stock movers. Good morning, Valerie Teitel.
Good morning, Avani. Let's start in the tech space. NVIDIA announcing a tie-up with Navitas Semiconductor, and those shares are jumping 28% in pre-market trade for Navitas. Now, Navitas has some technology that helps turn a AC current into a high-voltage DC one, and NVIDIA wants this because it helps them be more efficient when it comes to powering those AI stacks of NVIDIA chips. So Navitas shares jumping nearly 30% in pre-market. let's move on to rare earths, the topic du jour. We're seeing critical metals rally yet again. This is one of the biggest miners in North America, up 38% on the back of some news that they have secured a long-term buyer for future production from a massive rare earth mine that they are building in Greenland. So rare earths, again, a big topic of the day. Lastly, let's move on to Papa John's. This one might leave you a bit hungry, Ivani. They are shares are rising yet again over takeover speculation, up another 2.5% after a 10% rally yesterday. And this comes after a report that Apollo has submitted a takeover bid for Papa John's at $64 a share. Comes after months of speculation for a takeover target. Bonnie?
The perfect 5 a.m. snack, Valerie, just when you're going to bed, not when you're getting up. That's Valerie Teitel in London there. Thank you. And in just moments, we're going to be speaking to Henry Allen of Deutsche Bank on the market resilience. Later this hour, JP Morgan's Kelsey Barrow joins us to discuss the labour market and the yield curve. So Henry Allen then of Deutsche Bank, staying optimistic despite the ongoing trade war between Washington and Beijing. He says it's in no one's interest for a recession to occur, writing this: a key reason for the market's resilience in 2025 is that sell-offs are acting as a consistent brake on policymakers. Henry joins us now. He's macro strategist at Deutsche Bank. So a consistent brake on policymakers, but will markets be a consistent brake on the Washington-Beijing link, Henry?
I think they will, because actually one consistent theme that I think we've a bit forgotten about as we've recovered so fast in terms of market performance is just how important that US-China trade truce back in May was to alleviating fears that there might be some sort of recession after the Liberation Day turmoil. So when the US and China did reach that trade truce in May, and that was the one that lowered tariff rates by 115 points on both sides, we saw a huge risk-on move in response. The S&P 500 was up more than 3% that day. High-yield credit spreads tightened by 38 basis points in a single day. So the fact we're then getting the reverse of that, a sign that that trade tension might be on the escalation again, has naturally led to the reverse move. We saw a big fall on Friday. Credit spreads widened considerably. But just as we saw back in April, we also know that policymakers don't want sell-offs. They create negative wealth effects, bad headlines, generate unpopularity. So it's really not in their interest for that to happen. And we have seen consistently that, generally speaking, the escalations in the trade war happen at the highs for the market. And as we see a sell-off, that then tends to lead to de-escalations.
Henry, I would posit that U.S. policymakers perhaps don't want to see a sell-off, in particular the president, but do Chinese policymakers care if there's a sell-off in U.S. assets, or U.S. equities at least?
So I think Chinese policymakers are certainly more sanguine on the performance of the US stock market. But of course, at the end of the day, that's what Trump is reactive to. And we saw most notably back in April when they delivered the 90-day tariff extension just a week after Liberation Day, which was evidence for how sensitive they are to market turmoil. They don't want that to happen. We've seen that similarly on central bank independence, that on both occasions when there were credible reports that Federal Reserve Chair Jay Powell might be fired, both on Easter Monday back in April and again in mid-July when there was that New York Times report, the administration quickly rode back. So, it's clear that both for equities and for bonds, they really don't want to see the kind of disruption that would generate those negative headlines and cause a downturn in the economy. After all, US inflation is already picking up a bit. The tariffs are likely to slow growth relative to what it otherwise would have been. So they don't want to make that situation worse, and Trump's entire rhetoric is about creating kind of the new golden age of America and a new age of prosperity. So if there is a downturn or much slower growth, that really isn't in his interests.
We're going to be hearing from Fed Chair Jay Powell a little later on, but we did hear from Philly Fed President Anna Paulson yesterday, and I want to play you something she said.
Labor market risks do appear to be increasing, not outrageously, but noticeably, and momentum seems to be going in the wrong direction. Against this backdrop, the FOMC's decision to cut rates by 25 basis points in September made sense. Over the rest of the year, I view easing along the lines of the median SEP policy path as appropriate.
So, Henry, we're likely on the cusp of another 25 basis points decrease. What's your view for the rest of the year into next year? And will any of this give the equity market boost, another leg up? Or does that all depend on other geopolitical matters?
I don't think the Fed cuts by themselves are likely to boost the equity market simply because they're already priced in. A 25 bip cut in The next meeting is widely expected again in December. So I don't think that would come as a surprise. I think the big issue for the Fed right now is twofold. One is that inflation is still running above their target. It has been for over 4 years now. Now, it isn't the high inflation of 2022, 2023, but it's still lingering in the high twos and widely expected to go up into the threes in the coming months because that tariff impact is still hitting the economy. It isn't a one-off price shock. They're lagged because, we had the 10% baseline in April. We then have a bunch of sectoral tariffs. We then have further trade deals. Now we've got this 100% tariff threat on China as well. So we've got this continuously sequential tariffs coming in. And then at the same time, the other issue the Fed faces is that they're flying blind on a lot of the economic data due to the government shutdown. So, we still don't have the jobs report that was meant to come out at the start of the month. CPI would have been tomorrow, but it's looking as though we won't get that tomorrow either. That's going to be delayed. At the rate things are going with no sign of a compromise between Republicans and Democrats, it's not implausible that we even see the next jobs report at the start of November impacted as well. So that's making life very difficult for the Fed because, yes, we do have private survey data they can use, but that's pointing in different directions. So you've got some surveys like the ADP suggesting that private payrolls contracted in the most recent month. You've also got some more optimistic stuff as well.
Yeah, and we are getting that CPI data October 24th. They have called some people back into the BLS. Henry, this idea of a debasement trade is, as if we didn't have enough to think about, this idea is percolating strongly now. Are you seeing evidence of it? And if so, what regions, where are the flows going, what asset classes?
Well, it's a fascinating phrase, the kind of debasement, because the original great debasement actually happened in the 1540s under King Henry VIII in England. Basically, his policy was, and some argue there are parallels today, he literally changed the gold and silver coinage by inputting more base metals like copper into the coinage. And so that generated widespread inflation in England in the 1540s. So that's the debasement idea going back 500 years. Today, I think we're seeing some echoes of that. I think investors are fearful about inflation, partly to that point that inflation is still lingering above target. There hasn't been the real willingness to show proper hawkishness to get that down again. But then we're also seeing huge flows, of course, into gold and silver prices, both at record highs right now, which actually echoes what we've seen in previous debasement instances, because there is a recognition that when inflation gets going, it is those precious metals that keep their value. We saw that actually in the 1970s as well. One of the few assets that did really well in the double-digit inflation of the 1970s were gold prices. So absolutely, I think those are one of the best hedges right now because they've had such a consistent track record of keeping their value as investors are fearful of debasement.
Henry, thank you so much. That is Henry Allen of Deutsche Bank there joining us. Now to other top stories trending on the terminal this morning. Japan's main opposition parties are meeting today to weigh the possibility of uniting against ruling Liberal Democratic Party leader Sane Takaichi. The vote could oust the long-ruling party from government. UK employment through August unexpectedly rose and wage growth slowed more than forecast. The latest data prompted traders to add to bets on further rate cuts from the Bank of England. UK unemployment rose to 4.8%, the highest since May of 2021, and wage growth slowed to 4.4% in the private sector. Samsung disappointed investors despite reporting its biggest quarterly profit in more than 3 years, in a sign of healthy AI chip demand. Shares slid as much as 2.1% in Seoul, reversing strong early gains. The slide is due in part to high investor expectations. Coming up, trade tensions heating up. China hits back with curbs on some units tied to a South Korean shipper. More on that next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Earnings season is here.
Earnings season begins once again.
So much going on.
Bloomberg is first to break the numbers.
From Snowflake, from Pure Storage, from Urban Outfitters, and yeah, from NVIDIA.
Coming up, we'll talk about some of the other earnings that are coming out.
With the smartest insights.
Third quarter numbers are going to be really important. The commentary is going to be important. It's all going to be about margins because margins lead to earnings. And if earnings come down, we have a problem.
You have to come back again soon. This is really excellent.
Continuing coverage on Bloomberg.
I'm Bonnie Quinn in New York. It's time now for your front page news. First up on the Washington Post, officials have reversed more than half of the roughly 1,300 layoff notices sent to staff at the CDC. The move spared personnel dealing with measles outbreak in the United States, but staff responsible for monitoring and protecting the U.S. from biological, chemical, and nuclear threats have been hit by the layoffs. Next up on the Wall Street Journal, President Trump's big gamble on tackling Middle East problems. Trump wants to quickly pivot from a Gaza ceasefire to the perhaps thornier problem of broader peace in the region. He's betting that 2 years of war transforms the region so much that animosities can be set aside. And on the Financial Times front page, U.S. Treasury Secretary Scott Bessent has accused China of trying to hurt the world economy. This comes after Beijing imposed sweeping export controls on rare earths and critical minerals. In that FT interview, Bessent said this is a sign of how weak China's economy is and, quote, they want to pull everyone else down with them. Meanwhile, over in France, Sébastien Lecornu will address the Parliament today for the first time since being reappointed Prime Minister as his fledgling government tries to pass a budget. Joining us with the latest is Bloomberg's Caroline Conan from Paris. Caroline, what happens today?
So Sébastien Lecornu will deliver his general policy speech at 2 p.m. London time, 9 a.m. New York time. And of course, this is again a moment of truth. You know, he was supposed to deliver this general policy speech last Tuesday, but then of course you had this whole political saga last week with Lecornu resigning and then reappointed on Friday night. So clearly today is this moment of truth, and the socialists who have 69 MPs in parliament have actually become the kingmakers, and they have said that they will support another motion of no confidence against Sébastien Lecornu in a couple of days' time, unless he decides to say today that he's suspending the pension reform, you know, this 2023 reform that is the flagship reform of President Macron's second term that passed back in 2023 after months of protests and strikes in the streets, and that is supposed to bring the retirement age from 62 to 64 years old in France. So the socialists want to suspend this until the next presidential elections, which at the moment is planned for 2027. We'll see if that's where Lecornu is heading, but everyone in his entourage have been calling for this suspension because another government collapse in France would probably cost more than just suspending this reform for a couple of years.
Caroline, would he have to get Macron's permission to roll back the pension reform? And if he got that permission, wouldn't that weaken Macron, beyond repair?
He may have got that permission just now because, in fact, he spent the last hour at the Élysée Palace with President Macron. There was supposed to be a cabinet meeting an hour ago, and that cabinet meeting was delayed by 1 hour, so no one knew exactly what was going on. But then we found out that Le Cornu was indeed with President Macron, probably discussing, this is it, this is the last chance. And Le Cornu has accepted his appointment on Friday, saying that he only was doing this out of duty, that his only mission was to pass a budget, and he's described himself as a soldier monk to this whole situation with the budget. So he will do everything in his power to avoid another collapse. And in fact, he is presenting his budget as we speak in a cabinet meeting. That will be the next step. This budget will, of course, be very much amended in Parliament because Le Cornu has said that he will not seek to force the bill through Parliament without a vote.
Well, we are seeing the weaker euro and the OIT Bund spread back around 84 basis points. We'll continue to keep an eye on this evolving situation. Caroline, thank you. That is Bloomberg's Caroline Conan. Coming up, mounting trade tensions. The latest on the US-China tit-for-tat next. This is Bloomberg.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs?
How
and you're lowering the cost of the meatballs.
I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We actually are running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday. Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
is Bloomberg Brief. I'm Bonnie Quinn in New York. China hitting back at the U.S. by sanctioning 5 American entities of the South Korean shipping giant Hanwha. This comes as President Trump's tariffs on furniture and lumber take effect today. Now, in an FT interview, Treasury Secretary Scott Bessent accused Beijing of damaging the world economy after China unveiled restrictions on rare earths and critical minerals supplies. Joining us now to pull it all apart is Bloomberg Executive Editor for Asia Markets, Paul Dobson. Paul, I want to ask you about the shipping first, because obviously China is putting limits now on some units of a South Korean shipper, but the U.S. had already imposed port charges, which was affecting China. So who hit out at who first, and from which side is the retaliation coming from? Can we even tell?
It's a little bit like a playground dispute in that respect, isn't it, Bonnie? You know, he started it, no, he started it. But what we do know is that there's this continuing tit-for-tat escalation, particularly in the maritime space in this regard, you know, not just over existing ships and where they can dock, but also over shipbuilding and that industry. The US has seen a decline in its shipbuilding industry. South Korea is trying to help it to recover. China sees that as a threat because China has been a dominant force within shipbuilding in recent years. So there's that kind of friction going on there. But the bigger thing, you know, and what really is rattling the markets isn't so much about these ship companies at all. It's about the fact that, you know, the assumption is that at some point there will be a sort of stop in the tit-for-tat. Raising of more barriers and more kind of obstacles, and again, getting down to doing some serious talking and ironing things out again. And at the moment, we're seeing an escalation rather than a de-escalation or calm, and that's why markets are so upset by the latest news.
So much whipsawing. Now, the Treasury Secretary said a lot in that FT interview. He said he still expects the meeting to go ahead between President Trump and Xi. But he also made the suggestion that the Ministry of Finance and the Ministry of Commerce are not on the same page in China, or that perhaps they're on purpose not on the same page, that they have a different approach. Is that even possible in a country like China? Could that be something that's actually true?
Well, the way the Chinese decision-making is made is often kind of, you know, disparate and then by committee and consensus and stuff like that, and it all comes back up to central decision-making. So it is possible that at times there's not a complete alignment or singing from the same hymn sheet, but you could equally argue that it's quite possible that the US government is trying to sow some, you know, disarray or throw some sand in the eyes of the Chinese decision-makers to try to, you know, create some internal tension and friction and stir things up a little bit too. So, you know, information, disinformation, that kind of thing is all going on. I think, you know, Besson's other point, though, that this isn't just, you know, kind of bad for the US, but is bad for the world, is something that is chiming with other people that the US are talking to. The idea that China is really, you know, doubling down on the regulation of exports of rare earth materials to everywhere and not just to the US. And this is another area where that competition is really heating up. So a really interesting thing we saw today was a lot of Australian critical mineral companies saw their stock price really surge on this idea that the US may be interested in taking equity stakes in some of those companies, i.e. tying up that supply chain a little bit more towards the US and away from China. And that's the kind of positioning and elbowing for sort of power, authority, influence that we're seeing in some of these spaces at the moment.
Paul, thank you so much. Wonderful context. That is Bloomberg's Paul Dobson there. Coming up, we're going to be speaking with Kelsey Barrow of JP Morgan Asset Management on the Fed's gradual descent to neutral as we await Chair Powell's remarks later on, and as we see this Treasury market bid as we come back online today after the holiday. That's all next. This is Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here is what you need to know. Mounting trade tensions. China places limits on 5 U.S. entities tied to a South Korean shipbuilder and threatens further retaliatory measures. Big banks kick off earnings with JP Morgan, Wells Fargo, Goldman Sachs and Citi all on deck this morning. And stocks look like they might take a dip today following Monday's substantial gains as investors await Fed Chair Powell's remarks. So let's look at those futures now because it looks like risk is cracking. You can see they're all pointed lower. NASDAQ 100 futures, the worst performers. Let's take a look at yields as well because we're seeing the yield curve bid to the degree that we're seeing the 2-year yield down 3 basis points, that 10-year yield hugging 4%, and the 30-year yield down a basis point or two to 4.60. We're also seeing gold just off its record high, which it hit earlier today. So that gold trade continues, as my next guest just pointed out to me. We'll get to her in one moment. But first, let's get to some individual stocks to watch. Here's Valerie Teitel in London. Valerie.
Good morning, Bonnie. Let's start with trades in the AI space. NVIDIA announcing a partnership with Navitas Semiconductor. We're seeing shares of Navitas rally over 25% in pre-market trade. Now, Navitas has a technology that helps convert an AC power grid into high voltage DC power. And this is critical when it comes to NVIDIA, who's looking for more power efficiency when it comes to their stacks of AI chips. So this is a positive one for Navitas, up some 26%. Let's move on to rare earths. These have been in the spotlight this week and last week. Vonnie, as you know, critical metals up 35% in pre-market trade. This comes after they've announced they found a long-term buyer, a 10-year buyer for a future production of rare earths coming out of their massive mine in Greenland. Now, this would help them expedite the mining in that space now that they have contracts tied to a buyer for those final products. And lastly, I want to move on to a Wall Street Journal report on some M&A when it comes to major timber players in the U.S. 2 of the largest timber producers in the U.S. are set to combine. The Wall Street Journal is reporting could create a $7 billion behemoth. We heard shares of Ryanair up 1.5%, and PotlatchDeltic, those shares are up over 7% on the back of this report. Vonnie?
Just as tariffs go into effect on lumber. Thank you so much. That is Valerie Teitel. JP Morgan's Kelsey Barrow seeing Fed rate cuts in October and December with a mosaic of private and survey data suggesting downside risks to the labor market. She writes, quote, the Fed's gradual descent to neutral could still be accelerated with significant scope to cut rates below neutral if warranted by the data. I'm pleased to say Kelsey joins us now, fixed income portfolio manager at JP Morgan Asset Management. Kelsey, what would entail an accelerated glide path? Would it be, less wage growth, just more people signing on?
So I would say that probably the thing that would get the Fed to accelerate the pace of rate cuts would be a rise in the unemployment rate. Now, I hesitate to say that as we are in a government shutdown, so we don't get the unemployment rate, we don't get initial jobless claims. But what the data that we do receive is telling us is that it is increasingly hard to find a job, and that the downside risks to the labor market are probably the more important thing for the Fed to be focused on, rather than the continued escalation of tariffs and what that means for inflation.
What is this yield curve telling you right now? Because we're right down to 4%. We didn't get any of the move that we got yesterday in the equities market because obviously the bond market was closed. So the bond market took a stance and it's still there. But a 4% on the 10-year, 4.60 on the 30-year?
Yeah, so here we are again at 4% on the 10-year. That's been a significant resistance level for the market. But if you look at the front end of the curve, we continue to reach lower lows in terms of yields. And when you have lower lows in the front end, but you have more resistance in the back end, that's what's resulted in some of the curve steepening trades that we've seen that come in fits and starts throughout the year. Now, our range for the 10-year Treasury yield that we think we should be trading in is around 3.75 to 4.25. So we're smack dab in the middle of that range right now. Now, when I see the data kind of across the board and the live market prices, you have the weakness in the oil markets, weakness in equity futures, and then you have the strength in the dollar and the strength in the bond market. In these kind of classic risk-off episodes, what is most encouraging to me is that fixed income is continuing to serve as that ballast in the storm. High-quality fixed income relative to a few years ago is performing very well and is anti-correlated with the riskier parts of the portfolio.
So you're smack bang in the middle of your 50 basis point range, which is quite the range. If we get that cut at the end of October, does that range change, or do you just assume there's another one in December and we're just moving along nice and, moderately?
Yeah, so if we get the cut in October, which I think is really the market's base case, it doesn't necessarily mean that the range for the 10-year Treasury has to move significantly lower than what it is now. Just cutting from here, I think at this point, is still viewed as risk management cuts within a soft landing or sub-trend base case. In terms of what I would be watching in terms of the market is not so much what the market pricing is for October and December, and more about where the terminal rate is. So the market pricing of the terminal rate, so the lowest point of the Fed funds rate in this cycle, has been fairly sticky and hasn't been able to fall materially below 3%. And that's an indication that despite some of this uncertainty, volatility, government shutdowns, tariffs, the market still doesn't see the need for the Fed to cut materially below neutral. And that's where the asymmetry in duration and owning duration portfolio really comes in.
You say it is a possibility, though, that the Fed could end up doing that. What would be the various factors that would have to coalesce in order for that to happen?
Right. So I think it does come down to the labor market. It comes down to the unemployment rate or an increase in layoffs. But also, financial conditions are a big thing to watch. One of the tailwinds for growth in the second half of the year has been the easy financial conditions, the tightening or relative tightness of credit spreads. To the extent that that starts to soften a little bit, reduces that impulse, that positive impulse from easy financial conditions.
Bondholders elsewhere, France and Japan in particular, are demanding more yield, but that's happening in more and more countries now as we get more and more indebted. Has that become a significant theme for your investors yet? And what should we be looking at in terms of the United States if that really takes hold in the US? Because it hasn't fully yet.
Right. So, we've had cycles and market narratives that have highlighted the stress in certain deficit trajectories. And more recently, the two, that I think have been most focused have been France and Japan. And, from those perspectives, I would say that there has been a lot of opportunity in terms of active management and positioning within the European sovereign debt market. It's not just one market, it's many markets. And you've had the trajectory of some of these markets kind of go in opposite directions. And so you've seen for the first time, for example, that the yields in France are above the yields in Italy, or the first time in quite a while. And that's an indication that the market is reassessing some of these trajectories, recognizing that, the prior winners may not necessarily be the winners in the future. But as it relates to the U.S., obviously we've seen record highs in gold, as you mentioned at the open, also demand for silver. And there's a lot of questions around dollar debasement. And when I look at the dollar today, the DXY, which is up, and when I look at the continued robust demand for treasuries, which you see today in the price action, but also in the auctions, what I would say is that this to me seems more like a technical story associated with the gold and silver markets rather than necessarily a clear fundamental rebuke of the dollar at this point.
Right, okay, yeah, the dollar index DXY firmly above 99 now, but we are seeing a much weaker euro today and a stronger yen. Kelsey, this dollar story, how does that impact treasuries? Will we continue to see, for example, the appetite that we have been seeing, which hasn't been terrible? I mean, some of the auctions were middling, but mostly we've seen pretty okay auctions.
Yeah, auctions have been fine. I would say that there is still a robust demand for fixed income, particularly high quality fixed income. I think there is an interesting debate around how the dollar will perform if this risk-off environment continues. So traditionally, the framework that's used to think about the dollar is something called the dollar smile, where you have the dollar perform the best in two extreme scenarios, one in which the U.S. is significantly outperforming and one in which the U.S. is significantly underperforming. What we've seen more recently is what we call the dollar smirk. So the U.S. dollar still outperforms when the U.S. is doing exceptionally well, but in those risk-off scenarios, you haven't necessarily seen the same bid to the dollar. And I think it will be interesting if this risk-off trade does continue to watch what we really see there in terms of sponsorship.
All right. A smirk doesn't tend to last as long as a smile, right? Kelsey, thank you so much for joining us. That is Kelsey Barrow of JP Morgan Asset Management. Now to the other top stories trending on the terminal this morning. The International Energy Agency raised its estimate for a record oversupply of oil in 2026. In its latest report, the IEA said that global oil supply will exceed demand by almost 4 million barrels a day next year. That's roughly 18% above last month's estimate. The average price of a new car in America topped $50,000 for the first time last month, driven by a surge in sales of EVs and luxury models. New car prices are up more than 25% from 5 years ago as Americans buy pricey trucks and sports utility vehicles while spurning budget models. Google plans to invest about $15 billion to build an AI infrastructure hub in southern India over the next 5 years. It will be Google's biggest investment in India to date. The project will anchor the regional government's plan to accelerate the local AI industry. Coming up, the latest turn in the US-China trade tit-for-tat. Details on China's new shipping curbs next. This is Bloomberg.
Used to be, one would say, What's that got to do with the price of tea in China when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. China is hitting back at the U.S. by sanctioning some U.S. entities of a South Korean shipping giant. Meantime, Treasury Secretary Scott Bessent tells the FT that China is trying to damage the world economy after it imposed export controls on rare earths and critical minerals. Joining us now is Bloomberg's Roz Matheson. So, Roz, we are seeing a tit for tat. Depending on where you look, it's either China's trying to escalate or de-escalate. And this FT interview really did have a lot of poking on the part of Treasury Secretary Scott Bessent. In your opinion, does this get ratcheted back?
Well, it's interesting because we are seeing, you're saying, a lot of posturing going on. So China and the US trying to get potentially in the strongest position going into this possible conversation between Xi Jinping and Donald Trump later this month in Asia. But it's quite risky business that they're doing because they are coming at each other in a variety of ways, not just rare earths, critical minerals, the tech space, but also, as we've seen now, shipping, just reflecting the extent of the tensions across the trade and economic relationship between these countries. And some of it may just be largely posturing. It may be trying to get in that position ahead of the meeting. But again, you know, up until that meeting, Xi Jinping and Donald Trump both need to decide for themselves, does this meeting still make sense? Am I going to go into that meeting and come out of it with what I need, or is there risk here in even having that conversation? And so it's really about not getting to the point where this relationship gets so tense they decide not to meet at all. I mean, you heard the comments from Scott Bessent to the Financial Times saying that China is apparently hurting the global economy. So the message is that China's causing itself reputational damage, not just with the US and others. But in the same token, he's saying the lines of communication between the US and China are still open. He, in fact, plans to meet with the Chinese Vice President, He Lifeng, one more time, possibly this month, before a Xi and Trump sit down. So on the one hand, there's the tough talk that's going on and these actions that are happening. On the other, there's a sense that conversations are still going on, at least behind the scenes.
And it's interesting, it almost seems like the soldiers are doing the fighting, right? But they're leaving sort of the leaders out of it for now. President Trump actually saying warm things almost about Xi Jinping the other day on his plane. And Scott Bessent saying he does think that this meeting will continue to go ahead, even as he said that he doesn't think that the Ministry of Commerce and Ministry of Finance are on the same page when it comes to US policy. So it really is a fascinating play out. Do you think that these tariffs that take effect now, though, will bring down parts of the U.S. economy, as Scott Bessent has said, or at least hurt them deeply, even if they're rolled back at some point, Roz?
One of the key things that is happening alongside all of this is, in fact, that tariffs are taking effect on products including lumber, timber, kitchen cabinets, upholstered furniture. And so those are taking effect and due to, in fact, go up even more come January, unless, of course, all the legal actions against this tariff regime collapse it. And so the question is, what does that do to the US economy at a time when there are lots of concerns around housing affordability, the status of the construction sector, and that's something that Donald Trump is looking at very closely. He wants that to be, you know, a priority. But do these tariffs hurt housing affordability in the US? Do they hurt the building sector? Do they deter construction? Already we're seeing building materials prices have been going up, and they've been going up for many years, but does this give another leg to those prices rising? And so does that impact, you know, the US consumer, people who are trying to build houses or look to increase their furniture? And so do we see, in fact, damage to the US economy down the line from these tariffs that the US administration is enacting?
And of course, there's the rare earths question as well, Roz. The Treasury Secretary also talking about how China is just ruining everything by, you know, taking away the possibility of importing rare earths, but that there were other places the US could get rare earths. That's not quite true, is it?
Well, that's right. They're rare for a reason, and that's because there's only a few parts of the world you can get them, or you can get them easily, or you can get a reliable supply. And that's really been a fundamental part of the tensions between China and the US. China has them, the US wants them, and China can control supply and turn that on and off. And China keeps saying, yes, we're going to send you more rare earths, and they're not necessarily doing so. And so that's really the key leverage point in the relationship. And now you see Scott Bessent again casting this as a broader thing. What China is doing is not just at the US, but it's hurting the global economy. It's going to hurt countries around the world. And that idea of reputational damage for China at a time that China is trying to position itself as an alternate power globally and a statesman in a way on the stage on a whole lot of other issues, including the environment. This messaging from the US is that China is possibly going to be self-defeating.
Roz, thank you so much. That is Bloomberg's Roz Matheson there. U.S. bank earnings kicking off this morning with JP Morgan, Wells Fargo, Goldman Sachs and Citi all on deck. Bloomberg's Nora Melinda joins us now for more. So Nora, big picture, what can we expect out of these big banks?
Well, a big day, especially as we kick off earnings season here. Of course, in the absence of government data, given the shutdown that we've been experiencing, a lot of eyes are going to be on these key big banks here in the United States, of course, especially as we've been seeing a rebound in deal activity. If you look at the KBW index, which tends to look at a lot of banks, including regional banks here, it's actually nearly doubled in terms of gains in comparison to the S&P 500. So we really have seen a pretty robust picture here for a lot of these banks here. So it's about the continuation here. There's going to be a lot of scrutiny in terms of M&A activity. Of course, the ever going on story of tariff concerns here. People are really going to be nitpicking these fine details here from some of these bigger names.
I want to concentrate on Goldman for a minute because it's lost a lot of senior bankers recently and it does seem to be on the back foot. I mean, it is up 37% this year, but what in particular are we expecting out of Goldman?
I mean, Goldman, people are actually expecting some top-line growth here. Of course, this is actually due to the IPO activity that we've been seeing from Goldman Sachs, as well as the deal activity that, of course, has kind of been underscored more broadly across the entire industry here. But I mean, as we think about the deal that they have coming up here, it's really just about them trying to get some closer proximity to the banking space, as well as just any sort of private affiliation here. A lot of these companies are remaining private here with a little bit less IPO activity more broadly in the market.
Yeah, Goldman agreeing to buy venture capital investor Industry Ventures. It's a $965 million deal. How unusual is this kind of a deal for a bank like Goldman, Nora?
I mean, if you look at what we're seeing year to date in terms of the gains here, I mean, I think any sort of news like this is going to propel a bank like Goldman forward, and especially just given the fact that we are seeing some M&A, we are seeing some deal activity in the broader banking space. It's really about whether or not we can see a continuation here and what the outlook is like and what we're hearing from the commentary from these earnings calls moving forward here, Bonnie.
Are we anticipating any surprise to the downside? I mean, you know, JP Morgan usually brings us its fortress balance sheet and everything is usually pretty good with JP Morgan, and likewise for many of the others. Any analysts out there sounding notes of warning?
I mean, I think that it's always just about whether or not there's any sort of cracks, particularly in credit. That's what a lot of people are focusing on heading into these reports here. I mean, if you look toward Tricolor, First Brands, I mean, these are stories that we've really been covering in recent weeks. And so there is some sort of caution as we're heading into the season as to what these other banks are flagging in case there's any sort of, uncertainty ahead, but it's really an interesting picture that's being painted right now, but broadly expecting positivity out of this earnings season here for these major banks.
Yeah, we're definitely listening to those earnings calls after the releases. Nora, Melinda, thank you so much. That is Nora there. Coming up, those bank earnings kicking off and Fed Chair Powell's remarks in your day ahead. We'll get you prepped. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. Of course, bank earnings kicking off with JP Morgan, Wells Fargo, Goldman Sachs, and Citi all reporting before the bell. It's going to be a busy morning. Busy afternoon, too, because Fed Chair Jerome Powell is speaking at the NABE conference in Philadelphia at 12 p.m. Eastern. And, of course, it's the start of the blackout period, so all eyes will be on that. And President Trump is welcoming Argentinian President Javier Milei at the White House. That takes place at 1 p.m. Let's take a look at some of the movers now in the pre-market. Critical mineral firms extending gains as trade tensions between the U.S. and China intensify. As you can see, up another 36%. Navitas Semiconductor rising as the firm unveils devices for NVIDIA. Another nice gain for Navitas today. And Coinbase down about 4% of the pre-market as Bitcoin drops below 112. You've Mara Holdings, Cipher all lower. Cryptocurrencies, altcoins in particular, down by more than $150 billion over a 24-hour period, according to CoinGecko. As for the macro picture, well, it doesn't look too pretty on the equity side of things. We have yields lower today as the bond market is bid, and gold once again at a record. That's it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
there is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
For many investors, there aren't that many alternatives to the U.S. market.
There has been so much complacency within the market.
There are going to be pullbacks. Those could be buying opportunities.
Markets are just still so focused on AI is great for the long term.
This market is really going to get its mojo going forward from earnings.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, tension rebuilds. China and the US positioning for negotiations later this month as Fed Chair Jay Powell gears up to reveal his thoughts on the economy. JP Morgan is kicking off quarterly earnings season on Wall Street. Those numbers about 45 minutes away.
Can good news from corporate America overwhelm some of the geopolitical jitters that continue to mount overseas? This is a real question here. JP Morgan might not be indicative of the rest of earnings season. Nonetheless, people are highly attuned to any kind of volatility, any kind of downside surprise, any kind of mediocre surprise in any of the corporate earnings that do kick off in earnest this week.
JP Morgan kicking off things later this hour. Next hour, numbers from Goldman Sachs. This hour right now, equities pulling back by 0.9% on the S&P 500. Tension between the US and China in focus. Last week, it was about flexing over refining capacity of rare earths. This week, it seems to be about shipping.
It is about shipping. Today, China sanctioned the U.S. units of a South Korean shipping giant. This comes after what's going on with rare earths last week. What you see is both Beijing and Washington lining up the bargaining chips and the leverage they can use at the end of the month when President Trump and Xi Jinping sit down. Even more importantly is going to be when Scott Bessent, the Treasury Secretary, sits down with his counterpart, because he had some hot rhetoric in the Financial Times today when it comes to China, saying that this is a sign of how weak their economy is. They want to pull everyone else down with them.
And this is the problem, I think, for investors right now. Is this just positioning for negotiations later this month, finding some leverage, pockets of leverage, or is this the real deal, a sign of things to come?
Right now, the market's treating it as simply trying to get leverage. This is not a capitulation on the risk on trade. I think a lot of people saw that yesterday when we saw the huge swelling to buy the dip, when we saw conciliatory language out of President Trump. I keep thinking about what Pete Shear said yesterday at the Academy. It feels different. And this morning, I was thinking the fact that China did not offer up the same type of conciliatory language that we got from President Trump, that tells you something. It feels like maybe there is a slightly different tinge to this round of tit for tat.
It does feel different for me as well, because when you read through more of what the Financial Times is reporting, a senior U.S. official told the FT that the timing of what China did was so surprising because it was disproportionate to what they were expecting. So if this is fact, and the U.S. official is on background talking to the Financial Times saying that this was not what we were expecting, then that means that the rhetoric is certainly amped up going into the year end.
There's a bit of a tell in the bond market, by the way. That rally from Friday, it holds, it sticks. Yields are threatening to break below 4% on a 10-year maturity this morning. We're down 3. That line in the sand, we're right on top of it right now, 4% on 10-year bond yields.
People are more worried about weakness than they have been. They're worried about the blowback, the disinflationary aspect of the tit for tat, especially in lieu of what happened in April 2nd. That, to me, is a very different feel. Jean Bovin of BlackRock yesterday said long-term, we could still see that inflation. That could be a concern. But near-term, we could get a reprieve. And this is a perverse way of putting it, but we all understand that. A reprieve from the idea that the economy is slowing enough to give a bid to the bond market so you don't see those runaway yields. Not necessarily something that's screaming all clear for people to pile in, but nonetheless a tactical trade that a number of people are getting behind.
Stocks down, bonds up. Bond yields are lower this morning. We're down by 3 basis points on 10s, 4%. A break at 350 on 2s, 347 so far this morning. Coming up this hour, Keith Lerner of Truist with stocks whipsawed by trade tensions. Elias Galou of Bank of America as fund managers see risks of a bubble. And Gerard Cassidy of RBC Capital Markets as big bank earnings kick off later this hour. We begin this hour with stocks sliding as investors count down to the start of earnings season. Keith Lerner of Truist writing the following. The current bull market likely still has further upside, underscoring the importance of staying focused on the broader trajectory rather than short-term turbulence. Keith joins us now for more. Keith, welcome to the program. Are you expecting some short-term turbulence this earnings season?
Yeah, well, first, great to be with you. I think it may be a little bit of a spookier October. We didn't get the seasonal weakness that a lot of folks were looking for in August and September. And as you just discussed, like we have this big meeting, it's at the end of the month. The Fed's meeting's at the end of the month. I think earnings continue to be the North Star, but I will say heading into the earnings season, and we've had just one of the strongest 6-month rallies we've seen in history. Expectations are somewhat high. You did see some complacency, put the call ratios were really low going into this as well. And as I look at the overall market, you're just seeing some minor cracks. So I just think this month is going to be a bit more turbulence. We still think we're in a bull market that deserves the benefit of the doubt. But, I think this turbulence is likely to continue through this month.
Keith, Anne-Marie and Lisa were talking about the tension between the US and China somehow feeling somewhat different going into negotiations at the end of this month. And I think you can see that in the price action. Yesterday's bounce smaller than Friday's sell-off, and the sell-off resumes again this morning. Keith, is there something different about things this time around?
Well, I think the biggest challenge from a market perspective is just that you're going into this with higher expectations. You're at a 22 multiple. As I mentioned, you've had this big run. So you just have, you're more vulnerable to bad news. Whether this actually from a political side is different, we just don't know yet. I mean, that's just the reality. We don't know. I think what we've seen over the last, 6 months is that when we start to have more tension in the markets, eventually, cooler heads prevail. But as just mentioned, we just made new highs in the market. So the question becomes, how much of a move down do we need before we start to see kind of a backup? And we're only a few percent from all-time highs. So I suspect that we actually still have some more work to move on the downside before investors start to focus back on what we think is the North Star of this bull market, which is still earnings.
So, Keith, this isn't a buyable dip yet for you. Is that correct?
This is not a place yet where I would say I would be aggressively buying here. No, I think, if we look back historically, we haven't had even a 5% pullback since April. We often talk about pullbacks or the admission price to the market to eventually higher prices. So, we're a few percent from an all-time highs with these kind of a little bit of a cracks. I like a little bit deeper of a pullback, and I'm not saying 15%. I think something in the 5 to 10% range would be something where we would say potentially be more aggressive.
I wonder what your read-through is going to be from the bank earnings that do kick off shortly. We are expecting, based on what Jefferies reported a while ago, this boom in M&A, this idea that there's more corporate confidence. We're seeing that in surveys. Does that do enough to alleviate concerns elsewhere and make you have conviction to buy in a more broad-based manner?
Yeah, well, I do think it's important. I think, we're all looking at whatever economic data that we have, and there's certainly some divergences between, like, say, Atlanta GDP, which is well above 3%, and the softening in the labor market. And it's really about what are the banks seeing? What are we seeing on credit? What are we seeing on lending? In our view, what we're seeing is still this kind of two-speed economy where the high end is doing well and there's more challenges, especially at the low end. So I want to see if that continues. We did get Delta last week, which was encouraging, talking about an upgrade to their view based on the high-end consumer. So I suspect that continues, but I think it is important. And to be frank, we're not selling here. We're sticking with the underlying trend. But if for us to add more to risk at this point, we would prefer at least a little bit of a further pullback or more of a consolidation in time where you kind of chop around and kind of reduce these expectations. This morning, the B of A fund survey came out, and we saw that sentiment or allocations are the highest since February of this year. That was prior to the setback, which was exacerbated by the tariff uncertainty.
Keith, when you're looking for a catalyst to look at what could potentially be a pullback in the market to then buy more, is it going to be this month as the tensions ratchet up between Washington and Beijing?
I think it could be. And the other thing I've been looking for, listen, I expect to have a good earnings season. One thing, as I mentioned, the North Star of this bull market has been earnings. So I'll be really interested to see how stocks react to good earnings. Last quarter, we went into the earnings season and expectations were really low. There was a lot of uncertainty around tariffs. What's interesting about heading into this earnings season is analysts have been raising their estimates into the earnings season. That's highly unusual. The last time we saw that was for the Q4 2021. So that just also means we have higher expectations. And then it also comes down later on will come down to tech. Tech's the big part of this market. We're still bullish on tech longer term. We still think the dominant theme is tech. But, I want to see how stocks react to good news, because I certainly think we'll have a decent earnings season overall.
So, Keith, we have seen these pockets of credit stress. I think we should explore as well. First Brands, Tricolor, Tricolor. Have we decided which one it is, Bremo? Tricolor? Tricolor?
It's Tricolor. If you go south of the border, it's Tricolor.
Okay.
I think that's sort of endemic.
Thank
you. That's great.
So, Keith, we've seen those pockets of credit stress, whatever Lisa said, and First Brands as well. Keith, do you think that's a private market issue and the public markets are insulated from what's happening there, particularly financial institutions? How are you and the team thinking about that situation?
For the most part, we do think it's idiosyncratic, but we have to keep an open mind. We have seen credit spreads over the last week or so really kind of rise for the first time in a while. We all know that credit spreads are at the lowest in some areas since the 90s. And, Friday, in our view, as a portfolio manager, was a good stress test for us to see, does diversification still work? I mean, we've got some questions for people. Why do I own only tech, or why do I own any bonds? And what we saw, especially on Friday, is a good stress test. We saw high-quality bonds do well, outperform. We saw gold outperform, and then we saw crypto actually underperform. So basic diversification works again. I am paying attention to the credit markets. We have seen spreads move up, not in an alarming way, but something we should at least pay attention to.
Keith, you mentioned the Bank of America fund manager survey, and in that survey, it showed that 57% of all respondents thought that private credit or private equity is the latest source or the greatest source of any kind of systemic risk or systemic credit event in the near future. That is the most conviction that we've seen in terms of a potential catalyst going back to 2022. Do you agree with that? Is that where you're looking for potential catalyst for some sort of disruption?
Well, a lot of times the issues in the overall equity market begin with the credit market. So is that the most concerning thing? I don't know. As I think about more of the public markets, we have a lot of companies that have term debt. They have big cash balances. Earnings have been relatively positive. So I don't know that we have a big credit event unfolding here, but we all do know that there's been a huge amount of money into these private markets. They're more opaque. And I think that's something that could kind of creep up more on investors, because it's just we have less information there. Think about it, we have less information on the overall economy right now without some of these these economic reports or government reports. So in the private credit markets, you just have less information. So when things start to unravel a little bit, you have less information to understand more broadly what's happening. But again, as I think about more of the public markets, it's not something that at this point we really see as a systemic issue.
Hey, Keith, appreciate it. Thanks for jumping on. Keith Lerner of Truist. Big morning coming right up. It looks a little something like this. In about 30 minutes' time, around the 6:45 mark Eastern time, we should have numbers from JP Morgan. Later on this morning, 7:30, we should have numbers from Goldman Sachs. This afternoon, Look out for this at 12:20 Eastern Time. Chairman Powell addressing the economy. We'll have full coverage of that on Bloomberg TV and on Bloomberg Radio a little bit later. The Fund Manager Survey of Bank of America came up a few times in the last 10 minutes. Some of the numbers in that. Number one tail risk, AI bubble. A record 60% say global stocks are overvalued.
At the same time, you see cash allocations at the lowest levels going back to December of 2024 and really close to the trigger of 3.8% that could get people a little bit nervous about an overwhelming bullish take. So yes, concerned about that overvaluation, but also concerned about missing out.
We'll talk to Bank of America in about 5 minutes' time on that survey. This morning, equity futures pulling back by around 0.9% on the S&P. We're down by more than 1% on the NASDAQ with an update on news worldwide. With your Bloomberg brief is Lizzie Burden. Hey, Lizzie.
Hey, John. BlackRock took in $205 billion worth of client money in the third quarter, the world's largest fund manager expanding its footprint in private credit and in alternative assets as well. Investors also added $153 billion on a net basis to ETFs, which topped $5 trillion for the first time. Elsewhere, China has placed sanctions on US units of a South Korean shipping giant and has threatened further retaliatory measures on the industry. It's the latest in a series of tit-for-tat trade escalations between the two countries. Still, China's Ministry of Commerce said that the door remains open to talks, with officials set to speak later this week. And Broadcom shares are lower after the chipmaker became the latest to forge a blockbuster deal with OpenAI for data centers. OpenAI agreed to buy custom chips and networking components from Broadcom to help power AI services, with plans to spend tens of billions of dollars more on Broadcom chips in the future. It follows similar agreements from fellow chip makers NVIDIA and AMD. And that should be my brief, John.
Another massive move for another chip maker. Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, AI bubble territory.
We're getting into bubble territory for sure. If this whole AI thing turns out to be a lot of hype, that's not exactly the end of the world. It's not like 1999.
Up next on the programme, we'll catch up with Elias Galou of Bank of America as he breaks down the Fund Manager Survey from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Got a really busy morning coming up, quite a 24 hours for you. Happening later on this morning, in about 25, 30 minutes from now. Should get numbers from JP Morgan. Later on next hour, numbers from Goldman Sachs. You'll hear from Citi as well. This afternoon, you'll hear from Chairman Powell, 12:20 Eastern Time. All of that to set up your Tuesday, heading into Wednesday when you get a ton more earnings from the big banks on Wall Street, Bank of America and Morgan Stanley, plus another read on the airlines, United, just around the corner. The setup this morning, really defensive, so check out the equity market. Equity futures down across the board by 1% on the S&P, off by 1.2 on the Nasdaq 100, and super defensive in fixed income too. 2s, 10s, 30s, bond yields down across the board. 10s threatening to break through 4. We're looking at the prospect of a 3 handle here. We're down by 3 basis points on the session.
People don't seem particularly concerned about inflation. They don't particularly seem concerned about the U.S. losing its haven status. And I've seen so many notes over the past couple of weeks sort of debunking this idea of the dollar and of U.S. government debt losing their status as a safe haven. Two things can be the truth at the same time. They can be less of a safe haven. They would have been rallying more. At the same time, it clearly is the risk-off feel that is vindicating the appeal of government debt as that place for people to park their cash.
So there's your 3 handle, 3.99 on 10 so far this morning. We're on the bond market later this hour. Under surveillance this morning, entering bubble territory.
We're getting into bubble territory for sure. If this whole AI thing turns out to be a lot of hype, it's not exactly the end of the world. It's not like 1999.
Here's the latest this morning. Bank of America out with its October Global Fund Manager Survey showing for the first time investors consider the AI bubble as the biggest tail risk. Joining us now to discuss, Elias Kalou of Bank of America. Elias, welcome to the program, sir. Just going through some of these numbers, these stats, stock allocation, 8-month highs, a record 60% say global stocks are overvalued. The number one tail risk is the bubble in AI. Elias, do you see those data points as enough to constrain this bull market?
Look, John, clearly the overall FMS sentiment is nearing full bull territory. However, I would highlight that we're not quite at close your eyes and sell level, because there are a few metrics that would temper the full bull sentiment, in particular the fact that there are still more FMS participants who think the global economy will weaken in the next 12 months rather than will strengthen. Also, when you look at the allocation to US equities, that is the center of the AI story, the allocation today is neutral. Investors have trimmed their underweight on US equities over the past few months. They are now neutral on the biggest stock market in the world. And that is why we continue to say that sentiment and positioning are less and less of a tailwind to global risk assets, but it's not yet the big headwind it was at the beginning of the year.
Elias, could you say the same thing about gold? What's curious about this moment is that we've got all this to say on the equity market, valuations extended, bubble territory, all of that, and then you've got gold as the most crowded trade. What's the relationship between the two?
Look, clearly what's unique about 2025 is that you see several asset classes that are hitting all-time high at the same time. Gold, equities, credit spreads as of the end of September had hit a historical lows if you adjust for the balance sheet of US corporates. And at the same time, Bitcoin as well had hit all-time high earlier in the year. Clearly, what's happening today is that investors are trading long-term secular themes. They're trading AI. To do that, they are taking an exposure via the equity market. And that is why they keep buying despite the perception that global equity markets are overvalued, just hit a new record high this month. But at the same time, they are hedging the new themes on Fed independence, the new theme that inflation is just not going to go back to the target of 2% via gold. What's very bullish about gold, which we capture now with the FMS survey, is that gold allocation for institutional investors is very low. The weighted average gold allocation is 2.4%. It has not increased since September. It's stable since August, and that is why we think the gold rally has further to run. Although in the short term, the price velocity, the fact that gold is trading 25% above its 200-day moving average, means that there is a risk of a short-term consolidation.
Which you would recommend that people buy, since you see gold going to $5,000 now by the end of next year. I am curious whether we get the same kind of read-through from cash allocations that we have in the past, given the fact that there is this gold offset, that maybe cash doesn't serve as the same type of safety as it has in the past at a time of real questions around debasement of fiat currency.
Absolutely. Look, it's a great point. I think what's very important to consider here is the relative allocation to cash, but also the outstanding cash holdings. If you look at the FMS survey, it does show that cash allocation have dipped below a very important threshold that is 4%. It's now at 3.8%. It's remained under 4% for the past few months, and yet risk assets have rallied over the same period. On the other side, what we see in terms of global cash holdings, they are pretty much at record high. If you just look at the money market fund assets in the US, they've hit a record high of 7.3, 7.4 trillion. So yes, exposure to cash is low. In fact, FMS investors say they are underweight cash by the most since December, but the holdings of cash remain quite high still, and that is giving investors enough confidence that they can continue to add in terms of their risk asset exposure.
Which raises this question, if people really are this bullish, why are they so concerned about private credit and private equity? This to me stood out of the whole survey, the idea that 57% of respondents see private equity and private credit as the most likely source of a systemic credit event. It is completely different than even last month. What's triggering this? Do you see validity here?
Yes, it's maybe the strikest reversal that we've seen in this month's survey. We've been asking this question on the most likely source of a global credit systemic event since 2022. And what was striking this month is that we recorded the biggest conviction on the unique source of a credit event, in the sense that almost 60% said it was private equity and private credit. Look, the reason is very simple. The investors just look at the latest development in the auto consumer subprime market over the past few months, the default wave that have engulfed Tricolor, First Brands, and they also see the linkages between the private credit market and the financial system. You know, there have been a few news that several institutions were exposed to these default waves, and that is spooking investors. When they see that credit valuations are maybe just as exuberant as AI stocks are, and that is why they are now a bit more cautious on this side of the story.
The most bullish survey since February. Alice, thanks for breaking it down. Alice Galou there of Bank of America. So strange to see KKR down on the year by close to 20%. At the same time, Goldman Sachs is up by close to 40%. We'll dig into Goldman later this morning. Those numbers about 60 minutes away. Let's turn to GM. In the pre-market, this headline for you, seeing a $1.6 billion charge on EV production realignment. Here's the quote from the company. Following recent US government policy changes, including the termination of certain consumer tax incentives for EV purchases and the reduction in the stringency of emission regulations, we expect the adoption rate of EVs to slow.
To translate this, essentially people aren't buying as many EVs because of the removal of some of the tax credits, and as a result, GM needs to get on board and right-size some of its production. I wonder if they're the first, I wonder if they're the last.
The Republicans have basically gotten rid of these credits. You can get as high as $7,500 of a tax credit. That's the highest under the Biden administration for an EV. That all dried up September 30th. So if you're not getting that, why are you going out and buying an electric vehicle?
GM this morning, down by 2.5%. Up next on the program, we'll catch up with Gerard Cassidy of RBC Capital Markets with bank earnings just around the corner. Plus, Yahira has your morning movers.
issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Equity futures on the S&P. The decline resumes. We're down by 1% on the S&P 500. What a ride over the previous 2 sessions. The biggest one-day rally on the S&P since May, following the biggest one-day drop going back to April. This morning, down again by 1.3% on the Nasdaq 100. In the bond market, super defensive morning. 2-year bond yields down by 3 basis points. 10s briefly with a 3 handle. 10s at 4 this morning. We're down by 3 basis points. That's the price action cross asset. Let's get you some single names ahead of the opening bout 3 hours away with your morning movers. Here's Yahara. Hey, Yahara.
Hi, John. It's been a swing back and forth for the semiconductor stocks as they continue to track the flare-up in U.S.-China trade relations. The latest escalation by Beijing is sending NVIDIA, AMD, and Broadcom all lower. And it's a sharp reversal for Broadcom, which just yesterday surged nearly 10% on that news that it was teaming up with OpenAI. But investors seemingly questioning whether the AI euphoria can really outweigh the latest round of trade war jitters. And it's not just chip makers feeling the impact. Rare earth stocks are extending their rally today with critical metals up nearly 30%, while USA rare earth and MP materials are also higher, on track for a 4th straight day of gains. The U.S. sector has been surging ever since China tightened its grip on its rare earths. And we end on Stellantis, the European car maker's ADRs falling 4.8% as the credit agency Moody's changed its outlook to negative, though it did maintain its current ratings on the company. Moody's says the automaker's profits remain weak as U.S. tariffs and sluggish demand over in Europe continue to weigh on results. John?
Automaker stocks not having a good morning so far, that's for sure. Yahara, thank you. More from Yahara later on in the program. Numbers just dropping from Wells Fargo. Here's the headline. Third quarter net interest income coming in at $11.95 billion. The estimate was $12.01 billion, so just a touch softer, lighter than expected. That stock in the pre-market, Bramo, just about unchanged.
What's fascinating here, and it kind of goes to the dichotomy that you were talking about, KKR down on the year, big banks up on the year. It seems like the actual banking and lending aspect didn't meet expectations in terms of revenues, but it came to banking, it was the opposite. Investment banking fees, $840 million versus the estimate of $742 million. You can see even provisions for loan losses coming in lighter than expected. This speaks to this question of whether Tricolor and the others are something that's endemic of some sort of credit issue or not. Provisions for credit losses, $681 million versus the estimate of $1.2 billion. So this is really coming in with sort of a read, at least on their consumers, saying there isn't as much of a credit issue, but maybe they're not making as much money from the lending portfolio as they are from just banking all of the activity that we see going on.
So that's the latest on Wells Fargo, coming a little bit earlier than anticipated, 15 minutes earlier than anticipated. The numbers from JP Morgan. With the latest, let's cross over to Scarlet Fu. to break down these headlines. Hey, Scarlett.
Hi, John. Yeah, a lot of red headlines here for JP Morgan. Let's start with the capital markets and trading revenue. Equity sales and trading revenue, where JP Morgan is a leader here, $3.33 billion, handily beating the consensus estimate of $3.04 billion. When it comes to FICC sales and trading revenue, $5.61 billion. Analysts were looking somewhere in the neighborhood of $5.33 billion. Investment banking revenue, $2.69 billion, also higher than what was anticipated. Remember, this was a quarter in which there was a lot of IPO activity, there was a lot of M&A activity, and all of that shows up in these numbers here. Jamie Dimon also making some comments saying that the firm continued to benefit from higher client activity. We had gotten some kind of setup from the firm that things were looking pretty good, and the anticipation heading into these results was for a beat and raise kind of quarter, especially for the likes of JP Morgan and Goldman Sachs, which we'll be reporting a little bit later on this morning. In addition, let me just give you some more comments from Jamie Dimon. He is saying that the U.S. economy generally remained resilient. And this is critical here because we are in a data vacuum. Without any government data, investors are really looking towards these set of results to shed some light on how companies are doing and how consumers are doing. And so far, so good, at least when you look at the capital market side of the equation. Dimon continues to say there continues to be a heightened degree of uncertainty, so cautious as always. When you look at some of the bottom line numbers here, earnings per share for the quarter was $5.07. If we were comparing like with like, the consensus estimate was for $4.83. That is a big beat as well. Dimon saying some signs of softening are emerging, particularly in job growth. So again, as much as he says the U.S. economy is generally resilient, he does add a degree of caution when it comes to job growth and the uncertainty out there, especially when you think about the macro environment with all the tariffs or tariff threats flying around. Let's go back to Wells Fargo for a moment here because those numbers came out as well, and it was a miss, especially when you look at the net interest income line, and that was the one that investors are reacting to here. Net interest income for the third quarter of $11.95 billion does miss the average analyst estimate of just above $12 billion. The bank also reaffirms its net interest income outlook for the full year of $47.7 billion, just slightly higher than what was anticipated. But the focus here really is on how Wells Fargo builds itself out after the asset cap had been removed by the Federal Reserve.
Scarlett, thank you. Scarlett, stay close to break down these numbers. We'll have Goldman in the next hour or so. If you are just joining us, welcome to the program. So, upside surprise, third quarter equity sales and trading revenue, $3.33 billion, the estimate just north of $3 billion. The JP Morgan third quarter fixed sales and trading revenue number comes in at $5.61 billion. The estimate was $5.33 billion, so that's another upside surprise. The stock a little bit lighter this morning. We're down by 0.7%. Just bear in mind, year to date, that stock is higher by close to 30% for 2025. We've had quite a run. For those of you interested in the commentary from Jamie Dimon, the JP Morgan Chase chairman and CEO, here's the full quote for you. Where there have been some signs of a softening, particularly in job growth, the U.S. economy generally remained resilient. However, there continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation. But guess what? JP Morgan comes out with all those warnings and then prints some upside surprises.
They printed the upside surprises. I think it's important where they printed them. It goes back to the banking and trading activity. That is the upside surprise with fixed sales and trading and equity sales and trading. Interestingly, net interest income came in below expectations, akin to what we saw at Wells Fargo. I mean, look, this is light, but the expectations were very high, as you mentioned. I also think it's interesting that provisions for credit losses were $3.4 billion versus the estimate of $3.08 billion. How much is this in recognition of some of these geopolitical risks? And how much is this a signal that the likes of JP Morgan wants to take more risk because there is more upside profit on the other side? There are two ways of interpreting this, and that's what I'm going to be listening for in the commentary.
Jamie Dimon is also talking about the fact that the U.S. economy generally remained resilient amongst all this uncertainty. Meanwhile, just 6 days ago, he sat down with our own Tom McKenzie talking about there's still a chance of a recession in 2026. Meanwhile, he's saying, even though amongst this heightened uncertainty, the U.S. economy was resilient. So which is it? Are we resilient right now, or he's really worried potentially about a recession?
This is the one. It's heightened client activity. Clients have re-engaged. Corporate clients have re-engaged. You've seen that in the deal flow. You've seen that in the debt issuance. You saw that through the whole of the month of September. The biggest leverage buyout on record. Debt issuance. Tons of supply. Clients have re-engaged in a major way going towards year end?
What we heard from Jefferies kicking off the earnings season for the banks was an unprecedented amount of revenue from activity, from deals, et cetera. You see the same type of activity in Wells Fargo. You see the same type of activity in JP Morgan. How big is that pipeline and how bulletproof is it to any potential shock coming forward? Is it predicated on the idea of rate cuts, or is it the companies see an opportunity in a wide open capital markets that these banks are happy to facilitate?
Gerard Cassidy of RBC Capital Markets standing by. Gerard will be with us throughout this morning, breaking down these bank numbers. Gerard, welcome to the program. First of all, JP Morgan, upside surprise on equity sales and trading revenue, likewise for FIX. Gerard, is that a sign of things to come later this morning?
Jonathan, I think it is. And we all know that the markets have been very resilient in the third quarter, as these numbers point out for both Wells Fargo and JP Morgan. The trading numbers were better than expected, as you pointed out. And it really, I think, portends well for the others that are in that business, of course, Goldman Sachs, Morgan Stanley, as well as Citigroup and Bank America.
Gerard, Jamie Dimon highlighting all the risks out there. I see them too. We all do. Geopolitics, tariffs, trades. But ultimately, Gerard, there's something about client activity and clients re-engaging into year end. What do you think is behind that, Gerard? And what do you think makes it sustainable into 26?
Yeah, and I think what we're seeing is that a lot of pent-up demand was pushed from 2022 and 2023 as well as 2024 into this year. And so you might recall that the activity a couple of years ago was quite depressed in the mergers and acquisition area as well as IPOs. And so I think what you're seeing now, because of the resiliency in the markets, because of a more supportive approach out of Washington with this administration on mergers, you're seeing a lot of activity that could have been done over a year ago, and now it's coming through right now.
What's your takeaway, Gerard, from the fact that, as John was pointing out earlier, KKR and the other big private asset managers have seen their shares fall quite a bit this year? There are concerns about credit issues within some of their portfolios. And now banks, which previously had decried the competition from some of these private asset managers, are delivering huge returns from the activity aspect of their business. Does it suddenly look like a pretty good business model and maybe prevent them from getting into the lending business as much as maybe they had hoped a couple of years ago?
It's interesting, Lisa, because you might recall back in July of 2023, the Federal Reserve put forward what they called the Basel III Endgame, and it was going to raise the capital levels for many of our biggest banks substantially. So as a result, these banks went on what they called at the time risk-weighted asset diets. They pulled back from lending. And so the alternative asset managers, the private credit markets, had a field day. In fact, Jamie Dimon commented about how uncompetitive this Basel III Endgame was. And now, as we know, that's been thrown out. A new Basel III Endgame is coming, possibly by the end of this year or into next year. And it's going to be much less constrictive for the banks. So the banks are back in the game. So I think part of the reason maybe the old asset managers like a KKR are not doing as well this year is that they do have now real competitors in the banks. And then second, the growth has been spectacular for these companies. And whenever you have rapid asset growth, you always have to be a little concerned that could there be some issues on credit down the road. And also the numbers are very opaque. So that I think is a combination of why those companies might be struggling versus the banks now really excelling.
Gerard, stay close. Just want to jump in with the outlook from JP Morgan. Now seeing full year net interest income of about 95.8 billion. The previous outlook had about 95.5. We've seen this movie so many times, haven't we, Lisa? JP Morgan comes out with a beat. Jamie Dimon comes out with a lot of cautious commentary. And then a headline drops about 2 minutes later, raising the outlook.
Look, this is clearly someone who views himself as a risk manager at a time where the risks seem to be always to the upside. It's also the key sandbagging that JP Morgan is known for. I wonder, Gerard, how you can put these two things together, or whether the sort of pipeline of deals, the pipeline of activity that's fueling a lot of these earnings can really sustain themselves, given some of the risks that Jamie Dimon keeps highlighting, but haven't really come to fruition in terms of market performance.
You make a good point, Lisa, and this the classic wall of worry that we see out there, and markets tend to do pretty well as we climb that wall. But Jamie Dimon is a conservative CEO, as he should be, and he's always going to point out the big risks that are out there, while at the same time, they run their business day by day, they execute day by day, and right now we're in a very strong investment banking market that's akin to what we saw in 2021. And so I think what you're going to see going forward, as long as the market conditions remain resilient, companies will come public, there will be more mergers going forward, and the investment banks obviously are the beneficiaries of that kind of activity.
Gerard Cassidy of RBC. Gerard, you're going to stick with us. Looking forward to catching up some more, anticipating those numbers from Goldman Sachs. A lot of the story we're talking about around the banks is pretty well understood. It's reflected in the share price rally we've seen so far year to date. Slight move lower off the back of those numbers on JP Morgan. Now that stock turning positive, up by about 1/3%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief with the latest worldwide. Here's Lizzie Burden. Hey, Lizzie.
Hey, John, a reminder of those earnings. JP Morgan reporting third quarter revenue that beat the average analyst estimate. The bank also recorded beats on equity sales and trading revenue. And the bank's chief executive, Jamie Dimon, is saying that the economy remains resilient. However, there continues to be a heightened degree of uncertainty. Elsewhere, Wells Fargo also reporting earnings this morning. The bank raising a key profitability metric, marking the first major update about the bank's next growth target after the removal of regulatory restraints. However, Wells Fargo did report a miss on net interest income. The company also reaffirming that its guidance for net interest income remains steady and stands. And shares of General Motors sliding after the automaker announced a massive $1.6 billion charge related to shifting electric vehicle production plans. GM cited the end of federal EV tax credits and relaxed emission standards for the expected hit, writing in a regulatory filing, "We expect the adoption rate of EVs to slow." And that should be my brief, John.
Lizzie, thank you. Appreciate it. Thank you very much. Up next on the program, we'll break down the latest. So far, so good for the big banks on Wall Street. Lizzie went through the numbers. JP Morgan up by 1.3% of the pre-market. Wells up by 2.6. Goldman Sachs 45 minutes away. Gerard Cassidy of RBC still with us.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
So we've had numbers from JP Morgan, from Wells Fargo already this hour. The numbers were okay, and it fails to put a floor under this equity market. Equity futures down, taking another leg lower. We're down by 1.3% on the S&P, on the Nasdaq down by 1.6%. In the bond market, check it out. Fixed income, 2-year, 10-year, 30-year bond yields. Bonds hold on to those gains. Yields are down by 3 basis points, just about holding on to 4% on 10s, 2s. At 347.
If we revisit an April 2nd type of decoupling between the U.S. and China, banking activity that might be in the pipeline won't be enough to really get people back on the sides of trying to boost valuations further. I just wonder where the off-ramp is and whether this market is trying to suss out that maybe this time it's going to go on a little longer, or maybe this is a good selling opportunity, lock in the gains and wait for a better entry point.
Let's talk about the latest. Wells Fargo, JP Morgan reporting just moments ago with the latest. Here's Bloomberg's Scarlett Fu. Hey, Scarlett.
Hey, Jonathan. So we're looking at JP Morgan erasing earlier declines. It's now up slightly here. Coming into these results, the idea was that there would be potential upside to the capital markets revenue. Check. That's exactly what we got, with a beat on both FIC trading, fixed income currencies, commodities, as well as equities trading. And this was the case where JP Morgan had already guided higher in September for both of those businesses. We also saw a solid net interest income for the quarter, and in fact, JP Morgan boosting its full year net interest income to $95.8 billion from the consensus estimate of about $95.47 billion. We're also hearing some cautious commentary from Jamie Dimon, the CEO, saying that the U.S. economy has remained generally resilient, but he does see a heightened degree of uncertainty, particularly when it comes to job growth. Assets under management for this company also swelling to $4.6 trillion thanks to the booming stock market, which increases the value of those assets. Provisions for credit losses does increase as well, so kind of in tandem with that cautious commentary from Dimon. $3.4 billion set aside for potential bad loans. Analysts were looking for somewhere in the neighborhood of $3.08 billion. Let's move on to Wells Fargo, which is a stock that has kept pace with the S&P 500 and its peers so far this year, but since the last earnings report has really underperformed. So you can see it's gaining about 1.3% so far today in the early trade. Net interest income for the quarter that passed did miss analyst estimates, but the bank maintained its full year forecast of $47.7 billion in net interest income. And more importantly here, it aims to achieve tangible common equity return of 17 to 18% in the medium term. That is an upgrade from its previous guide of about 15%. And just as a point of comparison, JP Morgan's target for the medium term of tangible common equity return is about 17%. Wells Fargo, of course, has been constrained by the asset cap imposed by the Fed. It was the case for about 7 years, and the Fed just lifted that not so long ago. So we're looking at other parts of the business that it's growing. Investment banking fees increased 25% to $840 million. Analysts were looking for 741.6. I know that's a drop in the bucket compared to the likes of JP Morgan, but it's an area that Wells Fargo is certainly looking to grow.
Scarlett, thank you. Scarlett Fu with the latest. More from Scarlett later this morning. Numbers from Goldman Sachs, 40 minutes away. Jared Cassidy of RBC still with us. Jared, let's pick up on what Scarlett was talking about. This story's pretty well understood. That's reflected in the rally we've seen already in the names so far this year. The challenge for people still in the stock. Story's well understood. How full is the valuation?
In terms of JP Morgan, John, the valuation is full. But if they continue to deliver 20% return on tangible common equity and numbers like you saw today, you can see obviously the tangible book value per share continue to grow. And even if the valuation remains unchanged, there's still upside in the stock.
What do you need to hear, Gerard, on the call in terms of either AI adoption or future points of revenue going forward to say it's still a buy, even with full valuations?
It's a very fair question, and I would say that one of the areas I think investors are going to focus on is the traditional banking area. They JP Morgan reported very nice loan growth on a year-over-year basis. And yes, we all know about the capital markets business, investment banking being very strong, but it's really going to come down to also the traditional banking businesses and what kind of growth they're going to see. And again, they saw very good growth today in the year-over-year loan growth. So that will be one of the areas I think people will focus on. And then the sustainability, of course, of those capital market numbers.
Going forward, I wonder how the announcement that we got from JP Morgan yesterday kind of plays into the future earnings revenue. We heard that they're planning to increase their investments to strategically important companies in the United States, potentially investing alongside companies that the U.S. is taking a stake in or the ones that might be relevant to that type of effort. Does that move the needle at all, or is that a drop in the bucket when you start talking about $95.8 billion of net interest income in a year?
It certainly doesn't move the needle, but it's very important. JP Morgan is our largest bank in the United States. And Jamie Dimon has always expressed his desire to be a very strong supporter of the U.S. economy and the U.S. in general. So in our view, when you come out with an announcement like they did yesterday, he's putting his money where his mouth is, if you will, and he's investing in the United States. He believes in our country. He believes in the democracy, and he's a leader, and he's showing it with this type of announcement in our view.
If he's putting his money where his mouth is, given yesterday's announcement, given today, he's talking about complex geopolitical conditions, do you think this means the bank might take steps to de-risk from China, they themselves?
I would certainly say that they're always on their guard when they talk about their global expansion. And when you're expanding into a communist country like China, you've got to be especially careful. And so I don't necessarily believe they're going to pull back from that. But certainly there has been, under this White House, an increased focus on investing more into the United States. And it's also due to the fact that if you think back during the pandemic, the supply chain disruption was dramatic. And many of the investments we're seeing today is as a result of that. And I think what you're seeing here, JP Morgan is also now taking a very sharp look at looking at the critical industries that they want to support with this announcement they made yesterday.
Gerard, it's good to see you. You're going to stay with us, I know. You're going to break down the numbers with Goldman Sachs in about 35 minutes' time. Stay close. Gerard Cassidy of RBC with the latest on Wells Fargo, on JP Morgan. I think we've got to bring you the latest on the broader equity market because this downdraft continues. Took another leg lower in the last 15 minutes, even with fairly decent bank numbers from the likes of JP Morgan and Wells Fargo. Equity futures down by more than 1% on the S&P 500, and we're holding on to those losses even with an upside surprise on some of the banks so far.
It all comes down to this question of whether the U.S. and China can repair what seems to be an escalating feud, and really whether they can even meet with Xi Jinping and President Trump on November 1st, given the rhetoric that we've seen, which seems to be only heightening. And China's response wasn't necessarily the same type of conciliatory language that we got from Trump. And for that reason, people are saying, hold on a second, things are already looking pretty frothy. Why don't we just take some chips off the table despite what we see from the banks?
The Financial Times reporting also giving some context and depth of what China has been coming out with. They said that this was on the list of negotiating bargaining chips China presented in the summer. And the lead negotiator said to them that they will be very aggressive and the U.S. would face, quote, hellfire if things didn't go their way. They were using this in the summer and then came out with this right ahead of potential sit down between Xi Jinping and President Trump. It took 18 months to just get agricultural purchase agreement done. Trump won. Does anyone think this is going to get done in 2 weeks?
The big difference between the risk aversion of the last few days and the drama of April, this rally of the bond market, 10-year bond yields, close to 4%, twos at 347. Coming up next, Lisa Shallard of Morgan Stanley, the Republican Congressman Mike Lawler, Kay Hurt of JP Morgan, and we get more bank earnings with Gerard Cassidy of RBC.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Used to be one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The economy in the US is very strong.
There are some signs of slowdown within the labour market, but we're not talking about recessionary.
We have a slowing in terms of the economy, but we don't have an outright contraction.
Most of the data is telling us that we're seeing slowing economic growth, but no recession.
Macro is weakening enough. We are a bit more confident that the Fed can deliver.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Declines across the board. We're down by 1% on the S&P 500, down by 1.5 on the Nasdaq 100. Okay numbers from Wells Fargo and JP Morgan failing to lift the mood this morning. Wells Fargo higher by 1.6%.
So they came out with banking activity in particular really beating expectations, whether it's trading, whether it's the M&A that we have been seeing. As you point out, though, right now what is taking the dominant stage is this tit for tat between China and the U.S., and it shows how much a re-escalation in trade wars can overwhelm really good bank earnings. So it raises the question, even if we do get corporate America firing on all cylinders, are we susceptible to something on a geopolitical level that torpedoes the dynamism that we've seen in equity markets?
You see that tension, that risk aversion bubbling away in fixed income so far this morning. In the bond market, 10-year bond yields down by 3 basis points, just about holding on to 4.
When it comes to this rhetoric between Washington and Beijing, I don't think it's going to stop today. It is going to continue until these two leaders meet, and potentially there's not going to be an outcome come 2025. This might bleed into 2026. Maybe they put a lid on it, but it doesn't mean we're going to get some grand bargain deal because there's no deal on the table right now. And usually you would see the Chinese president only agree to a summit when a deal is in place. The more important meeting, I think, is when the Treasury Secretary sits down with his counterpart and potentially we get leaks of a contour of what could be agreed upon when it comes to this relationship. Right now, it's about chips. Last week, it's about rare earths. Who knows what it's going to be at next week?
That seems to be the factor right now in equity markets worldwide. Later this morning, we get more bank earnings. Goldman Sachs is about 29 minutes away. After that, we'll hear from Citi. Later on this afternoon, Chairman Powell, 12:20 Eastern Time. It's amazing how little people talk about the Federal Reserve over the last few weeks with regards to this market. Like, I'm stunned by it. We have guests come on to talk about 10, 15 minutes about the market and barely touch on the Federal Reserve.
Because what are we going to say about the Fed? They are data dependent. We have no data. They are completely split, and we don't know who the Fed chair is going to be next year. Ultimately, they are following the market. They are not necessarily leading the market, and I think that that is the truth. Right now, people are expecting them to cut 2 times this year, and they're saying that there is enough consensus on the committee that probably can get behind that. Okay, we can forget about that, because any forward look beyond that is completely irrelevant, because it is a completely different Fed come spring of next year.
Let's see what Chairman Powell delivers later on this afternoon. Enjoyed the rant. It's right there with you.
What are we going to say? What are we going to parse through?
Along. Lisa Shallot was there too, sort of nodding away.
Plus, it's the easiest job in Washington, Jonathan. It's a coin flip. You know that.
Donald Trump's absolutely right. The president nailed it.
All right.
Okay. Coming up, Lisa Shallot of Morgan Stanley as bank earnings deliver some upside surprises. Gerard Cassidy of RBC with Goldman numbers coming up next, and Kay Herr of JP Morgan ahead of Fed Chair Jay Powell's latest address. We begin this hour with big banks failing to lift equity markets. Stocks down across the board, the S&P negative by more than 1%. Joining us around the table, Lisa Shallot of Morgan Stanley Wealth Management. Lisa, good morning.
Good morning.
Do you agree with Bramo on the Fed?
Absolutely, actually. Not unusual that I agree with Lisa, but fundamentally, it's not entirely clear what would catalyze the Fed to change its view, what would catalyze a shift in the Fed funds curve.
How relevant is Fed policy to this rally and valuations at the moment?
I think it's been very, very critical. But to Lisa's point, I think we've baked in what we can bake in at the moment, knowing what we know. And it's been pretty concretized. I mean, one of the things we've observed is the extent to which underneath this rally over the last 10 weeks, you've had this really kind of pro-cyclical, junky broadening, right, where you've really seen small caps lead, you've really seen micro caps lead, and that kind of thing is very much premised on much lower interest rates. And we're in the camp that says that piece of this trade may have gone too far.
Is there something that we're interpreting maybe a little bit incorrectly with the broadening out in the rally in asset prices? And John was mentioning earlier this rally in gold and stocks, this idea that you see haven assets rallying at the same time that you see risk assets rallying. Is this a sign of inflation percolating through where it can in this question of dollar debasement on the heels of the Fed set to cut rates regardless of what the inflationary backdrop really is?
Very much so. I mean, this is a case when the everything rally, right? When bonds are going up, stocks are going up, gold is going up. It tells you that there's still too much liquidity, sloshing around in the system. And here's the Fed signaling, that they're prepared to give us another 100 bips. In an economy that right now looks like U.S. GDP is, growing at a real basis at least 3%. I mean, this crazy town.
Well, does it give you confidence that we are seeing a rally in treasuries amid the crazy town in the face of some potential exogenous shock in the form of some sort of geopolitical decoupling? I mean, the idea that we're seeing that rally, as John was pointing out, in the long end of the yield curve, maybe giving a bit of a softening to that, saying, well, actually, maybe this is a normalcy in terms of the reaction function of government bonds.
I'm not sure that what we're seeing is all that normal. Like I said, the degree to which cross-asset allocation, cross-asset correlations, I should say, are so close to one, just makes you think that there's a huge amount of liquidity out there and people are buying everything hand over fist.
What do you make of the recent tension between Washington and Beijing, the decoupling Lisa's talking about? Are we going back to that volatility we saw in April?
I don't know that we're going all the way back to April, but I think we're getting to a much more realistic place. We went from in April, the world's coming to an end, to, after April 9th, oh, only kidding, nothing's going to happen. This is all going to go away and be nothing. I think the reality is that unlike some of the other economies where, the United States has kind of essentially dictated a deal, it is very clear that our relationship with China is very different. And there's much more equal balance here. We need things from them. And they need things from us. And that means you're actually going to have to negotiate, not something that this administration has demonstrated a very, robust track record. They've done a very good time at dictating thus far. And so I think that this could be a little bit drawn out because there are going to be puts and takes and some compromises.
If this gets drawn out and there's no agreement when these two leaders meet, what kind of market reaction could we see?
I think this is where some of the tempering in the market, comes in. Our best guess is it's not necessarily a material correction, but it's a consolidation in the market. And I think you get back actually to the big getting bigger and a concentration in the high quality names and some of that lower quality trade that I talked about, kind of coming off. Some of the sizzle, some of the froth coming out of this market. As folks realize, okay, wait a minute, this is some serious stuff. Who really wins here? And my guess is it's going to be the bigger guys are going to be able to survive this.
Lisa, let's talk about some other serious things in private markets. I think people find it difficult to take the temperature of what's happening over there. And they use some public market proxies, like the stock of a KKR or an Apollo, which is down around 20% so far year to date. And they point to certain idiosyncratic issues, if we can call them that, the likes of First Brands and Tricolor, and they're trying to work out just what is going on here and what does it mean for me in public markets over there. How do you answer that question at the moment?
So that's a fantastic question, because I think it speaks to this disconnect between the small mid-cap world, which is really what is inside of these private equity portfolios. And our thesis has been, if everything is perfect in private equity world and portfolio world, why aren't we seeing more deal activity? Why aren't we seeing more distributions? And our thesis has been, because there's a little bit more pain there, because there are high borrowing costs there, there is some stress there, those portfolio companies are feeling some of the brunt of tariffs and pressure on margins and the borrowing costs. And so, from where we sit, what you're seeing in the public equities of some of these general partners is reflective of that stress. And it is telling us, I think, and confirmatory of our view, that some of the smaller micro-cap, mid-cap stocks that have run, maybe are overheated.
What's the difference between weakness and a sense that there is more pain in some of these areas versus systemic risk, which is what some people are worried about, a credit event that could potentially precipitate something more pernicious?
Yeah, so there's always the risk that, you have credit events in these kind of markets where people have taken on leverage. I think one of the things that folks hope is that because some of the froth in the lending has occurred in the private markets, that it's not systemic. And for the moment, we're willing to buy into that argument.
Lisa, it's good to see you.
Good to see you
Thanks
guys.
for breaking it down. Lisa Shallard of Morgan Stanley. Some concerns about what's happening in private markets here, reflective of maybe what's going on in the broader economy, more so than what's happening at the top of the S&P 500.
What I find interesting is you're not seeing that kind of stress necessarily at the big banks or in their balance sheets, and how much are they catering to a very different clientele now that is better financed, wealthier, bigger companies, and they can be insulated from the stress that you see much more consolidated in some of these private asset companies, not because they're taking excess leverage, but because of the aspect of the market that they're catering to.
It's well said, very well said. The latest numbers from Wells and JP Morgan, pretty decent. Goldman Sachs, about 20 minutes away. Let's get you an update on that and a whole lot more with your Bloomberg brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. JP Morgan reporting third quarter revenue that beat the average analyst estimate. The bank also recorded beats on equity sales and on trading revenue. The bank's chief executive, Jamie Dimon, saying that the economy remains resilient. However, there continues to be a heightened degree of uncertainty. Elsewhere, Wells Fargo also reporting earnings this morning. The bank raising a key profitability metric, marking the first major update about the bank's next growth target after removal of regulatory restraints. However, Wells Fargo did report a miss on net interest income, and the company also reaffirming its guidance for net interest income remaining steady. And Ukrainian leader Volodymyr Zelensky is planning to meet with President Trump in Washington on Friday. The two will discuss air defense and weaponry as Russian strikes on Ukraine's energy system intensify. Zelensky is looking to secure long-range Tomahawk missiles from the US, and he also plans to discuss importing natural gas from the EU, Norway and others. And that's your Bloomberg Brief. John?
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the promise of pay.
We are so very grateful that President Trump has stepped up to ensure that our troops are going to be paid on October 15th.
Until Donald Trump gives them permission to meet, they're going to continue to hide as it relates to sitting down and negotiating a bipartisan agreement.
I think it's fair to say the president's been pretty busy elsewhere over the last 24 hours.
No, you don't say. Shutdown doesn't exist for him.
I mean, come on. I mean, for good reason, too.
Yeah, well, I think that there's been a very big geopolitical tint at the same time of a government shutdown in the United States.
Up next, we'll get into the main debate down in Washington, D.C. We'll catch up with the New York Congressman, Mike Lawler. He joins us next. Live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
We're recovering somewhat, still down by 1% on the S&P 500. On the Nasdaq, we're down about 1.3. Talked about these moves in fixed income in the bond market with this tension rising, rebuilding between the US and China. Two-year bond yields down 3 basis points, 10s down to 4% on 10 so far this morning. Said this a few times in the last 60 minutes. The bank earnings have been okay. Wells Fargo, JP Morgan, Goldman coming up later. It's just failed to lift the broader equity market, even with gains for JP and for Wells.
You have this broader concern about geopolitical tensions. You also have, of course, the idea that these big banks aren't necessarily banking the entire consumer base of the United States and that there are different consumers, some of whom are struggling more than others. But I think that the bigger point here is valuations are elevated and there still is quite a bit of uncertainty. And that reality is coming to the fore this morning.
That's the latest on the stock market. Remember, you will hear from Chairman Powell later on this afternoon, 12:20 Eastern Time. Under surveillance this morning, the military getting paid.
The Democrat Party is utterly rudderless. We are so very grateful that President Trump has stepped up to ensure that our troops are going to be paid on October 15th, while we wait for Democrats to stop holding the country hostage.
Speaker Mike Johnson and I have not met. We know that until Donald Trump gives them permission to meet, they're going to continue to hide as it relates to sitting down and negotiating a bipartisan agreement.
So here's the latest this morning. Americans feeling the pinch of the shutdown stalemate. President Trump promising to pay troops tomorrow, but holding back checks from other federal workers. With the latest down in D.C., in Washington, here's Bloomberg's Tyler Kendall. Morning, Tyler.
Hey, John, good morning. So some of the pressure points are being eased, but there is little sign of progress as the Senate returns to Washington today, but the House still remains out of session. Now, the White House has confirmed that both the military as well as members of the U.S. Coast Guard are going to get their paychecks this week. The military is going to see their pay funded by $8 billion in unallocated funds for research grants within the Pentagon, while the U.S. Coast Guard is going to see some funds redirected within the Department of Homeland Security. The White House is also maintaining that a key supplemental nutrition program for women and children will be funded through tariff revenue. And while both sides of the aisle are at least quietly happy that the administration is making these moves, ultimately all of these moves are facing legal scrutiny since Congress didn't appropriate the funds for this reason. Plus, there are a lot of other issues that don't have as immediate of solutions. Everything from small businesses seeing federal loans halted to companies reporting issues issuing stock and other securities since most of the SEC is currently furloughed, not to mention that there are delays nationwide at airports with a shortage of air traffic controllers. Now, Republicans maintain they're not going to negotiate with Democrats until the government reopens, but our understanding is there are at least some bipartisan informal conversations happening on Capitol Hill about some structural changes to the Affordable Care Act premium tax subsidies in exchange for an extension. But, John, at this point, it doesn't appear that it's happening at the leadership level. Now, November 1st is the beginning of open enrollment. That could be our next big pressure point, but that's still 2 weeks away.
Tyler Kendall with the latest down in Washington. I'm happy to say we can extend the conversation with New York Congressman Mike Lawler. Congressman, welcome back to the program, sir. The good news, the military looks like it's getting paid. Can you just walk us through how you would characterize current negotiations?
The Democrats refuse to do their job. You know, Hakeem Jeffries talks about getting permission. The reality here is that AOC and Zohran Mamdani and the progressive left are who's driving the ship here. Chuck Schumer and Hakeem Jeffries have been petrified to do their jobs, and so they shut the government down. for fear of a primary challenge from the left, and to show their progressive base that they're, quote unquote, fighting back, resisting, President Trump. And it's fundamentally wrong. They are holding the American people hostage. House Republicans passed a clean continuing resolution over 3 weeks ago to keep the government funded, to pay for all of these critical programs, to ensure that our troops are paid, to ensure that Border Patrol agents are paid. And yet Democrats have voted over 8 times against the clean CR. And we'll see what Chuck Schumer and Senate Democrats do today, but it doesn't look good. When I was in Washington last week, I went and confronted Hakeem Jeffries to his face and pointed out that if he's serious about tackling the healthcare challenges in our country, sign on to the bipartisan legislation that would do that. And he refused. So this really is not about healthcare. It's not about a specific policy outcome. This is about Democrats showing their progressive base that they're fighting back against President Trump. Meanwhile, look at the juxtaposition. President Trump, on a 24-hour trip to the Middle East, secured peace, and Democrats are playing patty cake here in Washington, D.C., shutting the government down and holding the American people hostage.
Well, we're 2 weeks in. There needs to be some off-ramp at some point. Would you support structural changes to the Affordable Care Act, premium subsidies, in exchange for an extension to get the government back up and working?
Well, to be clear, the off-ramp is the clean CR that's been sitting in the Senate for over 3 weeks. With respect to the Affordable Care Act, number one, since Obamacare took effect in 2010, you've seen premiums skyrocket across the country. And Democrats put in place these enhanced tax credits during COVID. They were slated to expire at the end of this year. Democrats knew that. They passed it into law. And they knew that they couldn't extend it beyond that period because of the cost associated with it. I have signed on to legislation to extend it by a year because we don't want Americans' health care premiums to spike. But it speaks to the fundamental problem with Obamacare, which is that it didn't actually do what it was intended to do, which is reduce health care costs in America. And in fact, it has exploded since its inception. So, look, I am open to obviously solving the issue. Both short-term and long-term, we have to address the cost of health care in this country. But Democrats just, pounding their fists on the table, stomping their feet, and demanding their way is not the way to govern. You don't hold the American people hostage. And by the way, don't take my word for it. Go look at every quote from Chuck Schumer, Hakeem Jeffries, Nancy Pelosi, and name the Democrat. They all previously believed that you don't use government shutdowns to exert policy outcomes. And now fundamentally they have changed their view because Donald Trump is president.
Congressman, also being held hostage right now is data, which the financial services industry, the Fed, we all rely on. You are on the Financial Services Committee. Do you think the White House should deem the BLS data, like the jobs report we're still waiting on, essential?
Look, obviously that information is critically important for the Fed and others to do the work that is required. But this is the fundamental challenge. They're trying to figure out how to pay for instance, our troops, which is vital. They're trying to figure out how to pay for critical programs like WIC and SNAP. And so these are the very difficult decisions that any administration is put in because of the incalcitrance of my Democratic colleagues here. Look, I've been opposed to government shutdowns regardless of who has tried to do it. I criticized my Republican colleagues last Congress when some of them wanted to shut the government down over Joe Biden's disastrous open borders. While I agreed with them on the merits, the fact is shutting the government down wasn't going to solve that problem. And the same applies here. What the Democrats are doing is creating more problems. The Fed, to your point, needs to be able to do its job. They need to cut rates. They need the information with respect to jobs, for instance. That is critically important. So, yes, we want them to be able to get that information. The fastest way for all of this to come to an end The fastest way to ensure that government does its job is for my Democratic colleagues to go back to Washington today in the Senate and vote yes to open the government up and pass the clean CR.
The White House has also taken aim on projects in New York City, $18 billion worth of New York City infrastructure projects. You are in a swing district, and you are facing a lot of challenges. A lot of Democrats are lining up to try to flip that seat come the midterms. Are you concerned about potentially the pushback you're going to get from things like this, billions of dollars being frozen right here in New York?
Look, I've already spoken out against the freeze on that project, and I've been in touch with the administration to get that project back up and running.
Are they going to?
But again, the fastest way to do that is to pass a clean CR. And that's the point that I've made over the last week to my New York colleagues and to the press, that these projects can easily come back online when the government is open and running. Gateway is a critical project for my district. We don't have a one-seat ride from Rockland County, where I live. Gateway will provide that. So this is a critical infrastructure project, not just for New York City or New Jersey, but for the region. But you know, this is something that I have fully supported in terms of getting the funding for that project, and will continue to fight to do it. But again, based on conversations, it's not that hard to figure out. If you open up the government, a lot of this stuff will be resolved.
Congressman, we got to go. Appreciate your time as always. I'm sure you've got to go too. Mike Lawler there, the New York congressman, on the latest situation down in Washington, D.C. The latest situation on Wall Street, a big week beat for Goldman Sachs. Third quarter fixed sales and trading revenue, $3.47 billion. The estimate, $3.18 billion. We'll get into those numbers in just a moment. Jared Cassidy of RBC is with us next.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Live from New York City, welcome to the program. What a volatile few sessions since Friday. Friday, the biggest one-day loss since April on the S&P 500. Monday, the biggest one-day gain since May. This morning, we're down again by 0.9% on the S&P. On the Nasdaq 100, we're down by 1.23. Lots of earnings to talk about. JP Morgan and Wells Fargo already reporting just moments ago. Goldman Sachs, we'll have more on that in just a moment. With your movers this morning, here's Yahira. Hey, Yahira.
Hi, John. We start on the banks, and with JP Morgan up first, shares are slightly lower, down about 0.1%, even though it crushed it in trading and investment banking. No surprise there with all the volatility we've seen in markets, plus the level of IPO activity and data center financing. Meanwhile, turning to Wells Fargo, those shares are up 2.3%. While it's not a big player in the space, it also posted better than expected investment banking fees. Wells did slightly miss on net interest income, though those shares are brushing it off, up 2.3%. Another company reporting results this morning is Johnson & Johnson with a beat and a raise. Those shares are down about 0.2%. The market really punishing stocks this morning. Investors were also cheering its plans to separate its slower growth orthopedics business within 18 to 24 months. And we end on GM. Shares are falling 1.7% now. After it's set, it will incur a $1.6 billion charge in the third quarter as it reassesses its EV plans due to slower demand. It cites the Trump administration's moves to end the federal EV tax credits and relaxing emissions rules. Remember, GM had been pushing hard into EVs, but now it says that it expects the adoption rate to slow. John?
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. Let's get some more on the bank earnings. Record third quarter revenue for Goldman Sachs. With the details, here's Scarlett Fu. Hey, Scarlett.
Hi, John. Yeah, Goldman Sachs really delivering on its traditional areas of strength, trading and investment banking. Investment banking revenue rose 43% year over year. Advisory revenue rose 60% year over year. And underwriting rose 21% for equities and up 30% for debt. Now, when you look at trading overall, there's a bit of a wrinkle when you break it down into asset classes. For FIC, fixed income, currencies, and commodities, that rose 17% to $3.47 billion, handily beating the average analyst estimate. But the equities trading rose 7%, and that missed the consensus estimate by about $200 million, $3.74 billion reported for the quarter. Goldman also set aside less money for bad loans for the quarter, setting aside $339 million versus the consensus estimate of almost $370 million. In addition, for these big banks, their biggest expense is compensation, and operating expenses did increase 14% year over year, more than anticipated. Compensation expenses rose by the same amount, 14%, more than anticipated as well. One thing to keep in mind with Goldman, of course, is that it is the most exposed big bank to investment banking revenue. So it'll have the fastest response among all these different firms that we track to recession risks or any kind of erosion or deterioration in market conditions. But for now, this looks like a solid number, especially on the investment banking side.
Scarlett, thank you. More from Scarlett later on this morning. Just go through this line by line. Advisory revenue beat, global banking and markets beat, investment banking beat, record third quarter revenue for Goldman Sachs.
And it comes from a lot of pretty steady revenues. It's not just the idea of markets going up or down. It's the financing activity, the prime brokerage activity, record quarter in both the FIC side of things as well as the equity in terms of that type of financing activity. I just wonder whether this really is going to be a tell about the vulnerability that Scarlett was saying going forward to the deal making kind of coming off, or what they see in terms of the pipeline. Is there going to be an ongoing activity pipeline that is similar to what we just saw in the third quarter?
Jared Cassidy of RBC Capital Markets still with us. Jared, you touched on this earlier on this morning. Let's build on it. Lisa was just talking about it. You talked about the pent-up demand. How much of it is just pent-up demand? How much of it is new business that can carry through, push through into next year and beyond?
Jonathan, it's a really good question, and we're going to get those answers, I think, on the earnings calls for Goldman Sachs and JP Morgan, because we have to remember private equity, when you look at their portfolio companies, we hear from those firms that they need to monetize those investments. And because of the slowness in the IPO market in 2024, we're likely to see more of that take place in 25 and 26. And to your point, Jonathan, about the advisory business, a way to monetize those investments, of course, for those private equity companies is to sell some of those portfolio companies. And I think you're going to see more of that. So I think we're going to hear good news on the future pipelines from these companies about advisory revenues as well as ECM activity.
How much, Gerard, is that a broader read on the economy versus a specific sector that has a lot of pent-up demand? And it's important because if you do believe that there is this potential for geopolitical risk or if rates aren't cut as much, is this a vulnerable type of pipeline that could be building?
The pipelines for the investment banks are always market dependent. And I know that's an overused term, but it's true. And so you're right. If there's elevated global risk, that certainly makes those pipelines a little more fragile. But right now, the U.S. economy, as you guys know, when you take a look at the Atlanta Fed forecast for what they think it's growing at is well over 3%. So that's real positive for this type of investment banking market. So the outlook is more, I would say, of robust growth here in the U.S., even though you do have those global tensions, which does add to the risk.
Goldman Sachs emphasized a lot of their repeat revenues, whether it's the financing business, the prime brokerage efforts on the part of FICC and equity investment units. There's also a question about asset and wealth management and some of the record management and other fees that they brought in. How much do you view this as a bank that is more insulated to a cycle versus something that is more susceptible to the ebbs and the flows in market activity and just market sentiment?
So they're always going to be, a prisoner, if you will, of the markets, and that's not necessarily a negative term. But yes, they have diversified into more predictable revenues, as you described, the wealth management area being one of them. And I think what you're also finding is that under the leadership of David Solomon, they have really decided to increase their penetration in their top 150 institutional accounts. And they've had real success there. They want to be number 1, 2, or 3 with those accounts for that repeat business that you just described. So yes, they are improving that. They are having more predictable revenues, but we also have to remember the biggest part of their business still remains trading and investment banking. And there's nothing wrong with that, but it is something that you have to be cognizant of in terms of market conditions.
We're talking about also any kind of read-through to the underlying consumer, and we point to the idea that credit losses, Scarlett was mentioning, came in lighter than expected at $339 billion versus the estimate of $369.6 million. All of these are rounding errors when you look at their actual revenues. Is there any tell from that in terms of the broader economy and any potential slowdown in certain sectors, or is this completely different because they're dealing with high net worth individuals who have a very different credit profile than maybe some of the areas that are seeing bigger pockets of pain in the United States?
It's interesting because it's ironic when you look at their credit, the consumer credit side of Goldman Sachs, it's really not high net worth. It's, I would argue, when you look at the FICO scores, it would be, middle market down to above, near subprime, but not subprime. But we also saw that JP Morgan in their outlook piece, they lowered their credit card loss expectations. So what we're seeing on the consumer side is, yes, that subprime, the low FICO score consumer is certainly struggling with the higher inflation, lower wage gains, but the middle market and then the emerging affluent and affluent markets are still very healthy, and that's where most of the banks focus their lending on. They're not going after the subprime market. And earlier, when we were talking about credit, we have to also remember post-financial crisis, the U.S. banking industry has been de-risked. And that's also showing up in these numbers today for all the banks.
Jared, is the same true for the regional players, the regional banks?
John, absolutely. Now, of course, we have the idiosyncratic credits that you guys have talked about with First Brands and Tricolor. We're certainly going to see that happen from time to time, but the regional banks, in our view, also should be reporting good quality credit as well as we go forward into the reporting season this week.
Because I know you cover Fifth Third as well, that tie-up with Comerica. Jared, are you focusing on seeing more of the same from the regional players into year-end? We've talked lots about the deal flow, but within the deal flow, the mergers and acquisition story is getting a little bit more interesting for the banks.
John, it really is. And if you start to see rates continue to come down, one of the obstacles to getting more deals done is the marks that the buyers have to put on the seller's assets. And as you recall, many of the banks bought bonds and made loans back when rates were much lower in 2020 and 2021. As those portfolios burn off, and if rates come down further, that obstacle goes down, which makes deals, even more attractive. So yes, as you and I have chatted in the past, back in the 80s, we had 18,000 banks and thrifts. Today, we're down to about 4,300. M&A activity ebbs and flows, and we expect over the next 12 months, you'll see a real pickup within the banks, more mergers and acquisitions, especially if rates continue to trend down.
A sign of things to come. Jared, you're going to stick with us. Jared Cassidy of RBC. We'll have more from Jared in the next hour. Get numbers from Citi in about 20 minutes' time, following record third-quarter revenue from Goldman Sachs this morning, and almost, I stress almost, a beat across the board.
I mean, honestly, the only one point where you didn't see a beat was in equities trading. Everything else, pretty much across the board. Net interest income came in at $3.85 billion versus the estimate of $2.87 billion, so almost an entire $1 billion in addition to what people were expecting. The EPS was $12.25 versus the estimate of $8.40. It really goes to the question, is Goldman Sachs highly leveraged to the cycle of capital markets and what we're seeing in terms of deal activity, as well as high net worth individuals? So they're not going to see the weakness. How translatable, how transmutable are these types of earnings to, say, the smaller banks, to some of the more regional players, as well as to private credit, which is more connected to the underlying economy?
The stock is a little bit softer this morning, but that stock has had quite a run for 2025. Goldman Sachs so far this year, before today, year to date, up around 40%. Big move for the year so far. Let's get you an update on stories worldwide. Here are your headlines with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Goldman Sachs shares are lower after the investment bank reported third-quarter earnings. Goldman beat on estimates on advisory revenue, investment banking, and saw record third-quarter revenue coming in at $15.2 billion, up 43% from a year earlier. Global deal values topped $1 trillion for just the second time on record, boosted by a slew of major transactions in the quarter. Elsewhere, the US has begun collecting tariffs on imports of lumber and timber at a rate of 10%, as well as on cabinets, vanities and upholstered furniture at a rate of 25%. The moves, which went into effect at 12:01 a.m. Tuesday, threaten to raise renovation costs and deter new home purchases. Currently, roughly 7% of all goods used in new residential construction come from foreign suppliers. And President Trump hosting Argentinian President Javier Milei today. The White House expected to announce a $20 billion lifeline to prop up the South American country's economy. This after the US Treasury began to buy the Argentine peso to help stabilize the economy and bolster support for Milei. Milei faces a midterm election, of course, later on this month. And that should be my brief, John.
Lizzie, thank you. More from Lizzie next hour in about 30 minutes' time. Up next on the program, the case for cutting.
The FOMC's decision to cut rates by 25 basis points in September made sense. Over the rest of the year, I view easing along the lines of the median SEP policy path as appropriate.
A few more days of Fed speak before going into the blackout, the quiet period. Chairman Powell delivers an address later on this afternoon. We'll break things down with Kay Herr of JP Morgan. Live from New York City, you're watching Bloomberg TV.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs? And you're lowering the cost of the meatballs,
I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We actually are running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Live from New York City, welcome back to the program. Equity futures on the S&P 500 just a little bit softer. Big day ahead. Includes Chairman Powell later on this afternoon, 12:20 Eastern Time. More earnings coming up later. Numbers from Citi in about 14 minutes' time. Numbers from the bank so far so good. The equity market, though, is failing to get a lift. The mood isn't changing. Equities down across the board. We're down by 0.9% on the S&P. On the Nasdaq, we're down by a little more than 1%. The only good news I've got for you is that we are off session lows. In the bond market, that rally holds. Had a rally on Friday, closed on Monday, and the move sticks. Yields are down by about 2 basis points, 4 on 10s, and briefly a 3 handle on a 10-year maturity earlier on this morning.
So I guess the real question here is how much comfort can investors get from the idea that developed market government bonds are acting in the way that they traditionally do, which is as a risk-off haven. Is that really something that you could take forward, or is this sort of a momentary knee-jerk reaction at a time where people have a lot of money sloshing around and are looking to put it somewhere?
Very different to the price action of April.
Yes.
I know we've said that a few times, but the risk aversion of April, we were selling bonds too. That was kind of scary at one point. We're not seeing that over the last week.
And I don't know how much it's the revenues coming in from tariffs. I don't know how much it is concerns that Jamie Dimon represented when it came to the labor market softening. I don't know how much it has to do with Federal Reserve officials that are going to be cutting rates and trying to support bond markets no matter what. There is this question about how sustainable this is, and I think that really is what we're going to continue to ask.
Let's turn to the Federal Reserve. Under surveillance this morning, the case for cutting.
Labor market risks.
So here's the latest this morning. Some problems with that sound, obviously. Chairman Powell getting ready to speak, just not quite yet. A full day of Fed speak ahead with Fed Chair Jay Powell speaking at 12:20 Eastern Time. Kay Herr, the U.S. Global Fixed Income Currency and Commodities CIO at JP Morgan Asset Management, writing the following. Despite the absence of government data, the Fed is on track to deliver another risk management cut at the end of the month, in line with market pricing. Kay joins us now for more. Kay, good morning.
Glad to be here, John. Thank you for having me.
Thank you very much for being here. So no strong case to deviate from the dot plot. When did things get harder for this committee?
So it's an interesting question, and let's take a step back. First off, I think every time I've been on Bloomberg, I've been here to comment on a piece of economic data. CPI, jobs numbers, there's always data. So it's kind of interesting to be here this morning without a data that you want an immediate comment from me on. It's kind of actually a little more relaxing.
Kay, I'm struggling too. And I think
You're
gets
just
awkward.
making it up, John. It's fine.
I make it up every day. Don't worry about it, Kay. I worry about this Fed at the end of the month because it could be uncomfortable for them. They might not have payrolls. They will have CPI. And CPI might have a 3 handle. Now, you expect that rate cut, but how uncomfortable is that rate cut with inflation around 3%?
So look, I think if we go back to August, and obviously Powell's speaking again today, but we go back to August, Chairman Powell made very clear that his primary focus is the labor market. And while we have not received yet non-farm payrolls, and it's unlikely that we will get them before the Fed meets at the end of this month, the data that we can see, like the Indeed job opening type data, any type of survey data, continues to indicate that jobs are harder to find. And I think with the Fed's focus on jobs, they continue. They cut 25 basis points in October. They cut 25 basis points again in December. They cut 25 again in January. That's our base case.
Does that make you like long bonds here with the 10-year at 4%?
Yeah, in terms of long bonds, yes, we have been modestly short duration. We've had a view for a while now that the 10-year is going to stay in a range between 3.75 and 4.25. As John observed, 10-year has struggled to break through 4 on technicals. It touched it this morning, behaving, as you noted earlier, in a classic, risk off, back to bonds. So candidly, as a bond manager, as a bond PM, it's kind of nice to see bonds doing exactly what they're supposed to be doing at this point.
I'm struggling with this idea that we can have asset price inflation. We can have a part of the consumer doing incredibly well because of the wealth factor, because of the stock market, as well as the fact that they're getting paid more and they're getting paid better, that we can have all of that without inflation, even if you do have a cohort of the labor market that's flat on its back. How do you reconcile those two things?
You raise a great point, and I think to quote the big boss back at JP Morgan, there's an awful lot of money sloshing around. And I think that's exactly right. There's an awful lot of money sloshing around, and that's what's driven equity price appreciation, appreciation in various things. Inflation's a little bit trickier. When you think about inflation, what are the primary drivers of inflation? You get inflation from wages. We have not seen any wage inflation. I'm not talking about the next CPI print that we get. Undoubtedly, that will be a hot number because we've got effects from tariffs. But when you take a step back and think broadly what drives inflation in the U.S. economy, it's wages. Like I said, the wage data is the labor market is clearly showing signs of weakness, so no signs of wage inflation. You look at rent inflation. There's been an awful lot of supply that's come on. The housing market continues to remain weak. We don't see long-term structural rent inflation. And then thirdly, it's inflation expectations. Those also have remained relatively contained. So near term, yes, I think you'll start to see the impacts of the tariffs. But longer term, it's hard to make a case for high sustained inflation given the weakness in the labor market and the weakness in the housing and rental markets.
But Kay, how uncomfortable is it going to be for the Fed to cut, knowing potentially they're going to have a hot CPI print, because we will get the CPI report. But as you said, we're probably not going to get the labor market report. Jay Powell says he's data dependent, and the only data he's going to have going into this is potentially hot CPI.
I think they'll go back and look at some of the real-time data, so that some of the survey data, and the survey data, whatever you're looking at, continues to indicate that jobs are harder to find, and there's a shortness of, there's not as much people quitting jobs. I think the other thing that they're going to get, which is going to be a focal point for the next three weeks, is earnings. As you noted, earnings have started in earnest today, and I think there's going to be a big focus on margins, on what companies are doing in terms of passing through the tariffs, but also what companies are doing with the labor force. So I think that'll be things that they'll focus on.
Neil Dutta agrees with you. He writes in from Renmark. He says the following: the labour markets are slowing, oil is coming down. Worrying about inflation here just demonstrates how off the reservation some of these officials are at these central banks.
Well, okay, maybe that's the case. And I hear that a lot of people agree with him, and I understand the case. I can also understand the case on the other side. When you see the earnings, the likes of what we've gotten from the banks, when you see the asset price inflation, and then you see the fact that some people are willing to pay $14,000 for a first-class ticket over to Zurich at a random time, you start to wonder, at what point are we looking at asset price?
I think it's more than that, but
yeah, I would just like to go on the record that I'm not going to Zurich, and I'm not flying first class anywhere. I'm not sure where that came from. Maybe that was the last person that was in this seat.
I'm just curious about at what point asset price inflation translate to either real world inflation or a deflation in the asset prices. I just think that there might be some sort of disconnect
I think Lisa's projecting just a little bit. I think possibly, maybe. Is that you doing a search for next year? right?
That's literally the cost of...
It's more than $14,000.
All right, let's move on.
Why Zurich? Move, someplace else.
That's true.
You buying gold in Zurich? Is that what your angle is?
But
now we're tying everything together. I now see the increase in the gold prices.
About the asset price inflation and the debasement of the currency leading to a broader-based inflation in the underlying economy.
So let's take it back to earnings. I think the real drive...
Thank you, Kate.
The real driver of asset prices is the underlying earnings. So I think the real focal point right now should be on earnings. What are sustainable cash flows, and what are the multiples that people are willing to pay for those?
So in public markets, the large companies are printing money and doing really well. In private markets, we're seeing some signs of stress. How are you thinking about the distinction you would draw between some of the credit stress we've seen in private markets and what you're seeing in public markets?
Yeah, I think the interesting thing is that increasingly the distinction between public and private markets is blurring. You know, if I think about my career in the financial markets and fixed income markets over the last 26 years, there used to be a very clear delineation. This is public, this is private. What we've seen over the last decade, really, over the last 5 years in particular, is the blurring of those. Private equity sponsors, they don't really care whether they're borrowing in the levered loan market, the high yield market, or in the private credit market. So I think there's a blending and a blurring of all of those. So I do think, you know, we have started to see some credit. I would call them at this point idiosyncratic. Are they, is there a theme on them? There seems to be a theme of some fraud, some possible fraud. Back to Lisa's earlier point, I think when you see so much money sloshing around, it's not uncommon, late cycle at this point. I don't want to bring up shades of 1999, 2000, but if you go back in that era, that was absolutely a time of corporate malfeasance. So I think that's something to watch for. And I think you make a great point. Overall, in large cap S&P 500 land, earnings are strong, cash flow is strong. We've started to see some weakness and cracks in other pieces of it. It remains to be seen. It looks like, I haven't looked at this morning's earnings closely since I was here prepping with you all. But so far, it looks like credit quality remains pretty strong. It looks like loan growth is growing in those markets. So, you know, maybe just idiosyncratic, but I think, as you all know, when we're managing bond portfolios, some people might make it seem exciting that it's about what the Fed's doing, but there's an awful lot of bottom-up individual security analysis, and that's really where we're focused right now, John.
We try and make it sound exciting anyway. Kate,
it's really not, John.
Kate Hare of JP Morgan from New York City this morning. Good morning. The third hour up next.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises And for both, it's now or never. Democracy and climate. And they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
For many investors, there aren't that many alternatives to the U.S. market.
There has been so much complacency within the market.
There are going to be pullbacks. Those could be buying opportunities.
Markets are just still so focused on AI is great for the long term.
This market is really going to get its mojo going forward from earnings.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. On the S&P, up by, or rather down by 0.8% on the S&P. On the NASDAQ, we're lower by more than 1 full percentage point. On the Russell, we're negative 1.25. That screen reflects the tension between the US and China, but check out the banks. We've had a lot of beats on Wall Street so far this morning. From Wells, from JP Morgan, from Goldman Sachs, higher almost across the board, particularly for Wells Fargo, up by 2.6%. Citi, the latest, and we've got another beat, Bramo, this time from Citigroup.
Yeah, beat across the board. I mean, if you take a look at their fixed sales and trading, it's $4.02 billion that was the revenue coming in versus the expectation of $3.74 billion. Markets revenue came in at $5.56 billion versus $5.97. We can go through all of the numbers. The takeaway here is it's beating across the board in the banking sector, as well as the personal banking revenue, as well as asset management, firing on all cylinders at a time where the banks seem to be operating in a world of their own. High expectations and still continuing to exceed them.
Citigroup up by 0.8%. In the last half an hour, the last 30 minutes, Goldman Sachs with record third quarter revenue, Citi revenue beating in every single division. With the details, let's cross over to Scarlett Fu for more. Hey, Scarlett.
Hi, John. Yeah, I'm taking a look at these numbers, and it's a solid beat across the investment bank and markets business, as we've seen with most of the other banks as well. For overall markets revenue, $5.56 billion, higher than the anticipated $5.07 billion. Fixed sales and trading, $4.02 billion. Analysts were looking for just under $3.75 billion. Equity sales and trading revenue, $1.54 billion, also higher than the anticipated $1.33 billion. And investment banking, which is a smaller part of Citi's business here, $1.17 billion, higher than the anticipated $1.05 billion. So FIC was a real standout here for Citi, which was anticipated. Just looking at the numbers here, the CFO, Mark Mason, had been giving indications that perhaps the firm was maybe backing away from its explicit cost targets for the full year. So we did get an update on that. It says it sees full year expenses higher than $53.4 billion. The stock right now is still trading a bit higher in after hours, pre-market trading at the moment here. Citi, of course, is still targeting a return on tangible common equity of 10 to 11% for 2026, so that profitability measure does remain intact. In terms of the return of cash to shareholders, Citigroup bought back $5 billion of its common shares in the third quarter as well, and it still sees a full year adjusted revenue of above $84 billion. So again, a lot of question marks here when it comes to the outlook for expenses and revenue for this year after the Mark the CFO, Mark Mason, had given an indication that perhaps the firm would be emphasizing other metrics and not so much the actual line for total expenses. We'll continue to go through all these numbers right now, but one more thing I wanted to add on is Banamex situation, the Mexican unit that Citigroup is trying to sell. Of course, it did reject an offer from Grupo Mexico, and it did announce sales, an attempt to sell a 25% stake. It says that it continues to work towards a planned public listing of the firm. The big question is, when will that happen? Will it be delayed until late 2026 or beyond?
Scarlett, thank you for breaking it down. More from Scarlett Fu later this hour. Here's the statement from Jane Fraser of Citi. The cumulative effect of what we've done over the past years, our transformation, refresh strategy, our simplification, have put Citi in a materially different place in terms of our ability to compete. The stock is higher this morning on the session by a little bit, on the year by a lot. Citigroup is up this year by close to 40%. Similar story for Goldman. JP Morgan's higher by 30%. This has been the issue for me so far this morning, Brammer. How much of this morning is new? The numbers are great, but this story is well understood, and it's reflected in the rally we've seen so far year to date.
Which is the reason why people said they've got a very high bar to beat, and guess what? They did, and they raised it. And so this is the question, how much more is there in the pipeline? This is why we're all going to be listening to understand exactly how big the pipelines are for the fourth quarter and beyond, how predicated this is on an ongoing strength in the consumer, and for Citigroup in particular, because they are so global, they are such an international, transcontinental kind of bank. What kind of flows are there at a time of rising geopolitical stress? Are they seeing that in terms of their banking, or is that encouraging people to take more action to diversify into other regions?
Let's stick with the earnings this morning. Matt Stuckey of Northwestern Mutual Wealth Management writes in the following: the scarcity of earnings growth that for the past few years was only found in large cap tech can also be found across a variety of segments of the market. Matt joins us now for more. Matt, I guess just to build on the conversation we've been having, does that include the financials, the big banks on Wall Street?
Well, it certainly does, and thank you for having me again. Good morning. Just looking at the numbers for JP Morgan that were reported just a short while ago, you're talking mid-teens to 20% plus in terms of trading revenues. And then if you add into that just the continued health of the consumer, at least JP Morgan's consumer, driving credit and debit card spend up 9% in terms of volume year on year. That is very healthy top-line revenue growth. Again, to my earlier comments that I sent over, it's not just a Mag 7 environment anymore. Certainly those companies are continuing to be healthy, but you can look to other parts of the market still and see pretty attractive top-line growth.
Matt, it's been really impressive to see the deal activity of the past few months. Fifth Third getting it together with Comerica. Biggest leverage buyout in market history announced in September. Paramount still going after Warner Brothers. Matt, is this just a feel, a sign, a sense of things to come for 26? That's certainly the conversation we had earlier on this morning. Is this more than just pent-up demand? Is it something bigger than that?
Well, I think it's a reflection of market conditions to a certain extent. You're looking at high yield credit spreads kind of near 25-year tights, and that opens the M&A window in addition to a change in the administration from last November. And so companies are seizing the moment, and companies like JP Morgan, like Goldman Sachs, as we're seeing this morning, are capitalizing on that environment, kind of really generating healthy top-line growth in those fee-based businesses. So, it's a question of whether or not, a company has a strategic rationale for expanding through the M&A window, because it certainly is open to them at this moment.
We used to extrapolate out from bank earnings to the rest of the earnings season and sort of atone to the overlying economy. Can we still do that if some of these deals are driven by low credit spreads and financial conditions that seem increasingly divorced from what people talk about in the labor market and other pockets of select credit weakness?
Well, I think the nice thing about bank earnings coming first in the earnings season is you do still get a pulse on the consumer. And in the absence of government-related data kind of being shut off, at least for the time being, it's a somewhat comforting reminder that if you look at the credit quality of the banks that are coming across the wire this morning, that things look fairly benign in terms of their own kind of credit experiences. Specifically here, if you're looking at charge-offs for for JP Morgan, down year on year, down quarter over quarter. And so some of this labor market weakness that, has really captured the attention of policymakers really isn't impacting the credit performance at this point for banks. And it's still also reporting, pretty healthy consumer spend levels at the aggregate level. And so, I think if we're looking just at, the investment banking activity, that can tell one side of the story, but there is a consumer update that comes with bank earnings reports that I think is really valuable in the vacuum of very little economic data rolling across the wire.
We're seeing it not have that big of an influence on equity futures this morning. They are lower, and it has to do with the geopolitics of the moment, the escalating tit for tat between China and the United States. I just wonder if there is enough momentum in the underlying consumer that you're sussing out from some of these earnings to give you confidence to buy a dip, right? To go in if there is even a modicum of a sell-off in the face of geopolitics.
Well, I think dips probably, we should talk about those as more in the 5 to 10% category, not the 1 to 2% category. And so I think if we're looking at the market setup here, certainly earnings are strong, but valuations are also very high. And I would say market psychology, just in terms of kind of what's been driving markets higher post-April, has been a risk on sentiment, with some areas of the market, that have little to negative earnings kind of really leading the performance of the market. And so to me, I would say risk appetites are pretty full on the part of the investor. And so, that's not necessarily the dip buying kind of mentality that you want to charge into until some of those excesses start to burn off in the market.
Are you basically saying that potentially this quarter, the next few weeks, could be driven by the geopolitical headlines, less so the earnings, because the rhetoric has gotten so hot and the valuations are so high?
Yeah, I think that certainly is potentially, something that we need to watch out for. Just look at kind of what aggregate risk is priced into financial assets here. Again, we have credit spreads near 25-year tights. The market's trading 22.5 times forward earnings, kind of near the top end of the range for the last 5 years. And so it doesn't take a whole lot of incremental risk to be added into the equation for that to find its way into security pricing. That being said, earnings trajectories look stronger than any point in the last couple of years, at least from a broad scope. If we're looking at things like large caps, small caps, mid caps, all looking at earnings revisions pointing up and to the right. And so it's been a better earnings backdrop to probably navigate maybe some incremental headwinds from the geopolitical perspective, but certainly, from a pricing perspective, any kind of wobble in terms of the geopolitical outcomes as we head into those negotiations could affect asset prices.
I guess, is it an opportunity to buy before the sit down, or potentially you want to know what the news is of the sit down after?
It'd be really difficult probably to say, the outcome of that conversation more than the incremental investor. And so to me, I don't think you kind of position a portfolio with little to no edge going into that decision. I think you just stick to kind of what your overall portfolio is and continue to kind of use diversification as the way to navigate, a lot of headline risks that might be coming between now and then.
Matt, appreciate it. Thanks for jumping on, sir. Matt Stuckey there of Northwestern Mutual. Following the latest on the banks on Wall Street, really, for many of us, earnings season begins 2 weeks tomorrow. Meta, Microsoft, Google, that's at the beating heart of what's happening, not just in this market, but also the broader economy at the moment as well. So you've got to wait a few more weeks.
That is the GDP story right now, is the AI spend, and how much does that continue to really beat and raise. That's really going to give us a sense of how long this rally can keep on going, regardless of what goes on in terms of the geopolitical noise.
Then you get numbers from NVIDIA in like 10 years.
November 19th.
Yeah.
2027.
Basically Thanksgiving.
I know. It's ridiculous. I wish they'd bring it forward, but they've got their own reasons. Okay. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. Citigroup beat Wall Street estimates across all 5 major business lines. Total revenue jumped 9% as multiple divisions set record for a third quarter. Expenses also climbed 9%, part of that coming from higher spending on compensation and on benefits to lure a wave of bankers recruited to bolster deal-making. Now, services and US retail banking units both had their strongest quarter ever. Elsewhere, Fed Chair Jerome Powell is set to speak today before the National Association for Business Economics in Philadelphia. It is his first major public appearance since the policy meeting last month, which, of course, exposed deep divisions among Fed officials. Meanwhile, Philadelphia Fed President signals she favors 2 more quarter-point interest rate cuts this year. And the International Energy Agency is expecting a record oversupply of oil next year. The agency expects world oil supply to exceed demand by almost 4 million barrels a day by 2026. The anticipated oversupply comes as OPEC Plus and some of its rivals continue to boost oil output. And that's your Bloomberg Business Flash. Your Bloomberg Brief, John.
Hey, Lizzie, appreciate it. Lizzie Burden, thank you. More from Lizzie in about 30 minutes' time. Just tracking a media call for JP Morgan, the CFO, Jeremy Barnum, being asked about what's happening in private markets and the exposure to things like First Brands, Tricolor. Didn't have exposure to First Brands, good news. Has a $170 million charge-off for Tricolor. You can see where the attention's going to be, the spotlight on the earnings calls in the next few hours.
How much of this credit quality worthiness is going to be called into question as a result of some of the recent hiccups? And how much does really the point that Kay was making really remain relevant, which is when you have frothy markets, you get malfeasance, you get fraud, you get things that happen in funny ways, and how do you really reduce your exposure?
And a lot of that's happened in the dark, with little transparency. S&P 500 futures negative here by 0.8%. Up next, the morning calls plus Gerard Cassidy of RBC as we recap the latest round of bank earnings. Earnings season on Wall Street commences.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I think it may be a little bit of a spookier October. I think earnings continue to be the North Star. As I look at the overall market, you're just seeing some minor cracks. We still think we're in a bull market that deserves the benefit of the doubt. But, you know, I think this turbulence is likely to continue through this month.
3 years into this bull market, an 80% plus rally, trillions of dollars of wealth created over the past 36 months. Equity futures on the S&P 500 negative by 0.9% this morning. On the Nasdaq, we're down by 1 full percentage point, dominating today's trading. In fact, dominating the trading of the last 3 sessions, this tension between the US and China.
Absolutely. And the latest call out basically from the Treasury Secretary saying that what China is trying to do when it comes to rare earths is bring down the entire U.S. economy. And what we have this week is more basically targets when it comes to hot rhetoric and what they plan on doing when it comes to ships. Last week it was rare earths. All of this before the 2 leaders are set to meet. Is there enough time to basically put a lid on all of these issues? That remains to be seen.
Stocks down, bond yields lower. We're down by 1 basis point on 10s to about 4%, down 2 on 2s to about 350, just sub 350 at the moment. Kay Hare of JP Morgan on the program about 30 minutes ago, just making the point that this is I guess, comforting, the fact that bonds are doing what they're meant to do?
Well, if you're a bond investor and you're looking to weakness in the economy as providing a support to bonds, then this should give you some confidence. That said, the rally isn't that significant on the long end, so if you're going to be bearish in any way, which some people might be, you would look at something of a, bear steepening, and that would be sort of what's going on.
Some people,
Some people, technically.
Got to find something, haven't you? Just like that little thing.
You have to find the contrarian trade.
I'm with you.
There is this question of how much this is buyable versus something that just is momentarily, that's a knee-jerk reaction.
The negativity, but all right. That's the price section. Let's get you some morning calls. First up, Wolf Research upgrading AMD to outperform, saying it needs to, quote, simply execute after its OpenAI deal. Next up, Bank of America cutting its price target on GM to 61, expecting lower North American volumes. And finally, Piper Sandler raising its price target on Schwab to 100, optimistic on the overall health of retail traders. And the #1 performer on the S&P through most of this year, Robinhood. It's just been flying.
And frankly, the retail investors have been bullish, and they've been the ones that everyone else, the institutions, have been chasing. And they've gotten it right. They've gotten rich. And frankly, the people who haven't been in the market have been the ones that have lagged behind in the spending and in the earnings. So at a certain point, success begets success.
True. And they've been successful, that's for sure. Let's stick with the financials. Big banks kicking off earnings season today. JP Morgan edging lower, despite the bank boosting its net interest income forecast for the full year. The CEO, Jamie Dimon, said in the release, while there have been some signs of a softening, particularly in job growth, the US economy generally remained resilient. With a recap of the earnings this morning, here's Scarlett Fu with more. Hey, Scarlett.
Hey, John. Yeah, JP Morgan, Wells Fargo, and Goldman Sachs all reported their results a few minutes early. Maybe they were super excited to get their numbers out, because the setup into this earnings season is that the big banks would beat and raise, especially for JP Morgan and Goldman Sachs. But you look at how they're performing in the pre-market trade right now. JP Morgan and Goldman Sachs shares are lower, perhaps because they were seen as the big stars and they had gained so much, outperforming the broader market and their peers. We already got some indication that the results would be solid on the investment banking and trading front because of Jefferies' results. Jefferies posted its best third quarter ever, thanks to an explosion of M&A. We saw M&A globally top $1 trillion in the third quarter, only the second time ever. And that boom creates a multiplier effect where you get equity financing, debt financing, hedging, divestitures. So to that point, Goldman Sachs investment banking fees rose 42% and advisory fees surged 60%. JP Morgan had guided the investment banking fees to double-digit year-over-year increases. It delivered on that. The standout really when it comes to FICC trading was Citi coming through with an 11% jump to $4.02 billion, and JP Morgan reporting a 21% increase. On equity trading, Goldman Sachs actually missed by a little bit. JP Morgan rose 33%. What's interesting, of course, is also the third quarter tends to be kind of seasonally slow, but because of all the excitement over what's happening with the deregulation and the AI trade, the activity has been certainly very, very robust, and that has translated to better revenues and profit for these big banks. In terms of the net interest income, which is the difference between what banks earn on loans and pay for deposits, their bread and butter, as you mentioned, John, JP Morgan did raise its full year outlook by about $300 million, but for the third quarter, its net interest income did miss ever so slightly. Of course, investors and analysts are perusing through, scrutinizing these reports for any indication on what these banks say about credit quality, about consumer and corporate confidence, especially because there's no economic data right now because of the government shutdown. Jamie Dimon was fairly cautious. He usually is in his comments. But having said that, the numbers really speak for themselves. And because of the big gains in their share prices, you're seeing a little bit of pullback in the star performers.
Scarlett Fu with the latest. Scarlett, great work this morning. Tremendous as always. Jared Cassidy of RBC Capital Markets back with us for a final word on things. Jared, so today we've heard from JP Morgan, Goldman, Citi, Wells Fargo. Tomorrow, Morgan Stanley and Bank of America. What have we learned this morning, and how does that inform your view of what we can expect tomorrow?
John, I think what we should expect tomorrow is the fact that the trading results for Morgan Stanley and Bank of America will likely mirror what you saw today from the big banks, which were very good. You know, the FICC numbers in particular year over year were strong, and we anticipate that we'll see that for the others. Also, the investment banking results, as you pointed out already earlier in the show, were also strong, and we should expect that as well for Bank of America and Morgan Stanley. And then finally, on Bank of America, since they've got a real deep dive into the consumer numbers we've seen today whether it was JP Morgan, Citi, or Wells Fargo, all were resilient, and we would expect Bank of America's numbers to be resilient in that area as well.
And on the call that John was mentioning, JP Morgan called the CFO of that bank saying that he's not really seeing any cracks in the credit market aside from a couple of idiosyncratic areas, and says that for investment banking, all drivers are pretty much in place. I do wonder, though, that what we heard from the Wells Fargo on their call is that middle market clients are still cautious on borrowing. How much do you expect the success to be mirrored in smaller and mid-sized banks that are going to report that might be more leveraged to those middle market clients?
It's going to be interesting, Lisa, because certainly Wells has got a good read on the middle market of the U.S. It's predominantly a U.S. bank. And the regional banks, though, could also benefit from the fact that the capital expenditures that we're anticipating due to the big, beautiful bill that was passed in July with the depreciation of 100% of those capital expenditures in year one could drive commercial and industrial loan demand. It's interesting to note JP Morgan's loan growth year over year was 7%. Wells was much lower, closer to 2%. So I think what you're going to see is that Wells is still coming out of that asset cap. It's going to take time. They have indicated that. And so I think the read to the regionals is still positive based upon what we saw from JP Morgan's loan growth.
Gerard, I know that you probably don't want to pick favorites or winners, but so far it is early. Who do you think is winning the earnings season right now?
Of the four that came out, obviously JP Morgan's numbers were very strong across the board, so you probably have to put them up at the top of the leaderboard. Citi's numbers were also very good. They had a higher tax rate, which on a bottom line basis impacted EPS, so you'd probably put them up second. And then, you know, the other two, Goldman and Wells, are tied for third. You know, there's gold, silver, and bronze for everybody.
Gerard, thank you. Appreciate it. Gerard Cassidy of RBC. Tremendous to have you with us throughout this morning, breaking down the numbers from the likes of Goldman, JP Morgan, Wells Fargo, and Citi. We don't have data, we've got earnings. And in those earnings, if you're worried about the consumer, I know this is not a broad view of the US economy. Certainly the likes of Delta captures the upper income earners, but so far pretty decent. Okay, it's not reflective of any kind of freak out that you might have seen off the back of a massive step down of the payrolls growth that's developed over the last year.
If the big banks saw a real issue with credit concerns, they would have increased their credit loan loss provisions much more than they did. And what you're hearing in the commentary is not a lot of concern about some sort of rapid deterioration. So far, those warning signs just aren't coming out in the way that you would expect if we really are about to fall off a cliff.
It's an overused phrase, I know, and we've been using it repeatedly since the pandemic, but the K-shaped economy. Yesterday, we called it the Delta Airlines economy. It's what it feels like. It's what you see in the data. It's what you see in the earnings.
I just wonder how sustainable it is. I mean, I don't want to go all, societal,
sure,
but there is that question. There's also this question of, does the upper income drive inflation for the rest of the economy?
Up next on the program, we'll catch up with Joe Davis of Vanguard as he's expecting just one more rate cut. Plus, Yahira Anand with your morning movers. The blockbuster AI deals keep coming.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Just check out JP Morgan in the pre-market. Just wanted to give you a sneak peek of what's happening on the earnings call, at least in the last 20 minutes or so. A lot of interest in what's happening with the elevated credit cost figure over at JP Morgan. And JP Morgan being very transparent about the situation, saying that contributing a $170 million charge-off was the issue with the subprime auto lender Tricolor Holdings. Jeremy Barnum, the CFO, had this to say: "We're not in the habit of calling out exposures to individual borrowers, especially for amounts that are quite immaterial, but it's getting attention, so, quote, we might as well not dance around it." I think Jamie Dimon, the CEO and chairman of JP Morgan Chase, saying not exactly our finest moment.
Yeah, really being pretty open about this, and it explains why their credit loss build was greater than other banks relative to expectations. It also is interesting, they went on to say this is not something they're seeing in a broader credit market issue. This was a couple of bad actors and that they're going to continue to be vigilant. But it does speak to that loan loss builds that otherwise seemed out of sync with the rest of the banks.
Quote, "We do not have any exposure to first brands. There's nothing more." But these banks are going to get questions about what's happening with those credit events in private markets over the last few weeks. And I imagine we'll get similar questions tomorrow on earnings call with regards to the other banks.
Well, to build on that, and it isn't just with respect to these names, Jamie Dimon also did comment on private markets and concerns there, saying not seeing it yet, but saying that he is worried about transparency. The lack of transparency in private credit will become an issue, particularly, he said, if it goes retail. So clearly there is a greater degree of attention being placed to this. I also want to point out one other thing. And I noticed this as I was digging through the results. Their headcount rose from last year. So they're talking about AI taking over all these jobs. You know, maybe not. Their headcount actually went up a little bit year over year.
They're leaning in
yes.
to heightened client activity, let's put it that way. Equities, if you're looking at stocks this morning, of course, we're lower by 0.9% on the S&P. We are off session lows. We're still down on the Nasdaq by 1.1%. The tension between the US and China coming back to the surface started on Friday. Felt like we backed away on the weekend, but only really one party backed away over the weekend. So when we bounced on Monday, we didn't take back all the losses of Friday. Then again this morning, just more details of China just tightening the screws a little bit, positioning for leverage going into talks at month end.
Yeah, the new port fees on U.S. ships is what we got today out of China. This matches what the U.S. was doing as well when it comes to Chinese shipping. Last week, it was about rare earths. And on top of this, you have the Treasury Secretary speaking to the Financial Times, talking about some of the context of what's going on in these trade negotiations. And really, he was really rough on China, saying they're in the middle of a recession or a depression, and they're trying to export their way out of it. The problem is they're exacerbating their standing in the world, meaning what they are doing when it comes to rare earths is not just going to hurt the United States, but it's going to hurt all other trading partners as well. That's a tailwind for the bond market so far this morning. Yields are lower across the board. We're down by 2 basis points on 10s, just north of 4% on 2s, 347. That's a cross-asset price action with some single names into the opening bell, about 58 minutes away. Here are your morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We have our latest AI deal, and it is a big win for AMD. Oracle plans to deploy 50,000 of AMD's new MI450 chips in data centers starting in 2026, just highlighting the race to build more AI computing power. The deal positions AMD as a growing rival to NVIDIA amid this push to meet the soaring demand for compute power. As I said, AMD shares rising 2.3% on that news. Meanwhile, moving on to banks, corporate deal making is back, and you can see it in these results. Wells Fargo shares are up 3.2%. While it's not a big player in the space, Wells Fargo posting higher than expected investment banking fees, though net interest income did come in slightly below estimates. Meanwhile, Citi revenue, it beat estimates on revenue across all 5 of its major business lines, while Goldman Sachs posted record third quarter revenue on trading and investment banking, but those shares down 2.6%. And we are seeing rare earth stocks extending their gains. Look at critical metals up nearly 35%. Now, I will note USA rare earths up 11%, MP materials up 8%, on track for 4 straight days of gains. The sector has been surging ever since China tightened its export controls on these rare earth minerals, and with every escalation since, including that one overnight by Beijing. John?
Yahara, thank you. Thanks for the update. The rally in that space has been unreal. Phenomenal. The opening bell just around the corner. Let's turn to the Federal Reserve. Jerome Powell set to speak at the NABE annual meeting in Philadelphia later on today. Mike McKee's on the ground and has more. Mike, thanks for joining us and making time for the program. In mid-September, the Federal Reserve met, and since then they've been light on economic data. What more could Chairman Powell add later on this afternoon?
Well, that's the question of the day, John, because, of course, Jay Powell has taken both sides of the issue so far. Here's what he said a week after the Fed meeting. The last time we heard from him, he said near-term risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. Two-sided risks mean there is no risk-free path. Well, that's what folks on Wall Street would call MODO, master of the obvious. And since Jay Powell has to basically lead the Fed, you got to figure out where he's going, or he's got to tell us where he's going, because Friday is the day that that night the Fed blackout starts. And even though we're going to get the CPI numbers next week, the Fed will be in blackout. We won't know what they think about them. And this is a very divided Fed. If you look at what members of the Open Market Committee have been saying since the last meeting, you've got Myron, Paulson, Waller, Bowman, Daly, the usual suspects on the dovish side, and you've got just as many on the hawkish side. It's those who are cautious in the middle who could go either way, and we don't know which way they're going to go. Goolsbee and at this point, Philip Jefferson, along with Musalam and Michael Barr are the voters. Where does Jay Powell lead them? That's going to be the question of the day. And you made a good point earlier in the show, John, about Jay Powell is data dependent, but he doesn't have any data. So what's he going to say? That's going to be the big question today.
It's going to be very interesting, Mike. Looking forward to your coverage later on this afternoon. That speech drops at 12:20 Eastern Time. They're in a tough spot, aren't they? They don't seem to have a consensus on how to move forward at the moment. They disagree or have division around the data we actually have. But then we've got a bunch of data we don't have. And then you could see this situation where they don't have payrolls, they do have CPI, and CPI is around 3, and they're going to cut interest rates in October.
And then you add on top of this the fact that there's probably going to be new leadership and potentially a new member come early next year. You put all this together and you get this reticence to really do anything that makes waves. I do wonder if there is a reassessment of what the neutral rate is, if we do get some sort of inflationary read that is elevated in tandem with the earnings, whether the earnings take on a renewed interest for some of the Fed officials in the absence of anything else.
Let's stay on the Federal Reserve. Joe Davis of Vanguard writes the following: we expect the Fed to ease once more in 25, with October, that meeting being slightly more likely. Joe joins us now for more. Joe, welcome to the program. What makes October more likely, given we are light on economic data at the moment?
Well, I think it's just the slowdown we've seen in the labor market. Clearly, there's a number of forces at work. We've seen some supply come down materially over the course of this year. But the fact is, demand and businesses have held back on hiring, too. And so for that reason, our assessment for over 2 years is the Federal Reserve has been restrictive, perhaps not as restrictive as some think. And so this is really getting them to that elusive neutral rate, which no one knows what it is, but I think they're approaching where it should be.
Joe, Mike McKee talked about it, the amount of division on the Federal Reserve. I assume you believe there is a consensus on how to move forward. I'm struggling to identify that consensus given the amount of different views I see in the Fed speak. What do you see?
Well, I think this is actually somewhat typical of the various facets of the economy you could look at. When you're actually close to, let's call it appropriate. I mean, you have a GDP numbers that would, at the margin, say you shouldn't be easing at all. The inflation would point to that as well. But then you got the labor market that would suggest that you got to take a little risk management in these policies. So I think with that, depending upon how policymakers weight those various data feeds, again, we're going to have a lack of visibility here. I think that's actually par for the course where we're at now.
I just wonder how much they are prioritizing the labor market if they cut rates by another 50 basis points. I mean, what is the direct read-through to actually supporting the labor market?
Well, I think that's the key issue, and actually the gap between where GDP is and where the jobs market is, I think is the key issue for the next 6 or 12 months, because does the gap close because productivity is starting to rise, and we'll start to see then a stabilization and perhaps a modest firming in the labor market. That's case A. Case B, though, is that the labor market is symptomatic of weaker growth ahead, and then GDP would come down. That's a more recessionary impulse. We lean on the former, not the latter, but it's explaining that gap. That's the critical policy diagnosis over the next 6 months.
How much is this sort of quietly a Federal Reserve that is aware of the fiscal sustainability of the United States? And I say this with a lot of questions around Fed independence, but this is an issue facing central banks around the world. The idea that there is just so much government debt outstanding that inflation concerns have to be paired much more with fiscal sustainability and paying back that debt than they do, say, anything else. I mean, how much is that coming into play here in the back of some people's minds?
I think it's in the backdrop, but it's increasingly will be in the forefront in the next several years. And you see that in the price of gold, which would seem inconsistent, its rise with the S&P 500. In our framework, it's not. I mean, what we have said for 2 years is that there's going to this coming tug of war between AI's transformative ability on a positive side, and then if it disappoints, some of the deficit pressures, which again you're mentioning, you see a little bit of that in the so-called debasement trade. We are just starting this sort of tug of war, and that is how the market is going to play out over the next 3 years, is that tension.
Joe, are inflation concerns going to be more front and center for the Fed at the end of the month, not just because we're going to get the CPI report, but also because the ratcheting up of tensions and rhetoric and sanctions between Washington and Beijing?
I think they're still assuming, and I think it's appropriate, that although inflation's been sticky, some of the so-called, dare I say, transitory factors of the tariffs, you have to look through some of that. That was our thesis, that the Federal Reserve would start to ease policy, and it's one of the biggest rationales for us expecting it in October, and I think it's appropriate. I think the Fed will look at, the financial markets, less so gold, but more break-even inflation rates, term premium in the Treasury market, and that's still somewhat reassuring that we don't have a material inflation problem, certainly not what we had in 2022. The key question comes back to, where's the labor market 6 to 12 months in a Federal Reserve that has eased? Then there would be a reassessment.
But when it comes to the recent trade rhetoric and the tit for tat between Washington and Beijing, if we don't get some sort of deal by the end of the month and this bleeds into 2026, how much more concerning does this story become for them? How challenging?
Well, it becomes certainly concerning. Again, this is not a great shock if you're a central banker, if you're an investor to face, right? Because you have downward pressure on growth if tariff goes up, even from the uncertainty, and you push up the inflation rate. So it's clearly stagflationary. It's a sort of card you don't want to have dealt. I think you have a Federal Reserve that's assuming the inflation is more temporary than the labor market. There's a little bit of risk in that assessment, but I think that's fair for now. But the drag into 2026, that would be, I think, unexpected should the trade rhetoric accelerate.
Joe Davis of Vanguard. Joe, thanks for jumping on. Appreciate it. Trying to look over what Chairman Powell might say later on this afternoon without data and predicting what the Fed might do at the end of the month without data. We'll have CPI, by the way, should have it October 24th. The chairman is attempting to lead the committee to one particular perspective around the inflation story, and we saw that at the end of August in Jackson Hole. One off, not all at once. Trying to set up the committee to look through any inflationary bumps off the back of the trade story. And I think we saw that reflected from Anna Paulson yesterday as well, from the Philadelphia Fed, when she said, I simply don't see the type of conditions, especially in the labor market, which seem likely to turn tariff-induced price increases into sustained inflation.
This is the reason why I find it really interesting, in the absence of labor market data, how they can come to any kind of consensus about the other side of the mandate. So maybe it is a one-off. Do they really see deterioration, or do they see an increase in productivity? How much of a read-through can they get from some of the earnings that we're getting right now that speak to a pretty strong economy, and then say, well, that's a different economy than the one that we're facing off with? And then how much do they see any cuts in interest rates and actually benefiting the labor side of the mandate, given the transmission mechanism, which is capital markets, which are wide open? So these are some of the issues that we have to face off.
It's so important. What difference does it make, given how loose financial conditions already are? Equity futures on the S&P 500, negative by about 1% this morning. There's a wait to the tape this morning, going into the opening bell about 45 minutes away. We'll have an update on stories worldwide with your Bloomberg Brief. Let's cross over to Lizzie Burden for more. Hey, Lizzie.
Hey, John. Alphabet betting big on India. It plans to spend about $15 billion building out an AI infrastructure hub in the southern part of the country over the next 5 years. Alphabet plans to partner with Indian companies with plans to accelerate the AI industry locally. Now, the state plans to host 6 gigawatts of data center capacity by 2029. Elsewhere, AMD shares rising in the pre-market after saying that Oracle plans to deploy a large batch of its new AI chips. Oracle plans to put 50,000 chips in data center computers starting in the third quarter of next year. Oracle and AMD did not say when they expect the installation to be completed. And finally, NVIDIA has begun shipping their DGX Spark chip, which the company calls the world's smallest AI supercomputer, powerful enough to run massive AI models on a desktop. The Spark can be ordered online starting today and will cost nearly $4,000. NVIDIA CEO Jensen Huang kicked off the global rollout by hand-delivering one of the first units to Elon Musk at the SpaceX's Starbase in Texas. And that should be my brief, John.
Hey, Lizzie, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, Henry Schwartz of SIBO Global Markets as options traders prepare for earnings volatility. Live from New York City this morning, good morning to you all. You're watching Bloomberg TV.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
The data that we can see continues to indicate that jobs are harder to find. And I think with the Fed's focus on jobs, they continue. They cut 25 basis points in October. They cut 25 basis points again in December. They cut 25 again in January. That's our base case.
That was the base case of Kay Herr of JP Morgan joining us in the last hour or so. If you are just joining us, welcome to the programme. As we count you down to the opening bell about 42 minutes away, equities are down by 1% on the S&P 500. The tension between the US and China rebuilds. The Nasdaq is down by 1.3%. You see it reflected in the bond market as well. Yields down across the curve. 10s are down by about a single basis point at the moment. Briefly with a 3 handle earlier on in the session. Now 4.02% on 2s, down about a basis point or two to 348.28. As we count you down to the cash open, your week ahead and the next 24 hours shaping up as follows. At 12 p.m. Eastern Time, Fed Chair Jay Powell speaks at the NABE annual meeting. Also today, the Argentine President Javier Milei visits the White House. Tomorrow, earnings from Bank of America, Morgan Stanley and United Airlines. Thursday, a lot of data, all of that dependent on the government shutdown. On Friday, President Trump meeting with the Ukrainian leader Zelensky in Washington. And you get the feeling, after what's developed in the Middle East over the last week, that's the next big push.
Absolutely. This is what the president's focusing on. He actually talked about it as well yesterday when he was in the Middle East, how that is another foreign policy goal of his. So it's pretty critical that Volodymyr Zelensky will be making this trip to Washington. We haven't seen really enough emphasis on bringing Putin and Zelensky to the table since that Alaska summit, and I think the president's going to focus on that now that Gaza has phase 1 done. They're going to still deal with phase 2.
And that's the latest on the foreign policy front. Let's turn back to the earnings. Earnings season upon us. Options traders preparing for volatility ahead. Henry Schwartz of Cboe Global Markets writing, most of the increase in dispersion have come from the large cap tech names as investors look to earnings to justify the increasingly high valuation for the sector. Henry joins us now for more. Henry, good morning. Good to see you.
Thanks. Happy to be here.
Before we look ahead, can we start with Friday? The amount of volume that you saw go through and how much of that came from zero-to-day expiry?
So, yeah, Friday was the new all-time record for the industry, 110 million contracts. Okay, keep in mind, before COVID, average daily volume was around 19 million contracts. We'd never seen a day over 50 million. And this year, we've had 2 days over 100 million contracts. So, the industry is basically running at about 21% annual growth. It'll be the 6th annual record in a row. Friday was insane. I mean, and in fact, keep in mind, it didn't even start until 11 a.m. It was actually relatively quiet until then. And then, then word of the 100% tariffs hit, and the market fell out of bed. We saw an explosion in volume, which is, and volatility as well. You asked about the zero DTE. That has been kind of the hottest story in the last couple of years. And normally on kind of a high volatility day, the zero DTE crowd actually kind of tails back their activity. But Friday was a little bit interesting, right? Because, this was kind of an unforeseen comment. So the zero DTE volume was kind of already at work. And it was about, in SPX, it was about 61% of the average daily volume, which is a little bit lighter. But, when we see volatility explode and big market moves, you end up basically, that's when the hedgers come in and a lot of positions are adjusted. So that kind of dilutes that zero DTE share.
I think what you identified that was really important about Friday's price action is this wasn't a sign of panic. What you saw in the volumes was actually people start to position for the upside. Were they anticipating what actually happened over the weekend? Ultimately, it materialized anyway.
Yeah, I mean, we've kind of been here before, right? April was a really wild, first half of the month. And I think that is what people were looking for. So, VIX was up about 5 points on Friday, about what you'd expect on a move of, a little bit over 2%. And, we look at kind of exactly what goes into the VIX, right? It's constituted, it's built by a bunch, a strip of SPX 30-day options. So they can all lift or, one side can lift more than others, meaning out of the money puts or out of the money calls. When we see fear and panic, it's the out-of-the-money puts, right? That's what we saw in August of, when the yen carry trade unwound. We saw, a real panic to the downside, although it was very brief. On Friday, we saw everything lift, but we did see that upside call volatility lift a little bit more than the downside. So it basically did look like positioning for exactly what we got yesterday.
How much are these broad market positions versus individual stock positions? How much is this disparate with respect to betting on the Mag 7 versus the entire market as the economy?
So, I mean, basically, on days like Friday, there's kind of a rush into the super liquid, basically SPX, the biggest ETF. So the single stock volume, although it was very, very high, that kind of takes a back seat on the big days. But, as you said before, the chatter has been about, the concentration of the Mag 7 and kind of, is this sustainable? And most of the commentary is like, this isn't the healthiest moment for the market.
Well, how much do you see that reflected in options, the idea that people are looking for downside risk for some of the high flyers versus upside risk, especially after days that are volatile?
Yeah, I mean, we actually don't see a lot of downside hedging in those single names. The single name activity, especially the Mag 7, it really has been kind of a story of using options for kind of the leverage and the convexity you get, generally to the upside, just because that's how the market has behaved. And then in the big indexes like SPX, that's where we basically see some of these big structural hedges. Now, you see those actually rolling out, hopefully next month, depending on the shutdown, Mag 10 index options, which will actually make it much easier if you did want to do a hedge, basically buying puts in the Mag 10 and selling puts in the S&P to kind of, position for, maybe a little bit of a rebalance in the market.
When it comes to the price action on Friday, is it reminiscent for you of what happened during Trump 1, or are things different this time?
Things seem to be different this time. Trump 1 was crazy at the beginning, and then it got really, really quiet, right? 2017 was the lowest realized and implied volatility we'd seen in decades.
Then blew up in early 18.
Yeah, then things, we got Volmageddon, we got some fireworks towards the end. For the people that I talked to, this definitely is kind of a different moment. It's really interesting with the government shutdown. Things were really quiet at the beginning, right? We just kind of rallied, and then we rallied again, and everybody's like, well, hey, nothing's going to happen, and things are just going to be quiet, and the market, this bull market just keeps trudging higher. There does feel like there's been a shift, maybe in some of the geopolitical issues. It was a little bit of, buy the rumor, sell the fact. Now things are kind of unfolding, and, I don't know, people are not quite ahead of it anymore.
Henry, it's good to see you. Thanks for breaking it down. Henry Schwartz there of SIBO Global Markets. The moves on Friday, the story that Henry was talking about, just speaks to the conditioning of investors over the last year to just buy any weakness off the back of this story.
And frankly, that was all the commentary. When are we going to buy this? And on Monday, it was like, yeah, we're going to do it now. And today, we're seeing maybe another round of risk off, but it doesn't feel like a massive sort of cathartic freak out. It just sort of feels like, probably should take some chips off the table.
It'll be interesting to see if these moves stick this morning. Down 1% on the S&P, even with fairly decent bank earnings across the board so far.
Can corporate earnings in the United States overwhelm the ongoing uncertainty of a major blow-up between going forward?
Earnings season begins on Wall Street tomorrow. Bank of America and Morgan Stanley. Before we get to tomorrow, later, Chairman Powell at 12:20 Eastern Time. Look out for that reaction from Marvin Lowe of State Street, Jill Ford of Wells Fargo, Alex Altman of Barclays, Christopher Marinac of Jenny Montgomery Scott from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
All right, if you bought the dip yesterday, today could hurt. 30 minutes until the start of the cash trade. I'm Matt Miller. Danny Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, China raises the stakes in its trade fight with the U.S., this time targeting American shipping. Wall Street absolutely crushes estimates. A resurgence in deal-making, boosting revenue at J.P. Morgan and Goldman Sachs, but that was expected. And a rough ride for General Motors. The automaker takes a $1.6 billion hit after rolling back its EV production plans. Let's take a look at the banks, though, as they are kind of kicking off earnings season today. We did expect, and I don't know how this is possible, we did expect the banks to beat estimates. You'd think analysts would just raise their estimates, right? J.P. Morgan Chase down right now more than 1% in the pre-market, and Goldman Sachs off 2.5%. So even with, knocking the cover off the colloquial ball, the shares are still trading off. Citigroup right now is up. In terms of what we're watching today, Bloomberg Chief Wall Street correspondent Sri Natarajan joins us here at the desk, and he's got the latest on the bank. So Sri, I saw a story this morning on the Bloomberg saying which banks were expected to beat estimates, which to me, that doesn't make any sense. Why don't analysts then raise estimates?
Well, they can only go about how the management is guiding them, and management's always smart to guide them to a place where they are sure when they report the numbers that they can try and beat those estimates. And that's what they've done this quarter. If you look at all the big numbers, especially in capital markets, especially in the investment bank side, when you look at trading and the deal-making side of things, all the banks have done really well. And that was kind of expected.
We knew that.
As the year has progressed, you've seen a big tick up in deal announcements. That is now starting to flow through into fees. There has been heightened trading activities, and along with the financing side of that business in the markets unit for a lot of these banks, that has meant that the numbers have come in pretty good. So the next question is, if that's the case, why is JP Morgan trading down? Why is Goldman Sachs trading down? And the answer to that lies in the fact that when you're up 35% for the year, the market was already expecting you to perform well and even outperform. But in the last few days, especially with all the overnight news out of China, if there is any real risk that this spat grows into something worse than a spat, that could put a chill in markets again. That could make the big corporate clients uncertain again. And that would mean that all these businesses that have been firing on all cylinders for JP Morgan, for Goldman Sachs, for Morgan Stanley, everyone else, that could slow down, and that could bring down their numbers and therefore impact their stock again.
Right, so the big macro news affects them as well, obviously. And, you know, whether or not they beat estimates, that's kind of a numbers game. It's kind of a parlor trick that we play every quarter. It doesn't matter, I guess, to serious investors. But there is the color you get, specifically from Jamie Dimon every quarter that we wait for on the economy and the involvement or the exposure that they have to these big bankruptcies that we've been hearing about. Tricolor, First Brands, what do we know?
So let's hit off with the macro factors first, because when you look at the earnings results and try and read the tea leaves, what is it telling us about the broader consumer economy, about the broader economy in general? Well, to be frank, not a whole lot other than the fact that the US economy is still very resilient. But Dimon, in his prepared remarks, in his statement, was very clear to point out that there are a lot of macroeconomic concerns brewing that could have a big impact on 2026. He's talking about the weakening labor market and his fear that there could be sticky inflation. That's really not good. And then you look at some of these idiosyncratic issues, if you want, with Tricolor, with First Brands, and how it has affected banks. JP Morgan was not exposed to First Brands, but in the case of Tricolor, it had a $170 million charge-off. That's the new news we got from JP Morgan today, that their hit from the Tricolor fiasco was about $170 million. That contributed to a roughly $800 million credit cost. They said there's another one-off situation where they've been impacted a little bit. Again, nothing systemic that we could point to. Dimon did say Tricolor was not our finest moment, and when something like this happens, you can be sure that we are reviewing all our checks and controls, and sometimes you just can't avoid these situations, but we're going to do everything possible to make sure it doesn't happen again.
What do we know about profitability for these banks looking forward? I heard Allison Williams from Bloomberg Intelligence say that, especially for Wells Fargo, you know, they've raised their return on tangible equity target.
Well, Wells Fargo is actually the most interesting news item today, and that's why the stock in the pre-market at least is up more than 3%, because remember, back in June, that punitive action from the Federal Reserve, from their chief regulator that had placed an asset cap on Wells Fargo for so many years, that had been lifted. So that immediately led to questions about what would this mean for Wells Fargo? Can it finally narrow the gap with its bigger rivals like Bank of America and JP Morgan? Back in June, back in July, you didn't get that level of clarity from Wells Fargo, and that's why maybe the stock momentum also peeled off a little bit. But today they said they are lifting their medium-term targets for ROTCE, for their return on tangible common equity, to about 17 to 18%. That means the market can be certain that as their balance sheet grows, they will invest in activities that will surely drive up their profitability. And they're keen on sort of trying to make a play even in the investment bank segment. And you've seen their fees grow there. They're still a minnow compared to the big players, but that means there's room to grow.
All right, very good wrap. It was as good as I expected. You meet estimates. Sri, thank you very much. Sri Natarajan, because I knew it was going to be good from him. Let's turn to the auto story now. General Motors reporting a $1.6 billion charge related to scaling back its EV plans. The company says in a regulatory filing, quote, following recent U.S. government policy changes, including the termination of certain consumer tax incentives for EV purchases and the reduction in the stringency of emissions regulations, we expect the adoption rate of EVs to slow. Joining us with more is Bloomberg Intelligence Global Autos and Industrials Research Analyst Steve Mann. And Steve, this is especially interesting because I thought General Motors had come up with this strategy where it was going to be able to sell a lot of pre-October inventory to its dealers, take that EV credit, and continue to pass it along to customers for the months to come. But I guess it's decided not to try that.
No, they decided not to do that, and that 1.6 billion write-down is huge. I mean, GM was probably the most aggressive, if not global, among the big three, Detroit big three, in moving into EVs. They have a very complete, full EV portfolio that they need to really rethink what they're going to do with it.
So how is GM positioned in EVs now? I know it's a story of slowing growth really for everybody, but they have such a huge product offering, right? Everything from the $28,000 Bolt to the $160,000 Cadillac IQ, and in between. Are they outperforming the rest of the industry?
Certain models they are outperforming, but I really think that they do need to rationalize that portfolio. They'll continue to launch the Bolt. You know, you've seen it in the media. It's priced under $30,000. You know, addresses one of the issues that consumers have with pricing of EVs. But anything in between, right? Like you know, the Blazer, like some of the pickup trucks, you know, those are less popular with consumers. And I wouldn't be surprised, you know, looking at sales in the next couple of quarters, if you know, if those models go away.
All right, interesting stuff, because such a big offering, right? Blazer, Equinox, Sierra, Silverado, Hummer. It's just a huge gamut for EVs from a mainstream, from an incumbent car maker. Steve Mann of Bloomberg Intelligence, really appreciate your time. We want to get to the big China story, though, because that country is hitting back at the U.S. Rising trade tensions are raising them, I should say, between the two countries. China sanctioned American entities of the South Korean shipping giant Hanwha. This coming as President Trump's tariffs on furniture and lumber take effect today. Bloomberg Washington correspondent Tyler Kendall has the latest from outside the White House. So, is it going to be fine?
Well, that's the big question, Matt. Of course, this move when it comes to the sanctions is escalating a long-standing dispute between the U.S. and China when it comes to the maritime sector, really considered to be the latest point of leverage amid these tensions. As you mentioned, China moving to sanction and target 5 U.S. entities of this South Korean shipbuilding giant, as really this White House has looked to shore up ties with allies in Asia to help bolster its own position within the sector. You'll recall even South Korea had committed $150 billion in planned U.S. investment earlier this year when it comes to shipbuilding in order to clinch that trade deal with this White House, because the backdrop here is much like critical minerals. China really does have this grip when it comes to the shipbuilding sector. It accounted for more than a third of the global fleets last year alone. Now, the U.S. itself, worth mentioning, did take its own action this morning, starting to impose fees on Chinese ships that are docked at American ports. That's the big question, though, what you asked, because in the backdrop here, we are just leading up to this potential meeting between President Trump and Chinese President Xi Jinping at the end of the month, as the White House maintains that threat of an additional 100% tariff still remains on the table. We did hear from the Treasury Secretary Scott Bessent in an interview yesterday saying that he expects that meeting to still take place. He called China's new unveiling of its export curbs on critical and rare earth minerals last week to be a miscalculation. In his words, Matt, we might get some developments later this week. It is worth mentioning that China's vice finance minister is here in Washington for meetings, and a person familiar does confirm to us that he's already been in touch with Scott Bessent's team.
Hey, I want to ask about the shutdown. What is it, day 14 right now? Tomorrow, the military apparently is going to get paid, and that could just allow this shutdown to go on even longer, right? Because it doesn't force the Democrats to come to the table.
Right, exactly. So we have seen some of the pressure points been eased, including military is going to get paid. Our understanding is this is going to come from $8 billion in unallocated research funding from the Pentagon. Coast Guard also is going to get paid. That's going to come from diverted funds from the Department of Homeland Security. And then another third pressure point I'll put on your radar that appears to be eased is that the White House confirms it's going to use tariff revenue to fund one of the supplemental nutrition programs for women and children. But all of these things, of course, are facing legal scrutiny, while both sides of the aisle are happy that the administration found solutions. But there are some areas that don't have as easy of solutions, such as small businesses being able to get loans, as well as these disruptions we're seeing across the country in airports. So, Matt, we're going to have to see if this keeps ramping up the pressure.
All right, Tyler, thanks very much. Bloomberg's Washington correspondent Tyler Kendall there at the White House. Some breaking data from the International Monetary Fund, the IMF, warning that the global economy is showing signs of strain from sweeping U.S. tariffs and protectionism. The global economy expected to grow by 3.2% this year, up from 3% predicted in July. So that's a gain. In 2026, growth is seen, though, edging down, still to more than 3 at 3.1%. In terms of futures this morning, we see them down across the board. S&P futures, after we had a gain in the cash trade yesterday of 1.5%, now down 0.9% as the China concern is raised again. Let's get a look at some of the other movers on our radar today. Moody's downgraded its outlook for Stellantis from negative to stable, to negative, I should say, from stable. That's a downgrade. Citing weak operating performance and uncertain profitability, Oracle plans to use 50,000 AMD chips next year for its data center build-outs. That's good news for the chip maker. And Johnson & Johnson raised revenue guidance for the full year after earnings topped estimates. It also plans to separate its orthopedics business from the rest of the company within the next year and a half or 2 years. Next hour, we're going to speak with Johnson & Johnson CFO Joe Wolk right here on Open Interest, so stick with us for that story. And coming up, we're going to get the analyst view of bank earnings with Baird's David George. This is Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs? And you're lowering the cost of meatballs.
I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We actually are running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Let's get now to high interest to look at what's making headlines around the world. In a bid to make the European Union more competitive, the bloc is drafting rules that could require Chinese companies to share technology and build more of their products in Europe in order to gain access to key markets like cars and batteries. That's what the Chinese have always done to their competitors coming in. The plan would also push firms to use EU-made materials, hire local workers, and possibly form joint ventures with European partners. Now, sentiment among small business slipped last month to a 3-month low as owners grew less optimistic about the economy and more uneasy about rising costs. The NFIB's optimism index dropped 2 points to 98.8, with more owners expecting weaker sales. Small business owners are planning price hikes to offset inflation. The group's uncertainty gauge also jumped to the highest since February. And the protein boom is hitting the breakfast aisle. Pop-Tart maker Kellanova is rolling out Pop-Tarts Protein next month. It has the same frosting and sprinkles, but with 10 grams of protein per serving. It's part of a food industry rush to add protein to everything from Doritos to ice cream as shoppers and GLP-1 users chase higher protein diets. Let's get back to bank earnings now. JP Morgan soared past estimates for trading and investment banking fees thanks to a resurgence in deal making that we saw coming from a mile away. The surprise, though, Wells Fargo raised a key profitability metric, its first major growth target upgrade following the removal of regulatory restraints. Joining me now is Baird Senior Research Analyst David George. He has a sell rating on JP Morgan and a neutral on Wells Fargo. And David, I guess, the first question has to be, will you change that rating on WFC? Because it's going to do better, it looks like, than the market had anticipated.
Hey, Matt, good morning. With respect to our ratings, we're always obviously evaluating those, and we'll publish our thoughts sometime later today after the conference call and kind of having the opportunity to analyze the numbers. But as it stands now, we're staying neutral on Wells Fargo and underperform or sell on JP Morgan shares.
All right, so JP Morgan, I mean, everyone's talking about how great it did compared to expectations. How do you look at these banks, David, before they come out? Since we knew deal making was fantastic, we saw IPOs coming back, we heard from Jefferies that trading was going to be good. So how do you get into these, and what's your reaction to the earnings at JP Morgan?
Well, the earnings for both JP Morgan and Wells Fargo, Matt, were both very good, and I would characterize them as excellent, really. I think it's important to note that, particularly for JP Morgan and the other investment banks, this was probably the highest bar that we can think of in many, many years with respect to just the expectations going into these numbers. And it is no secret that deal activity is very high, and there's been a lot of optimism around IPO, secondary activity, as well as M&A. Trading has been very good, but it's really a function, we think, of just very high expectations. And to give you some context, JP Morgan trades at over 3 times tangible book value. That's the highest valuation of its existence. We've covered the stock for 25 years. It's never been more expensive. So I think it's important to differentiate the company, which is outstanding, and the stock, which is not particularly interesting to us here at 3:05 this morning.
What's your take on the consumer here? It looks like the macro picture has also a lot to do with movement in shares today, certainly for JPM and Chase. And I know you cover also other consumer stocks, for example, American Express.
Yeah, so far it continues to show what many call this K-shaped economy, where the high end is doing exceptionally well and the lower end is having some challenges. JP Morgan's credit card delinquencies were actually down quarter over quarter, which was encouraging, and we think that bodes well from the likes of American Express. It kind of remains to be seen on Capital One, which is a stock we like a lot. But consumer today is in relatively good shape. We're obviously keeping an eye on things like retail sales. Unemployment is something, obviously, that's going to get a lot of attention in the months to come as we get this return to office mandate across corporate America, along with the impact of AI. So, but credit quality broadly, other than some of the well-telegraphed corporate one-offs like Tricolor, credit quality looks actually very good. And I think this portends well for what we'll see from the regional banks the balance of this week.
The regional banks, I guess you like those stocks at least a lot better, David. I look down the list at, Huntington Bank shares, M&T, Fifth Third, PNC. You've got outperforms on all of those. Why do you like them better than the big money center banks?
Yeah, I think it's a function, Matt, of just the risk reward of those stocks and expectations around those stocks is materially different than the mega cap stocks. This is really the widest differential that we've seen in the last 25 years between the valuations of mega cap stocks versus mid cap stocks or slightly smaller stocks than the mega caps. And you can buy a stock like PNC, Fifth Third, Huntington, as you said, for 9-10 times earnings, and JP Morgan trades at 10 times pre-provision earnings or 15 times forward earnings. So it is not a reflection of the company. It's just we cover stocks and are trying to help our clients make money, and we think that there's a good opportunity on a relative basis in a lot of these regional bank stocks. And we're starting to see, Matt, an improving yield curve and Loan growth has showed some signs of life as well. So if the Fed is on a cutting campaign, which we think they are, regionals are going to be in a position to be able to make money on both the asset side of the balance sheet as well as the liability side of the balance sheet. And we think that portends well for pre-provision earnings growth at a lot of these regionals over the next several quarters.
David, great to get some time with you. Really appreciate it. Baird, Senior Research Analyst David George. Coming up, we begin the trading day with Joanne Feeney as trade tensions send markets down with earnings season kicking off. This is Bloomberg Open Interest.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Earnings season is here.
Earnings season begins once again.
So much going on.
Bloomberg is first to break the numbers.
From Snowflake, from Pure Storage, from Urban Outfitters, and yeah, from NVIDIA.
Coming up, we'll talk about some of the other earnings that are coming out.
With the smartest insights.
Third quarter numbers are going to be really important. The commentary is going to be important. It's all going to be about margins because margins lead to earnings. And if earnings come down, we have a problem.
You have to come back again soon. This is really excellent.
Continuing coverage on Bloomberg.
Quick look at futures ahead of the opening bell. We're down across the board. We had a good day yesterday after a very bad day on Friday. We were down 182 on Friday, up about 102 yesterday, and now it looks like we're going to lose more ground when the cash trade opens. Look at Walmart pre-market as the company says it's partnering with OpenAI to create shopping experiences on ChatGPT. Users will be able to shop Walmart directly on the app by clicking a buy button later this fall, and as a result, the big box store up 1.7%. We are looking forward to the stock market open. We're going to be joined by Joanne Feeney, and then later in the program, legendary trader Paul Tudor Jones. This is Bloomberg.
take us inside and tell us what you can, without violating confidences, what it's like to be in a board meeting of Berkshire Hathaway. You've got, for a long time, you had Charlie Munger, you have Warren Buffett still there as the chair, and you've got other people now on the board. Do people ever say, Warren, you're wrong on this? Or Charlie, you don't really know what you're talking about? Does that ever happen?
The difference on the inside versus the outside is really very limited. In other words, this is a company that's valued transparency, candor. I mentioned Warren and Charlie, their ability to teach. And so I would say there were no surprises being on the inside versus the outside because of that culture. I would say the one difference of nuance is it's just amazing how much Warren and before Warren and Charlie together think about the durability of the business, how much they think about risk, how much they are determined that they are trying to build something to last, and the sense of responsibility they feel to their shareholders, the people that have their life savings in it. And that was one of the big lessons from Charlie in terms of our business, was to really reinforce this culture of stewardship.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
We are moments away from the start of the cash trade today. This is Bloomberg Open Interest. I'm Matt Miller. Looking at futures, down again. They were up yesterday. They were down Friday. They're gyrating is the word Will Shaker has written in for me. Here, S&P futures down 0.9% after a 1.5% gain yesterday, a 2.7% drop on Friday. NASDAQ doing a little bit better, 1.1%. The small caps even better, 1 1/3. You have the opening bell on the New York Stock Exchange, Etsy ringing the opening bell. They've had a banner year. Year to date, those shares are up 33%. Although, if you're a longer-term investor, they're down about by half over the last 5 years. This company, Collegium, is up by half over the last 5 years, up 50%. They're up 12% year to date. It's a pharmaceutical company, and they seem to be doing something right, or at least we need their product, so we have to pay for it. In terms of stocks to watch, we've got the banks here. Is this pre-market? We should see the live trade. Pre-market, we were down across the board, and the cash trade is going to be likely similar. Even though JP Morgan earnings soared past estimates for trading and investment banking fees driven by market volatility and a pickup in deal making. Goldman Sachs deal values topped $1 trillion in the third quarter, lifting revenue to a record. And Citi beat estimates across all 5 of its major business divisions. Now we're looking at the cash trade here, and there's still red arrows across the board because investors expected this. Market volatility is accelerating as China and the U.S., this is another reason, China and the U.S. up the ante on trade tensions. We've seen sizable moves in major indexes since President Trump on Friday threatened 100% tariffs on Chinese goods. Then on Sunday, he said everything's going to be fine, so investors bought the dip. And now China said, hold on a second, we have to deal with your shipping. So we're down again. The VIX climbing to levels that have not been seen since June, right now at 21 2/3, but nowhere near the 50 handle in April. So we're at least far away from Liberation Day. This sets up traders for a volatile earnings season. Let's bring in Advisors Capital portfolio manager and partner Joanne Feeney. And Joanne, what can we expect? How do you deal, first of all, with this trade tensions piece?
Well, good morning, Matt. It's certainly never a dull moment here. You know, the trade tensions obviously flaring up, and investors really need to try to keep some long-term perspective in this situation. Now, we know that trade barriers of 130% tariffs on Chinese imports would be very problematic, particularly for a lot of small businesses and households, but also for large businesses that derive a lot of their inputs from abroad. So it's a significant threat. It's most likely a negotiating tactic, although China increasing the rhetoric overnight doesn't help things. So a long-term perspective is helpful. Keep in mind that there are lots of different areas of the market in which to invest, some more resilient than others to this kind of a tariff threat.
So which are they? I mean, what do you want? Outside of AI, and we'll put that aside for a moment and talk about it. I promise we'll get to AI, is it a bubble or not? But in terms of safety, in terms of a harbor, where do you go?
Right. So, we have different strategies here. One of the ones I manage is our core balance strategy. And in that strategy, what we like to do is generate a bit of a higher dividend yield than is typical for the S&P 500, about double. We're trying to get about double the yield. And that does create an opportunity for investors to ride out some of the stock price volatility because they're going to be getting those cash dividends, every quarter, every 6 months or so. And you can find companies there that are more stable to these kinds of shocks to the economy, whether it's in consumer staples or in energy, in particular in the pipeline companies, which don't tend to trade closely to the price of oil, for example. You can also find some stability in some REITs and in some of the financial stocks. So looking for higher income is one way to find sort of high quality companies that generate that yield that helps investors ride out these stock price volatilities.
You like Walmart, TJ Maxx, they're in your resilience bucket. What do you think about the announcement? Actually just crossed, so I'm not sure if you even had time to see it, but I do note you have a Bloomberg terminal next to you, so I'm guessing you're caught up. Walmart is going to work with OpenAI to put a buy button on ChatGPT.
Yeah, and that's a great thing for investors to see. More and more applications of AI are appearing, whether it's in consumer retail like this, whether it's in industrial companies helping farmers, whether it's in IT services. So to see this kind of an announcement is, I think, very helpful for folks to recognize that real applications, profitable applications are emerging. I know it's been hard to see much into the future for how valuable AI could become, and we don't know, right, how valuable it will be. But this kind of an example helps investors see that. And obviously Walmart, you're right, is one of those, stable, relatively stable, relatively high yield, resilient companies, along with TJ Maxx and some of the others in the staples group that can help investors ride out this kind of volatility.
Are you worried about an AI bubble? We had a survey that showed more than half of investors think that we're in one right now. That doesn't mean, obviously, the gains can't keep going. That doesn't mean we're about to see it pop, but are we in a bubble?
We don't believe this is a bubble, and here's why. For the comparisons that some folks are making to the dot-com crash, we have a very different set of companies involved that have much stronger balance sheets that are generating significant cash flow. Now, I'm not talking about all of the players, like obviously OpenAI is not one of those, but the Microsofts, Googles, Amazons, and their suppliers like Broadcom, NVIDIA, AMD. These are all companies that are making real profits, and we are, again, starting to see more and more applications. One way I would like folks to start to think about this, the deals that are being made between NVIDIA, OpenAI, AMD, Broadcom, OpenAI, and a bunch of private companies have been referred to as circular deals, and boy, this is a concern. We have sellers of chips providing the money to their customers to buy those chips, and isn't this a terrible thing? Think about it this way. If this is a way for these companies to become vertically integrated in some sense. If we had a single company providing the AI services and building its own capability to do so, including making its own chips, that would be a vertically integrated firm, top to bottom, all providing AI services, and building and investing in that capacity would be a perfectly sensible thing to do, and no investor would bat an eyelash at it, provided the firms had plenty of cash flow to pay for it. So think about it as sort of a different way to get to a vertically integrated firm, but a better way for investors, because investors can then pick where do they want to invest in this AI architecture. Do they want to own the chip companies, the service providers, the network suppliers? Instead of having it all in one firm, like a vertically integrated firm would do, you have separation of firms, which gives investors more control over the risks they want to take. So in some sense, it's a more efficient way to have essentially a vertically integrated firm And again, nobody would be worried about one big company making investments in their future product lines and services like we're seeing in these so-called circular deals.
All right, Joanne, that's a great way. That's a great place to leave it. Very interesting take on it. Advisors Capital Portfolio Manager and Partner Joanne Feeney talking to us about this market, where to find some safe haven and the potential of an AI bubble. She says it's not. Let's get a quick check on what's going on in the stock market right now after a little gyration from Friday down to yesterday up to back down again today. This is the move screen, a great place to get all the information. You have 148 gainers right here with 350 down. So it makes sense that we're off right now 1.3% or 88 points. On the plus side of the ledger, Wells Fargo really is the bank that's come out with the news today as it raises its return on tangible equity estimate for 2026 to 18%, 17 to 18%. That is a positive surprise for investors. And Walmart making a deal with OpenAI doesn't hurt, a gain of 1.5%. On the downside, you've got all of those companies that, you know, it was a Bank America survey, actually. Bank America surveyed global portfolio managers, and 54% said we're in an AI bubble. NVIDIA down 4%. Broadcom down 3.8%. Amazon down 2.7%. Later on in the program, I am going to ask Paul Tudor Jones this very same question. You know, is this a bubble? And if so, how far along are we? He's going to join us at 10 o'clock. Coming up next, banks continue to beat earnings as asset valuations balloon, but traders are not buying. They're getting sold off today. More on that financial outlook next. This is Bloomberg Open Interest.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. And Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Time now for our top calls, some of the analyst action and focus this morning. First up is T-Mobile getting an upgrade to a buy at RBC. The firm expects the telecom operator to see stronger subscriber growth versus its peers. The company reports earnings next Thursday. Warner Music is getting a bullish upgrade from Wells Fargo thanks to a successful turnaround at Atlantic Records. The analyst says the label hit its highest market share in 3 years under its new CEO, and he believes Warner's growth is set to re-accelerate. And finally, Salesforce is getting a downgrade at Northland Securities. The downgrade comes amid a lack of acceleration from the company's AI offering. The downgrade comes ahead of the company's closely watched Dreamforce event that kicks off this week. But let's get back to the bank earnings. JP Morgan soared past estimates for trading and investment banking fees. Wells Fargo raised a key profitability metric, and Citi beat estimates across all 5 of its business divisions. Bloomberg's Catherine Doherty covers the sector for us here at Bloomberg and joins me now. Why do we even bother talking about estimates? Like, honestly, what is the point of talking about these analyst estimates that we know are based on the company sandbagging?
I would not say that is a guarantee every quarter. The companies are obviously trying to outperform and prove to the market that they have more, not just in their performance for the third quarter, but looking ahead. So they don't want to signal that this is the end. I think that you're also hearing some very interesting commentary from the executives this morning. We've kicked off the calls with both the media and with analysts. Today, we had Citigroup's executives talking about the U.S. consumer. They're talking about a tale of two cities. They're saying that at the high end, those with much money in their accounts, they're spending at higher rates than the lower end, so they're calling out that differentiation there. JP Morgan is talking about the various risks or exposures to non-bank financial institutions. They're saying that that exposure is manageable right now. They feel comfortable with it, but Diamond is also saying that this could get worse in a downturn. And he says, quote, "I suspect in a downturn we'll see higher than normal credit losses in certain categories." So it's really not just the results and the various beat or misses in the estimates. It's what is ahead and what the executives are saying as it relates to the economy and the outlook moving forward.
And their exposure to high-profile bankruptcies, First Brands, Tricolor. We learn a little bit more about who has it and who doesn't, right?
That's right. So today, JP Morgan did reference that they have some exposure, very minimal, 170 million, to Tricolor. They said they do not have exposure to First Brands. Citigroup asked the same question. I think this is going to be a trend for all the banks in the next, today and tomorrow. And Citigroup had said that they have no exposure to either company. So I think that this is a good opportunity, if banks haven't come forward yet to talk about their potential exposure, to do so now and to give some clarity to the market.
In terms of Wells Fargo, Allison Williams was on Bloomberg Radio this morning, she of Bloomberg Intelligence, and she said this is really the story of today's earnings because they raised their return on tangible equity target for 2026, and this is a standout where we actually learned something new about the outlook from a bank.
It's a new era for Wells Fargo, specifically because their asset cap has been lifted. So that means that they can basically take more risk than they had been previously. They were constrained. So investment banking was actually a standout for them, even though they are quite small compared to the likes of JP Morgan and Goldman Sachs. If you think about the future for Wells Fargo, that is what Allison is referring to in terms of the metrics to keep looking for. We haven't had a lot of quarters yet where we've seen the bank be able to perform without this asset cap. So now we're getting a little flavor of what's ahead, and that could be a big upside for them. That's expected, given that they did have those constraints that they were operating under previously.
We've seen some incredible gains. I mean, not just for Wells Fargo, right? If you look at JP Morgan and Goldman Sachs and Morgan Stanley. One of the things David George from Baird told us earlier was, you know, for example, a drop of 3.5% at JP Morgan today. That's not because it's a bad company. That's because the stock has done so well. You see here it's tripled over in the last 5 years. So these stocks have really outperformed.
The financial sector has done quite well. That is not across the board. Some laggards are not. There's been gains, but it's really then the question of who is gaining faster or more than their peers. And you've seen some fall-offs just in recent days. Friday was a really bad day across the board. It wasn't just due to financials or within that financial sector. Today, I think that because a lot of the estimates were baked in and there was an expectation that deal making was going to be coming back and that trading was also going to be quite strong, I think that's the reason you're not seeing the shares react in such a positive way, because these are good results overall.
They're not immune to the macro issues. Jamie Dimon saying, this is a quote, "There continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation."
That's right. Yep. And we're going to look out for more commentary. Citi's going to have its call a little later at 11 o'clock. And every time these executives are able to give their sense, especially because we've had a delay in job reports and some of the other consumer data points that economists and the rest of Wall Street really look to in order to gauge where we're going in the future. So now it's up to the banks to give what they see just based on their own performance and their own data and spending.
All right, Cato, great wrap up. Thanks so much for joining us. Catherine Doherty there covers banks for us on the other side of the building. You can follow our coverage of bank earnings from Catherine and her colleagues on the T-Live blog. If you have a Bloomberg terminal sitting in front of you, type TLIV GO for that. Check on what's going on with stocks right now. We're down 1.25% on the S&P, a loss of 83 points. So we're still far below where we opened on Friday morning. The NASDAQ down 1 2/3% right now, 24,340. Coming up, Johnson & Johnson raises its full-year forecast while announcing it will separate a unit of its business, the orthopedics unit, I believe. We'll bring you the details with the CFO. He joins us on Bloomberg Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up to the minute news news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what stocks are doing right now. About 20 minutes into the session, S&P 500 down 1.33% after gains yesterday and a big drop on Friday. We continue to gyrate on trade tensions. NASDAQ down more, getting closer to 2%. That drop, and the small caps holding at a 1% loss. Take a look at what's going on with NVIDIA right now, down 4.1%, and that is a huge weight on any index on which is listed, definitely on the S&P and the NASDAQ. Intel down 6.5%. Tesla off 3.6%. There was a Bank of America survey out in which 54% of the respondents said we are in an AI bubble. GM right now, what is going on? General Motors is up 0.1%, even after saying a reorg of its EV business is going to cost $1.6 billion, which is a lot of money. Eli Lilly and Johnson & Johnson are both down right now, and we're going to talk a little bit about pharma because Johnson & Johnson is boosting its sales forecast for the full year. It also is announcing that it will split off the company's orthopedics unit. Cynthia Coons, who leads our healthcare team, joins us now with the latest. So a couple of different big pieces of news for J&J. Cynthia, where do you want to start? What do you think is more important to the investor?
I think the orthopedics split is a pretty big move for a company that there have been a lot of questions about whether or not or why they're keeping the medical device business along with pharmaceuticals. So taking out this piece of it sort of answers maybe some of the questions of what they strategically see fitting with their company, but also just sort of, I think, continues to raise questions about devices sitting alongside pharmaceuticals in a big company like J&J.
And they continue to, divide off, as a lot of companies, conglomerates have been doing recently. We're in a cycle where they're spinning off the units. I've been through cycles where they build them up as well. What do you think Joe Wolk is going to say about this? We're going to talk to the CFO in the next hour. Is this part of his strategy to really get laser focused on, one business?
Well, I think they want to continue to tell the story about the medical devices belonging with pharmaceuticals, but specifically they want to look at medical devices from a big innovation point of view. And so the story I think they want to tell at this point is that they can use a medical device business to innovate in surgery, or they've been trying to work out drug device combos and things that are just on the more cutting edge side of orthopedics than, say, continuing to make hips and knees and things that maybe don't see the bigger step change in innovation. So I think that's the story they're telling. It's to improve margins, basically. They're trying to get rid of the lower margin part of the overall med tech business. But interestingly, in all of this thinking, they've decided to still keep med tech with pharma. So they'll continue to have to sell that story to investors.
I hope they make an elbow. I need an elbow. You can get a good knee, you can get a good hip. Yeah. Elbows are still a problem. Let's talk about the drug prices because we've seen deals from Pfizer and AstraZeneca with the Trump administration on pricing. What are we going to hear from J&J on that front?
So they've said the dialogue is constructive. We're not sure exactly where they're at in this conversation, but from what we've seen so far and the sort of pattern that appears to be emerging is that the companies are forging deals with Trump that play into both bringing more manufacturing back to the U.S., which J&J has already announced plans to do, but also with regards to launching drug prices, lower drug prices, or launching them at the same prices as some overseas markets. So it'll be interesting to see what J&J puts on the table with Trump. We'll know that, I guess, when their announcement comes out, but I'd be surprised if they don't have an announcement soon because it is kind of the season for making these kinds of deals to avoid these tariffs.
Yeah, absolutely. Cynthia, great to get your coverage. Thanks so much for joining us here on the desk. Cynthia Coons runs our healthcare coverage for Bloomberg News. We're going to have more on Johnson & Johnson's earnings with the company's CFO. I may have mentioned he's going to join us at 10:30. Joe Wolk in the next hour. Also, coming up in the next hour, Paul Tudor Jones joins me on the set to talk about concerns that we're in an AI bubble as well as the debasement trade. This is Bloomberg Open Interest.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. Scarlett Fu, Paul Sweeney live here with you in the Bloomberg Intelligence program. In just a moment, Scarlett, we're going to be hearing from Paul Tudor Jones, Tudor Investment Corporation co-chairman, chief investment officer. He's speaking with Bloomberg's Matt Miller. So we're going to bring it to you in just moments.
And it feels like we're at this junction in the markets where things are now changing. Buy the dip no longer works automatically the way it did maybe a few weeks ago. The big banks reported decent earnings, and you're not seeing them celebrated maybe the way they would have a couple of weeks ago.
Yep. So what we're seeing here is red on the screen here, driven primarily by some trade talk with China. So we'll stay on top of that story as well as the earnings throughout the morning. But right now, let's go to Paul Tudor Jones from Tudor Investment Corporation with Bloomberg's Matt Miller.
We welcome our TV and radio audiences for a conversation with one of the most respected traders on Wall Street. Paul Tudor Jones is known for his foresight. He shot to fame after anticipating the Black Monday crash in 1987. He then went on to make a series of successful global macro trades, like shorting tech stocks ahead of the dot-com bubble, but also big in philanthropy. He founded the Robin Hood Foundation, a charitable organization committed to fighting poverty in New York City. Every year, the foundation enlists the boldest names in finance in a stock-picking contest known as Pick a Ticker. And Paul Tudor Jones, I'm happy to say, joins us now here at the desk. Paul, thanks so much for your time. I want to first ask you about Robin Hood before we get to the markets, because I know you have a big conference with JP Morgan tomorrow, right?
We do. We have a conference tomorrow. There's still a few tickets that are available. We have some great speakers. I'll be interviewing Dario Amodei, who's the CEO of Anthropic. So actually, he's the person that should be answering your AI questions, not me. I can't wait. There's so many I want to ask him on AI. We've also got Ken Griffin and Jamie Dimon. It's going to be a fantastic and a very informative and educational day.
Will all of those guys participate in Pick a Ticker? Because this is a contest you do with Bloomberg, right?
Right. So Pick a Ticker is you pick one long, one short, It's a 6-month contest. Think of fantasy football meets the markets, because this year we're going to allow you to change your picks, I think 2 or 3 times during the 6-month process. So you put in $10,000. It's going to go to charity. 75% is going to go to Robinhood to help the least among us in New York City, which sadly has twice the national poverty rate. And I think we've all got a vested interest in making sure New York not just survives but thrives, because obviously Wall Street, which is the reason for so much financial wealth that all your viewers have, is something that we need to be able to, in New York City, have a thriving city, because the most important city in this country has got to always succeed.
Yeah, I mean, you have raised, I think, $3 billion over the time since you founded Robinhood for fighting poverty in New York. I want to ask about Wall Street, and specifically about this equity market. I do watch our competition, and I saw your interview with Andrew last week. You said this is like October of 1999. But after that, as you pointed out, the stock market doubled. We had a drop in October, like an 11% intraday drop, but then the stock market doubled to March of 2000. Are we still in line for a doubling of this market?
Well, it's so funny, because you'd mentioned that 54% of fund managers think that we're in an AI bubble. If it's a bubble, it's a small one. If you just think about, and again, how do you actually define bubbles? If you think about the bubbles of the past 3 or 4 decades, the Nikkei in '89, NASDAQ in '99, biotech 2000, just after 2011, 12, China 2007, all those were 400 to 600% gains. The NASDAQ's up 200% off the bottom. So I don't know whether we're going to blow off like we did in 1999. Is it possible? Are all the ingredients in place? I think clearly they are. For me, the one thing that you can never, ever forget is that a year from today, assuming that the president gets his wishes, that the Fed funds rate's going to probably be in the 2.5%. I think they would like to see it at 2.25%. So I think 2.5%, 2.75%. Obviously, whoever the new Fed chair is going to have to be able to intellectually move that board, a majority of the board. He's probably, whoever the new Fed chair, let's say they've got 6 solid votes, so he'll have to find 1 more. And I don't think it'll be that hard to do. But if you're going to have 2.5% overnight rates, or 2.75%, that's a really compelling story for higher equity prices.
Well, not just that. I mean, you've got Neil Kasar on our opinion team yesterday laid out the argument that this is not the same as 1999 because these companies are so profitable, right? 95% of the S&P 500 is expected to post earnings growth next year, and the average earnings growth is 16%. It's obviously a lot more for the Mag 7 or the Great 8. Plus, you don't have the same kind of leverage that you had back then. You have less than 100% debt to equity, and in 1999, it was more than double that.
Right. Well, the only thing I'd say is I don't think you've got the leverage necessarily in the corporate balance sheets yet. You clearly have leverage within the equity ecosystem, and by that I mean you just had a proliferation and explosion in derivative products. I want to say that levered ETFs are up 250% since the 2022 bottom. And I want to say that there's 400 or 500 with another couple of hundred in the pipeline. So you're clearly creating derivative leverage, whether it's in the options market. We see single stock options. We just see options activity exploding. Everywhere you look, there's greater leverage, again, in the equity infrastructure for what has become really trader nation. We have the highest percentage equity holdings by individuals in history. We have, again, more levered activity. You don't see it in margin debt because margin debt is actually an old anachronistic tool. You see it more so in the options markets. You see it more so in the levered ETFs. So it's somewhere down the road, a little similar I don't think we're there yet, but somewhere down the road, there's going to be some real issues with that.
Nonetheless, you're long now, right? I mean, at least last time we spoke to you in June, you said your portfolio would be long stocks. You said you'd be long gold. You said you'd be long Bitcoin. And those have been great picks. Check out this chart, right? Gold alone is a 22% gain, but all of them are well above zero. Do you hold on to that portfolio?
So I would take them one by one. I think for stocks, the critical time is going to be the last week here in October, and when we see the big tech earnings, as well as by that point in time we'll have greater clarity on the resolution of the U.S.-China conflict. I would think that if the NASDAQ is higher going into early November, then you've got a chance for a real ramp in the last 2 months. What happens between now and then, I kind of think the market's going to be on the defensive until we get to, that's going to be a intersection of just so many really, really important data points. So that's going to be a critical time. They also have a Fed meeting that week. So I would think, my prior is that it will resolve to the upside. We'll focus on where Fed funds will be. The market will look ahead 6 to 9 months and focus on that. Bitcoin and gold are interesting. They're interesting as a pair in the sense that if I just look at since Liberation Day, you've had about $40 billion of inflows into a combination of Bitcoin and Ethereum ETFs, and you've had a like amount of inflows into the combination of gold and silver. But if you think about it, the vol-adjusted $40 billion that goes into Bitcoin, because it's had, say, 5, 6 times the vol of gold, was really a much, much bigger bet on crypto than it was on precious metals. And yet, gold has outperformed Bitcoin since that period in time. So clearly, retail has made a mistake in terms of trying to figure out which of the two debasement trades were going to outperform. And I have to admit, until a couple of weeks ago, I thought Bitcoin digital gold was going to outperform, again, the historic stores of value. I think they're both probably still good, but my guess is, again, we're here in the fourth quarter, momentum into the end of the year, that of those two, it appears that gold and silver are going to outperform crypto. You know, I'm always going to be a trend trader. I'm always going to follow the momentum, and I'm not going to be so prideful that I'm going to try to outguess what the market's telling me.
But you do think that we continue to see inflation? Because I've been talking to Neil Dutta from Renaissance Macro. He's pushing back on this. He says inflation hawks need to seek help. But his main point, I think, is that housing, the shelter component is going to come down. He said in a note last week, housing prices are likely declining. The fact that home buyer demand has declined even as rates have dropped suggests that a deflationary psychology has infected the housing market. You buy that?
I think I'm probably looking past current conditions, and I'm just thinking about the future. And we're in a fiscally constrained time. So why is it that the president is hell-bent on finding a Fed chair that's going to have easy money? Because the only way that we can reduce our debt to GDP, that you could even begin to deal with a 6% budget deficit, is to have the lowest funds rate you can possibly have to lower your interest costs, to stimulate growth, et cetera. The only way to reduce debt to GDP is to have, obviously, nominal growth exceed your interest rate. So in a situation like that, particularly given where we are in this economic cycle, where we are now, it's just hard not to see, and I think this is what the market's looking ahead to see, inflation not be rekindled and start up again, 6, 12, and in a more serious fashion, 18 months hence. You can kind of see it now. Again, think of this. We have $370 trillion worth of global financial assets. 370 trillion. So when you come to a market like gold, which is 12 trillion, silver, which is, oh my Lord, a fraction of that, Bitcoin, crypto, which is say 2 to 3 trillion. It doesn't take very much. Then you start thinking about the copper markets and some of the other rare earth minerals, and you think about just individual commodities. Good gosh, the ability to elevate those prices because we have so much, again, money and financial assets. It just takes a small tweak to really begin to create a rise in the price level. And I think we'll see that, assuming that we have a new Fed chair who's going to take the funds rate down to 2.5%. And I think the White House is thinking they'd like to see the funds rate at 2.25 to 2.5.
Will we see a significant drop in the dollar from that? Because we had seen, right, in the first half, the biggest drop for the dollar since 1973. That's the year I was born, so a long time ago. But
you're a baby.
But we have, thank you. But we have recently seen the dollar recovering, showing a little bit of strength here as people look for, I think, safe haven in that.
Well, look, you've got an FX, you've got a fiat money debasement going on pretty much virtually around the world, right? The bond vigilantes, though, are being held in check by, again, central banks and populism that are pushing central bankers to run hot. So the currency debasement trade has really turned into a gold trade and a crypto trade, right? Bond vigilantes have been shunted to the back, told, or been put in abeyance, and instead it's manifesting itself in gold and crypto. That's really what's going on. So again, look at the new Prime Minister of Japan. She's already advocating for the BOJ to go slow on normalizing rates. You can't make it up. They've got negative 1.5%, and it's almost like they just want to deny that they have an inflation problem. But so that's what we're seeing. And again, at some point in time, we're going to have some precipitous moments in sovereign debt markets. I don't know whether it's Japanese bond market, the U.S. bond market, but we're going to have some precipitous times. And if you just think about, we're not even close to that yet. We're not even close to that trust moment we had 3 years ago where the currency was under attack, the stock market, the bond market was under attack. Just imagine if and when we get to that day, which I think with 6% budget deficits in the U.S., that day will come. Just imagine what gold and crypto, for that matter, the dollar, imagine what they're all doing. We're in good times now, right?
Even with the shutdown.
Yeah, even with the shutdown, we're in good times now.
I wonder what you think about you mentioned rare earths, and even we can't inflate our way out of that problem, right? J.D. Vance said, we have the cards, but it seems to me China has us between a rock and a hard place. Meredith Whitney put out a note on Sunday, and she says, you know, don't bother being distracted by 100% additional tariffs that President Trump was talking about, because aside from the massive dependence on the U.S. industrial complex for these rare earth minerals and magnets, the U.S. military is 100% dependent on them and is nearly depleted of its reserves. Yeah. What can we do about that?
Yeah, I'm sorry, I don't have a good answer for that one. I wish I did. I really, I don't envy Trump and his cabinet trying to figure out what's going to happen here in 2 weeks. I really don't.
I just think of the strategy that it looks like the White House is following, right? They take a stake in MP Materials. They take a stake in Lithium Americas. They're trying to ramp up mining so they can produce these things. And at the same time, they're taking stakes in private companies. How do you feel about that as a long-term free market capitalist, the U.S. government getting in and picking winners and losers?
I'm not in favor of that. And again, the reason why is it's the same reason My concerns are I see concentration risk everywhere I look. When now we have individual investors with the highest equity allocation they've ever had in the history of the United States, really 4 times that of the rest of the developed world. So I get nervous about that concentration. I get nervous about the fact that we have 35% of the S&Ps now concentrated in 7 stocks. I get nervous about the fact that this administration, even if all those decisions were smart and correct, again, if you just think about the #1 rule of portfolio portfolio management is you want diversification. That's why our founding fathers created us as a democracy, not a monarchy, because you want that contestation of ideas. So I'm nervous when I see concentration virtually in anything. Again, whether it's in the stock market, whether it's the composition of the stock market, who owns the stock market, or the decision-making that's getting made in Washington. It makes me nervous because I don't think in the long run, right? Even if all the decisions that President Trump making are great, is that going to embolden the next president, who may not make as good of decisions, to do the same thing? So I'll look at that, and again, it raises caution flags for me.
But you're still long stocks right now? You're still long the NASDAQ?
I wouldn't say I'm long at this second. I'm clearly, again, I think there's such a confluence of possibly negative, possibly positive events. I think I want to kind of wait and see where we are in a week or two time. But my belief is that we'll be substantially higher by the end of the year.
All right, so just to end on where we started with the pick a ticker contest for Robinhood, I asked you last time, and I'll ask you again. For players at home, what tips would you give us? What would you put?
I'll probably, I think it's going to begin November 1. I'm sure I'll probably be long. The NASDAQ will be my long. Remember, you see, it's really interesting because the last 12 months of a bull market, typically you double the annual gains up until that point in time. But that's to the end of the bull market. So we've got this situation confronting us where the best part of the market's possibly straight ahead, but it's also the most dangerous because it could be the top. So I would probably be long the NASDAQ, would be my long, and I've got to think about what my short would be. It could be, it might be the bond market again, though that'll be a bit boring.
That wouldn't be boring. I'll take it.
Okay.
Paul, thanks so much for joining us. Really appreciate your time. Paul Tudor Jones, co-chairman, chief investment officer, of course, of Tudor Investment Corporation and the founder of Robinhood.
All right, our very own Matt Miller speaking with Paul Tudor Jones, Investment Corporation, co-chairman, chief investment officer, Paul Tudor Jones. So a wide-ranging interview. So good to hear from Mr. Jones about what he sees in this market.
He sees concentration risk everywhere he looks, and the late stages of a bull market is when you make the most money, and we certainly have seen a straight line up for equities.
Yep, absolutely. We're just starting the 4th year of this bull market, and it's risen 80% during that time. So just extraordinary. All right, let's get a reset of the market here. We got a little bit of a sell-off. We'll go to John Tucker, any Bloomberg Business Flash.
Yeah, but it's pairing some of the earlier losses at this point. This Bloomberg Business Flash, Paul and Scarlett, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. The trade tensions bubbling to the surface again, so that to some degree is overshadowing the earnings that we got. J.P. Morgan Chase soaring past estimates for trading and investment banking fees. Goldman posting record third-quarter revenue. Citigroup beating Wall Street revenue estimates. This across all 5 of its major business lines. And then you have some of the individual movers today. AMD, Advanced Micro Devices, up just shy of 1% right now. They say Oracle is going to deploy a large batch of its forthcoming MI450 chips next year. Love the MI450s. Keith Lerner at Truist Advisory Services, meantime, sees volatility ahead for investors.
as I look at the overall market, you're just seeing some minor cracks. So I just think this month is going to be a bit more turbulence. We still think we're in a bull market that deserves the benefit of the doubt. But, I think this turbulence is likely to continue through this month.
And the S&P 500, 43 points lower. That's down about 0.7%, 6610 on the index. The Dow down 221 points. And the NASDAQ 100 right now down 262 points. That's the leader in terms of declines, down 1%. And attention, Walmart shoppers, you can now use ChatGPT to browse and buy stuff through their catalog. The current Walmart
On the website?
Yeah, the current Walmart or Sam's Club accounts get automatically linked to ChatGPT, so no longer just for writing your term papers, kids.
Lisa Mateo says she uses it. I mean, I walk into a store with my little scribbled note saying I got to buy some bananas.
I guess it's kind of obvious, but I don't even think shopping was a use case for artificial intelligence.
Writing term papers, on the other hand, John Tucker.
Exactly.
My days of writing term papers are.
Give me 300 words on George Washington crossing the Delaware.
Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. John Tucker was just reporting on this. Oracle will deploy a large batch of AMD's forthcoming MI450 chips next year. It's kind of like our AI story of the day. It seems like every day we've got one of these stories of these tech companies doing business with one another, maybe even involving some investments in each other. Anurag Rana, it's his job to keep it all straight here. He's a technology analyst at Bloomberg Intelligence. Anurag, if you're Oracle, if you're AMD, is this just business as usual? Why, or is this something new and unusual?
The slight unusual part is that the AMD chip seems to be doing at parity at what NVIDIA chips are for this particular case. Now, I do not know what kind of workloads Oracle will put on it, so you really can't do an apples-to-apples comparison. But the story at this point is Oracle has a massive backlog of orders, and it needs to invest money to get them converted into revenue. They need to open more data centers or rent out more data centers. They need to buy more chips, buy more hardware, and combine all that together. And eventually, then they're going to get paid for all that stuff. So they're going anywhere they can find chips right now. And, it seems that AMD is their next stop.
So there are a couple of threads to pull on there. It feels like AMD is increasingly the #1 alternative to NVIDIA's chips. We can talk about that in a little bit. But what struck me is that there's no dollar amount disclosed in this deal or partnership or promise. The previous deal that AMD struck with OpenAI just said tens of billions of dollars in new revenue. Why are firms keeping it so vague?
Well, because they do not know at how many chips they would need, at what point, at what capacity. This is it's not, it's more so signaling that we are not just truly dependent on NVIDIA. We have other options as well. It helps them with navigating in terms of pricing from NVIDIA also. We know NVIDIA chips are getting expensive over the last few years. So there could be one reason. The other thing we don't know is what kind of workloads there are, because we know for the absolute best of the best, you have to use NVIDIA chips. That's what we know as of today. Whether all of that changes in 12 to 18 months, we don't know. But there are other workloads that may not require that amount of, firepower or horsepower, you could say. For that, you may use, AMD chips or something even more inferior.
And even yet another announcement in your space today, Anurag, Salesforce, a company you've been talking to us about for many, many years. Salesforce and OpenAI today announced an expanded strategic partnership. What's going on there?
Yeah, so for me, this is actually a far bigger news and has more ramifications in the long run. If you see what's been happening in the software landscape over the past 2 years, the threat is that OpenAI will come and it'll take away, basically the businesses of all the application software vendors, whether that's Adobe, Workday, Salesforce, HubSpot, you name it. Because OpenAI has shown capabilities that their model can help out in functions such as finance, human resources, sales automations, etc. This integration between the world's biggest CRM software vendor, which is Salesforce, and OpenAI shows that both of them will be working together, and it'll be easier for enterprises to go inside OpenAI ChatGPT, ask for what they want. That gets connected to the data that resides in Salesforce, makes it very easy for the enterprise customers to do their work as well, rather than just going into, Salesforce. So I think this is a bigger news in the long run, but, we are all talking about Oracle as well.
Yeah, OpenAI announces a new deal with someone every day, Paul. This is kind of what you're getting back to. And this really, both of these announcements are the latest in this string of big tech building more computing infrastructure and meeting this demand, this insatiable demand. I've really lost track of the permutations. Anurag, what worries you about these back and forth announcements and partnerships and, the billions of dollars that may or may not change hands? Do we think that these are just announcements that may not come to fruition if circumstances change, for instance, in the next 6 months?
See, from a Salesforce point of view, and which is what I was, you would say most of us are worried about, of the legacy software names, it's a good thing because OpenAI is a new channel of communication with, the rest of the world. If you can integrate your product with them, it kind of saves you from getting disrupted. The question is, at the long run, and then we'll find out what happens is, will OpenAI have that much level of funding to keep up with all the promises that they have? They have given very high revenue estimates for the next few years, but at the same time, the rest of the bigger, tech vendors are not, just sleeping at that point, I would say. We'll find out whether OpenAI will be able to gain market share from the likes of, Microsoft, Apple, Google, and Meta or Amazon, or this is going to be just an expansion of the overall market.
All right, Anurag, thanks so much. As always, appreciate getting the benefit of your wisdom. Anurag Rana, technology analyst for Bloomberg Intelligence. He is stationed in that well-known technology hub of Chicago, Illinois. Let's get back to these markets here. We're definitely off the lows that John Tucker was recently reporting here, but we'll see how the bounce goes, if at all. Lorraine Gilbert, she is the CEO of WealthWise Financial, joining us from Dallas, Texas via that Zoom thing. Lorraine, we're just kicking off earnings here today with the big banks here. What are you looking for from corporate America this earnings season?
Yeah, well, it's good to hear already that the big banks are showing profitability, especially in M&A, which was lackluster before, and now we're seeing a resurgence there. That's positive. And what we look at in the financial sector is just the overall economic overview on how B2B is going and even B2C is going. And so, we'll be looking for that. I don't expect any big surprises during earnings season. I think we're going to continue to see year-over-year growth like we're expecting, 7 to 8%. So I think all is well as far as earnings season is concerned. When it comes to the markets, what you were just mentioning, seeing a little bit of a dip, I think that it's October. And every October, we expect some volatility. And in a sense, looking at China, this is, in a sense, a repeat of 2018. Trade tensions, more volatility. We've been telling our clients to expect volatility in this last quarter. But at the end of the day, we still end up in the markets by year end, is what I would say.
So I want to get your thoughts on the debasement trade, that idea that people want to de-risk their portfolios, get away from the U.S. dollar. Silver hit a record $53.55 in London trading today. It's since come back down a bit. Gold continues to power higher, $41.50 an ounce right now. How much credence do you give this idea that investors are actively moving away from the U.S. dollar and dollar-denominated assets when equities continue to hold their own?
Yeah. So I think there's a fear trade that is going on. And when we see fear, we see a run up in gold and other precious metals. So I think that's what we're seeing, a lot of fear around the globe. And frankly, China purchasing gold, which then causes this ongoing frenzy. Gold goes up and more people want to buy it. And so that's what we're seeing there. I think when it comes to getting away from the dollar, I think that the dollar is still the reserve currency. And so you still have the dollar and our own treasuries being a safe haven. So, and I think we've seen that most recently with some dollar strengthening. So I wouldn't put too much credence into that. The U.S. is still that safe haven.
Lorraine, what are we doing in the bond market here? Again, the 10-year Treasury sitting right around 4%. That seems like, I don't know, a decent living for most honest folk. Or do we take maybe some credit risk outside of that?
Yeah, I think if we see that 4% break, then we're going to be taking on more credit risk. We've seen some expansion on spreads, and so we would like to see some more of that and then go in with more credit risk. We've been playing it on the more high quality side, and we've had duration a little bit beyond the benchmark, and we've been sitting on some pretty nice yields with that. So I think that we will take on credit risk if we continue to see that those Treasury numbers go below 4%.
Laureen, is there anything that you're worried about that keeps you up at night? A lot of people talk about the credit blowups in First Brands and Tricolor, and there's a lot of talk that those are idiosyncratic. It's a one-off. There might have been fraud at those companies. But Jamie Dimon, the CEO of JP Morgan Chase, did say when you see one cockroach, there are probably more, indicating that maybe there's something to it.
Yeah, well, what we have here in the United States, at least with our big banks, is a lot of strength. So I'm not concerned about our financial institutions per se. And I think that, yes, there have been problems in other areas. Of course, we saw the problems with fixed income and going out too long, et cetera, before. But all in all, I think that our financial institutions are strong. I think what keeps me up at night when you say that question, what I'm concerned about is that overextension, a potential AI bubble, and how do we play that? Well, we feel like AI is still going to be a catalyst for growth over the next decade, and a lot of investment there, and talking about all the different opportunities that we see in AI, and yet we can get beyond our skis there as well. Yep. And so I think it's just a matter of taking some gains where we feel like we've seen some enormous gains, and then redeploying those assets.
Laureen, thanks so much for joining us. Appreciate your time. Laureen Gilbert, she's the CEO of WealthWise Financial, joining us from Dallas, Texas via that Zoom thing. The sell-off, we're still right on the screen, but we are off the bottoms. The S&P's down 37 points. That's a 0.5%. The NASDAQ's down 228 points. That's 1% here. The VIX, 21.1. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg newsroom with this Bloomberg Business Flash. The trade tensions leading to the risk-off mood today, although the major averages have paired some of the earlier losses. 291 stocks are higher, 211 lower right now in the S&P 500. You have information technology. That's actually the worst performing industry group, and that's home to the most active stock, which would be NVIDIA, down 3.4%. Now, after the bank earnings, Wells Fargo among the most active, up 4.7%. Bank of America up 1.4%. Citigroup up 1%. And then you have JP Morgan Chase actually down right now. JPM 1.7%, and overshadowing the earnings comments from the CEO Jamie Dimon of deterioration possibly in credit quality. While stocks are selling off today, Lisa Shallett at Morgan Stanley worried about asset price inflation.
Yes, we haven't seen inflation in the real economy, but perhaps we're really starting to see inflation in financial assets. Just too much liquidity from everywhere around the world, sloshing around, looking for places to go.
And right now, the S&P 500, 30 points lower. That's down just about 0.5%, 66.23 on the index. The Dow down 72. The NASDAQ 100, 195 points lower. A record number of money managers say AI stocks are in a bubble following the huge rally this year. According to a survey from Bank of America, 54% believe tech stocks too expensive. Oh, yeah, did you see this one? The protein craze. Coming for sugar-frosted Pop-Tarts.
That makes sense.
Kellanova is going to offer a version of Pop-Tarts with higher protein content starting early November. Pepsi also plans a higher protein version of Doritos. And I know when I think of protein, I think of Doritos and Pop-Tarts. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. What's your favorite Pop-Tart?
Cookies and cream, but I haven't eaten it in a long time.
Sure
That got
you
me
have.
through pizza and Pop-Tarts, got me through business school. Totally.
That explains so much, doesn't it?
If you're a student now, we just, put some protein powder on those Pop-Tarts for you,
I guess,
right?
maybe. I guess. That's how I rolled back in the day.
That's it for me. Back to you, Scarlett and Paul.
All right, John Tucker is going to go put some protein powder on his goldfish right now. In the meantime, let's take a look at these bank results, because 4 of the biggest banks reported results today, and the stars were expected to be JP Morgan and Goldman Sachs. And indeed they were, if you look at the numbers that they posted. But if you look at the share prices, not so great. We're seeing declines, modest declines for Goldman Sachs and JP Morgan. Citi and Wells Fargo, by the way, are moving higher in trading. Let's bring in Allison Williams. She is our senior analyst at Bloomberg Intelligence, covering global banks and asset managers, to recap the U.S. bank earnings. Is this a case of expectations were pretty high for a beat and raise quarter? The banks delivered exactly what was expected, if not more, and it's kind of like ho-hum.
I think that's exactly right, especially for JP Morgan. They did give the disclosure on the tricolor charge off, which again is something they probably wouldn't even do, except that there's so much focus on it. They made comments about where their stock price was trading, and they don't like necessarily buying back at these levels, which obviously signals that it's elevated. But again, they do that all the time. So I think it is just a case of it was a really solid quarter. I mean, the trading was exceptional, but people had very strong expectations. On Goldman Sachs, there were maybe a couple of things. So the equities trading
that missed
did miss. Again, they're number one, a good result, but still, I think you would expect them to do better. It's always tough to say that they missed expectations, because these are hard to estimate, but the growth was not, when you look at the growth there, you look at the surprise versus JP Morgan, there might have been a little disappointment that they didn't blow it out a little bit more. All the other lines were great. I mean, the M&A, super strong. They're the leader there. That's good. I think the one thing on Goldman that it has, I think, investors a little bit percolating is this announcement of Goldman 3.0. So they
say more about that.
So they announced this. They said that they announced this morning to their employees something called Goldman 3.0. It's going to be focused on AI and improving efficiency. And so I think it's a little bit of a question mark, because normally when companies announce these plans, first of all, that it's generally from a position of weakness, and when they announce it, they give you all kinds of targets, what's the cost, what's the goals. They're not giving any of those numbers. They said we're going to talk about this more in January, so I think there'll be a lot of questions from now until then. Before that, you do wonder, so is there an upfront cost involved? Is there an issue we don't know about? Personally, I just think that their return targets were very high. We've had an amazing environment, and still you would expect them to be beating their targets, like JP Morgan is exceeding their target and when times are good. And so I think, to me, for a while I've been saying I would expect them to reassess their target. Morgan Stanley, I would expect them to reassess their return targets, just given where we are in the environment. What can we expect over the cycle?
How about loan growth? So when the bankers at Citi or Wells sit down with their corporate customers, is there demand for loan growth out there?
We are seeing some pretty good loan growth. We are seeing growth on the commercial side. We have a new acronym. It's not a new acronym, but a probably more common acronym, which is NDFI, non-depository financial institutions. So basically, fintech, non-banks. What are the loans that the banks are making to this, quote, shadow banking area? How much has that been driving loan growth? And so I think that investors and analysts are really focusing on the sources of that as a source of growth, and could that create some problems down the road?
So help us look ahead to what we can anticipate for Bank of America and Morgan Stanley tomorrow. Clearly, the trading numbers and the investment banking numbers, advisory numbers, are going to be similar to what we saw for the Big Four today, which is they kind of blew them all out of the water. But beyond that, there are specific issues with Bank of America net interest income. There's question marks about whether it can deliver on that, because a few years ago it didn't. And then Morgan Stanley is all about that wealth management profit margin.
So for Morgan Stanley, really, they'll be, I don't want to call the tiebreaker, right? But we'll look at their equity trading, and if it comes in super strong, then there might be more questions around Goldman. If it's less strong, that really just shows that JP Morgan was a standout with their results. So people will be, I think, focusing on that. From the wealth management franchise, the key thing about that business is it prices at the beginning of the quarter. So they're set for a good 4Q. In the U.S. wealth management business, that's how that tends to price, and higher starting levels as well for asset management. The focus is on the pre-tax margin, as you said. We are seeing higher costs come in. Higher performance-based costs is something that we're going to see in the wealth business. JP Morgan talked about higher pay, having to compete with hedge funds and fintechs, et cetera, and really those costs kind of contributing. So I think we'll be watching that for Morgan Stanley, as well as Bank of America. Bank of America also has a very sizable wealth business, but the focus there, as you said, will be net interest income. We've been trained for so many years that higher rates are good for banks, but I think that as we're going into a more normalized rate environment, what we're really focused on is loan growth. And so even though there'll be some focus around, the Fed and the rate outlook for Bank of America, it's really the loan growth and how those trends are going. They do have a sizable commercial business. They obviously have a sizable consumer business. JP Morgan made comments about a resilient quarter, but some concerns ahead. We'll see what we hear from Bank of America.
All right, not for nothing, but I worked at 3 out of the 4 banks that we just reported today, just leaving it at that.
So you could do the bank earnings route next time.
Come on. Easy peasy. But Allison's, she's the best out there. So we're fortunate to get a few minutes of her time. Allison Williams, senior analyst covering the global banks and asset managers for Bloomberg Intelligence, working nonstop, sunrise to sunset today, that's for sure. And I'll note that one of my prior firms, Citi, stock's up 1.5% today. It's up 39% year to date. I mean, it feels like maybe they're kind of turned a quarter out of the doghouse for investors, so we'll see.
Yeah, their FICC trading really blew it out of the water, but that's their area of strength, certainly more so than equities and investment banking.
Boy, when we at Salomon Brothers came over to the Citi platform, and we had like brokers, and we had a huge sales force, we felt like there was nothing, no deal we couldn't get. We could leverage the fact that Citi's been trading currencies for this company for 100 years and say, hey, we want your bond offer, and we'd get it. It was a cool time.
The power of the institution.
Yeah, darn right. We'll have more coming up. This is Bloomberg Morning.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Domino's reported some results that were pretty good. Stuffed crust, that's the winner. You called that out on your earnings release.
I feel like I've seen those in commercials so often, but I never realized it worked that well.
It works. You darn right.
Is that the Spicoli effect?
Could be. Could be. You're doing some gummies.
Please explain.
Paul, you want to handle that one?
The more and more legalized cannabis.
Okay.
Is there a correlation? Yeah, you go for your Domino's pizza. Click the button, by the way.
Yeah, I know.
Great
We
app.
just need to add some protein powder to it.
Sure.
Our own business.
All right, Michael Halen, he covers all the restaurants for us. He's a senior restaurant and food service analyst for Bloomberg Intelligence, zooming in from Princeton here. Mike, talk to us about Domino's. What's the story there?
I love the Spicoli reference, by the way, but yeah, it was a great quarter. I mean, 5.2% same-store sales in the U.S., and everyone knows quick service restaurants, have been struggling due to low-income consumer weakness. They did it with, to your point, stuffed crust pizza. They were the only major national pizza chain that did not have stuffed crust pizza, so they added that to the repertoire this year, and that's boosted sales. Value this quarter was the best deal ever. $9.99 for any pizza, no matter how many toppings you want on it, right? So giving people a discount that they really want on an item they really want. And then, DoorDash. DoorDash is the first quarter they were fully rolled out on DoorDash, and that has really helped them take a chunk of that third-party delivery aggregator business, boosting same-store sales.
Okay, that all makes sense, but is that sustainable, especially the promotions like $9.99, which definitely sound appealing in this day and age? I mean, these campaigns might drive volume, but at some point, don't they erode profitability?
Well, I think, what we saw was margins were flat, so to your point, but what management said and what they're right about is that, you don't take margin to the bank, you take dollars to the bank, right? And so they did this $9.99 deal, and they actually ran it longer than expected because franchisees were making so much money off of it, right? And so, yeah, they're willing to sacrifice a little bit of margin expansion here for that traffic because it's making franchisees happy, and that's the key when being a franchisor. So, I think this is sustainable, right? They have only a fraction of the third-party delivery business, right? But they have a third of the pizza market in the U.S. So that's a huge slug of business that we think is a great opportunity that's going to continue to build over time. Uber Eats, it took them quite some time to build some momentum there. This was just the first quarter of being fully rolled out on DoorDash, so we think it's going to have a big impact over the next 3 quarters. But it sounds like it can continue to build. Stuffed crust pizza, right? This is something that's a permanent menu item. This is not something that is, just a limited time offer that's going to be run for a few weeks, right? And then value. They have a bunch of different value things. They do these boost weeks, and they have a tip promotion. And so they run different value at different times. But what they've done is been able to, create a name for themselves and are owning certain type of discounts that they run throughout the year. And so I think that is important for national pizza players. It's a business that's heavily weighted toward low-income consumers. And, to my point earlier, they're struggling right now.
So, Mike, explain the economics or explain the strategy of using these third-party delivery folks like Uber Eats or DoorDash. What changed for Domino's, for example? Why would they not use them but then make the decision to use them?
Yeah, great question. So, at first it was really about the cost, right? And years ago, third-party delivery companies were charging 30% plus. Domino's, number one, they waited till the prices came down. Also, their business is really just using the marketplace. They're still using their own delivery drivers, right? And so they're able to use DoorDash only for their marketplace and pay a much, much lower VIG to the company for the listing, right? And so they were the last of all the major pizza players and QSR names. They were the final holdout. A big part of it was they were just so big in delivery and they didn't want to cannibalize the margin on that business. But what we're seeing is it really drive transactions. This quarter, we saw positive same-store sales growth with carryout as well as delivery. They saw same-store sales growth with every income cohort. It was a very strong quarter across the board.
You can count on people to not want to get off their couch and always order in, and that's a guaranteed moneymaker.
The only offspring that's still on my dole is my last guy. He's in college, and he knows he has to call me or text me.
Does he?
To get pre-approval to use any third-party deliveries, because I hate that cost.
Yeah, I mean, well, as Gen
cost.
Xers and older, you know, the thought of paying out extra for someone to deliver food to you is just...
So I haven't heard from him in like 6 months on this
That's
issue.
good,
Yes.
progress.
Yep.
So, Michael, is Domino's attracting higher income consumers who are perhaps trading down and looking for those deals like the $9.99 pizza? And I wonder how much more market share they can pick up that way.
Well, same-store sales, to your point, did grow with higher income consumers. They didn't talk about whether that's a trade down. Naturally, though, you will see that from increasing your third-party delivery sales, right? Because those customers tend to skew younger and skew more affluent. So, so we do know that's going to... Yeah, yeah, exactly.
All right, Mike, thanks so much. Always appreciate getting some of your thoughts there on the restaurant business. Mike Kalin, Senior Restaurant Analyst at Bloomberg Intelligence from Princeton. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Coming up in this hour, we're going to check in with Ira Jersey, Bloomberg Intelligence Senior Interest Rate Strategist. I think Chairman Powell speaking like today.
Yeah.
So we'll get a little preview there. Neil Sipes, he's a Bloomberg Intelligence financials analyst, talked to us about the BlackRock earnings. Get this, BlackRock hauled in $205 billion in private assets. Unbelievable. So that's some amazing news coming out of there. Steve Mann's going to talk to us about General Motors. They're taking a $1.6 billion charge on Trump-induced EV pullback here. So that is tough news there in the auto business as that industry continues to try to navigate from internal combustion engines to EVs. Tough blows there. Right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost. Global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. The stock sell-off, pairing some of the earlier losses. J.P. Morgan Chase shares down 1.3%. That comes after earnings of the CEO, Jamie Dimon, warning of a potential deterioration in credit quality. They added $810 million to the reserves just in case a bunch of loans go sour. But Allison Williams just told me that's not why they're down. It's been up so much and people are taking profits on this. Goldman Sachs telling staffers to expect an additional round of job cuts this year as the bank seeks further cost savings across its businesses. And then you have Advanced Micro Devices that was up just about 1.8%. The chip maker expanding an AI partnership with Oracle. And meantime, after the back and forth between the U.S. and China on trade, Kate Moore, CIO at Citi Wealth, says investors should get used to the tariff turmoil.
The President of the United States will continue to use tariffs as a negotiating tactic with all of our trade partners. We saw this, of course, with China on Friday. It is not going to be off the table for the duration of this administration.
Right now, the S&P 500, 30 points lower. That's down just about 0.5%. The Dow down 37 points. The NASDAQ 100, 208 points lower. That is down just about 0.8%. Strap in, strap your seatbelts. Kelley Blue Book says the average price of a new car in the U.S. has topped $50,000 for the first time. They cite a surge in expensive electric vehicles and luxury models driving prices higher. I guess you got a lease, right?
That's what I did.
I am not paying 50 grand for a car.
Or you buy a used car, although in the East Coast, that's kind of painful because, those cars have been destroyed by years of salt on the streets.
Matt Miller got me into a Ford F-150, the electric one, like a year ago, because he knows everybody.
But how much?
Ford. $94,000.
I don't know how people do it.
I don't know how people do it.
Seriously don't. But anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Paul and Scarlett.
All right, Paul Sweeney and Scarlett Fu, thank you so much, John Tucker. We are going to take a look at some of the stocks on the move. And just quick mention that Market Drivers is brought to you by Van Eck. Van Eck marks its 70th anniversary this year with a legacy defined by forward-thinking strategies, resilience through market cycles, and an enduring commitment to clients. Visit vaneck.com. For our Market Drivers segment today, we want to welcome Danica Sokova. And Danica, just on the heels of what John Tucker was saying about new car prices, you're focused on General Motors, one of the biggest automakers.
General Motors, and we're talking about EVs, but we're not getting quite the reaction we were expecting. Of course, the news today is that General Motors is incurring a $1.6 billion in charges tied to its pullback from electric vehicles. Of course, we've seen all those EV makers reacting to this, but actually the stock was down 2% in pre-market trading. We're seeing a little bit of a jump. It's up 1%. Of course, the stock was under a lot of pressure. We've been following the news about the EV credits for quite some time, so perhaps some of this was already priced in. The stock is up only 5% this year, and now we're actually seeing a little bit of a positive reaction there. We've seen a lot of automakers react to this. Tesla introduced a less expensive version. Ford Motors, Stellantis have been shifting product plans. Even GM announced in June that it would build a gas-powered pickups and SUV factory at Michigan, and that facility was actually previously slated for electric vehicles. So things are changing fast. Maybe investors are seeing some kind of bottoming of this EV trade that has been quite negative for those companies, and we're seeing small relief today on top of pretty negative news for the company.
Yeah, the one question I still can't answer, we're how many years into this EV story, is really what is the underlying demand for EVs out there in the U.S.? I just don't know.
After the tax credit expired, I mean, it feels like not a whole lot.
I don't know. I don't know. I just don't know the answer to that. I can't imagine being in a car company trying to forecast that out. All right, what else you got?
We have Domino's. Demand for pizza is strong, even as EV demand is falling. The stock rose as much as 4.8%. It's coming after the company. Total domestic store compensation sales growth was pretty strong for the quarter. Domino's logged higher revenue in the third quarter. We're seeing sales growth in U.S. franchises continue to grow, and international one. Total U.S. sales rose 7%. International sales were up 5.7%. The stock is actually flat on the year, so this is much needed relief we're seeing today. Domino's says it continues to gain share from other pizza chains and deliver promotions to increase order. We had the best deal ever promotion with stuffed crust pizza. I don't know if you tried it.
$9.99.
But it's helping. It's helping.
We've been told.
And that's one of the reasons we're seeing some good results there.
All right, the stuffed crust pizza is made of premium buttery flavored dough stuffed with melty cheese made with 100% real mozzarella and topped with Domino's garlic seasoning and a sprinkle of Parmesan.
Wow.
What do you pair that with? Pinot?
That $9.99
Diet
pizza.
Coke.
The old Coke. All right, Polaris, real quick.
Polaris is having a great day. It was up as much as 11%. The recreational vehicle maker is pulling out of the motorbike business, and investors are pretty excited about that. Polaris designs all those off-road recreational vehicles like ATVs, but they were also focusing on motorcycles, which apparently wasn't that exciting for investors. The company also gave preliminary results for its third quarter that were pretty good. So that's another relief for investors. The stock is up 18% year to date, and you can imagine a lot of the spike is coming off today's news. The company didn't disclose the terms of the sale, but said divesting the business will boost its annualized adjusted earnings by $1 $1 per share. The CEO said the sale would let the company focus on the parts of the business that grow the most. And of course, these are all ATVs, UTVs, all those four-wheeled vehicles. So yeah, a lot of excitement from investors on that piece of news.
All right, good stuff. Denitsa, thank you so much. Denitsa Sokova with our Market Movers. And for more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Well, Jay Powell will be speaking later on today. And you know, I wonder what he's going to refer to because there's no economic data to speak of.
Yes, exactly.
It's a data-dependent Fed with no data.
I don't know.
Right? All right, let's bring in Ira Jersey. Ira Jersey is, of course, Bloomberg Intelligence's chief U.S. interest rate strategist. Ira, this might be an obvious question, but does Jay Powell get data before other people? Can he call up someone at BLS who might be working on an emergency basis and say, just tell us what you have so far?
Well, no, they don't normally operate that way. I mean, you know, who knows, but probably not, especially since they're not releasing that report until the 24th now. You know, one of the reasons they want to release that report on the 24th isn't so much to help the Fed, although it certainly will, you know, coming out a few days before the end-of-month Fed meeting, but it's for Social Security payments, right? So they want to make sure that there's cost of living adjustments that go into those payments to support those people who get Social Security.
So in the absence of, you know, official government data, what do you and your kind, Ira, in the Treasury market, what do you guys look at?
Yeah, we're using some of that data that you can find on WSL Alti, which is a lot of the private data that's being released. So it's everything from the ADP report, although that sometimes doesn't have a great relationship with the payrolls report. Looking at things like the ISM surveys, which of course came out, you know, a week or so ago, and you know, all of this suggests that all of the data that's still coming in suggests that the modest slowing in the economy that we've been seeing when we had the official data continues to go on. So I think from the Fed's perspective, yeah, you know, it'll be interesting to see if Chair Powell mentions this today in Philadelphia, whether or not he's, you know, they're looking at some of this data for you know, for results that you know, quite frankly, you know, there's people who are worried that, hey, inflation might still move higher. You had recently the China news that we're going to be imposing more additional tariffs on China, and will that increase inflation? But at the same time, it's the job market and the rest of the economy that the Fed has to look at. So you know, it's a foregone conclusion based on market pricing that the Fed's going to cut again. I think it's really, you know, how far do they go? Like, okay, maybe they go 2 more times this year, but do they then cut in January and March next year as well and get down toward 3%?
Ira, before we let you go, there's no government data, but the government is still selling debt. After all, we need to pay for our bills, and so that continues unabated. This week, it's a lot of short-term debt. Last week, we had some longer-term debt. Have there been anything that raised your eyebrows that got you concerned?
Yeah, so last week's debt auctions weren't quite as strong as as September's. September's were blowout months in terms of debt auctions, and so last month last week was a little bit weaker, but still relatively robust demand for Treasuries, particularly that longer duration, you know, 30-year debt, which actually still saw reasonably good demand. The end users continue, so end users meaning investors, continue to be the major buyers, where dealers are hardly participating at all in these auctions.
All right, Ira, thanks so much for joining us. Always appreciate that. Ira Jersey, he's the chief U.S. interest rate strategist for Bloomberg Intelligence. He's one of the best out there on the street. Appreciate getting some of his thoughts. All right, BlackRock, you got to be kidding me. I mean, this is a $190 billion private equity player. Stock's up 1.4%. They had some good earnings. We'll get to that. Stock's up 14% year-to-date, hitting a 52-week high, which makes it an all-time high. But here's a number that just blows me away. They pulled in $205 billion in new client money in the third quarter. I mean, where does that come from? I mean,
is it all going into gold ETFs?
All gold ETFs. I don't know. Neil Sipes, it's his job to tell us what's going on. He's an analyst covering all the financials there at Bloomberg Intelligence. A, where does this money come from for the BlackRocks of the world? And B, what are they doing with it?
Yeah, I think it's coming from pretty much anyone you could possibly call a client these days. And to your point, $13.5 trillion, it's an eye-popping number. I think we have the same discussion in a strong market backdrop. We have the same discussion every quarter of the number gets bigger and the asset flows that they're pulling in continue to hold in there. And I think that's the big story that we're focused in on today with BlackRock is we're defying the law of large numbers where growth should slow down once you hit these numbers. It's not slowing down. In fact, it's sort of picking up a little bit. And importantly, the fee story is going alongside with that. So the fundamentals are positive.
I saw Henry Kravis speak many, many years ago, and he says, it's easy to raise money. It's easy to deploy money. It's really hard to exit and monetize and get that money back to your clients. Where are we in private equity in general, Blackstone maybe in particular, about harvesting a lot of these investments that they've made over the years?
Yeah, I think no doubt it's been a more challenging backdrop for the past, called two-ish years. I think we're starting to see, as you look at key indicators like the IPO market, key exit strategies through M&A. M&A had one of its best quarters since things slowed down in 22. Last quarter, IPOs similarly starting to come back to life. So you're starting to see the broader environment be a little bit more conducive to sort of the capital recycling between LPs and GPs to once again get that story going and sort of justify why everyone wants to be in private assets. For sure, all those expectations for institutional high net worth all the way down to mass affluent, everyone wants greater exposure to private markets. So that sort of shows you that the funnel is going to continue, but we do need sort of the natural progression of capital recycling to follow through. And as long as markets and the macro backdrop can remain supportive as we sort of are today, barring the past week or so, it looks like things are going to pick back up. Again, question marks down the road, though.
Yeah, but not everything in private lending is doing great. I think about what's going on with Tricolor and First Brands, and BlackRock is exposed to First Brands' problems, right? Because it had some cash that invested in a Jefferies fund that was exposed to that trade debt. What did Larry Fink say about that? What did we learn from the company in terms of just how deep that exposure could go?
Yeah, so these are going to be third-party investor funds that are funneled into that Point Bonita fund that Jefferies sort of supports, and of course has that First Brands exposure. So the direct impact to BlackRock is not something that we're concerned about. And on the call they talked about the private credit landscape remains pretty healthy. There are, of course, always going to be smaller pockets, particularly in some of the more recent cases that we just noted with Tricolor and now potentially First Brands. When there's whiffs of fraud, of course, that's something that is always going to cause an issue. But I think the broader private credit market metrics continue to look healthy. And I think for now, the problem pieces that are, of course, generating large headlines do seem somewhat isolated.
Raising capital, if you're not BlackRock, how is it out there raising capital?
Yeah, well, I think that almost goes back to the point of you have to get exits first, because a lot of these firms have been sitting on their assets for quite some time. We've all seen those charts where private equity hold periods have expanded from 5, 6, 7, 8-year hold periods on average. To sort of get that capital funneling back through again, you got to create those exit opportunities. So we're starting to see that. I think once that story develops, of course, the fundraising side of the business can also pick back up. Again, I think we're in that period where the near term is still in question in terms of how robust and how quickly this capital is going to be flowing. But long term, the narratives are still there. And by the way, that's why we saw BlackRock pay so much for those pricey transactions last year in GIP and HPS.
Did we learn anything in terms of demand for crypto products from BlackRock today?
Yeah, I think we continue to see that they are in high demand in terms of the ETF products, at least. We've seen the Bitcoin ETF, the Ethereum ETF on BlackRock's platform be pretty meaningful drivers in that $200 billion flow number that you talked about. And particularly important is that these are not your beta 4, 5, or 3 basis point type funds. They are meaningful, and they're becoming sort of a much easier way for the retail population and institutions to get exposure to the cryptocurrency, whether that's 1 or 2% of a total portfolio. Over time, it looks like the ETF is going to be a nice path, particularly for that advice channel through advisors to sort of garner that exposure. So continues to be a driver. Of course, we know that product is inherently volatile, just like Bitcoin itself. So I'm sure that'll ebb and flow, but for now, it's been a product that's strengthening.
We hired this
guy when he was a kid. He was a pup. He didn't know anything. Now he's like the axe on
He's
BlackRock.
schooling us.
It's amazing. He's had great development. That's what we do at Bloomberg Intelligence. Neil Sipes, financial analyst, Bloomberg Intelligence, the pride of the University of Dayton. We'll have more coming up. This is Bloomberg Morning.
Headlines and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we're brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Some of the earlier losses evaporating for the major averages. The Dow down 15 points right now. S&P 500 down 31 points. And the NASDAQ 100, 214 points lower right now. Best performing stock in the S&P 500, that belongs to Wells Fargo. It's up 6.2%. They say they're aiming to achieve return on tangible common equity of 17 to 18% in the medium term. That's an increase from its prior guidance. That's a key metric for them. By the way, after 7 years in the doghouse for behaving badly, the asset cap on wells. That was removed in June, so kind of a new era for them. As the U.S. tries to focus more on mining critical minerals and rely less on China, shares of Critical Medicals Corporation, this is a ticker symbol CRML, today they are up, another 16%. Remember, yesterday it was up 55%. Rayonier has agreed to buy Potlatch Delta. Potlatch Delta. I almost said Potluck Deltage. Ticker symbol PCH. This is an all-stock deal valued at about $3.4 billion. It would create the second largest publicly traded timber and wood products company in North America. And by the way, the U.S. is starting today. The new tariffs went into effect.
Yeah, that's why I feel like this is
the timber, lumber, kitchen cat,
a deal done from a position of weakness. You know, they kind of have to do something because the whole economics of their industry is changing.
Okay. You know more than me.
I don't know, maybe I'm wrong, but that was my first thought.
And this is the day I have to go to Home Depot and buy some 2x4s.
Oh, lucky you.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Ball.
All right, thank you so much, John Tucker. You know, as we've been following the markets, buy the dip seems to be working, Paul, because we've seen the indexes really pare their losses, and the Dow is now little changed, unched basically. The S&P 500 only down 0.5%.
Yep, absolutely. It works until it doesn't.
There you go. All right, let's bring in James Abate. He is Managing Director and Head of Fundamental Strategies at Horizon Investments. He is a value-based investor. James, I'm sorry, because that's difficult right now. You could argue that it's difficult to find value because everything just keeps getting, things that were frothy get frothier by the day. What do you make of this inability to keep prices down?
Well, I think if you look at, some of the risks that are involved in the growth segment of the market, I mean, clearly, some of these vendor financement arrangements, mainly between OpenAI and NVIDIA, Broadcom, AMD, has seen some pretty severe market overreactions and valuation concerns. So, Broadcom and NVIDIA trading at 26 and 27 times trailing revenue, respectively. And even outside of the semis, Oracle's trading at 14 times revenue with its profit margins declining. There's no doubt, though, that, AI search tools are fabulous. They're a permanent life-changing event. But, just like Netscape, Yahoo, AOL, Alta Vista, yielded its search dominance to Google, I think you're going to see one dominant player. Maybe it's OpenAI, leaving other players' investments potentially impaired, if not worthless. So the second point is, be careful what you wish for with some of these companies. If you do become the dominant player, OpenAI's valuation is $500 billion, right? So, but the cost to build out just 1 gigawatt of data center IT capacity costs about, $7 to $15 billion, depending upon what it might be. That translates to a need of revenue of about $30 billion per gigawatt. So, right now, OpenAI's current annualized revenues are only about $12 billion. Now, this being said, the opportunity for value investors is that the data center is the heartbeat of AI, and the race amongst all the wannabe winners gives out a capability that over the next few years, we're going to have $500 billion in CapEx. 25% of that is on infrastructure spending and heavy ongoing capital spending. So, I'm literally back from a trip from Northern Virginia, which is the largest concentration of data centers in the world. And the number one issue slowing projects down is utility capacity and power generation and transmission. So when you think about this, right, so value investors can keep pace with their growth peers by recognizing the transformation, of the utilities and the energy transportation sectors, from dividend plays to one that's more exciting growth opportunities without losing a lot of the attributes of yield and natural inflation hedges that value investors covet.
James, how do you guys define value?
Value is creation of where rates of return on capital exceed the cost of capital, but a good company does not always translate into a good stock. The price that you pay for an investment is the single most important thing that you can identify to determine whether or not it'll be a good investment. I think, Paul, you're probably the same age as I am. And, when you were an analyst at CSFB, remember, prior to 1999, I mean, technology-related companies were categorized under the S&P industrial sector, right? Because there wasn't even a separate IT sector under the GIC standard, So when you think about value opportunities, I remember in early 1995 as a new portfolio manager trying to convince my boss why Microsoft and Intel deserved to be re-rated higher as their cyclicality or the risk was declining relative to the more cyclical industrial companies because desktop computerization was becoming ubiquitous. Similarly, someone smart enough to recognize the change in NVIDIA's growth outlook in early 2023 reaped great gains from a re-rating. So from us, the standpoint of, identifying that change, though it's not a new phenomenon, but utilities and energy pipelines should no longer be viewed as bond proxies or solely for income-oriented investors, but prime growth investment beneficiaries of the continuing AI infrastructure build-out and a way for value investors to enjoy a positive re-rating period that I think will have persistence.
All right, James, thank you so much. James Abate joining us right now, and again, giving us some perspective on these markets, managing director and head of fundamental strategies at Horizon Investments, a value-based investor seeking value in a market like this.
Yeah, that's a tough road to hoe here because it seems like the market is clearly valuing high growth, and if it doesn't have AI tied to it, you're in trouble a little bit here. Speaking of an industry that's kind of, I don't know, in transition, that's probably the polite way to say it, is the auto industry. And we saw General Motors today incurring a $1.6 billion in charges related to paring back electric vehicle productions plans due to flagging federal support for plug-in vehicles. Steve Mann joins us. He covers the global autos and industrials industry for Bloomberg Intelligence. Steve, tell us what's in this charge. Why is GM doing this, and why is GM doing this now?
Look, Paul, I used to work at GM prior to being an analyst on the sell side. And look, I think what GM is doing today is a little bit unprecedented because they're actually changing the direction of that ship around fairly quickly. Once, when the $7,500 subsidy expired, they knew they had a portfolio that was not congruent with what they think sales is going to be. So they're going to have to rationalize that portfolio. They've been the most aggressive, if not globally, but among the top, the big three in Detroit in rolling out new EVs. So, they're going to have to review that portfolio, maybe even wean out some of the, lower sales, less profitable EVs going forward.
Yeah, what surprised me about this action, like you said, they've been pretty aggressive on the EV front, is Ford has delayed or scrapped some plug-in models and definitely moved money away from the EV business, which it's been losing money on. And it seemed like General Motors was taking the stance of like, no, that's not us. We are going forward with this. Right. Is GM simply catching up to the economic realities that Ford has already acknowledged, or is there a different strategy at play here?
I think it's really hard to foresee. These policies are changing so fast. With Biden in the administration, there was a huge push. Not just GM, but a lot of automakers was pushing EVs. You had new startups like Rivian, like Lucid pushing EVs. But things have changed, and look, GM is reacting to it. It's interesting you brought up Ford, and now actually Ford. Chris Farley looks actually pretty good, right? He looks like he made the right call. But I think, if you look at the bigger picture, what GM is doing today is probably just the beginning. We'll probably hear more, not just from GM, but from the other makers in terms of their EV plans going forward.
Has this changed the way you're viewing the evolution to EVs, that, hey, maybe it's not going to be as far as we thought or as quick as we thought? How should we think about that? Because it seems to have lost steam, and I'm not sure if it's just tied to this administration and its policies and names, or is it more market-driven?
Well, I think it's up in the air. Personally, I still think there is a market for EVs, not necessarily in the U.S. The Chinese are still pushing EVs. the Europeans, to a certain extent, are also pushing EV. I think, with the current policies of no subsidies, no penalties for, selling gas guzzlers, and U.S. consumer is still loving the gasoline engine. I think it's just going to take a little bit more time to shift to greater penetration in EV. Look, there is demand, right? Because if you look just before the expiration of the $7,500 subsidy, we did see a spike in EV sales, BEV sales. So there is a certain segment of the consumer that is looking for EVs, and I think a lot of people who have driven EVs love them. So look, it's just going to take time, right? It's going to take time to get there. There's still other hurdles that the EV industry has to overcome. For example, the charging infrastructure. That needs to be built out.
Yeah, no kidding. Which legacy automaker, not just in the U.S. but around the world, has figured out the best approach to EVs? Gotten the balance correctly?
Yeah, I just take a step back. I think GM is probably the best because they actually have,
even with this about face.
Yes, because they're reacting to reality fairly quickly. Look, they're cutting back on the U.S. EV capacity, potentially EV product offering, but they're actually doing fairly well in China. They do have plug-in hybrids. They do have extended range EVs, which I think we talked about it here before, and they also have battery electric vehicles in China. And sales have been improving over the past few quarters over there.
All right, Steve, thanks so much for joining us there. Steve Mann, Global Autos and Industrials Research Analyst for Bloomberg Intelligence. Again, as Steve was saying, GM, a little bit of a pullback, more than a little bit of a pullback from the EVs and the investments, and they're going to take a $1.6 billion charge here.
Yeah, pretty sizable. Have you driven an EV? Like, what would it take for you to convert to an EV?
I would if I didn't have to pay any premium for it, because it has no value to me, so I wouldn't pay a premium for it, and still you have to pay a premium today. But there'd have to be better charging facilities, infrastructure.
Yeah, you don't want to deal with that anxiety, the range anxiety.
Yeah, so I'm not there. I did buy my number 4 offspring, or released him a hybrid, because he lives in California for school, and the gas is like $6 a gallon. So he pitched me on the hybrid,
and he sold you on it.
He sold me. He sold me. So now I own a hybrid. How about that? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, the trade tensions still weighing to some degree on risk sentiment, although the major averages have paired some of their earlier declines. The Dow down just about 4 points right now. I think it's going to go green. And just there we go. It's now up 8 points. The S&P 500 28 points lower. That's down 0.4%. The Nasdaq 100, but still down 207 points right now. That's down about 0.8%. And those trade tensions come after China sanctioned U.S. units of a South Korean shipping giant and threatened further retaliation. Now, for the bank earnings, well, started today. The expectation was for beats and raises all around. And Wall Street's biggest firms mostly delivered. Wells Fargo, that is the best performing stock right now in the S&P 500, up 6.2%. Among other things, they raised their guidance on one of their key metrics. Meantime, Dana Doria at Envestnet says any trade-related sell-off should not be much of a surprise.
With the multiples that we're at now, the market really can't. You have to expect a pullback when there's some bad news. Even if, to a certain extent, we all kind of sit and think, well, this is not really where we're going to land. You know, there's going to be a negotiation. There's going to be a lot of posturing. There's going to be a lot of talk.
And cryptocurrencies, they continue to lose ground today. We have down 3.4%. The mother of all cryptos, XBT USD, Bitcoin, largest digital asset by market value. More volatile tokens sinking even more, dragging the combined market value of all the cryptocurrencies down by more than $150 billion over just a 24-hour period. This comes again as China's hitting back against some of the U.S. tariff threats. Also, let's wrap up with the mood of small business owners. A little less rosy last month from the National Federation of Independent Business. They do their sentiment survey every month. It fell in September to a 3-month low. The owners of small firms less optimistic about the economic outlook. There was also more concern about excess inventories. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Scarlett and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We're joined by Jen Bartash, senior retail staples and packaged food analyst at Bloomberg Intelligence. There's a million important things we can talk about, but I have to lead off with this. Kellanova offering a version of Pop-Tarts with higher protein content starting in early November. This follows Pepsi's plan for higher protein version of Doritos. I don't even know what protein is and how you add it into something. Jen, what's going on here?
Hi, Paul. So really what we're seeing is a lot of these packaged food companies are tapping into this protein trend. It's something that consumers are really looking for. And at the end of the day, when it comes to PepsiCo or it comes to Kellanova, this is really about making people feel marginally better about eating food that is bad for them, right? Let's just be honest about it, right? So, you know, when you put protein on the package, people feel like even if they're making a bad choice, it's not as bad as it could have been. And that's really what's behind this.
It's like the equivalent of vanity sizing at retailers, right? You know, you're actually a size 6, but we're going to tell you you're a size 2 so you feel better and buy more clothes. Is this as simple, Jen, as just adding protein powder on top of the Kellogg's Pop-Tarts? Excuse me, Kellanova Pop-Tarts?
Yes, so what they've done is they've added protein into the pastry part of the Pop-Tart, and that changes the texture and the taste just a little bit. But what's really interesting is the consumer trend behind it. You know, we ran a proprietary protein study back in the middle of the summer, and what we saw was that almost 40% of consumers eat something with protein enhanced, whether it's a snack or a beverage, on a weekly basis. And you know, at least 38% said that they're eating more protein-enhanced products in the last 3 months. So clearly there's a consumer uptake, there's interest in this, and that's what these companies are really tapping into.
Do I want more protein? Do I need more protein?
I'm eating more egg whites, but that's because it's available at work. What are you doing?
I don't know. I'm using the same thing I've always done.
Your goldfish do not have extra protein on them.
My goldfish do not have extra protein.
Listen, neither of you are on GLP-1 drugs, right? But protein is a big solution for people who are on those drugs. because you tend to lose muscle mass as a side effect of those drugs. And so as the uptake of GLP-1 goes up, there's more and more demand for these protein-enhanced products.
That's what I needed. Okay, now I'm at a cocktail party, and I need to sound smart on proteins. Now I got my
But
line.
apparently fiber is the new protein. And Jen, didn't the PepsiCo CEO say something about this?
Yeah, whether it's anything that helps kind of enhance the product. So when you talk about Doritos, so they have additional milk protein being added, higher fiber products. All of these things are things that the average consumer perceives as having a health or wellness benefit, and people are trying in small steps to be a little bit better about their health.
All right, let's get to another story I thought was really interesting. Walmart partners with OpenAI to offer shopping on ChatGPT. This sounds like a natural. What's going on here, Jen?
Yeah, this is an interesting move, but I think it really illustrates sort of that trend of what's happening across retail in general. Walmart's really been very good about doing experimentation and kind of checking out what the opportunities are, whether it comes to social media and social commerce particularly. And this latest partnership with OpenAI, this really does tap into that as well. Now, social spending is still very small in terms of the overall percentage of what retailers are achieving, but it's important to be present. And I think that's what's most notable about this announcement.
What is social spending, and how do the numbers differ from normal shopping through Walmart's website or going into Walmart's actual stores?
Yeah, so social commerce is when you're on a platform, whether it's on ChatGPT now, or whether it's on TikTok, or whether it's on Facebook, or any of the social media platforms, and you have the ability to add to cart and buy now. That's social commerce, but it's still a tiny fraction of the overall e-commerce that happens for these companies. So while it's important in terms of their showing that they're present and that they're aware of new technologies, it's not going to move the needle with regards to their overall e-commerce sales or their overall business mix at this point.
Jen, we've got a little bit more data, a little bit more time. And as it relates to tariffs, what's your best guess as to what your packaged food companies, your retailers, how are they kind of segmenting the tariffs and before maybe passing along something to the consumer?
Yeah, it's a complicated situation, Paul, and really what's happening is, where they can find alternative sourcing, a lot of companies have been trying to do that. There are some companies in packaged food where that's not as easy. So I would take McCormick as an example, where a lot of spices you can't produce domestically or you can't source domestically. And then it becomes a question of how do you negotiate with partners? Do you find alternative countries of origin that maybe have slightly lower tariff levels? And it's also a lot of effort right now is going into finding efficiencies that can help offset those costs so that they can absorb some of that cost and not have to pass it on to consumers. Ultimately, most of the companies we're talking to are saying that where needed, they will very strategically pass price through, but they're trying to avoid a unilateral price increase just due to tariffs.
How much of this work has been done, what you just described? And I guess I wonder how much of it will be covered in the earnings calls this quarter.
I think it will be definitely a topic of the earnings calls this quarter. But when we had tariffs back in 2018, a lot of companies started the process of identifying other options for sourcing. So there's probably been more progress made than people would recognize because it didn't just start this year. And so it's been sort of a gradual shift. And once they have those plans in place, they can sort of accelerate that. And then the focus really is on efficiencies. And that's where the technology comes back into play, where it helps them be better with regards to their sourcing, their negotiations, and really in terms of understanding what products they actually need to carry and which products they could perhaps suspend or discontinue.
Jen, thanks so much for joining us. Jen Bartash is Senior Retail Staples and Packaged Food Analyst for Bloomberg Intelligence. Adding protein to your Pop-Tarts. I got the cinnamon glaze. That was my Pop-Tart back in the day.
I like the Oreo one.
Yeah?
But I mean, I don't see how anyone can eat this for breakfast without gagging. It's too much. It's like cloying how sweet it is first thing in the morning. But, add some protein. Maybe I'm in.
Yeah, I don't know. Maybe. We'll see about it. So there you go. We've got protein into Pop-Tarts. We've got ChatGPT.
Protein into Doritos, too.
And into Doritos as well.
And mac and cheese.
And now you're going AI in your
Walmart experience.
What is this world?
I don't know. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. I think back in the pandemic, we all became, whether we wanted to or not, we became experts on the global supply chain and how fragile that is. And that is no more evident than in the airline business and aircraft manufacturing business. Apparently, it's not an easy thing to build a jet aircraft here. You need specialized skills and people with those skills. That's still rippling through the aviation and aerospace industries. Boeing and Airbus are suffering, quote, unprecedented delays in certifying, delivering aircraft, stifling airlines' growth and plans to decarbonize, customers are saying. George Ferguson joins us here. He's a senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. George, we're well past the pandemic here, and I know you've educated us and explained to us how intense these supply chains are and how complicated they are. Give us an update on the ability of Airbus and Boeing to deliver aircraft to their customers.
Yeah, so I think the update would be that Boeing is converging, I think, on Airbus as far as delivery numbers. Airbus sort of came out of the pandemic with supply chains, I think, in relatively better shape, and they were doing better at deliveries because of that. But recently, things have stagnated, and so Airbus has been having problems getting engines from specifically GE, which is making it hard for them to deliver their bread and butter aircraft, the A320. During the month, they delivered 59 A320s, not bad, but they want to be at 75 a month by 2027. and they have months where they're in the 40s, and so very sporadic. Again, I think a lot of it has to do with that GE supply chain. So it was an okay month, I think, for Airbus, and an okay quarter. They have a lot of work to do to get to their targets for the end of the year. Boeing just reported deliveries. They're in the 50s. Most importantly, 737s are around 40, I think it was, for the month, which is a pretty good number. It's been it's a little bit less than August, but has been improving. That's how they're going to drive cash flow and profitability, better cash flow and profitability. So it looks like Boeing really starting to get their throughput in the factory sort of in hand and working well, and starting to deliver some of that inventory aircraft, which will reduce some of the drag of on their earnings.
So at a recent investor or industry conference, Ben Smith of Air France KLM said, for some long-haul airplanes, we've been waiting for certification for 7 or 8 years, which is unprecedented. Yeah. What's going on with some of those wide-body jets?
Yeah, I mean, the 777 is, I think he's referring to 777, right? Boeing has been trying to get the 777X, their latest version of the 777, certified, and it just keeps pushing, and recently it pushed from a 2026 initial delivery to a 2027. I think, a lot of these airlines, they're looking for this airplane because it's going to be the biggest in the sky, right? Since the 747 and the A380 have been retired, this is going to be sort of the biggest seat count you can get. So it's really good for driving seat cost efficiencies at airlines. It's still, though, a small portion of Boeing's business. Yep. I mean, the backlogs, I think, around 400. So it's not huge. The biggest backlogs are to the Middle East, to Emirates and to Qatar. And my guess is that as Boeing manages challenges in the engineering workforce, unfortunately, I think 777 sometimes maybe gets some short shrift, and so certification sort of keeps getting pushed on that one.
U.S. government shutdown can't be helping this industry in terms of getting a certification and things like that. Are any of the companies calling that out as a challenge? Not yet.
I mean, we're about to go into earnings season, right? Yep. So they're all in quiet period. I think we'll hear, but I think you're right. The FAA, I'm sure, is not working at sort of full gallop at this point, given the government shutdown. There are some folks, I'm sure, that still have to work, but it's not going to help certification. We'll see how much longer it lasts. Again, 777, we'd like to see certified and delivered. We think Boeing still can keep that line open well into 2027. They have a lot of orders for the freighter still, but companies like Emirates, Air France, KLM, Qatar chomping at the bit to get that airplane in the portfolio. Lufthansa too.
What's the labor situation in the aerospace business? You explained to us that the industry lost a lot of talented, skilled people during the pandemic, and it's kind of hard to find these people and retrain them.
Yeah, it's getting better, and I think you could sort of look at some of those labor indicators, like these surveys that show jobs open and people looking for jobs. During the pandemic, there were a lot more jobs open than people looking for jobs. That's since crisscrossed. So that will improve stability in the aerospace supply chain. I guess it's not as an exciting career as maybe it was back when I was a boy, I guess, which was a long time ago. And so, there's people that would love to be able to work at home. You can't really do that when you're manufacturing airplanes. So they've had a hard time sort of backfilling a lot of the baby boomers that left. And the new workforce just isn't as, I would say, I don't know if it's fair, adept with their hands maybe as the boomers. And so they're bringing people in that haven't worked manufacturing and trying to teach them how to do that kind of business, which makes it even harder to train up. But it is improving. Again, we're seeing it, I think, in the throughput we're getting out of Boeing. The delivery numbers today are an indicator of it. And as we see the what do you call it, the employment situation get back in balance, it'll help.
Right. All right, George, thanks so much. As always, George Ferguson, Senior Aerospace Analyst for Bloomberg Intelligence. And for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM, Channel 121, access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up right now.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. The U.S. Supreme Court's rejected an appeal from the conspiracy theorist Alex Jones.
The court is leaving in place the $1.4 billion defamation judgment against the InfoWars founder for his claims that the 2012 Sandy Hook Elementary School shooting in Newtown, Connecticut was a hoax staged by crisis actors as part of a plan to enact more gun laws.
The official story of Sandy Hook has more holes in it than Swiss cheese.
In court 3 years ago, Jones admitted he knew the shooting really happened. In their Supreme Court filing, his lawyer said the $1.4 billion can never be paid. Michael Wallace, CBS News.
Jones is also appealing a separate $49 million judgment against him in Texas. Cody Ballmer, the man charged with setting fire to the Pennsylvania governor's mansion, has pleaded guilty to attempted murder and other charges. Day 14 of the government shutdown. CBS's Stacey Lynn is in Washington.
In a post on social media, the White House Office of Management and Budget says it's prepared to ride out the Democrats during the ongoing shutdown, adding, pay the troops, pay law enforcement, continue the rifts and wait. The post by OMB comes after the president announced this weekend the administration has identified funds to pay the military tomorrow.
On the Health Watch, CBS's Allison Keyes tells us Roche Diagnostics has had a key blood test approved by the FDA.
Roche says in a clinical study with 312 participants, the Alexis blood test was able to rule out Alzheimer's with a 97.9% negative predictive value. The company says the test can be used to help identify patients who are unlikely to have Alzheimer's, while those with a positive result will be recommended for further testing.
One person is dead, 2 others missing in western Alaska as the remnants of a typhoon swept away homes and prompted dozens of rescues.
I felt the house shaking. I saw the flood coming into our house, and it was very dirty, and things were floating everywhere.
Forecasters fear heavy rain in Southern California could spark mudslides in areas that have been hit by wildfires. It seems a changing electric vehicle market is going to cost General Motors a lot of money. Reporter Jeff Gilbert at affiliate WWJ Detroit.
GM will take a $1.6 billion charge against its fourth quarter earnings and has warned that more of the same could be coming in the future. GM bet big on EVs, and the government changed emission rules and also ended tax incentives for the purchase of electric vehicles.
New Instagram content default settings for teens are targeted for a PG-13 audience. Only parents can change them. Wall Street, the Dow is up 148. This is CBS News. Scientists in the UK have unearthed giant footprints that date back 166 million years.
200 massive footprints crisscross the limestone floor of a quarry in Oxfordshire, revealing the comings and goings of a long-necked sauropod, a Cetiosaurus, and a smaller meat-eating Megalosaurus. The largest prints are about 9 feet long each. The tracks stretch for more than 490 feet in what was once a warm, shallow tropical lagoon. Scientists at the University of Birmingham believe a storm blew through and deposited sediment on top of the footprints, preserving them for the ages. Deborah Rodriguez, CBS News.
A California engineer who's a gardener in his spare time has won the top prize at a major pumpkin contest in Northern California. Brandon Dawson's giant one weighed in at 2,346 pounds. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
China hits back. Welcome to the Tuesday edition as Beijing ups the ante in the tit-for-tat over trade ahead of President Trump's meeting with Xi Jinping. They say it's still going to happen. We're going to get the latest on this from Bloomberg's Michelle Jamrisco, covering the White House and national security for us in Washington. We'll get the view of the Fed chair a bit later on this hour. Yeah, Jay Powell in conversation at a National Association of Business Economics conference in Philadelphia. You will hear his remarks live and unfiltered here on Bloomberg Radio. And it's all after a look at Wall Street. On day 14 of the government shutdown, we set the baseline with Charlie Pellet at World Headquarters in New York. Charlie, how's it look?
Right now, we are looking at a decidedly mixed market. Yes, the Dow is higher, but the S&P, NASDAQ, they both remain in the red. We are well off session lows right now. 10-point drop on the S&P at 66.43. That is a decline now of 0.2%, but the Dow up 146. That is a reversal from earlier losses, up now by 0.3%. NASDAQ, the composite index, down 0.6%. Our Mag 7 index down now by 1%. The 10-year 4.04%, with the 2-year that's currently yielding 3.49% on the 2-year. Spot gold up 0.7%, 41.37 the ounce, and West Texas Intermediate crude 58.63 a barrel, down 1.5%. And Bitcoin now down 2.8%, 112,550 on a Bitcoin. JP Morgan Chase after earnings down now by 1.6%. Citigroup up 3.3%. Wells Fargo up by 6.9%. Big banks out with earnings. So how are they doing? Gerard Cassidy is head of U.S. Bank Equity Strategy at RBC Capital Markets.
Obviously, JP Morgan's numbers were very strong across the board, so you probably have to put them up at the top of the leaderboard. Citi's numbers were also very good. They had a higher tax rate, which on a bottom line basis impacted EPS, so you'd probably put them up second. And then, the other two, Goldman and Wells, are tied for third. There's gold, silver, and bronze for everybody.
Gerard Cassidy of RBC. He mentioned Goldman, down now by 2%. Goldman Sachs has told staffers to expect an additional round of job cuts this year as the Wall Street Bank seeks further cost savings across its businesses. Again, recapping, stocks lower, S&P down now by just about 0.2%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, many thanks. We'll be back to Charlie Pellet as soon as we can, because we'll probably be hearing first from Jay Powell before we get another update on the markets, though we'll be keeping track on the indexes here with kind of a lackluster session, you might say, and Powell could, of course, move markets, which is normal for when he speaks. Either way, we'll find out together. Welcome to the Tuesday edition of Balance of Power on Bloomberg Radio, on the satellite radio. Find us channel 121 on Sirius XM, and you can watch the radio on TV, as always, by going to YouTube. Search Bloomberg Business News Live. You can watch us on Bloomberg Originals. With much to learn today at high noon on the East Coast, along with me for the hour is Bloomberg's Mario Parker here in Washington, D.C. And Mario, we've got our eyes on the markets and the White House for a reason today. I should also mention day 14 of a shutdown. Funny, no one is talking about it the way they were last week, which is a little bit dangerous. But the president's making news today by way of China, by way of geopolitics. I'm guessing he's sleeping off that trip to the Middle East right now. He's going to be sitting down with Milei a bit later today in the Oval Office. It's pretty amazing how quickly we turn the page in this world, isn't it?
No, absolutely. You saw the president do kind of a turn and burn, right, in the Middle East yesterday, and now he's back, and it's business as usual, right? We know that China is top of mind. He and Xi are going to be preparing for this big meeting later on this month. This is something that the markets do care about and have been intently watching. We saw what happened last Friday as the two nations kind of escalated a war of words, or kind of a flame of a war of words, if you will.
That's right. So we're going to talk Argentina. We're going to talk China with an expert on the global South and White House politics. That, of course, would be Bloomberg's Michelle Jamrisco. Michelle, it's great to see you. We heard from the president on China yesterday, and before we start picking your brain here, I want to just get in his head for a moment, because while Beijing is ramping up pressure here in reaction to that post he made on Friday, president says there's nothing to see here, move right along, everything's going to be fine. Let's listen.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set. I know what happened. I really understand what happened, and I'm not even saying he's wrong. But then we met him with something much tougher than what he did to us. Again, because of the tariffs, it's much tougher.
I'm not even saying he's, if you put out a transcript, it would be difficult to understand exactly what he's saying other than it's going to be fine. Michelle, is it?
Well, and at the same time, it's vintage Trump, right? I mean, we've seen this before where the uncertainty on Friday definitely tanks the markets. But once they kind of learned, and we were all seeing that this is the sort of tit for tat, the escalated tit for tat that we had predicted would, lead up to this meeting with Trump and Xi, then the markets are a little bit more comfortable. It's almost like, wow, we're seeing these escalatory moves over the weekend between the U.S. and China, and all of a sudden this is kind of more familiar territory. This is kind of what we expect them to do before something calms down. But notable that you hear in that clip, and you've heard from other administration officials over the weekend and yesterday, that the communication lines are still open, that they're still talking. They haven't scrapped the meeting. In fact, USTR's Jamison Greer just said, in moments ago in a meeting that they still have a date and time for this meeting, and the plans are set. So, no threat of this blowing up right now. And I think we're just going to get used to these sorts of back and forth moves in the weeks to come.
And Michelle, do we have a sense of what the president was referring to when he said that he knows what was going on with President Xi at that time? Is he referring to this jockeying that you're outlining, or is there something else at play?
Well, I mean, as you know, Mario, he likes to kind of play that he knows and he can get inside the head of these other world leaders. Xi is someone he's very much respected, and he's said outwardly so, publicly and assumedly privately in many conversations, that he respects the strong leaders. In fact, he had a quote on his trip over the weekend. I don't want to botch it, but it was something to the effect of that he deals with the strong leaders easier than the weak ones. He just doesn't have the patience for who he deems a weak leader. So I think, being locked in these negotiations and this tit for tat with President Xi, he has respect for someone who others would deem an adversary that they couldn't really deal with.
Well, he's succeeded as always in upping the stakes around this meeting. Presuming it does happen, by the way, do we all, you both cover the White House, we assume there was a time, not just a date for this meeting? That, to your point, that is what Ambassador Greer said on the other network a little bit earlier. That said, the coverage of this meeting, not unlike what we saw with Putin in Alaska, you just raised the bar dramatically for a meeting that might not have had quite as much urgency beneath it before he started posting on Friday.
Well, two things on that. I think one, just planning-wise, of course they've got to have, at this point in time, probably they have a time and place that they're thinking of at least, right? And Mario can check me on that and his time in covering administrations. But also I think it doesn't hurt the Trump administration and Trump himself to kind of have this as a maintenance of leverage, to kind of keep hanging it over the Chinese and say, we're still willing to talk, but you do this again, or you put more curbs on us, we can always pull that meeting away and say this is not worth our time. Now we know that Trump wants this meeting. He wants to have a deal happen, and there are many reasons that the U.S. would need that to happen. China, for their part, also. So, your bet is as good as mine, but I think this meeting will probably still go on, and at least now is on track to happen.
And Michelle, what are some of the recent inflection points? Is it the maritime rivalry that we have with China right now, the U.S. between China right now? Is it the export controls? Is it rare earths? What are some of the inflection points?
Yeah, I mean, I think we've seen how rare earths and tech controls specifically across Huawei and, other, potential, hot points between the U.S. and China. Those are very sensitive issues, obviously big money issues there too. Also, the rare earths is something that Trump himself has talked passionately about, clearly wants to get those curbs removed and have the ability to take in what we need and kind of get the rare earth materials that the U.S. needs without any burden. But also in recent days, we've seen shipbuilding kind of rise up again, and that's a special vulnerability, I think, in recent years with the Chinese making headway and the U.S. kind of falling behind in that industry. So, the Chinese most recently in the last 48 hours, and again, market response hasn't been woven deep to this, but they slapped sanctions on the South Korean shipping giant Hanwha, the U.S. subsidiaries of that shipping giant, and they're also saying, we might respond to this other Section 301 investigation that the U.S. has started on the maritime industry. So some threats from the Chinese side in that space will also kind of rise to the level of meriting a lot of attention in the weeks to come.
If you're just joining us on Bloomberg Radio, we're spending time with Michelle Jamrisco with news coming out of China when it comes to trade, and standing by to hear from Jay Powell, who's going to be speaking momentarily from the National Association of Business Economics Global Economy Conference that's underway in Philadelphia. That might be coming up any minute now. Michelle, there's going to be obviously another big event today at the White House, and that's the Milei meeting in the Oval Office. Should we expect any chainsaws? What's on the agenda?
Yeah, maybe. I mean, this might be a fun one because it's Trump welcoming a political friend, another Latin American political friend who he has. They're cut from the same cloth in some senses. They definitely agree to your chainsaw point on cutting government spending. So who knows? Maybe Milei will have some advice on the government shutdown and how to deal with rifts and the sort. But joking aside, I mean, they do have a lot of business to take care of. Milei is facing a midterm election later this month. So to come at this time is a nice favor from Trump. He's also, a $20 billion lifeline might be on the table here to help save Argentina from an economic crisis, a deepening one down there, and this is kind of a familiar pattern for Trump, who was good friends with one of Milei's predecessors, Macri, and also encouraged the IMF at the time in 2018 to extend a $50 billion bailout or lifeline, whatever you want to call it, to the country, which has not really turned out to be a great business decision for the IMF, if it was one. So we'll see where that goes today. And then, of course, with foreign leaders in the Oval Office, trade is always an issue these days, so there might be something on that front, but we're not expecting anything in particular. We'll just see how the conversation goes.
And Michelle, Joe rightly pointed out that you're an expert on all things Global South. Besides just the politics of it, besides the fondness that the two men share, can you kind of give a sense of what the strategic interests are for the U.S. and with Argentina?
Yeah, I think it's interesting too, Mario, coming off a big weekend where, Trump was able to project this historic leadership on the Middle East peace deal. He's really trying to show in some ways that he is the leader that the world needs, not President Xi. So there is a little bit of like third country posturing. We've seen for a long time, for several years, both the U.S. and China saying, we are the moral authority. We are the ones who can help these global South countries in any way. We can make deals. We're the best for them economically and politically. And so I think this is a good example with, a large country like Argentina to say, for Trump to say, we're the big friend here. We're the ones that can make deals happen. We're the ones that you want to rely on and do business with, not China, de facto. So we'll see how that develops. Like I said, he's got a good friend in Milei, so maybe they'll cement some more business relationships that can kind of help further that argument for the U.S.
Jay Powell is just getting to the podium in Philadelphia right now, and we do expect to see Milei in the Oval Office next hour, right? This is going to be the 1 p.m. hour Eastern time when that takes place. We'll bring you into the Oval Office. Michelle Jamrisco, thank you so much, as always. Alongside Mario Parker, I'm Joe Matthew in Washington. And we want to bring you this conversation now with the Fed Chair, moderated by Emily Kalinsky-Morris, the president of NABE. This is live on Bloomberg Radio.
Many of your past recipients, including particularly my predecessors, Janet Yellen and Ben Bernanke. So thank you very much for this recognition. I will say, on a more personal note, I have greatly enjoyed my regular visits to your annual meeting and your conferences. It's really been my favorite venue all these years. It's a place... This is a place where we can talk about economic issues and not worry that someone's eyes might glaze over. I also appreciate the warm welcome I've always received here. And putting Fed staff aside for a minute, I can't think of a more lovable group of econ nerds anywhere. So thank you again for this prestigious award. And for the opportunity to speak to you here today. So, as we all know, monetary policy is more effective when the public understands what the Federal Reserve does and why. With that in mind, I hope to enhance understanding of one of the more arcane and technical aspects of monetary policy, the Federal Reserve's balance sheet. A colleague recently compared this topic to a trip to the dentist, but I found that comparison somewhat unfair to dentists. So today, I'll discuss the essential role that our balance sheet played during the pandemic, along with some lessons learned. I'll then review our ample reserves implementation framework and the progress we've made toward normalizing the size of our balance sheet. And I'll conclude with some brief remarks on the economic outlook. So, one of the primary purposes of a central bank is to provide the monetary foundation for the financial system and the broader economy. This foundation is made of central bank liabilities. On the Fed's balance sheet, the liability side of the ledger totaled $6.5 trillion as of October 8, and three categories account for roughly 95% of the total. First, Federal Reserve notes, that is physical currency, totaled $2.4 trillion. Second, reserves, funds held by depository institutions at Federal Reserve banks, totaled $3 trillion. These deposits allow commercial banks to make and receive payments and meet regulatory requirements. Reserves are the safest and most liquid asset in the financial system, and only the Fed can create them. The adequate provision of reserves is essential to the safety and soundness of our banking system, the resilience and efficiency of our payment system, and ultimately the stability of our economy. Third is the Treasury General Account, or TGA, currently at about $800 billion, which is essentially the checking account for the federal government. When the Treasury makes or receives payments, those flows affect dollar for dollar the supply of reserves or other liabilities in the system. The asset side of our ledger consists almost entirely of securities, including $4.2 trillion of U.S. Treasury securities and $2.1 trillion of government-guaranteed agency mortgage-backed securities, or MBS. When we add reserves to the system, we generally do so by purchasing Treasury securities in the open market and crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves, but does not change the total amount of government liabilities held by the public. So, the Fed's balance sheet serves as a critical policy tool, especially when the policy rate is constrained by the effective lower bound, or ELB. When COVID-19 struck in March 2020, the economy came to a near standstill and financial markets seized up, threatening to transform a public health crisis into a severe, prolonged economic downturn. In response, we established a number of emergency liquidity facilities. Those programs, supported at the time by Congress and the administration, provided critical support to markets and were remarkably effective in restoring confidence and stability. At their peak in July 2020, loans from these facilities totaled just over $200 billion. Most of these loans were quickly unwound as conditions stabilized. At the same time, the market for U.S. Treasury securities, normally the deepest and most liquid market in the world and the bedrock of the global financial system, was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals. That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions. And we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021, we announced a phase-out of our purchases, and at our next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So, a number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery. Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable. Our thinking was, was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions, and we were thinking of the events of December 2018 as well as the 2013 taper tantrum. Regarding the composition of our purchases, some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purpose of asset purchases in real time. There's always room for improved communication, but I believe our statements were reasonably clear about our objectives, which were to support and then sustain smooth market functioning and to help foster accommodative financial conditions. Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction without much of a difference. That's not always the case, of course. For example, the March 2023 banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continued to raise the policy rate through that time. Turning to my second topic, our ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Reverse repo rate, rather. This approach allows us to maintain rate control independently of the size of our balance sheet. And that's important given large unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates. The committee's plans lay out a deliberately cautious approach to avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and a discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities rather than by our pandemic-related asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates to control inflation, this is highly unusual. Our net income will soon turn positive again, as it typically has been throughout our history. Of course, having negative net income has no bearing at all on our ability to conduct monetary policy or meet our financial obligations. If our ability to pay interest on reserves and other liabilities were eliminated, the Fed would lose control over rates. The stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve, raising borrowing costs for the Treasury and private sector. Even after that volatile and disruptive process, the banking system would be less resilient and more vulnerable to liquidity shocks. The bottom line is that our ample reserves regime has proven remarkably effective for implementing monetary policy and supporting economic and financial stability. So I will close with a brief discussion of the economy and the outlook for monetary policy. Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's Beige Book. Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the September meeting. And I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
Fed Chair Jay Powell live in Philadelphia on Bloomberg Radio. He's going to make his way over to the chairs now for a conversation and a panel moderated by the president of the NABE, Emily Kalinsky-Morris. They're going to get mic'd up and get everybody set here, get a little glass of water, and be on to the conversation. That should last about a half hour. This is going to be interesting as we keep ears on the NABE conference in Philadelphia, live on Bloomberg.
We'll have about half an hour for questions. So
sounds like a long time.
Should have talked longer. So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. You know, as I mentioned, there really isn't a risk-free path now, since it appears that inflation is certainly running above our target, and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment or break-even employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is 50,000 plus or minus, something like that. And that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal, and that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly, and the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace, although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many, many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly. But then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
Right, and I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state-level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data in employment. So in the employment space, there's some plausible data. I will say generally, the private data, the alternative data that we look at, is better used as a supplement for the underlying governmental data, which is the gold standard, and it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes. Less so in inflation space and in economic activity space. And also, they're just, they're different private data providers use different universes and different levels of rigor in their data analysis. So, we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
Yeah. You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Okay. Fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue-to-issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create. Of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
All right. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is, reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advance as potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly, bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say in terms of what the Fed can do, you know, we deal with supply and demand. You know, we have an interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I mean, I've always liked the model that you know, technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, you know, their work, which they actually spoke about at Jackson Hole this year. But it's a 20-year-old book that they wrote. We can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, you know, potentially, you know, if there's really significant job loss. So there are a lot of, I mean, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Thank you. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but you know this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, you know, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
Okay. I think we're not going to get away without addressing this one, so I'll try to, again, group some of these together. First, there's definitely appreciation from the audience and your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, you know, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve, you know, the American public, and then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that, and as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not that gets to be political sort of right away. So we just do our work and do it as best we can. I mean, overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had 2 world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today, and second guess ourselves, which is only appropriate. We've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed isn't a government agency that does a good job for the public that it serves, and that is our only goal. And I think we do it pretty well. Don't look for perfection. You know, these are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then, internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, and but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right.
Mm-hmm.
And you know, that you come to places, not very commonly, but sometimes you come to places where people are going to have different views, and this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy, and people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going on. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, you know, in terms of people sincerely, you know, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around you know, a central answer. And that's, of course, part of what I try to do is you know, find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and you know, how long that could persist, and is there a risk there?
Sorry,
the interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, you know, we set interest rates according to, you know, the place where our economy is domestically, you know, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many factors, but, you know, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, you know, I think we need to set, as every other central bank does, they're setting rates in their, whatever their, you know, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back, and, you know, this is a momentous award, it's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as the chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You know, you're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and wouldn't and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible. But it's a very, very difficult thing, but it yields itself up over time. And you know, it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You've made a great choice, and I would say, wish you the best of luck.
Thank you. Agree. Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that you may not want to get into great detail on anyway. Some of these are pretty straightforward, but so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is, and is that something that will just
current immigration policy?
Yeah.
Yeah. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So we take that as completely, it is what it is. We take it as it arrives. More, I'd say, stronger policy than most people had expected. We've seen very sharp decline in growth of the labor force and in people entering the country, and yeah, I think you're only beginning to see the strength of that policy too. There's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean fewer people to work. You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't. But yeah, it's going to be a really important economic fact because that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and again, from our standpoint, we're just our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down, and but I just think you're going to reach a point at which unemployment starts to go up, and we haven't really. We may be hitting that now, but it's been remarkable how that line it just comes down, and which has been really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But you got to think we're making some progress and doing some good, and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say keep at it.
And likewise, NABE supports you.
we done?
I think we're done. Thank you so much.
Thank you. Thank you. Thank you very much.
There you have it live in Philadelphia. The chair of the Federal Reserve in conversation with the National Association of Business Economics. Live on Bloomberg. I'm glad we could bring that conversation to you as it generated a lot of headlines. The Fed chair saying the outlook has not changed much since the September Fed meeting. Powell went on to say that labor market perceptions remain on a downward trajectory. This was not the most upbeat speech. Referring to the balance sheet repeatedly, it was a big central focus in this conversation. The Fed may end balance sheet runoffs in the coming months, he said, with a Fed more nimble in its use of the balance sheet. Talked about the labor market showing significant downside risks, persistent tariff inflation, another risk, saying that inflation is still on the way up. With regard to missing data, we're going to talk to Molly Smith about this live from World Headquarters in just a moment. Everyone, he says, looking at the same non-government labor data, and there are less good substitutes for government inflation data. Bloomberg's Michael McKee also in the room there at NABE in Philadelphia. He's going to talk to us a little bit later on this hour, but we want to see how Wall Street is faring. We're certainly off our lows of the session. In fact, looking at a mixed market now. Charlie Pellet has the latest on the trade this Tuesday from World Headquarters in New York. Charlie, what do you have?
Right now, Powell, moving markets. We've got the Dow higher, the S&P higher, NASDAQ does remain in the red. We got three things going on that we're all keeping an eye on right now. Those Powell remarks that you heard live on Bloomberg Radio and television. In addition to that, keeping an eye on earnings. This morning we heard from JP Morgan Chase, Citigroup, Wells Fargo, Goldman, among others. Also keeping an eye on any trade developments, and that factoring into today's turnaround earlier on. So stocks erase losses after Fed Chair Jay Powell signaled concerns about a weakening labor market, reinforcing bets on a rate cut in October. Right now we have got the S&P 500 index higher by 15. We're now at 6670 on the S&P. That is a gain right now of just about 0.2%. Dow Industrial is up 320, gain there of 0.7%. And NASDAQ higher now by 43, gain there of 0.2%. We've got the 10-year 4.02% with the 2-year right now 3.47%. Gold is now surging by 0.9%, up $37.4147 the ounce. And West Texas Intermediate crude down 1.1%, 58.82 a barrel on WTI. Bitcoin down 2.7% right now, 112,646. We'll have a whole lot more on the economy and Powell's remarks coming up in just a moment with our Molly Smith and also Michael McKee. Again, recapping here, the Dow, the S&P, they're higher. NASDAQ lower. S&P right now up by about 0.3%. Your 10-year, 4.02%. Balance of power continues right now. Back we go to Washington once again. Your host, here he is, Joe Matthew.
All right, Charlie Pellet. We'll have more from Charlie in about 15 minutes as we follow the trade here in a post-Powell speech world. Is feeling a lot better than it did this morning, although our realities regarding China trade and government shutdown have not changed. It is day 14 of the shutdown here in Washington, and we thank you for joining us on the Tuesday edition of Balance of Power here on Bloomberg TV and radio as we welcome our global television audience to the conversation. I've got my eyes on the president's schedule today, and I just want to mention quickly that we do expect to bring you into the cabinet room, if not the East Room, where the president is going to be spending some time a little bit later on. There's a Medal of Freedom ceremony set for this afternoon, but more immediately, Javier Milei, the president of Argentina, is at the White House, and we are standing by for his arrival here with the president planning a bilateral lunch in the cabinet room. He may be spending some time talking before reporters. This was expected to open up to press. If it does, we'll bring you there for more with big questions about what's being framed as a credit swap, if you will, or a currency swap by the administration, others calling it a plain old bailout of Argentina. And we'll be hearing much more about that coming up later on. Right now, though, we do want to parse some of the words of the Fed chair, making investors feel better here on Wall Street, clearly lifting spirits with regard to his view. Speaking a bit earlier at the NABE conference, when it comes to balance sheet runoff, listen to what Powell said on Bloomberg.
Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates.
generating the headline on the terminal. Powell says Fed may stop shrinking balance sheet in months ahead. Editing that for us, Molly Smith, Bloomberg economics editor, joins us now live from New York. Molly, it's great to have you. The economic signs are looming large here, and it's interesting to watch the markets shake losses from earlier and turn positive. At least the S&P 500 now up 16 points. The Dow is positive, and maybe the NASDAQ chips away at some of its losses as well. How should investors be reading this?
I mean, clearly the sign here is that they're taking all this to mean that, Powell still sees signs of weakening in the labor market, and that's going to lend itself to another cut later this month, is at least seems to be what the read-through is coming through the markets here, and especially in the absence of really any other tangible government data to work with in this time. That's the biggest thing that you can hinge your hat on right now, if that's when you're trying to make these calls. And Powell did touch on that, on the lack of government data in the shutdown, and talking about the abundance of labor market data, but not so much on the inflation side. So, and how we're all really looking at all the same private sector indicators right now while the government shutdown persists.
And that's probably not enough, right? Indeed, he said we're all looking at the same stuff, and there are less good substitutes for government inflation data. We know BLS is bringing workers back in to crank out a CPI report before the next Fed meeting, but is that enough, Molly? What else does Powell need to get a clearer view?
I mean, that's going to be, it'll have to be enough, obviously, for the October meeting, and that doesn't change what would have otherwise been on the calendar for the October meeting. The real risk, though, for the inflation data that should be collected right now is that isn't happening. The BLS workers that were called back were just to work on the September CPI data. So all of that had been collected by the time the government shut down, just hadn't been assembled in the form of the report that we usually see about 2 weeks later. So that's all they're working on right now. But otherwise, all of the data collection that would be happening right now, with hundreds of price collectors sent around the country collecting tens of thousands of quotes on prices for all these goods and services that we spend money on every day, that isn't happening. So that's the real risk for the October CPI that would be due next month.
Well, and you've got a Speaker of the House here, Molly, who says we could be heading for a record. The budget chief at the White House, Russ Vought, on social media earlier, basically saying that we're ready for anything. OMB making every preparation to batten down the hatches and ride out the Democrats' intransigence. If this, in fact, goes on for weeks or months, do they retroactively accumulate that data, or do we just have a gap in the story?
There is a risk of there not being a report. That is a very real risk right now. There's some data that is comes from other sources that the BLS does compile every month. So they get prices on new and used cars from J.D. Power. There are other measures for gas prices, for prescription drugs, but otherwise, the vast majority of this is coming from either personal visits to brick and mortar stores, or calling these businesses on the phone, visiting their prices online, but it's happening by BLS staff. So that's where, almost 2/3 of the price collection just isn't happening right now. And that's really a risk.
So do we get to a point where we're missing enough data that the Fed has to delay a meeting or issue a statement saying there are not enough data to make a credible decision moving forward here on interest rates or on the economy?
That's a risk I haven't heard brought up before, and I'm honestly not even sure if the Fed, legally or in their statutory powers can even do that. They are set up to have 8 meetings a year. They're spaced out roughly 6 weeks apart. So I think in that case, it would just be, they have to work with what they've got. But that is a good question to look further into.
You go to war with the army you have. And when you heard Jay Powell talking about the job market, Molly, I wonder your thoughts on the next couple of months, because the shutdown could change this dynamic where you've got federal workers who are furloughed at best, not getting paid until they're made whole later. Again, at best, the president has suggested that maybe all civilian federal workers not be repaid at the end of this. We just don't know. But also the layoffs now. We had 4,000 last week on top of the 250,000 retirements that are taking hold, and there could be other layoffs against the backdrop of mass deportations. You know all these factors. Molly, could we end up putting these together in a couple of months if this is a protracted shutdown where it really is showing up in the numbers here? With Powell saying, I'm kind of amazed I haven't seen it already. What if it does start to show up? What state could the job market be in?
I think, immigration is going to be the much bigger factor here for the labor market than what happens in federal government employment. It's just naturally a much smaller slice of workers in the U.S. And this is just really a key debate right now. There was a really interesting blog from an economist at the Dallas Fed recently that was just arguing that the slower rate of job growth that we're seeing isn't reason for concern. This is just the labor market adjusting to the fact that we don't have this same supply of immigrants that we used to, and that naturally then the pace of job growth to keep the unemployment rate stable should be lower, and that shouldn't be concerning. So that's one view, but a lot of what you hear from Fed speakers is they're trying to balance that with what actually is real softness in the labor market, and that's the distinction I think that we're still kind of wrestling with.
You start to wonder if the Fed, which of course has its own funding, could start to perform its own research, or is private data the only way that they'll get a hold on this?
Well, the Fed already, as you mentioned, they do their own research already through the reserve banks, through the Board of Governors. Powell did mention, we're going to be looking for the Beige Book tomorrow, which I think just generally has taken on more significance, looking at some of the anecdotal evidence in the economy.
So
and
the Beige Book is the Bible now.
Your words here, Joe. I like that, but it is a fun read. Sometimes there are really fun little snippets in there if you have the patience to go through all the different 12 reserve banks and what's happening around the country. But yeah, that'll be, I guess, the next data point, at least from the Fed, that we'll have to look forward to.
So exciting. We call it the Beige Book. Indeed, the cover is beige. Someone like yourself, though, has to cover the data. That's your job, Molly Smith. You edit this data. You're up at 8:30 every morning waiting for this to hit. In the meantime, what do you get your arms around if it's not the same stuff that Jay Powell's talking about?
Yeah, I promise I'm not just sitting here twiddling my thumbs in the absence of something coming out at 8:30 in the morning. We had a story out today that I edited that was talking about these risks to the October CPI and what that report might look like if we even get one, just because of all the data collection that hasn't been happening so far. We're looking at alternative measures of inflation, which Powell said there aren't a lot of them compared to the labor market, where there seem to be measures of job openings, of hiring, of of wage growth tracked by so many other companies. So that's great for the Fed to have all that on the labor market. It's just not the same on the inflation side. We get some other private sector looks at consumer spending too, but again, it's just not the same as the labor market data.
Well, she's our economic guru with or without the data on any given morning. Molly Smith, it's great to see you and great to talk this out. Bloomberg economics editor with us live from World Headquarters in New York. We'll assemble our panel next as we wait for the president at the White House with President Milei. It's all ahead right here on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Powell speaks. Stocks move higher. The Dow and the S&P both solidly in the green. We got NASDAQ moving lower. A volatile session, though, saw stocks erasing losses as Fed Chair Jay Powell signaled concerns about a weakening labor market, reinforcing bets on a rate cut in October. You got to keep in mind that at one point the S&P 500 index was down as much as 1.5%. Right now the index higher by 0.3%, so reversing earlier losses. S&P right now up by 19 points at 66.73. The Dow is up 367, up 0.8%. The NASDAQ Composite Index down 0.1%, while the Bloomberg Mag 7 Index is down 0.5%. 10-year yield 4.03%, with the 2-year currently yielding 3.48%. Spot gold is up 0.9%, trading at $41.45. West Texas Intermediate crude oil down 1.1%, $58.82 for a barrel of WTI, and Bitcoin now down 2.5%, $112,890 on Bitcoin. General Motors shares are advancing. GM up by 2.4%. General Motors is incurring $1.6 billion in charges tied to its pullback from electric vehicles, a stark indication of the damage that policy changes will inflict on plug-in cars. Again, GM higher, up by 2.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, many thanks. We'll have more from Charlie Pellet in about 20 minutes as we track the Tuesday trade with a government shutdown. Now, day 14 of the shutdown. There will be voting later on today. It's going to happen likely in the late edition of Balance of Power, but only on one of the CRs, the Republican version, that which passed the House. The Democratic version is apparently now officially on ice, having failed in voting as well repeatedly in the Senate. Thanks for being with us here on the Tuesday edition of Balance of Power on Bloomberg TV and radio. Still in town while the House is out of session, Speaker Mike Johnson speaking earlier about some of the new levers that the administration is trying to pull to get pay to the military and some others. The Trump administration saying it's working on ways to get paychecks to federal law enforcement officers as well, similar to what the president ordered over the weekend for active duty military. But there's still a lot of gray on how this is going to work and whether it's in fact legal for the president to get that pay to the troops using unobligated funds, as they said, from the last fiscal year. Here's Speaker Johnson speaking to this end earlier today.
If the Democrats want to go to court and challenge troops being paid, bring it, okay? I'm grateful for a commander-in-chief who understands the priorities of the country, the necessity of national defense, and the urgency that we all feel and have voted for 8 times. Republicans have voted in Congress 8 times now between House and Senate to fund the troops and pay federal workers in all these essential jobs and agencies because we understand the necessity of that. Meanwhile, the Democrats voted 8 times to block their paychecks. I'm grateful we have a president who is willing to step up and do the right thing.
Speaker Johnson now floating the prospect, as I read in the Associated Press, of the longest ever shutdown. Quote, "We're barreling toward one of the longest shutdowns in American history," unquote. The Associated Press quoting him to say that he will not negotiate with Democrats until they hit pause on their health demands and reopen the government. Now, that shift in rhetoric, the longest ever, being matched by the White House, with Russ Vought suggesting on social media that the OMB is making every preparation to batten down the hatches, the cliche that he grabs, and ride out the Democrats' intransigence. Pay the troops, he says, pay law enforcement, continue the rifts, and wait. OMB making every preparation to batten down the hatches and ride out the Democrats, as I mentioned. Now, we're in our 3rd full work week today here with no end in sight. And as I mentioned, there'll be an 8th vote on the Republican-led stopgap funding bill. If you're with us on Bloomberg TV or on YouTube, you see the tweet there, the post from the Office of Management and Budget. We assemble our panel for their take on this, and I will add that we do expect to hear from the president a bit later on today. He's going to be hosting President Javier Milei if he does arrive at the White House. He's late at this point, and there's also an event scheduled for later on in a ceremony honoring the late Charlie Kirk. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist and partner at Stone Court Capital. What do you make, Jeannie, of the shift? And I realize it's a nuance, but the shift in Republican rhetoric, not only will we not negotiate with Democrats until the government is reopened, but we're prepared for the longest ever shutdown. Time to batten down the hatches at the administration. Will Democrats be able to wait them out?
Yeah, I think we're going to have to wait and see. The reality is it is a really important shift that you're talking about, because we've heard it from both the speaker and we've heard it from the White House and we've heard it from the OMB director, and they are taking active steps to remove all the pain that could get these sides together and talking by paying the troop, paying law enforcement, keeping WIC afloat. And so what then are the pain points that will actually bring these two sides together? It's hard to see them coming down the pike anytime soon. That's distressing. And it's also distressing to listen to the speaker talk about the fact, we welcome seeing you in court if you're going to be fighting against paying the troops. Nobody that I know of on the Democratic or Republican side is fighting about paying the troops. What we should be fighting about is the fact that the branch of government that you, Speaker, run is completely abandoned its role as the first and most important branch of the greatest country in the world. That is something worth fighting for. This money that we give in taxes goes to the first branch. They are the ones responsible for the power of the purse, as Alexander Hamilton liked to say, and they are the ones that allocate the funds. So that is where we should be focusing our attention. Yes, pay the troops, but Speaker Johnson, get your branch of government open, for gosh sakes.
Well, I think that remains a strategy, too, to keep the House out of session, even though there are a lot of lawmakers still walking around town. We'll be joined by one on the late edition of Balance of Power. But you mentioned WIC, Jeannie. I'm glad you said that, because this is the other way that the White House is preparing for the long term, the long haul, and as Jeannie said, removing a pain point while we're at it. The administration ensuring the Special Supplemental Nutrition Program for Women, Infants, and Children, known as WIC, will continue to operate for the foreseeable future. Rick Davis, what do you make of this strategy? Taking pressure points, pain points off the calendar and daring Democrats to go long.
Look, I mean, this administration and the Republican leadership in Congress, they're not trying to punish the individuals who are, government agencies, working at government agencies, supplying these important services. I mean, they do become part of the fodder in the debate. But what they're trying to do is get Democratic leader in the Senate. It's really a target of one, Chuck Schumer, to come to the table and pass a CR and frankly, de-escalate this whole thing. I mean, Jeannie talks about like all these big issues about, being the rightful place to, initiate funding for the government in the House of Representatives. House has done their job. They passed a clean CR. It's exactly what we've done 100 times before when we've had to do a CR. In fact, it's even easier than it's been in the past because Republicans and Democrats alike have always attached riders to make a point. And the reality is it's just the wrong fight for Schumer to fight. This administration's cagey, all right? They're gonna make sure that the wheel gets oiled so that it doesn't squeak too loudly. They can't afford the one thing that could really upset the apple cart are TSA people not showing up for jobs, saying that they're sick, walkouts by air traffic controllers. We've seen already Austin's airport shut down because they didn't have enough air traffic controllers. I mean, those kinds of things are unavoidable. There's nothing the administration can do to patch that together. But they're not trying to make the military suffer. They're not trying to make law enforcement suffer. They don't want the WIC program to go out of business. And so they're using extraordinary measures to try and make sure that doesn't happen while we wait around for Chuck Schumer to realize that $1 trillion of additional spending is not going to happen.
Jeannie, the CDC has now rescinded the majority of its layoffs that were announced on Friday, remembering Russ Vogt went forward with about 4,000 RIFs. At least we heard the number 4,000. It's really hard to know if 4,000 people, in fact, were contacted and dismissed. The CDC says they were errors, had to rehire people. The Administration for Strategic Preparedness and Response, however, is still seriously affected, according to the Washington Post. The AP says layoffs decimated the education department. Offices hit by reductions in force this weekend include those that oversee civil rights, grant funding, and special education. Are Democrats sure they want to keep doing this?
So far, they are sticking with it. And, you know, we have a president who has just come back from the Middle East, where he has prided himself on being the great deal maker, and that he did make a great deal over there. At least so far, we have a ceasefire. He should be able to use those skills at home. And instead today, what is he doing? He is greeting his dear friend, the president of Argentina, so the United States can give $20 billion of taxpayer money to Argentina. And now Rick is talking about the fact they want to get Chuck Schumer back. Well, what about helping the people in the United States who are both been laid off, both under Doge and during the shutdown, which is an excuse for more federal layoffs, and also all of the people who are millions, by any estimation, just ask Marjorie Taylor Greene, who are going to lose their health care as a result. Instead, this person who ran for office promising to make America great and America first is giving his dear libertarian conservative president of Argentina a $20 billion investment from U.S. funds, even though Brooke Rollins and others from, you know, looking at the soybean issue have said this is a mistake. And so I'm not sure this is about, you know, wanting to pay the troops. I don't know anybody in the Democratic side who doesn't want to pay the troops or keep WIC going, but we should be investing in the American people. The government should be open, and they should be doing the work they have to do.
Well, I'll bite on this because I've certainly heard this from a number of Democrats. And Rick, I don't know your thoughts on the optics here. The president with a $20 billion bailout contingent upon the election result in Argentina. I'm using the word bailout because that's what the Smart Analysis has called this. How do you justify writing a check like that with the government closed, SNAP benefits set to run out?
Yeah, it's a bailout. If it looks like a duck and it waddles like a duck, it's a duck. Okay. And so, like, this is counter programming like none I've ever seen, right? You know, you're trying to talk about how you're tightening your belt and you're using taxpayer funds to, you know, do this kind of stuff. $20 billion will pay those military guys for another month and a half. So there's no rational explanation as to why this administration is taking this time to bail out Argentina. It's never worked in the past. It's not going to work this time. I get that, you know, Secretary Bessent has friends who are involved in the economy there, and, you know, they want to see Milei get reelected, and that's coming up. And, you know, he just got waxed in the Buenos Aires province by the Peronistas. So, you know, bad counter-programming.
Bad counter-programming, says Republican Rick Davis. Of course, Democrat Jeannie Sheehan Zaino with great analysis as well. Many thanks to both of you for our panel. When President Milei arrives, he's a bit late. We'll bring it to the White House. It's all ahead right here on.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow higher, the S&P as well. NASDAQ, though, does remain in the red. It's been a volatile session today. Stocks erasing losses as Fed Chair Jay Powell signals concerns about a weakening labor market, but that is reinforcing bets on a rate cut in October. So here's where we stand. S&P 500 index very close to session highs right now, up 18. That is a gain of about 0.3%. Dow Industrials up almost 400 points, now up 398, gain there of 0.9%. NASDAQ, though, lower, down 43, a decline of 0.2%. The Russell 2000 index of small cap shares now surging by 1.5%, while the Bloomberg Mag 7 index is down 0.6%. The 10-year 4.03%, now with the 2-year currently yielding 3.48%. Spot gold is up $40 the ounce, $41.50, a gain there of just about 1%, while West Texas Intermediate crude oil down 0.9%, 58.94 on WTI. Bitcoin, meanwhile, down 2.7%, 112,706 on Bitcoin. Oracle will deploy a large batch of AMD's forthcoming MI450 chips next year, with 50,000 semiconductors to be put in data center computers beginning in the third quarter of 2026. Shares of Advanced Micro Devices up now by 3.4%. Also today, we do have Oracle declining by 1.9%. Other AI news, Alphabet's Google aims to invest about $15 billion building an AI infrastructure hub in southern India over the next 5 years. And Walmart is teaming up with OpenAI to enable shoppers to browse and buy its products on ChatGPT. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your host. Here he is, Joe Matthew.
Yes, sir. Charlie, we'll be back at the top of the hour with more on this careful what you ask for rally. Watching Wall Street for us every day here as we talk politics in Washington. I will mention very quickly, if you're just joining us, especially the president of Argentina has just arrived. While Charlie was talking, they went inside the West Wing. Javier Milei sitting down today with President Trump. They're going to be talking momentarily. It is appearing that press will be allowed in the room here. They're going to have a little sit-down, little lunch, talk about this $20 billion that the president is directing toward Argentina and what has been framed here on Bloomberg as a bailout, not a word that the administration is using, but it does look like we're going to have reporters and cameras in the room. So when that begins, assuming it does, and we can bring you that conversation, you'll hear it live as you would expect here on Bloomberg. Back to our careful what you ask for market here with Jay Powell speaking earlier. We brought you the conversation live from Philadelphia at the National Association of Business Economics, generating a heck of a lot of headlines, including just what the market wants to hear when it comes to interest rate cuts. But when you add it up, it's not a very good narrative. Labor market perceptions remain on a downward trajectory, he said. Therefore, we have the idea of an economy that will allow lower interest rates, if not demand them. Ending balance sheet runoff in the coming months, labor market showing pretty significant downside risks. Not exactly an economy that's booming. Michael McKee is actually there. He was in the room for this NABE conversation and joins us now live on Bloomberg TV and radio. Should we be careful what we're asking for here, Michael? What happens after you get a couple of interest rate cuts? Where will the economy be then?
Well, as the old saying is, Joe, what do you mean we? It's all dependent on where you sit. If you're the president of the United States, yes, you want interest rate cuts, but do you want them because the economy is failing? No, you probably don't want that either. Really what happened today is Jay Powell gave his version of the Hippocratic Oath, first do no harm. The Fed blackout starts this weekend. They're not going to be talking until the next meeting. It was his last chance to let markets know what they're going to do. And without saying we're going to cut, he used the same arguments that he made after the last cut to suggest that that's what's coming. The markets have priced in a 25 basis point cut, and he did nothing to dissuade them from that by talking about the fact that the labor market seems to be more of a danger to the economy at this point than the rising inflation rate, although he did say tariffs are pushing up inflation some.
We heard from the Fed chair on the lack of data in Washington right now. It's day 14 of our shutdown Michael McKee, he says, we're all looking at the same non-government labor data, so your guess is as good as his, apparently, and there are less good substitutes for government inflation data. How hungry are they for news at the Fed?
Well, they're definitely hungry for news, especially for something to hang a decision on. I mean, they have 500 PhD economists working there with an awful lot of data that comes in from all over, and they're able to put together a pretty good view of what's going on in the economy. But the American public and the people on Wall Street don't see all that data, so it's very helpful to them if they have the jobs report, which they're not going to have, if they have the CPI report, which they are going to have, to be able to use those to talk about what's going on. Now, the thing that is capturing a lot more attention at the Fed than perhaps it has on Wall Street yet is we're halfway through almost the month of October, and they collect the data for the CPI through the entire month. So the percentage of responses they're going to get in terms of all the CPI categories for October is going to be much lower. So when we get to the middle of November and they're trying to figure out what to do at the December meeting, are they going to have an inflation report to rely on? And of course, their PCE report uses inputs from the CPI and PPI, which aren't being collected right now. So they may be flying a little bit more blind when they get past this next meeting.
Remarkable moment that we're in once again. Michael McKee, great to have you with us, Michael, at the NABE conference in Philadelphia, where we heard from Jay Powell a bit earlier today, and we're balancing a couple of stories. If you're just joining us on Bloomberg, President of Argentina has arrived at the White House, and it does appear that we're going to be hearing from Javier Milei and President Trump at some point. They have taken what was a closed press event and apparently opened it, and I'm mentioning that because we are looking at a shot coming from the White House now. If they bring you into the room, we'll bring you with the cameras, as I'm joined now by Ian Marlowe, Bloomberg's national security editor, with a couple of important stories to talk about. It's not just Argentina, it's China that is moving stocks, at least was moving stocks before Jay Powell gave investors a reason to start buying the dip here, with big concerns about trade and the tit for tat that will apparently walk us right up to the meeting between President Trump and Xi Jinping a couple of weeks from now. I will mention as well, we've just heard from the president. It's a good thing that Ian is with us. They have blown up another boat off the coast of Venezuela. This just hit Truth Social as I was speaking. Donald Trump writing, under my standing authorities as commander-in-chief this morning, the Secretary of War ordered a lethal kinetic strike on a vessel affiliated with a designated terrorist organization conducting neo-trafficking in the U.S. Southcom area of responsibility, just off the coast of Venezuela. He says intelligence confirmed that the vessel was trafficking narcotics. It was transiting along a known route. The strike was conducted in international waters. 6 male narco-terrorists, he says, aboard the vessel were killed. No U.S. forces harmed. And there is a video attached, as we have seen the first 4, now 5 times. Ian Marlowe is with us, and we have plenty to talk about, as it turns out today. We can pick our areas, and I'll start off the coast of Venezuela. There are big questions about whether these strikes are legal and whether Congress will move ahead. It's been a failed effort so far with a War Powers Act. What authority does the president have to blow up these ships in international waters?
Yeah, according to him, all the power he wants, and according to quite a lot of other people, he's acting illegally against people who are not armed combatants of a state with which the U.S. is at war. And I think that's one of the main things here. That's why you've seen Congress move. I think there's also been a lot in the air about whether he will go beyond these strikes on boats.
Regime change.
Exactly, to something like that, or to strikes on the Venezuelan mainland as well. I mean, he's long alleged, Marco Rubio has long alleged, that Maduro is part of this, narco-terrorist network.
Yes.
And drug traffickers, terrorists, they're one and the same. They all deserve to be taken out. So we're seeing this in international waters now. Are we going to see it on the Venezuelan mainland with attacks that might bring, U.S. Air Force in contact with Venezuelan Air Force? We have no idea what we are, but that's something that I think a lot of people are looking for, whether they're going to expand this based on things Trump himself and people in his administration have said.
We did see them scramble jets at one point to buzz some of our ships. We've still got a flotilla off the coast of Venezuela, essentially. So big questions. That would require technically an act of Congress to be attacking cartels on the ground in another sovereign nation, right?
Yeah, I mean, we've seen airstrikes, say, for example, in Iran, where the U.S. backed Israel's attacks there with the big bunker buster bombs. You know, I think people in Congress would certainly say, Democrats would certainly say, you need some authorization from Congress. Trump has shown he's willing to go forward with a lot of things without Congress, and Congress is not always willing to, you know, come back and formally kind of reprimand and ask that they be taken into consideration. So we'll see, I think, and it'll be interesting to see if Venezuelan strikes continue. I mean, it's interesting that they're continuing, but still with boats, because that's something that he's already done numerous times before.
That's for sure.
We'll see whether it kind of escalates from there.
We heard from the president on Truth Social as well about his trip to the Middle East yesterday and the release of hostages, writing in mostly caps, all 20 hostages are back and feeling good as can be expected, he writes. A big burden has been lifted, but the job is not done. The dead have not been returned as promised. Phase 2 begins right now. President DJT, presumably he wrote that if he signed it. What happens if remains are not returned? Hamas has said they cannot locate them all.
We're seeing that already. Today there was some breaking news moving, suggesting that Israel is halving the amount of aid it's putting into the Palestinian enclave right now because of the delay in returning the bodies of the hostages. Obviously, this is a highly emotive issue in Israel. This is a sign of exactly how complicated this deal was. I think a lot of people were surprised that the deal came together kind of as quickly as it did in the end, and that Hamas agreed to release the living hostages. I think there's a lot of people, we have some stories now on the wire from correspondents suggesting that this is the moment that a lot of countries in the region are viewing with anxiety. They don't want this deal to fall apart. They don't want another cycle of violence beginning again in Gaza as Israel and Hamas start to feud and bicker over the details here, you know, the number of bodies, exactly where Israeli troops retreat to, and things like that.
Well, this is a pretty delicate moment we're in. We were discussing yesterday what will be required in terms of dismantling the tunnel network underneath Gaza. And if Hamas police are on the streets, you're going to have IDF forces sharing blocks with them. How does that remain a ceasefire?
This is everything you're talking about are potential flashpoints that have long bedeviled any attempt to get this type of ceasefire. Difficult. These were the deals, I think, to some degree, that the Biden administration was trying to hash out in advance. And it was so difficult to get buy-in on some of those that there was never any deal, right? And so the Trump administration has pushed forward very quickly to the hostage part, which was always the main part. But now come the details. Well, these were the things that, you know, where there was a lot of disagreement on.
As we move, assuming we move into phase 2 in any concerted form, there's going to be a real conversation about who governs Gaza. Now, there's this temporary authority, of course, and that has yet to be fulfilled. This board of peace has yet to be named, from what I understand. But the idea of a two-state solution is not embraced by all the parties who signed off on this, is it?
No, and that's putting it mildly. I mean, the Israeli parliament condemned any attempt to go forward with this. They view it as rewarding Hamas for October 7th.
But we heard El-Sisi on a microphone in front of the president endorse that idea yesterday. How do we get around that?
I think that is what the region views as a solution to this. And historically, the U.S. has also viewed that as a solution. But, you know, historically also, the U.S. and Israel have been very fast, close allies. And so it is a difficult thing to bridge. And I think probably an attempt will be to bridge it with vague enough language, a vague enough timeline that you can appease regional actors and potentially the Palestinians with a process that moves it forward, but in Israel's view, probably doesn't move it forward enough, or moves it forward in a way where Israel can maybe pull the plug on it if they don't want it.
You've been covering this for years by way of your beat on diplomacy, on the State Department. You've traveled with multiple secretaries of state into the region. Is the narrative correct that Israel's neighbors want to do business, that there is an economic incentive to normalize trade ties with Israel, that there is in fact opportunity there, or is that being overblown here in the United States?
I think it's true in that there is an undercurrent of a lot of regional leaders wanting to do business with a dynamic economy, but there are these long-standing cultural issues that for them with their own population gets in the way of them signing those kind of deals.
Boy, we need to keep talking about this with the help of Ian Marlowe. I thank you, Ian, for the insights as always. I'm Joe Matthew in Washington. Thanks for spending some time with us on the Tuesday edition. I'll meet you back here 5 p.m. Eastern for the late edition of Balance of Power. We'll see if they get in front of the cameras with President Milei. This is Blue.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, across Bloomberg platforms. I'm Carol Masser here at Bloomberg headquarters in New York City. He is not Tim Stanovic. He is Matthew Miller, who has been all over the place today.
Yeah, a lot going on today. Is this on? This is on. Okay, this is on.
The light means
there's
on.
so much going on today. The amazing gyrations that we had, right?
Yeah.
On Friday, we were down 2.7%.
Right.
Yesterday, we were back up 1.5%. This morning, we were back down 1%. And now we're back up. It's just insane, this trade. And the market clearly just wants to rally.
Well, and I think one of the things is what's happening with U.S.-China trade negotiations. We've definitely seen that's what happened on Friday, right? And we've seen that play out already on Monday and Tuesday here. It's also the big banks reporting. JP Morgan, Goldman, Wells Fargo, Citi. Not all the stocks reacted the same. Investors like some, they didn't like the others.
That's right. JP Morgan and Goldman Sachs both down, even as the market turned higher. So I was talking with Sri this morning. We're going to talk to him in a little bit.
Yeah.
And he said, look, the macro picture really does affect these stocks. But I talked to an analyst over at Baird who said the problem with JP Morgan is it's a great company. The stock is too expensive. And that's maybe why it's trading down.
Even though it's down today, it's up 27% year to date. So there you have it, folks. Hey, we're going to talk about that. We're going to get into U.S.-China trade talks ongoing, some starts, some stops. We see that play out. A fascinating story by our Enda Curran. Global trade flows moving on to avoid the highest U.S. tariffs since 1930s. Matt, the world is moving on.
Well, I just wonder if the rare earths risk isn't underappreciated here. I mean, they seem to have us by the short hairs there.
Yeah.
Because
you're talking about China.
Yeah, China. Because we, don't even mine them. If we did mine them, we can't refine them. And I'm not sure we could get that off the ground beyond military capability. So they have cards. They have the cards.
Yeah, exactly. All right, lots to come. Also, Matt's big interview with Paul Tudor Jones. There's a lot coming. You don't want to go anywhere for the next 60 minutes. First up, though, let's get a check on the trade. Your top business stories. Here is Charlie Pellet. Welcome back.
Thank you very much. Great to be back. And we're looking at a lot of moving parts to this market, including earnings, including tariffs, and including Fed Chair Jay Powell. A volatile session for the U.S. stock market. As Matt alluded to, Fed Chair Powell reinforcing speculation that officials are on track to cut rates in October amid a weakening labor market. You heard his remarks live on Bloomberg television and radio. The S&P right now up 20. We're close to session highs, up by about 0.3%. The Dow up 425, gain there of 0.9. And we've got NASDAQ lower now by 0.2%. The 10-year at 4.02% now, with a 2-year 3.47%. Gold is up $41 the ounce at $41.51, up 1%. And West Texas Intermediate crude oil down 1.1%. WTI 58.83 a barrel, and Bitcoin down 2.5%, 112,950 now on Bitcoin. Traders are focused on the unofficial start of the earnings season. Among the names reporting this morning, JP Morgan Chase down now by 0.6%, Citigroup surging 4.8%, Wells Fargo up by 8.8%, Goldman down now by 0.3%. Tomorrow we will be hearing from Bank of America and Morgan Stanley. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As Matt and I said, a lot going on this Tuesday. We do want to remind everybody we are monitoring a live event that's happening right now in the White House in the Oval Office. President Trump is meeting with Argentinian President Javier Milei. We're going to continue to follow that. Of course, they've been having a meeting, a luncheon, a bilateral luncheon, if you will, and obviously some significant developments between these two nations.
Well, and look, they're in the cabinet room. We're in the cabinet room, unless they've added a giant desk to the Oval Office.
Oh, sorry. Okay.
And Scott Bessent talking there because he has pledged to do whatever is necessary to help backstop the Argentinian peso. And it helped for a couple of days, but it isn't helping again. They're just bleeding dollars, and they may not have much left at all. So it'll be interesting. I'm actually going to talk with Hans Humes a little bit later on this afternoon.
He knows this world so well.
Absolutely, and get his take. I'll report back to you.
Distressed, emerging debt, right? All that good stuff.
Especially Argentina.
Man, you are just on fire. All right, we're going to talk about Matt's interview with Paul Tudor Jones a little bit later on because it was a great listen. I was in the car and I listened to all of it. In the meantime, as we watch and monitor for any headlines out of the meeting in the cabinet, room. We do want to talk about that volatile session on Wall Street. Matt and I talked about it at the beginning, right? We've kind of been bouncing around since Friday, if you will. And we did see stocks pairing most of their earlier losses amid hopes of U.S. and China trade negotiations still being on the table. U.S. Trade Rep Jameson Greer telling CNBC that President Trump will is still set to meet his Chinese counterpart, President Xi Jinping. Greer also saying that he thinks we'll be able to work through it with China.
It'll be fine. The president tweeted on Sunday that it'll be fine.
Well, even so, the world is kind of moving on, and we're seeing the new contours of global commerce taking off amid these global tariffs. Let's see what Enda Curran has to say and what it means in terms of the global macro environment. He is Bloomberg News global economy reporter. He joins us from our Bloomberg News Washington, D.C. bureau. Enda, good to have you here. First off, we do see these Wall Street swings on what's coming out between U.S. and China. Why is this still, just remind everybody, why is this still the most important global economic relationship in the world? Or is it starting to kind of change a little bit?
Well, they are the two world's biggest economies. They are, of course, completely interlocked with each other. China is the world's biggest manufacturer, but of course, America is their biggest customer. It's the biggest consumer market in the world. So obviously the trade tensions between them do spill over to everybody kind of caught in the middle of that in terms of supply chains. And that's what we're kind of seeing some reaction or some response now to the rest of the world, that even if your starting point is that, yes, we'll always have to do business with America because the consumer is so powerful there, trading partners are kicking tires and hang on a sec, who else can I do business with? How else can I diversify my markets? China's looking around, say, buying more agricultural produce from South America, as we know, but also its exports are going gangbusters to parts of the world other than America. And then those other countries in the middle are saying, you know, who else can we start doing more trade deals with? They're accelerating trade negotiations. They're accelerating ways of doing business with each other, looking for new markets. So it's very early stages, but that U.S.-China trade war is starting to poke some change in the global trade.
You know, I mean, I think the question is, the question that J.D. Vance probably doesn't have an answer to, can China be cut off from U.S. trade longer than we can stay solvent? Because the rare earth minerals that they have, we cannot get in size from anywhere else. And we're not going to be able to process them here, to refine them here anytime soon. So, you know, Meredith Whitney, in a note on Sunday, said, aside from the massive dependence on the U.S. industrial complex for these rare earth metals and magnets, the U.S. military is 100% dependent on them and nearly depleted of its reserves. So, I mean, don't we need them more than they need us right now?
Yeah, I think we're all at a point now where we are fully aware that if there is a vulnerability in the hawkish trade stance that the U.S. is taking on China, it's on rare earth supplies. China is the one digging them out of the ground. China is the one that's taking on the refining risk there, the environmental risk, and the costs associated with it at a scale that no other country is doing, and that's why America and everybody else is so reliant on China and getting those minerals out here. And that's why China, of course, it's well aware of its leverage. It's floated those export controls that it did last week or the week before that, of course, have sent shockwaves, not just through the US, but the rest of the world too. And China's making it clear that it's in control of these. Now, this is a policy error, though. If you go back maybe 15 years ago, there was a discussion around rare earth supply at that time. There were other options on the table. It's not just China that has these minerals. Other countries could have put money into the ground and put the money into the resources and the facilities needed to extract these. There are some companies in the US that are talking about or trying to get off the ground at the moment in doing this. But the point is we're at a stage where China has a grip and a lock on the system to the point where everybody else is years behind. It will take a long time. And
well, it's not just getting them out of the ground. And I mean, I talked to industrial CEOs who do business globally and have told me, look, we've seen the refining process in China, and it is horrific. It is the kind of environmental risk that American voters just would not be willing to take. So no one else can refine them at these levels, at least with today's methods, without sacrificing like a portion of humanity. So we're not going to do that, are we?
Well, and that's entirely right. Environmental risk is a big part of the equation. But there are some companies, by the way, including some in the US, who are looking for cleaner ways to do this. So but obviously nothing like on the scale that China currently offers. But other countries as well are coming to the table. Pakistan, for example, is floating itself as a potential partner for these minerals for the US. They can be sourced from other countries too. That's why Argentina is in the mix at the moment when we talk about the support that the U.S. Treasury is offering Argentina. One of the reasons is because of the minerals that Argentina has. So, but yes, the point is that no one's doing it on the scale that China is right now, and until that changes, China has leverage over the rest of the global trading system.
Hey, I want to go into your story that looks at global trade flows, and you look at what shipping companies are seeing and some of the changes. But there's a quote in the story, an associate professor of economics at the University of California at Davis, Ina Simonoviska, and it says this individual saying it's very clear that we are redrawing the map of international trade. We're going to see a lot more bilateral trade agreements between countries and subgroups of countries. She predicts this. What does that mean for economic growth for individual countries and for the global economy overall? Do we know anything? Is it good? Is it bad?
Well, it's early stages, but we are seeing signs now that countries are looking at accelerating trade negotiations with each other and signing deals with each other. Now, the European Union is one example. They've finally gotten that deal signed with Indonesia. They are getting that big trade negotiation with South America, Mercosur, off the ground, trying to get that ratified. Other countries are also looking at doing business more with each other. New Zealand and Switzerland and the UAE are among a group who've gotten together in this kind of a loose trading agreement that they've pulled together over recent months. And the point of all of this is as I said at the start, it's nobody suggesting the US is not the world's biggest consumer market and that they don't want to do business here. That's not the point. But they're seeing the tariffs going up at the fastest pace since World War II. It's more complicated, more costly for some of the businesses who want to do trade with the US, and they're asking what else can they do to diversify and mix up their supply lines and their markets. And we're seeing it in Peruvian fruit farmers. They're looking for new and alternative markets. In Lesotho, they're looking for alternative textile markets, maybe in Europe and in Asia. So, you know, as I say, the tariff wall, when it's gone up on the US side, it's not about countries not wanting to do business here, but they are certainly kicking tires on where else they can diversify. And that's what these trade negotiations are getting a shot in the arm, as one of the professors quoting the article said to us.
All right, we're talking with Ann Curran, global economy reporter at Bloomberg News in our D.C. bureau. At the same time, we are monitoring the White House, the cabinet room. President Trump is there with President Milei of Argentina. They are having a bilateral lunch and obviously meeting. We're monitoring any headlines that come out of that meeting. In the meantime, you know, and you talk about in this story these bilateral relationships, or at least folks that you talk to are talking about a lot more bilateral trade agreements. Who wins, though? Big countries, small countries, middle-sized countries? Is there clear winners and losers on that metric?
Well, probably the biggest countries will be the ones who come out of this in better order, because, you know, the system up until now, whether one agrees with it or not, but the broad system up until a few years ago had been rules of the road set by the World Trade Organization. This is where countries big and small could come together and have their disagreement and argue out their case for whatever their grievance was in the trade world. But, you know, we've moved past that now. We're kind of moving to this bilateral sort of approach to doing trade deals. So when you have a big country, they're able to set the terms on the table, and the smaller country, of course, has to work around that. And that's where we are. It's not just the US, of course. China is the other big player in the global trading system. They, as we just spoke about, hold the cards in so many areas now when it comes to not just rare earths, but they're the world's, you know, factory. So they also will set terms, and countries are worried about China's volume of exports and trying to compete against China too, given the scale and competitiveness at which they can produce products versus other countries. So the big picture is better for bigger countries, tougher for smaller countries.
All right, Ann Curran, thank you so much on today's news and his story. Global economy reporter at Bloomberg News. You can read the entirety of it. It's on the Bloomberg and at Bloomberg.com. And talking about important relationships, U.S. and China, certainly. But right now, what is top of mind for President Trump at the White House in the cabinet room is a relationship with Argentina, and he's there with President Milei. Let's listen in.
How well we're doing. Go ahead. Well, first of all, we have now 8 or 9, 10 countries, Argentina being foremost among them, that have aligned with the United States on issue after issue in international community events all over the world. in fact, these great allies like Argentina, but I can go into others, Costa Rica, you know, I don't want to leave anybody out, El Salvador, you know, but I think one of the more promising developments is later this month, there'll be an election in Bolivia after 25, 30 years of anti-American hostile government. Both of the candidates running in that election, in the runoff election, want strong, better relations with the United States and another transformative opportunity there. But so I think this is important. This is our hemisphere. It's where we live. And having strong neighbors such as this.
And great progress has been made, really.
And we'll make more. Absolutely.
Over the last 9 months. Really over the last 9 months. Yeah, please.
Mr. President, from Argentina, Buenos Aires, do you imagine soon a free trade agreement with Argentina? Could it be possible soon?
Yeah, it will be. Well, we're going to discuss some of it today. But no, we want to help Argentina. And we want to always help ourselves. But we want to help Argentina. And one of the ways we can do, they have great product. And we used to do a lot of trade, and then if you look at what the Democrats, well, they didn't know. They didn't know. Honestly, they didn't know what they were doing. But a lot of that trade disappeared, and they have great product. So we'll be trading with Argentina, and it'll be helpful to them, and it's helpful. It's good for us also.
Mr. President, yeah, was China trying to draw a wedge between the U.S. and Argentina by buying soybeans from Argentina and not U.S. farmers?
I would say so.
And China on the port fees.
China
they've
likes to
increased
draw
port fees on
wedges.
U.S. ships, too.
Yeah, sure. I mean, I guess that's natural. It's China, and it's natural, but it's not gonna mean anything in the end.
Mr. President,
from Argentina, should Argentina end the China swap and close the space base in Neuquén?
I don't think you should be doing business much with. You can do some trade, but you certainly shouldn't be doing beyond that. Certainly shouldn't be doing anything having to do with the military with China. And if that's what's happening, I'd be very upset about that, yeah.
And what about
You
the swap?
understand this, guy, right?
Mr. President,
You do understand.
Mr. President, what about the swap? Because it's so important for Argentina, the swap.
Go ahead.
The central bank.
The American assistance is not predicated on the swap with China being closed. Any reporting to that effect is incorrect.
But you said that Argentina has to expose China from your business or from your agenda, and the swap is so important for Argentina.
No, I was referring more to ports, military bases, observation facilities that have been created in Argentina.
Than the swap? More than the swap?
More than the swap.
He was referring to that. Yeah, behind you, please.
Yes, President, for Argentina, what's the benefits for United States in helping this way Argentina?
Just helping a great philosophy take over a great country. Argentina is one of the most beautiful countries that I've ever seen. And we want to see it succeed. Very simple. I mean, we don't have to do it. It's not going to make a big difference for our country, but it will in terms of South America. If Argentina does well, you're going to have others following, and a lot of others are following. You have countries in South America that 2 years ago would have never even been thought of to go as democracies or as just countries that want to do fair and balanced trading. And now I mean, you mentioned Bolivia, but there are numerous other countries that are coming our way. And Brazil, as you know, I had a very good conversation with the president. I met him at the United Nations before I went up to speak, and then I found that I didn't have a speech because I had no teleprompter. They turned off my teleprompter purposely. They made it impossible for me. But it didn't silence me. I spoke without, and it was a good speech. I mean, it was a good speech. But no, think of that. You go into the United Nations, I'm speaking in front of 158 leaders and the whole world. And I look at my teleprompter, and it's dead. They killed my teleprompter. They wouldn't let the man that operated into the booth. Can you believe that?
You don't have any specific interest in economic terms for the state?
I do have. No, I want to see it succeed. I think it's going to be great, and we will benefit also. But it's not that big a benefit because it's not that big a country, but it's a very important country, and it's a country that can be very successful. There are some countries that will never be successful. This is a country that has great potential if it has the right leadership, and you have the right leadership with this man right here. Okay?
Mr. President, would you support dollarization?
I would say that I'll leave that up to my my economic people, but I like the dollar. I'm very strong on the dollar. And anybody who wants to deal in dollars, they have an advantage over people that aren't. But for the most part, we're keeping it that way. I think if Biden would have, Biden, that group would have gotten elected, meaning Kamala, you wouldn't have the dollar as your currency anymore. You wouldn't have a world domination by the dollar if I didn't win this election. And now the domination, like BRICS. I told anybody who wants to be in BRICS, that's fine, but we're going to put tariffs on your nation. Everybody dropped out. They're all dropping out of BRICS. BRICS was an attack on the dollar. And I said, you want to play that game, I'm going to put tariffs on all of your product coming into the U.S. They said, like I said, we're dropping out of BRICS. And BRICS is like, they don't even talk about it anymore. Scott, you want to add to that, please?
We're very happy with the current currency arrangement.
Mr. President, your ABC fake news.
First of all, congratulations.
I don't take questions from ABC fake news. After what you did with Stephanopoulos to the Vice President of the United States, I don't take questions from ABC fake news. Brian, go ahead.
Yes, sir. First of all, congratulations on achieving peace. You are indeed the peacemaker. On a lighter...
Did you ever think I was going to be called a peacemaker?
Actually, I did. I saw some of the actions you were doing.
Go ahead.
But on a lighter note, Alyssa Farah, she is one of the hosts on ABC's show The View. She said a while back, I'll quote, "If Trump gets the Israeli hostages out, I promise I will wear a MAGA hat for one day on this show and say thank you for doing it." Your response?
Well, did she put the hat on?
Well, she hasn't got the hat yet.
Who is it? Which one?
Alyssa Farah.
Oh, yeah. Well, she used to work for me. So she used to work here. I'll tell you about Alyssa. She worked here. She gave me the most beautiful letter when, the administration, the time came up, the election was rigged, I left. She gave me the most beautiful letter you've ever seen. I was a great president. What a great job. Some of the letters have been quoted. This is Alyssa, who I never thought was very outstanding. I figured she would not make it. And she didn't have a big role here either. And then we had January 6th, and she left after that or before that, but she gave me the most beautiful letters. And then even months after she left, and while we weren't here any longer, she sent another letter, glowing letter, beautiful letter. And then she got hired by The View, and they gave her a couple of bucks, and she changed her view very quickly. I never thought she'd make it. Never thought she had what it took in any way. You know what that means. But she's on The View. But it just shows what a fraud The View is, because this woman gave me letters and statements. She said I was the greatest president in her lifetime. Now, she's not that old, so I didn't consider it a great compliment, but I've had better.
Can we send her a hat?
Well, recently I've had the greatest president of them all. I like that much better.
Mr. President.
Does that include Washington and Lincoln? Yes, sir, it does. I said, I like that president. So I think she's a total, I think she's a joke.
Mr. President, on Gaza, how long will it take Hamas to disarm, and can you guarantee that is going to happen?
Well, they're going to disarm, and because they said they were going to disarm. And if they don't disarm, we will disarm them.
How will you do that?
I don't have to explain that to you. But if they don't disarm, we will disarm them. They know I'm not playing games. Okay? Now, we did something monumental. We got the hostages back. That was the first thing we had to do. Above all else, get the hostages back. Now, they misrepresented because we were told they had 26, 24 of dead hostages, if we can use those terms. And it seems as though they don't have that because we're talking about a much lesser number. But that's a very tough subject. I want them back. That's what they said. I want them back. Also, they said they were going to disarm. And initially speaking, they needed, they did take out a couple of gangs that were very bad, very, very bad gangs, and they did take them out, and they killed a number of gang members. And that didn't bother me much, to be honest with you. That's okay. We had a couple of very bad gangs. It's no different than other countries. Like Venezuela sent their gangs into us, and we took care of those gangs. We have Washington, D.C. is one of the safest cities in the country. It was one of the worst cities in the country if you go back just a little while ago, right? Now it's safe. You can walk to work. Isn't it nice? But we have told them we want to disarm, and they will disarm. And if they don't disarm, we will disarm them. And it'll happen quickly and perhaps violently. But they will disarm. Do you understand me?
Yes, you say
because
quickly.
you always, everyone says, oh, well, they won't disarm. They will disarm. And I spoke to Hamas, and I said, you're going to disarm, right? Yes, sir, we're going to disarm. That's what they told me. They will disarm, or we will disarm them. Got it? Okay.
What is the deadline you're going to put on that? You say quickly, sir. Sir, you said quickly, but what is the deadline you're going to put on that before you take
period
action?
of time, pretty quickly.
Mr.
A
President.
reasonable period of time.
Congratulations on the peace you achieved in the Middle East, first
Thank you
of all.
very much.
And my question is regarding Argentina. Does continue...
Are you from Argentina?
I'm from Argentina, yes.
I like the Argentina. I like them much better than ABC. Than ABC fake news.
Me too, sir.
Yes, go ahead.
Does continued U.S. support for Argentina depend on the results of the upcoming legislative elections and the ability of the government to pass long-lasting reforms through Congress?
Well, I think if they don't do that, we're not going to be around very long. Scott, can you handle that one, please?
We're confident that the president's party will and the coalition will do well in the election, and this aid is predicated on robust policies, and going back to the failed Peronist policies would cause a U.S. rethink.
Thank you very much.
It's a little bit, it's a great question. It's a little like New York. You know, you're reading in Argentina about New York. We have a problem. We have a communist who's 33 years old, doesn't know a damn thing. Practically, he's never worked a day in his life. And he sort of caught on, right? And I'm not going to send a lot of money to New York. I don't have to. You know, the money comes all through the White House. And if they're going to be sending us stupid policies, I mean, communist policies, which is proven for thousands of years doesn't work. You know, we don't have to prove it again. We're not going to ruin one of our great cities because we'll make that great. We will clean up the crime in about 30 days. It took 12 days to do Washington, D.C., so New York is bigger. And Chicago, we've already made a lot of progress despite fighting from the government, but Chicago's doing great. Memphis is doing really great. You know, we have great support there from the political leaders. They said, please come in and clean up crime. And we love it. We've in 1 week, Memphis is so good. It's so much better. We'll have it within a month. We'll have that into a safe city again. And all of these cities, we want to clean them up. We don't like that opposition. But if somebody's going to be a communist mayor of New York, it's a fluke if he gets in. There are a lot of failed people that he's running against. I mean, we have failed. You have inferior candidates or something, because it's impossible to think that New York City can have a communist mayor. He's a communist. He's not a socialist, by the way. There's a big difference. He's a communist. He's down and dirty. He's a communist. He hates police. He wants to get rid of all police. I mean, how can a policeman? He hates Jewish people, and yet he's got Jewish people supporting. He hates Jewish people. So it comes through the White House. The funding for New York and for every place comes through the White House. And I'm very generous, and I was always very generous with New York, even when you had opposition there, but I was always very generous. But I wouldn't be generous to a communist, a guy that's going to take the money and throw it out the window, because you're talking about hundreds of billions of dollars. And we're not going to let somebody get into office and squander the taxpayer money from this country. We're not going to let it happen. So it's a little bit like that with, if you take a look at Argentina, if the president doesn't win, I know the person that he'd be running against, I believe, probably. We probably have the person. The person is extremely far left and a philosophy that got Argentina into this problem in the first place. So we would not be generous with Argentina if that happened. If he loses, we are not going to be generous with Argentina.
You talk about Argentina and important in the Latin America. What is your plan for Venezuela? But is the terrorism, the narco-terrorism in the President Maduro? What is your plan about it?
Venezuela's done a couple of things very badly. Number one, we get drugs and all of that. But we get something in a way worse, because they're a big purveyor of drugs, but we have worse. What they do very well is they send their criminals into the United States, and they send Tren-de-Aragua, that you know very well. You're from Venezuela, I assume. And they send them in by the thousands, literally. And these are the worst of all. And they emptied their prisons into the United States. They empty their mental institutions into the United States. And because we had a president who's low IQ, he didn't realize what was going on. And the people that are high IQ that surround him, but they happen to be lunatics, radical left, they're highly intelligent, radical left lunatics, okay? So in a way, that's worse than having a guy like Biden. But they ran the show. You heard about the AutoPen. The person that really operated the AutoPen, but it was really the people that told the person that operated the AutoPen what to do. Those are the people that really were president, okay? So we're not going to stand for it in this country. And by the way, that AutoPen thing is under serious investigation. Just this, I don't think you care because you're from Argentina. You couldn't care less about that. But I just want to say, because I do the weave, you know, the weave, cover a lot of different subjects. But the people that are involved in that AutoPen scam, because he barely signed anything. I mean, this guy, I don't know how you can be president. He barely signed it. But the only thing we can find for sure is that he signed Hunter's pardon, his pardon. Hunter's pardon, I like that. That's a combination. So we're going to work very much with the president. We think he's going to win. He should win. And if he does win, we're going to be very helpful. And if he doesn't win, we're not going to waste our time because you have somebody whose philosophy has no chance of making Argentina great again.
What's your advice
Steve, go ahead, Steve.
What's your advice for
Just to check something, just to check something, you said Hamas assured you that they would disarm. Was that a direct conversation or through Mr. Witkoff? Or?
Through my people.
Okay.
At the highest level.
What's your advice?
And it was meant for him.
What's your advice for President Milei and Argentina as a political leader?
My advice is to hold strong to his principles because he's right, and he's proving that he was right. He's got one problem. He's got people that are giving him tremendously bad press, even though they know it's wrong. He's got to hold true to his principles because he's going to win. He's going to win. He's doing the right thing. Everybody knows he's doing the right thing, but you have a radical left sick culture that's a very dangerous group of people, and they're trying to make him look bad. I believe he's going to win out.
And we're doing the right with China in this house.
China?
The Chinese.
Well, you have to be careful with China. Look, we have everybody deals with China. They have to deal with us too. We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us. But we have a fair relationship with China, and I think it'll be fine. And if it's not, that's okay too. You have to do and go where the punches are thrown. You got to put up the blocks. We have a lot of punches being thrown, and we've been very successful. Look. We have the most success. I think we're the most successful we've ever been as a country. We have now close, I've been saying 17, we have, I think, close to or maybe even exceeding $18 trillion going to be invested in the United States. That's more money than ever invested in any country before. Even countries with much bigger populations like India or like China. Nobody's ever had $18 trillion invested in the country. We have, and that's because of November 5th election, because I won. Oh, if she won, you'd be negative. You'd have people getting out of the country. This country we would have been in a major depression. If she won, we would have been 1929. They'd like to see that anyway. That's why they keep the government laws. They have a shutdown based on nonsense. They want to give away 1.5, think of it, they want to give away $1.5 trillion to people that come into the country illegally. And as you know, the borders now are closed. But when they hear that they get the greatest health care package in the world and they have no money, but they're living okay in another country, they head up and they start forming caravans and they try and come into our country. But the big problem is they want to give health care to people that should not get health care. They want to give health care to illegal immigrants by the millions. Look at Gavin Newsom, what he's done. He's ruined California. He gives health care to anybody. And I guess they do it for votes. I actually think it's bad politics, but...
All right, you are listening to President Trump. He is live there at the White House in the cabinet room there, of course. with Argentinian President Milei. An array of topics coming up, but in terms of the relationship between the two countries, the president being asked if there was a free trade agreement possibly with Argentina. He says it's possible. He also, Matt, was asked about the U.S. swap that is underway between the two nations involving currencies, the two currencies of the two nations, not predicated on Argentina ending the China swap, which has been there to help up Argentinian reserves. So a little bit more on that relationship. Sounds like still some questions to come.
Yeah, he's talking about his relationship with President Xi, and I'll just point out that is what shifts these markets. So when he makes a statement that's very negative and aggressive about President Xi or China, then you get a sell-off the likes of which we saw on Friday, 2.7%, 182 points off the S&P. When he makes a statement that's more positive, like he did on Sunday, China's going to be fine. He just said again, I think the relationship with China will be fine. Then you have a market rally. Then you have investors coming in to buy the dip. Today we saw it turn around, as you know, because Jameson Greer on CNBC said that the two are still going to meet. So if he says anything about President Xi right now, that could turn the market.
Yeah.
I'll continue to monitor the headlines.
All right, sounds good. And we do have most names in the S&P 500 over 400 higher today, folks. Here's where the S&P is. It's up 18 points. So at its highs of this session, the Dow Jones Industrial Average, a gain of 392 points, up 0.8%. NASDAQ 100 still under a little bit of pressure, but it's had quite a run over the last few months, down just about 20 points. So call it pretty much unchanged on the day. One group that has done really well today as a whole, we're talking about big banks or banks overall. The KBW Bank Index, folks, up 2.3%. 22 of the 24 names are higher in today's session. We've had
two big ones lower. Two of the big ones are lower. Two of the biggest names on the entire index are lower.
Well, this is what's interesting because J.P. Morgan, Goldman, Wells, Citi all reporting. J.P. Morgan and Goldman selling off, right?
Yeah.
And those are the two names you're talking about. Yeah. And Wells and Citi, Matt, are rallying in a big way.
I mean, and you get headlines like J.P. Morgan beats expectations on every level. Goldman Sachs knocks the cover off the ball. Analysts can't believe how well they did. And yet the stocks sell off.
But remember, something like J.P. Morgan has had quite a run this year. So, you know, expectations and reality, perhaps. Let's see what our experts have to say. Bloomberg News Chief Wall Street correspondent Sri Natarajan's here in studio, along with Bloomberg Intelligence Senior Analyst for Global Investment Banks and Asset Managers, Allison Williams, as I said, both in studio. All right, guys, let's start with J.P. Morgan because I feel like that's the bank that we want to always hear from. Allison, let me start with you. What do we need to know about the numbers in J.P. Morgan's business? Because as Matt says, sometimes the headlines look darn good.
And the quarter was darn good. It's just that I think there are some bullish investors out there that wanted more. And if you did, you know, so on today, they're underperforming. But if you looked at year to date, if you look at their valuation, if you look at their year to returns, you look at their profitability, all very, very good, executing well. Think that, you know, maybe some people just wanted some more there. Goldman Sachs, also strong quarter. They did miss on equities trading. So, you know, these numbers are hard to predict. But I think, you know, most people, including myself, you know, if you had seen sort of that upside would give you sort of further confidence in the momentum going into the next quarter. But the M&A advisory business, huge outperformance there. We think they probably outperformed most people in the quarter. They're the lead in that revenue. They announced this AI program. There's details. You know, we're going to have to wait till January for details, but that signals that efficiency is going to get better. You know, contrast, you know, two companies that are really performing very well to two companies that are, I think, have a lot of runway ahead of them, and that's Wells Fargo and Citigroup.
Can I just ask, before we get to Sri, because I've already asked him like 10 times today, why do the analysts consistently underestimate what these banks are doing? And it can't just be to get on the good side of management, right? When I see this morning, before any earnings came out, I saw stories about which bank was going to beat estimates. So when I see bank expected to top estimates, I wonder why analysts don't add more to the estimates. What is this game all about?
Well, first of all, trading, and when it's capital markets revenue, that really is the source of the upside. That is very tough. And banks are not going to guide you, right? You know, they don't really have an incentive to guide you because, by the way, like the last couple of days of the quarter could be horrible, or you don't know what's going to happen. And so I think banks are going to tend to guide conservatively. Analysts are going to tend to be conservative, right? Because that And by the way, like that just is not something that people bake into the run rate. So as I said, we're positive about the momentum in trading, the asset levels, et cetera. But I think if you're, forming estimates, you are going to tend to be conservative. And that's why you can get upside, especially if the strength comes at the end of the quarter. It's just hard for the estimates to catch up.
Yeah, totally get it. All right, so we care about JP Morgan's results. We also obsess over everything that Jamie Dimon has to say. He never disappoints with something that is highly quotable. In this case, it was when he was talking about a cockroach. Check it out.
Like, you should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay in other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
All right, that, of course, was Jamie Dimon earlier today on JPM's earnings call. Should we come on in on this? Because you're reporting on the quarter and, most importantly, what Jamie Dimon has to say about the macro.
So, Jamie Dimon has been running the biggest U.S. bank, which has a bigger market cap today than its three closest rivals combined. He's been doing that for nearly 20 years, and he didn't get there and he didn't stay there just on the back of sitting on his laurels, right? He is paid to look around the corners, and he is right to point out that the underlying numbers might be great. They might be marching toward another record revenue year, but when you see some of these problems, you initially try and dismiss some of them as idiosyncratic, but if enough of them start popping up, that becomes a concern. So that's why when Dimon says my antenna goes up when things like that happen, we pay attention, especially because in the last few days, we've been seeing some action in certain corners of the credit market where it does appear that there is some fear seeping into the markets. Dimon specifically flicked at the publicly traded BDCs that hold a lot of these private credit investments. And if you look at the discount to the net asset value that they're going at, it makes you worry about what's happening with some of the other non-traded vehicles. Will there be mass redemptions, and will there be domino effects off of that? And Dimon also points out that he feels like they're feeling very good about everything there. If you look at their numbers, you will not see any cause for stress, dismay, concern. But Dimon is right in saying eventually the cycle turns. And when it does, he thinks that, I suspect, when there's a downturn, his words, you will see higher than normal downturn type of credit losses in certain categories. And that's an important one to keep in mind, because what he's saying is your recovery rates might not be as great as you imagine, and that will impact the firms, and that'll impact the investors in those firms.
I want to ask about Wells Fargo. I'm so thankful that Bloomberg Radio has such a great program. In the mornings, Nathan Hager and Karen Moscow were talking to you, Allison, before I even got to work yet, and I get here pretty early. And you were saying this is really going to be the news of the day. And it has been the outperformer of the day because...
Can I just say, finally?
Well, because...
It's been long in coming.
So what's the story with Wells Fargo? They raised their return on tangible equity.
Yep. So the key metric for banks, return on tangible common equity, valuations, price to book is how a lot of investors value these banks. It's based on the return on capital. And, Charlie Scharf had said years ago, we're going to put 15% out there as a target. We'll revisit it at some point. They're running at 15% year to date. They upped that target to 17 to 18%. The asset cap is lifted. They showed a lot of progress that they've made, but they also showed some opportunity. And here's what I think is interesting. So one of the biggest areas of opportunity is the consumer unit. When we had Lori Beer from JP Morgan, the CIO of JP Morgan, talk about where she sees big opportunity. She actually talked about this at JP Morgan's Investor Day. Also, the consumer unit. Also, like a lot of what she talked about in terms of how technology was going to aid the bank was productivity in the consumer unit. So we're hearing that from Wells Fargo. So that really gives me confidence that this is a number that they can shoot to. Citigroup, by the way, I think you know, they're also kind of showing the path, right? So Citigroup talking about the fact that they are sort of 2/3 the way there with their transformation. And you know, we have Banamex coming, you know, it's pushed out a little bit, but I think showing you the path that, you know, could that be Citigroup? Again, talk about an even longer time, but could Jane Fraser finally be the one to get it done?
And I will point out, like with Wells Fargo now up, 8.2% for the day. It's their best day since election night, since Trump came back to power. This could be Wells Fargo's best day since then. So that is the power of putting a target out there. And I point that out again only because in a couple of weeks, you will have Bank of America with their investor day, their first investor day in 15 years. It has also been the worst performing big bank stock this year, up only, 14%, 14 and change. It is important for Bank of America to approach that investor day with a mindset of providing targets, aspirational targets for the market, instead of wanting to go out there with trying to explain to investors and analysts what it is that they do. Because I think investors will tell you they have a good understanding. What they want is better targets, and what they want is them achieving those targets. Otherwise, the stock will continue to languish.
All right, I do want to mention a headline crossing. We are continuing to monitor President Trump there at the White House. He is talking also about Russia and President Putin, saying President Putin does not want to end the war, and then going on to say that the Russian economy is going to collapse. So that is certainly another one of the big geopolitical events and actions that we've been keeping, and something that the president has been trying to bring an end to, and talked about that on the campaign trail. But again, President Putin doesn't want to end the war. That is the view from President Trump at the White House. I know you had one last question you wanted to
I wanted to ask Allison about the best way to value these companies. I was talking with Sri about this on Bloomberg TV earlier, and David George from Baird also was saying, like, look, JP Morgan can be a fantastic company, and it is. But the stock is just too expensive, which is why he doesn't have a buy rating on those shares. And then Sri and I were looking through the price to book. What is the best way? How do the best bank investors look at valuations that makes the most sense for banks? Because I think it's a little different than other equities.
It is different because, so if you think about banks, right, versus other kinds of companies, they use their balance sheet to generate profits. And so that's why return on tangible common equity is a key metric, right? Because the more profitability that you can generate using your balance sheet, the more you're willing to pay. So that's a little bit different than PE. You will notice that price to book is really favored in downturns. It's a place where people look for, you know, in terms of, you know, 1x price to book is sort of if you liquidate the bank, what can I get for this, versus the ongoing returns. And that's why you have companies like Citigroup trading below tangible book or below book, which obviously they've made a lot of progress since then, but for a long time,
I remember Deutsche Bank was trading at like 20% book value.
Right. Well, and the European banks, right? Because they're not earning their cost of capital, so basically you're eroding value over time. So that's sort of the opposite. And so I think, you know, those are kind of like two different ways to think about it. By the way, JP Morgan management also talking about they're not liking to buy shares back at this level.
I heard that.
You know, they're pretty daring that they're willing to call that out. But from an equity investor standpoint, that's not really helpful either.
Hey, 20 Sri. What do we have? B of A and Morgan Stanley tomorrow. Just quickly, what you're watching out for?
We're B of A, Morgan Stanley tomorrow. Again, we have analyst expectations set out there, so we're hoping they'll go and beat them. But which brings us back full circle to Matt's original point. Like, I don't know what he wants analysts to do. Should they apply a humility premium to when executives guide you in a certain direction?
If I were estimating someone's earnings, I would try and get it right. And if I was lowballing it for the last 9 out of 10 quarters, I would just add 20% or something.
You're doing it based on how the executives are guiding you. What do you want? A gut check premium?
Hey, kids, take this outside, okay? All right, we're going to continue this conversation. We will here at Bloomberg as we continue the bank earnings throughout the rest of this week. Right now, let's get a check on the trading session. Here is Charlie Pellet.
Thank you very much. Bank of America, which does report tomorrow, up 2.8%. Morgan Stanley, also tomorrow, up now by just about 0.7%. U.S. stocks, we're trading mixed. We have got the Dow, the S&P, they're both higher. NASDAQ in the red. S&P up 16, up by about 0.2%. The Dow now up 0.8%. after earlier losses. NASDAQ, though, in the red. NASDAQ Composite Index down 48, drop there of 0.2%. Your 10-year, 4.02% with the 2-year, 3.47%. Spot gold up 1%, 41.49 the ounce. West Texas Intermediate crude oil down 1.1%, 58.83 a barrel on WTI, and Bitcoin now at 113,085, trading lower by 2.4%. So again, recapping here, S&P 500 index holding on to a gain of 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, Wall Street has spent years preparing for $105 trillion to pass from elderly parents to their kids, but a different kind of wealth transfer is already underway. We talked about this a little bit yesterday, Matt. More than a dozen women in the world's 500 richest people have become billionaires after the death of a spouse. So watch it, guys. No, I'm just kidding. It's the highest number ever.
That makes sense because men naturally die at an earlier age than women.
I didn't mean anything sketchy there.
If you marry a woman who is your age, which I guess is not so normal among the ultra wealthy, you're likely to die before her.
Yeah, it's just logical. And people have reported on this, so it's nothing crazy like, a bad murder series or something.
Did you see what Stephen Colbert said?
What did he say?
He said if his wife dies, he's going like within a month because he can't imagine life without her. I think that's probably also something that happens
my husband
quite
would
often.
do the same thing. But let's talk about it because there is this incredible wealth transfer and also wealth concentration when it comes to women. So let's get into it. In this week's Women, Money, and Power, we're exploring how this shift is creating huge implications for how vast sums of money are invested, philanthropy, and the way that wealth is passed on to the next generation. Back with us is Jamie Majira. She is head of U.S. Wealth Advisory and head of retirement at BlackRock. It's the world's largest asset manager. They notched a record $13.5 trillion in assets. It's up from $1 million when we last talked in June, and we got the figure when BlackRock reported. I don't know that I said your name correctly.
Majera.
Majera.
You did,
Okay.
It was great.
It's been
Just
a
like
crazy
it's spelled.
Tuesday.
Just like it's
Majera.
Just
I
like
know.
it.
Well, I really like Jamie, so I want to get it right. Great to talk with you. How are you?
Great. It's really good to be back with you.
Well, we are talking about the environment generally, so let's start there. I know we did that over the summer when we talked, because BlackRock just sees so much in terms of the funds it oversees and the flows continue to grow, but that doesn't mean the flows are always going in the same places. What can you give us insight in terms of where money is going and where money is going out of?
Yeah, so first of all, excellent to be here. And you started by talking about flows. I'm going to take a gender perspective on flows. And talk to you a little bit about where we see money going globally with women. And so women more and more are earning wealth, they're acquiring wealth, they're owning wealth, they're playing a larger role in capital markets. They are investing and benefiting from these capital markets, and we think there's no better sign of hope in the future than having people invest and grow along the capital markets.
Is it because they're earning in it themselves and they're having some say, or is it also in terms of couples, because they are often breadwinners as well, that they also have a say at the table?
Yeah, so it's both, right? So when you think about women, women are more often now becoming breadwinners, primary breadwinners, quite often. They're also contributing to household along with their spouses. They're earning more money, but they're also acquiring, and you mentioned the wealth transfer.
Yeah.
We think about that in two ways. There's the intergenerational wealth transfer, where they're gaining assets maybe from their parents as they pass away. But the more interesting one is this horizontal transfer, right? So if a spouse passes away, or if there's a divorce, women are acquiring assets in that